prop books in India. So he knows a thing or two about trading. Sandeep, go on. Your question.
One very specific thing on oil only. See, yes, we are all concerned about the narrative or noise which is getting built, and it is quite concerning. But if you really look at the data, okay, when I'm talking about the employed volatility data of crude, it spiked up to 180, it's corrected to half, 90, which means smart people are not factoring this level of pessimism, what we are seeing around us. At least if that was the case, then vol could have been remain elevated for longer term perspective, which is not the case. In the last 7-8 days, it has become half. So that gives us confidence that smart people are not factoring this level of disruption, what people are looking at. And we always see that we all get carried away at that point, and we gave up actually, So we are in that sort of capitulative sort of scenario, which is all our bullish thought process has been given up completely. So the Walls data does not show. Just want to understand your perspective.
Yeah, so I slightly take a point from your question, which is people are not that bearish, actually. So that worries me a bit. So we have this shock is ongoing. And from our perspective at BlackRock, what is priced in the energy market has not really been fully priced yet in other markets. So we've had this uptick in the oil price, most obviously the spot price, but now the price for oil a little bit further out towards the end of the year is now much higher, suggesting the market is somewhat more worried that this situation will persist for some period of time. That should feed through into Rima's question for higher inflation, and this should give central banks a problem, meaning they can't cut, maybe they have to hike. Higher yields, and then in turn, higher yields should be a headwind for global equities. So this is a little bit unsettling. Again, I don't want to sound too bearish. Of course, it also presents opportunities, to your points, I think. And will there be certain areas where the baby is thrown out with the bathwater? For sure. And actually, this is the moment over the next, say, 3 months when we can pick the longs that will make our portfolio returns for the next 5 years. So we're very open to this opportunity, but for now, I still a little bit worry that what's priced in the energy market is not yet fully priced in global bond markets and global equity markets. I still think that's got further to run over the next several weeks.
And there's also this thing that oil is a physical, the basic thing, oil is a physical asset, which is so demand and supply, whereas things like equities live in the future in that sense, right? So there is that element of pricing or mispricing, whatever you want to call it, right?
And on the physical point, just quickly, Prashant, like there is a risk of people who can't get it. So you can buy and sell equities. Maybe you don't like the price, but you can.
If you don't have it, you don't have it.
There's a risk not just of a higher price, but we're seeing talk in certain parts of Asia of shortages, which is also an acute problem building on top of the chronic that we're talking to.
Please, another question.
Right. Hi, good evening. We've heard the saying that, data is the new oil. And as I reflect on that, I'm smirking because it seems that oil is oil and data needs the oil today. Right?
Well put.
So just wanted to ask you, either of the panelists, what's your take on the AI trade in the US? Does that slow down the entire juggernaut? Will the GCC countries withhold their investments that's going into the AI trade and any other second order effects?
Excellent question.
Thank you.
Ben, you want to take it?
I do. So it's been, again, slightly overwhelmed by, of course, the Iran situation. But the AI news flow over the last 4 to 6 weeks has been amazing. Incredibly positive in terms of the demand. No sign of a slowdown in demand. No sign of a slowdown in the CapEx. So people worry, is it a bubble? Will the CapEx slow down? There's no evidence of that so far. So I think the AI hyper mega super bull market is still real and ongoing, but will it suffer as a very crowded position in a general risk? I just sell everything, I don't even care what it is because I just want to hide in money. I think that's quite possible. So again, when I'm thinking about my laundry list of things I want to buy, maybe I'm not quite brave enough today, but I want to be brave at some stage in Korea with the memory play that they have. For energy, as you say, of course, is very thirsty for electricity and we don't have enough. So I'm not so heroic. I want to wait for some more clarity. But the AI trade, for your question, I think is still very, very alive. And the data over the last 4-6 weeks actually has been supportive of that. But again, it's been just completely overwhelmed, understandably, by the pictures and the reality of the Iranian situation. So I'm still very positive on AI, but I'm a pragmatist. Can it go down in this general risk-off? Of course it can.
I think wonderful question, and I think fantastic response there as well. We could go on, and such a fascinating topic. It's and so many directions we can take to it. But We're out of time. Ben, I want to thank you for dropping by. A wonderful conversation as always. Great insights. Art, we'll, of course, keep tracking this with you in terms of where oil goes from here. And I think you've got a close eye as anyone has. Thank you very much for taking out the time and joining us.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. These days when we talk money, investors have realized that talking about money only purely from an Indian equity market context is many a times not enough. In the last 15 odd months, the Indian market has underperformed global markets big time. And in this entire duration, the US market, for instance, has continued to be fairly Teflon coated. The market has weathered so many storms, whether it is the AI disruption, whether it is, of course, what's happening geopolitically, and now even the war in West Asia, the US market has remained relatively insulated. But this is not a conversation just about the US market. This is a conversation about Indian investors waking up to the need of diversifying their equity bets, the need to perhaps spread your equity investments in markets beyond India, going beyond Indian shores. Now, the problem when we talk about this is not too many Indian mutual funds are right now giving the option of investing in global stocks in a simple way. Why is that happening? What should investors do? And are there new options coming up via the Gift City? That is what we'll talk about on this show today. My guests are Aditya Agrawal of Wealthy.in and Nirmal Bari of PPFAS Mutual Fund. Now, I must say that PPFAS is one of the funds that has started offering some of these new concepts and these new options to investors via Gift City. So this promises to be a really, really interesting conversation. Thank you so much for joining us on the show, gentlemen. Welcome to both of you on the show.
Thanks, Surabhi. Pleasure to be here.
So, okay, I want to take a couple of steps back before we get started. And I think they say that the market is usually the best teacher. And Aditya, opening thoughts with you, because the market has taught the lesson of patience to Indian investors in the last 2 years. So why diversify?
Yeah.
And where to diversify? Let's start right there with the basics.
Right. I think we all often say, right, don't put all your eggs in one basket. I think that is something that we all understand even as kids. And if you even look at the theory of wealth creation, I think asset allocation is one word that we talk about a lot. And we ideally want assets that are uncorrelated. And we saw, for example, first what happened with gold and silver, and then we've been seeing for last 2
US President Donald Trump says that the US will hold off on targeting Iranian energy sites for another 10 days as talks are ongoing with Tehran. The pause on strikes had been set to expire today. Meanwhile, reports suggest that Iran hasn't requested a pause on energy site strikes and is yet to deliver a final response to the 15-point plan to end the war. Stock slump on Wall Street on fading hopes for Iran peace talks. The Nasdaq is in correction territory after Donald Trump said that the US was unsure of whether it would be able to or was willing to make a peace deal with Iran. Asian markets have opened lower, tracking the losses on Wall Street. The GIFT Nifty is also indicating a gap down start for our own markets. Oil prices edge lower in Asia after jumping over $108 a barrel overnight. Oil prices are set for weekly losses on West Asia de-escalation hopes. A big relief regarding the Strait of Hormuz. Iran has allowed ships from 6 countries, including India, Russia and China, to pass safely through the region. The Indian government eases oil and gas fears, says that the country has 60 days of oil supply. Good morning, you're watching Power Breakfast right here on CNBC TV 18 on this final day of what has been a truncated week. I'm Hormuz Fatakia. Let's first take a look at how the Asian markets have started off this morning and carrying on from where Wall Street left overnight. Asian markets are also trading lower in today's session. Of course, the Dow futures are higher, but that is more out of caution and out of the selling pressure that was seen overnight. The Taiwanese index down over 1.25% now. The Hang Seng is trading just below the flat line, but losses in the Asia Pacific are coming from the Kospi in South Korea, which is down close to 3% this morning. The Nikkei in Japan also trading lower by 1%, and the Shanghai Composite 2 trading 0.3% lower. So all across the screen, you are seeing some declines for the Asian markets. Of course, we had a holiday yesterday, but the Asian markets continued to function. And the GIFT Nifty, they'll give you an idea of how our own markets are likely to start off. Well, if you want to take some positive from this, is the fact that the early ticks were suggesting a 250-point gap down. It has now trimmed that down to 150 points. So we'll keep an eye out on how our own markets will start. Of course, we are up almost 800 points from the lows of Monday. So we'll keep an eye out on how the day turns out. But to the big story then, the war in West Asia continues to escalate, with US President Donald Trump saying that on the request made by the Iranian government, he is pausing the strikes on Iranian energy infrastructure for another 10 days. Dan Murphy is here with all the latest updates. Dan.
President Trump has extended that deadline for Iran to reach a deal for the second time. As you mentioned in that post on Truth Social, President Trump said he is pausing the threat to strike Iranian energy sites for 10 more days, pushing the new deadline to April 6. He says these talks are ongoing. But the Wall Street Journal is reporting today that mediators involved in these talks say Iran never actually requested that reprieve. And Tehran is sticking to its guns here, saying it's still weighing whether to engage at all. And then, of course, on the diplomatic substance as well, overnight we heard that Special Envoy Steve Witkoff confirmed in a cabinet meeting that the 15-point proposal was delivered to Iran via Pakistan. He described the response as strong and positive, but Iran's position remains pretty much unchanged here. Tehran says it's still waiting for a US response after rejecting that plan and presenting its own conditions as well, including war reparations, security guarantees, and most critically for traders, control over the Strait of Hormuz. Now, the good news is there does appear to be some movement on the water. President Trump saying Iran allowed 10 vessels through the strait as a goodwill gesture. That comes after Israel also said it killed the naval chief of the Islamic Revolutionary Guard Corps, Ali Reza Tangshiri, who said that this was a major development, and this was because he reportedly oversaw the blocking of the strait. The Treasury Secretary, Scott Bessent, also out overnight announcing a US insurance program designed to encourage more shipping through the waterway as well. That's going to launch shortly. The details on that, and of course whether it works, is another key question. Essentially what we're seeing this morning as well is the president coming forward, extending this deadline, seeking to buy more time for the US military buildup to continue as well. Additional troops are already arriving in the region, and the Wall Street Journal also reports today that that figure could be up to 10,000 additional Marines. President Trump repeating his 4 to 6 week timeline for military operations. He said the war effort is ahead of schedule, but the sense is, and the message from Washington is pretty clear here, this is an olive branch in one hand and a loaded weapon in play at the same time as well. The president clearly keeping options open here for what could be a possible ground operation inside Iran or inside Karg Island if these talks go south. The most important thing to underscore this morning is that we still don't know exactly who the Americans are talking to. And if that isn't clear enough, with regards to just how uncertain things stand at the moment, then nothing else is. It's still unknown why the president can't say who exactly he is negotiating with on the other side. So any suggestion that these talks are actually going well is a false narrative at this point, because there's no transparency about exactly who the White House is dealing with.
Dan Murphy, thank you for that update there. Of course, that remains the big question. But listen to Donald Trump, who said that Iran made a grand gesture by allowing oil tankers to pass through the Strait of Hormuz.
You know, I told you about a present, right? Steve, can I reveal the present?
You can do anything you want.
Thank you. They said to show you the fact that we're real and solid and we're there. We're going to let you have 8 boats of oil, 8 boats, 8 big boats of oil. This was 2 days ago. And they'll sail up tomorrow. That was 3 days ago. And I didn't think much about it. And then I watched the news and they said, something's unusual happening. There are 8 boats that are going right up the middle of the Hormuz Strait. 8 big tankers are going loaded up with oil right through. And I said, well, I guess they were right, and they were real. And I think they were Pakistani flagged. Yes. And I said, well, I guess we're dealing with the right people.
And now let's listen into Donald Trump on whether the US could take control of Iran's oil, drawing parallels with Venezuela.
It's an option. I mean, I wouldn't talk about it, but it's an option. In Venezuela, we've done very well working with Venezuela, certainly. And we've taken in billions and billions of dollars. And by the way, Venezuela is doing better right now than they've ever done in the history of their country. And it's sort of like a joint venture.
And based on all of this, oil prices still continue to remain at elevated levels, though they have eased ever so slightly. Let's get the latest from the commodity space with Manisha Gupta. Manisha, good morning. Back at close to 110 is Brent, but some easing this morning.
Well, yes, holding around that 106 mark, but you know, we are headed for a weekly decline, and that's an important one to watch out for. For the week, the crude prices are down by nearly 4%. Remember, we've seen a high of 115 as well into this week itself. The U.S. extending deadline for Iran to secure deal. Iran has allowed 10 tankers to pass through Strait of Hormuz are some of the factors that seem to be keeping the prices in check. While, of course, Iran has rejected the 15-point plan to end war. So what negotiations, at what level, who's doing them is something that the market is trying to read into. Having said that, even as we're looking at Iran, Israel and U.S. conflict, on the other side, you have Ukraine saying that they are using long-range strikes on energy infrastructure to maintain pressure on Russia. Well, this comes in on a time when we are already facing a lot of crude crunch, and this could be supporting prices as well. What we have seen in metals, though, is a bit of a profit-taking. So gold is seen 3% of a decline in the overnight market. Silver fell 3% as well. You have copper prices, which declined a percentage point. The strength in U.S. dollar and the U.S. Treasury yields at an 8-month high seems to be putting pressure across sector here.
Manisha, thank you for that update there. But energy market and the geopolitical experts remain wary of the truce talks and caution that the war may not be winding down. Now, they say that it is possible that Trump may be trying to buy time before the U.S. troops arrive in Iran. Listen in.
We have to observe on the ground, I live in Abu Dhabi, The drone strikes have continued, the missiles have continued, and the Marines, the US Marines, I believe, arrive later this week. So I think the situation is frankly still very tense. The facts on the ground are mostly unchanged. Indeed, it feels more of an escalation in the last week than a de-escalation. President Trump is sophisticated. So is it possible he's buying time for the Marines to arrive? I think that's at least possible. Of course, we don't know.
That's all that we have on this update from the global markets, but we'll set you up for today's trading session for our own markets on the other side of this short break, and also get you cues from Wall Street. Stay tuned. Welcome back. On to action from Wall Street. Then stocks ended lower despite Donald Trump's announcement of a pause on strikes on Iran's energy infrastructure. Of course, that announcement came in after market closing hours, but the futures today are trading with some bit of cautious optimism. But CNBC's Angelica Pebbles gets us a wrap of all the action on Wall Street before the announcement was made.
U.S. markets were down sharply across the major indexes in Thursday trading as oil prices rise again amid a lack of progress over ending the war in Iran. The Dow fell 469 points, the S&P 500 was down 115, and the tech-heavy Nasdaq lost 522 in a more than 2% drop. Wall Street is paying out record bonuses this year, just shy of an average of $250,000. That's according to estimates from New York State's comptroller. It was a 6% increase from a year ago, below the city's projection for its 2026 budget that assumed a 15% increase. Wall Street has a big impact on New York City's economy and is a major source of tax revenue for both the city and the state as a whole. United Airlines and its flight attendants union reached a tentative new labor deal Thursday, giving flight attendants their first raise since the pandemic. United is the last of the major U.S. airlines to reach such a deal. The union didn't give specifics on the new contract, only saying that it includes increased base pay, added compensation for flight disruptions, and new restrictions on overnight flight assignments. That's what's happening here in the U.S. Back to you in Mumbai.
Angelica Pebbles, thank you for that update from Wall Street, and set you up now for today's trading session. Our research team is here with the trade setup, the F&O cues and the stocks that should be on your radar. But let's first summarize the market cues that you need to watch out for and what are the F&O data indicating. Sudarshan is here with that summarization. Sudarshan, good morning. Well, we are up, 800 points odd from Monday's lows, but what's the F&O data indicating today?
So for us, it was good last two trading sessions. But as far as global cues are concerned, US market was lower yesterday, higher on Wednesday, and today again US futures are higher. So net almost no change in the last two trading sessions as far as US market is concerned, and that will be reacting because we'll be reacting today of 2 days of global cues. Now, first talking about the few indicators for our market. So first, India Volatility Index. While market was high, but there was hardly any change in volatility index, India VIX remains around the level of 24.50. So till the time it remains above 22 or say 20, it will remain an overhang as far as our market is concerned. Second indicator is Rupee. It continues to remain around the level of 93.97 to 98. On Wednesday also, we had closed at the record low level of 93.97. So we'll have to see if there is any further uptick or downtick in the rupee. That will be tracked very closely. And last one indicator is the crude. Again, we have seen a sharp uptick in the crude. Today in the morning, there is a bit like lower move from the level of 108, but still hovering around 105 to $106 per barrel. Now, on Wednesday, we saw big action on the both side, but majorly action was seen on the put side. That's the reason Nifty PCR, that is the put-call ratio, remains of the level of 1.10. On Wednesday, we saw it hitting 1.20 versus earlier day's level of 1.07. Now, we talked about global cues. Yesterday, we saw big action in all the tech names, and because of that, Nasdaq was sharply lower, down more than 2%, and similar move was seen both in Dow Jones and S&P. Even Asian markets tracking those global cues are largely in the red. You can see Taiwan index down more than 1%, Hang Seng also almost flat, but with a negative bias. Now, coming to the options data for our market, Nifty options data on the put side, 23,300 was the most active put option, with the addition of almost 23 lakh shares in the open interest, and 23,000 and 22,500 also were among the most active ones. On the call side, 23,400 and 23,300 were the most active ones. So support I'll see around Tuesday's closing level of 22,900, and resistance will be 23,450. In the index futures, we have seen FIs buying, but in the stock there was a minor selling, and they've added long position, and there was sharp reduction on the short side. That's the reason there was a short covering. One stock is in the ban, sale, and Saman Capital is out of the ban.
Sudarshan, thank you for that exhaustive summarization there of everything that you need to watch out for going into today's session. But of course, there are some stocks as well that you should be keeping on your radar. Upasana is here with that list. Upasana, good morning.
Good morning. First up, let me start with Infosys. It makes two strategic acquisitions. First one is the Optimum Achieve Holdings in the healthcare space, and the second one is Stratus Global LLC in the insurance space. Next up is LTTS. It announces a strategic divestment of SWC business, that is Smart World and Communication business, for 452 crore. RBL Bank also in focus as Emirates NBD gets nod from Central Bank of UAE for the acquisition of stake in the bank, but the RBI nod is awaited, is something we'll be watching out for. Bharat Dynamics also in focus, and as in the view of the current situation, the company has established 2 additional manufacturing facilities in Telangana and UP. The additional orders that the company foresees with this is nearly about 15,000 crores in FY26 and FY27. And additionally, company has also successfully completed its first off-production model for advanced Akash weapon system. Fino Payment Bank also in focus. An important update here, the CEO Rishi Gupta gets bail, but the bank withdraws resolution for 3-year extension with effect from May 2026. Aurobindo Pharma also in focus as Curatech Biologies. The company's arm signs marketing and distribution deals. Sula Vineyards also in focus as the company acquires Shandon's wine estate in Nashik to expand its wine tourism footprint. NHPC, the board approves 8,000 crore debt raising plan for FY27. HFCL also in focus as it invests 580 crore to set up manufacturing facility, and the board has also approved consolidation of defense, aeronautics, and even aerostructure business. So all in all these stocks will be on our focus today.
Upasana, thank you for that update there. Take a short break, get you all the latest from the world of AI on the other side. Stay tuned. Welcome back. Getting you the latest updates now from the world of tech in our new offering, the AI Pulse. Rachna is here with all of the latest. Rachna.
Well, today in the world of artificial intelligence, it's about courts, infrastructure as always, and some sports. But we start with what's happening in the United States. Anthropic has secured a landmark win. A federal judge has blocked the Pentagon from labeling the company a national security risk. This is after the company had earned that tag when it refused to enter a deal with the Pentagon. Now, this ruling is important because it raises important questions about how far governments can go in regulating artificial intelligence companies. Then there is OpenAI, who's moving quickly to build a new revenue stream. Its advertising business has crossed $100 million in annual run rate in just under 2 months. That signals monetization is becoming the next big thing, especially for OpenAI, which is looking at an IPO by the end of this year. But it also appears to be tightening its strategy every week. And today it has shelved experimental consumer features, which were focused on erotic features, and now is more moving towards enterprise and core AI development. This race is also driving massive spending, because there's Meta, who's scaling up its AI infrastructure push, taking a single data center investment to $10 billion, even as investors remain cautious about returns and even as we hear the reports of them laying off their employees. Now, the company is also under legal pressure. It has lost 2 major child safety cases in quick succession, with thousands of similar lawsuits still pending. And in India, the competition is now visible on the biggest stage, from Google's large push into the IPL to OpenAI's entry into WPL. AI companies are now reshaping sports sponsorships, but the focus here is on the Google Gemini's deal with BCCI. Then there's David Sachs, who's now out as America's AI and crypto czar, but he's not leaving Washington yet. Sachs, the venture capitalist and close Trump ally, has hit the 130-day limit for special government employees, stepping down from the role he's held since January. He now moves to co-chair the President's Council of Advisors on Science and Technology, a body that would also see Jensen Huang and Mark Zuckerberg on it. But this will be a body that reads like who's who of the big tech, like I said. So there'll be others, including Sergey Brin and many more. But the White House says it will not name a successor to David Sachs' role, meaning the AI's role effectively dies with Sachs' departure. That's all that we're picking up right now from the world of artificial intelligence, but we'll keep an eye out for more.
Rachna, thank you for all of those updates there. That's everything that you know from the world of AI. You take a leave on this edition of Power Breakfast from me and the team. Thank you so much for watching. Bazar Morning Call on the other side sets you up for today's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazar Morning Call. Usually we come out of a holiday, it's a Monday, but we're coming out of a holiday, it's a Friday, which means that you're going into a weekend. It's a Friday morning, lots and lots of action to cover. The war's still going on, and if it goes on, it's going to be week 5 as we come back next week, that is. We're coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, hi, morning.
Hi, good morning. And after a strong two-day relief rally that we had on Tuesday and Wednesday, this morning, the mood is cautious across the market.
Well, that's right. We'll be tracking markets as well as the war situation. But Rima, just one quick data point. In the next 10 days, 6 days are holidays. We have only 4 sessions that we are going to be working. So not so bad given the kind of news flow that we're looking at. But we need to take stock of the market. And Prashant has hopped across to the wall to tell us all that happened in the last day and what to look ahead. Prashant, take it away.
Well, absolutely. And I think, this kind of sort of says it all, which is that the 5th week is coming up, right? The West Asia war, Iran war, Middle East conflict, whatever you want to call it. Week 4. This is going to be the week 4. It was 4 weeks back, that Friday, 28th of last month, when, bombs started falling, and it's not stopped since. So the conflict continues, right? Now, there's lots of news flow and price action which we want to cover. And I want to just start with President Trump's tweet, which came in this morning. Actually, it came out right after U.S. markets shut, right? And this is what he said. He basically said that I'm pausing the period of energy plant destruction by 10 days to the 6th of April. So basically saying that we're not going to sort of destroy, we're going to pause strikes on power infrastructure for another 10 days, all the way till the 6th of April. He says that, well, the talks are, it's there somewhere. He says the talks are going very well, right? And that the commentary by news outlets, etc., is fake and false, etc. So basically, this is the critical, crucial part, 10-day pause. As I said, if you move along, the news came after U.S. markets shut. S&P 500 had already closed by then, and that is the close, right? 1.7% lower. And now we are about 10% off from the all-time high, which was made, I think, on the 29th of October. So we, of course, have fallen about 13-14% from the highs, and the U.S. market is now down about 10% from the highs as well. After that Trump Truth Social post came through, U.S. futures actually went up 1%. Oil prices fell 4% immediately after. But, well, if you look at it, all those moves have been faded. U.S. futures are up, but about 0.25% the last I checked. Oil, of course, has come back up again. So these knee-jerk reactions have all been reversed. Let's move on. And the markets, of course, are kind of reluctant to give or rather sound the all clear in that sense. Now, just a 2-day change picture, because, I mean, yesterday was a holiday and U.S. markets were trading. So what's the overall picture accumulated over the 2 sessions, right? S&P is down 1.2. Last night was more severe, but the previous session was up. So 2-day change, 1.2 lower on the S&P, NASDAQ down about 1.6%. Oil prices, 2-day change, 5.5%. Gold prices down 3.5%. Gold's now trading at about, $4,500, $4,600. 45 actually. Silver is under 70, 6.8, 7% lower on silver over the last 2 sessions. And if you get 10-year yield, last night jumped 7 basis points, but was down 3 the previous session. So net change is plus 4 basis points. So this is the 10-year in the US. Now I come to the news flow, right? You have OECD, which has lowered its growth forecast, GDP growth forecast, and raised inflation forecast for 2026 across G20 countries. I mean, actually, they've bumped the inflation forecast for India as well. Actually, India is right on top in terms of the hit to inflation. Treasury Secretary Scott Bessent is saying that a U.S. insurance program to boost shipping through the Strait of Hormuz will begin soon. How much this will help? I mean, at the end of the day, it's not money, it's physical safety which will make all the difference, and for commercial carriers to feel comfortable to travel through that strait. Now, Israel said that it has killed the Iranian Revolutionary Guard's Navy commander responsible for blocking the strait. The U.S. Central Command issued a release saying that, well, all Navy personnel in Iran should lay down their arms and surrender, etc. Trump said that, and this was interesting, right? Trump essentially claiming that, you remember when we were here day before yesterday, before the holiday, Trump claiming a present, a gift from Iran, right? And he essentially saying that the gift was Iran allowing several Pakistani flagged oil tankers through the Strait of Hormuz. So this was interesting. Pakistan, of course, has been trying to put itself at the center. Field Marshal Asim Munir and, of course, the politicians in Pakistan as well, trying to put themselves at the center of trying to negotiate a sit-down between both countries, trying to sort of, conduct back-channel talks between both countries. So this was interesting. I'll just tie in the levels here, right? The Nifty is up 800 points in the last two trading sessions now. I said this on Tuesday. Directionally, it still looks like it's winding down. But if there is no tangible progress as we come into the close of this week, which is where we are now, and into the weekend, markets will start to worry once again. And that is something similar to what is happening right now. So you look at oil, etc., as I pointed out, it's backed up once again. So maybe, you kind of sort of close the week out on a slightly weaker note. So the resistance here is 23,380 on the Nifty. That's the first level. Basically, these are gaps because there have been so many multiple gaps. The lower end of the next gap is 23,380, which is the next resistance. And then we kind of get to, so 23,370 and 23,380 are the two levels. The support stands at 23,065 for the Nifty. So just wanted to put these levels up before we go any further. But as I said, the GIFT Nifty is indicating a lower start, and it's down 150 odd points. So some give back from the 800 points that you've stacked up over the last two sessions, very much possible as we head into the weekend with multiple holidays next week as well. Nigel has walked across with the F&O positioning and the statistics. Nigel, take it away.
Well, before that, let's just do a quick check on the Asian markets. Well, Asia is open lower now for the second day, so it's a cautious opening. The Korean markets are down 2.5%. And remember, this follows a 3% decline yesterday. So in 2 days, Kospi is down nearly 6%. That's the Taiwan for you. The Taiwanese markets also down nearly 1.7%. Hang Seng is flat, but yesterday, Hang Seng was down nearly 2%. Oil prices continue to remain elevated, and while there are some positive de-escalatory sounds, the Dalal Street perhaps will want visible signs of progress, not just statements. And we'll talk more about it, but there have been some downgrades on India. Both Goldman Sachs, which has lowered the target price to 25,900, and you also have HSBC downgrading Indian equities to a neutral. But now let's talk about the F&O space. Nigel has walked over.
Well, President Donald Trump has announced that he will pause attacks on Iran's energy plants for around 10 days, at Tehran's request, according to him. He said that the talks with Iran were going very well. However, Iranian officials, well, they have termed this as one-sided and unfair. That's what's made crude as well as the bond markets very nervous. And both those two data points, well, they refuse to cool off. In fact, in comparison to where we closed off on Wednesday, both of them are much higher. The response to a U.S. Treasury auction as well in the last 24 hours or so, that was weak, and that's what's caused U.S. bond yields as well to remain elevated at around 4.4% or thereabouts. So despite that 10-day pause, oil remains the primary inflation threat, and we need to take note of that. Oil at around $106 per barrel. Well, it's far away from the $120 per barrel, but it's still in, in that very, very nervous territory. Well, though our markets have rallied over the past few trading sessions, but the Rupee market and the volatility index didn't pull back that much, telling you there is still disbelief in this rally that we've seen in the equity markets. So you'll want both of them to show some kinds of stability. The VIX, you'd like to head to around 20, while the Rupee as well, you'll want some stability on that front. But one clear positive was that the FI net sell number in Wednesday's trading session came down drastically. In a month where they have been pressing the exit button. And this is what caused the institutional number to actually turn positive, because it was positive to the tune of around 2,500 crores or thereabouts. But we just have two sessions till the monthly expiry on Monday. Ahead of that, the FIs, what did? They covered some shorts. Close to 9,000 contracts were covered. They continue to remain net short with close to around 85% of their positions on the short side. But they also wrote more puts than calls. And that's what's caused the PCR to move up to around 1.2 or thereabouts. And on the put side, there was writing at around the 23,200 put. And that tells us that the stop loss for these writers, it'll come in the vicinity of around 22,850 to around 22,900. while the resistance for the Nifty will come in at around 23,500, which if conquered, it'll put the bulls in the position to go ahead and challenge the 20 DMA, which is around the 23,900 or thereabouts. So in the near term, that's the broad range you're looking at. The Nifty Bank, well, that's been showing signs that it wants to defend at least that 51,500 odd mark. It's popped up in the last couple of trading sessions, but it appears out here is where you're seeing some kind of support. The last few sessions have been buying on dips on an intraday basis. That's been beneficial. The bulls will fancy their chances yet again, though the cues appear a little bit jittery. So we start off close to around 150, 200 points lower. Let's see whether or not we can see some kind of recovery getting into the weekend.
All right, Prashant Paroda, portfolio manager at Emerging Markets, Allspring Global Investments, now joining in. Prashant, you were slightly overweight on India versus the benchmark towards the end of last year as you wrapped up 2025. Has that view on India changed in light of the conflict, the fact that crude prices are likely to hold at elevated levels for much longer than even once the war comes to an end?
Yeah, you can take either an optimistic view of where this whole blockade would get resolved. Maybe it will get resolved in a 2 to 3 weeks period. And if that happens, we think the equity markets will rally and India will be the biggest beneficiary of that. Or you can take a pessimistic view and take the stance that this will not get resolved the entire summer. In that case, the only asset that will go up is energy. And even that will only go up to the extent there's not enough demand destruction, and that will come down as well. So we're still in the optimistic camp today, and we'll see if, there's a lot of back and forth between Iran and US, but we'll see if behind the scenes they'll be able to get to some sort of agreement. And again, the agreement doesn't have to be on all the issues. It just has to be on the Strait of Hormuz.
So what are you buying now in India, Prashant, if you are taking an optimistic view of the situation and believe that once it resolves, India will bounce back and rebound smartly?
Yeah, everything on India is on sale, right? So you can take your pick. I think, financials have taken a beating, and rightly so, because some people believe that this would be longer. So if you have a more optimistic view that this could get resolved in the next 3 to 4 weeks, you can pick your, some of the private sector banks that have gone down. You can also, some even like stocks in the communication services have been down. So actually, there's a lot of stuff to pick from, given everything's fallen so drastically over the last month or so.
Yeah, no, absolutely. What if I would ask you, Prashant, morning, what is your best case personally? We've all become closet geopolitical analysts. What's your sense? Yeah.
I think behind the scenes, there's more going on than what we see in the headlines. In the headlines, we are seeing a lot of, it looks like they're just not coming to any sort of conclusion. But I hope behind the scenes, there's something working. And we'll see in 3 to 4 weeks if this gets resolved. I think if this does not get resolved, not only for India, it's an issue for all emerging markets and Europe as well. So hopefully a better sense will prevail on both sides.
All right. Well, we got some flashes at the bottom of your screen. The government has cut excise duty on both diesel as well as petrol. We'll try to get, a quick analysis on that front, but that's a bit of a surprise, I think so. But that's the big data point that's coming in as of now. So we'll wait for some more data on that front. Prashant, coming across to you though, do you think India though could still outperform in global equities? And, before we get to that, what about equities as an asset class? You're going to have big inflationary worries. You'll have central banks that will be actually hardening their stance now. That's something that markets were not used to in the last few years. Do you think equities as an asset class actually could get shunned away globally for a period of, say, a couple of years?
I think a couple of years will be, assuming that, this kind of blockade continues for a long time, but I don't really see that. If you look at even Iran, 50% of their revenues is oil, government revenues, oil. Inflation was 50% before this whole event started. So I think people are overestimating how much stuff is left in their tank to continue this, because they also have to get their ships across. So I think over time, I think the entire world, including China, which gets a lot of their crude from the Strait of Hormuz, has to come together and help resolve this. So I'm still cautiously optimistic, and I think they say the time to panic is, if you have to panic, you have to panic early. So you have to panic in January or February. But if you still hold equities here, you have to be a little cautiously optimistic on how this will resolve.
Yeah. Prashant, stay with us. I just want to just quickly address news which is coming at the bottom of the screen. And this is very, very positive news coming through for oil marketing companies. The government has decided to take the hit. The government has essentially cut excise duty on petrol to 3 rupees per litre from 13 rupees a litre. And it has decided to cut excise duty on diesel from 10 rupees to 0. So remember, as oil prices have moved up sharply, the question always was, and day before yesterday, we in our market town hall spoke with economists Sajid and Neelkant, and this was the question: who will bear the burden? 10 years back, before fuel price deregulation, it always used to be oil marketing companies who were then compensated by the government of India and upstream oil companies like ONGC, etc. as well. But here, you essentially have got a situation where the government is saying that I'm going to cut excise duty. So basically, I'm going to collect less, which allows, I'm assuming, oil marketing companies to not pick up the entirety of the burden as far as the jump in their fuel cost is concerned, because they are buying oil to refine at a much higher price compared to pre-February 27th. So this is very, very large news. We should quickly try and get people like MK Surana. We should get some oil analysts on the phone line, and of course we should try the current CEO, chairman of oil companies as well, because this certainly does improve the prospects for oil marketing companies in a significant way. Prashant, I don't know if you have any thoughts. If you do, please come in. This is the government responding in a clear way. It's a signal as well, more than anything else.
Yes, and the government is always, this is not for any fault of India, right? This is a geopolitical issue, and the government is trying to cushion the blow for the consumers. And I think it's a very positive step and shows positive intent. So hopefully, things will get resolved on the geopolitical front as well. And a lot of those ships that are stranded will start moving from the Strait of Hormuz.
Yeah. So, no, absolutely. And, so the way this works for oil, as you can put up IOC, HP, BP, etc., please, the intradays. The way this will work is that, the oil marketing companies, because the IOC, HP, BP have refining and marketing as well, because they were buying oil at a much higher price and fuel prices at the pump are unchanged, they were losing on refining. Refining on the marketing side, they were losing big time. I think we had oil analysts with us I think a week ago, who said that, well, HP perhaps is the most exposed because their dependence on marketing is much higher. And, they would pose steep losses at an overall level, marketing, refining, everything included. So the government is saying that, well, I'm going to take away what you pay me as excise duty and effect these large cuts. So the prices at the pump don't go up for the consumer, for you and me, I will take away what I will give away, or rather take in less what I do previously, so that the pump prices don't go higher, and there is some amount of relief for you as well. So, which is the oil marketing company. So I think it's an important signal. There will be questions whether this will be a cut for the consumer as well, but I think that is very, very unlikely at this point in time. Mr. M.K. Surana is with us. He's former CMD of HPCL. Mr. Surana, welcome to the program. Good morning. Just come in here, sir. Big excise duty cuts. Is our understanding correct that the government is essentially, this is a shock absorber? Government saying, I'm going to collect less, pump prices stay same, and oil marketing companies don't bleed as much. Your sense, sir?
Yeah, that's correct. So in the past also, government has managed the prices like that. So what you said is correct, that it will ensure that the oil companies do not bleed and the consumers are not affected. That's the way it will be.
Yeah. But there's perhaps no change for consumers at the pump, right? They continue to pay the same. Not immediately, but do you think this could be a prelude to a change at the pump level, at a retail level?
See, it depends. Unlikely, because in the past it doesn't happen like that. So, and one more thing is that the total under recovery may be much higher right now. So, I think it's unlikely that the pump prices will change.
Yeah, I mean, it'll be kind of weird, right? International prices are going higher and pump prices go down. I mean, that doesn't make any sense. But you're saying that this cut on the excise front, I mean, while it will help financials of oil marketing companies, but under recoveries are much larger, much higher, according to you. Any numbers, Mr. Surana?
No, because it will be a changing number. So I wouldn't like to give the number, but the fact remains that when the crude prices are running like $100, $100 plus dollar, and so there will be under recovery right now, because the oil prices of the pump prices are the same since last 4 years almost.
Yeah.
So under recovery will be there right now without doubt, and it will definitely help the oil companies.
Yeah, yeah. Why do you think this would have been done? Because the government's own fiscal situation perhaps is also, I mean, as many economists have pointed out, a little stretched at the margin, right? Tax collection, etc.
We need to understand one thing.
Yeah.
We need to understand one thing, that the oil industry works with a big amount of money rotation. Okay. So if suppose you are not, you continue to bleed, then the liquidity will also be a problem, especially when the exchange rate is also high. So we need to be conscious of not only the crude prices, but also the exchange rate.
I see. Yeah, no, absolutely. And that has also been going the other way, right? So you're paying a lot more to import oil than you were doing before.
And if you are not recovering it at the pump, then the liquidity will be a problem. Profitability is one part of it, but the liquidity is also another issue in that case.
Yeah, no, 100%. 100%. Mr. Surana, we'll let you go, sir, but thank you very much for that quick reaction. This is very, very important news which is coming through. In a way, the first adjustment which the government is making after this massive oil shock, which has, of course, materialized over the last 4 weeks or so. We'll take a quick commercial break here. We're going to tell you, all the interactions which are lined up. This, of course, is a big story which we will get you more reactions on. But 8:35, we've got voices from the CNBC TV 18 town hall. So we had an array of experts, Ben Powell, Art Berman, we had Neelkant, Sajid, Harish Krishnan, Sandeep Tandon. So we'll play out snippets of that. 9 o'clock, Renu Baid of IIFL Institutional Equities to discuss the impact of West Asia war on consumer durables. 9:20, Tahir Badshaw of Invesco Mutual Fund is our market master of the day. 9:30, we'll bring you the management of Prestige Estates and discuss their outlook. We have the management of Brigade joining us as well a little after that. Real estate very much in focus on the economy and, of course, this oil business as well. Pranjal Bhandari will be weighing in on what this means. So that's coming up a little later. Lata in conversation with the MD and CEO of IDFC First Bank on the Haryana fraud and the outlook for the next financial year. That's at 10:15. Time for a quick break. Our list of top stocks to watch with our research team coming up on the other side.
Welcome back. Let's talk stocks now. This is CNBC TV 18's list of top stocks for the day. Oil marketing companies, of course, will be the big story today. Relief coming through on the back of the excise duty cut. Sonal joins in with more.
Well, that's big news and totally unexpected, where the petrol excise duty has been cut from 13 rupees a litre to 3 rupees a litre. On diesel, it has been cut to nil from 10 rupees per litre. Now, remember, the important part in this is that there's no relief for retail customers. This excise duty is only for oil marketing companies, and that is something which will be positive for them. But do remember, the inventory that they have right now does have excise accounted for it. So we'll understand what kind of accounting will take place. But yes, this is something which will help them reduce cash flows now that excise duty has been cut, and working capital management could improve. But again, on that inventory bit, we need to understand more. But this is a relief which is coming by for oil marketing companies. And of course, we'll be having more conversation with analysts, the companies themselves. But for now, it is a positive that has come by from the government in order to give relief to oil marketing companies, considering the big rise that we've seen in crude oil prices.
Thank you very much for that. Let me take off from there and talk about IT stocks now, because Infosys has made two strategic acquisitions which strengthen their presence in healthcare and insurance. The first one is called Optimum Achieve Holdings, where Infosys will be spending about $465 million. This is the healthcare offering, and healthcare is broadly 7% of Infosys' revenue. The second one is called Stratus Global LLC, for which Infosys will be paying about $95 million. Both the acquisitions are likely to close in Q1 of FY27, which means analysts are assuming 9-month revenue contribution. And if you just go by what these companies did last year, it should approximately add about 1.2% to Infosys revenues. That's the inorganic composition. But Infosys had also done an earlier acquisition, Versand, which is yet to close. So that will also incrementally contribute to the inorganic moves in FY27. So Infosys is on one hand. The other one is L&T Technology Services, LTTS. Now, they've announced the sale of Smart World Communication, SWC business, for 452 crores. Now, this was acquired only 3 years ago. That's in April of 2023. And at that time, the company had paid 800 crore rupees to acquire it, which means in 3 years, LTTS is selling the same business for 43% lower value. Now, this acquired company, the company SWC, which they're selling now, contributed about 9.6% to their revenues last year. It seems to be a part of the company's next 5-year goal, where they are focusing more on engineering infrastructure. The company has spoken about this Lakshya 5-year goal from FY27 to FY31. And as a part of it, they're divesting some of these non-core businesses, low-margin businesses, and focusing more on some pillars, which includes engineering infrastructure. But LTTS selling a business they acquired 3 years back at 43% lower value.
Got that, Rima. Thanks for that. Well, let's hop across to Sudarshan. He's here to tell us about Tata Motors, the PV segment. Sir?
So another issue, another production cut as far as JLR is concerned. This we are getting through Reuters. We have written to the company. We are waiting for the reply of JLR. But as far as the reports are suggesting, it says that there is a concern from a supplier side. That's the reason JLR has decided to cut the production for next 2 weeks. And that includes that the already they were supposed to cut because of the Easter weekend, and this two weeks include those 5 days as well. And remember, in 2025 also there was a cyber attack, and because of that, for several weeks there was a production cut at the UK plant and the other plants too. And this UK plant produces 2 of the major Land Rover cars, and those are Range Rover and Range Rover Sport, and those volume-wise also are the major contributors as far as JLR is concerned. So we'll have to see, because after the cyber attack, production had normalized. And now, after this supplier side issue, how much time does JLR take to bring the production at normalized level? But for now, Tata Motors PV, I'm going with red.
Thank you very much for that. More news in banks today. Ritu joins in with the latest.
Well, yes, lots of news flow in the banking space. 3 stocks to keep on your radar. It's green for Shriram Finance. The CCI there has cleared the Shriram MUFG deal. And with that, most of the regulatory boxes are ticked. The one pending piece is RBI's note for MUFG director's appointment on the board. And then that will pave the way for this mega deal closure. The other one also in the green, RBL Bank, that has an update with the UAE Central Bank approving Emirates NBD's acquisition of a majority stake in the bank. And also it covers the proposed merger of Emirates its India operations into the bank as well. So that's a step forward. But of course, the RBI nod there is still pending. And finally, mixed cues from Fino Payment Bank. After nearly a month in jail, its MD and CEO Rishi Gupta has been granted bail as of yesterday by a special judge for economic offences, which is positive. But the bank, of course, has said that it has withdrawn Rishi Gupta's reappointment as MD and CEO for now, and they'll only bring it back to the shareholders for approval after the RBI gives its view on his fit and proper status. So the business runs, but the question mark now sits at the top.
All right, Ritu, thanks a lot for that. Just a quick word with regard to this excise duty cut. Getting some feedback from economists, a 1 rupee cut will result in a 15 to around 17,000 crores revenue loss from the government's perspective. And in terms of a deficit number, it could push it up by close to 20 to around 30 basis points. Just rough analysis that I'm getting in there. So just thought I'll alert you on that front as well. But getting back to stocks that we're looking at, Madhya joins in to tell us about the cabinet clearing modified Udaan scheme for around 10 years. Madhya, take it away.
This comes as some positive news for the aviation sector that is impacted badly by the West Asia conflict. The government has hit the reset button on its regional connectivity scheme, Udaan, almost 10 years after it was first launched. The cabinet has approved a 28,840 crore rupees plan to take the scheme forward for the next decade, which is from 2026 to 2036. Now, the focus is clearly shifting from just adding routes to actually making regional aviation sustainable by building a dedicated ecosystem for regional connectivity. So under the new plan, 100 new airports will be developed from unused airstrips across the country. There's also a big push for last mile connectivity, which is helicopters. So 200 helipads are planned in hilly, remote and island regions. Importantly, the government will now fund the operations and maintenance of smaller airports for up to 3 years because many of these airports struggle to stay viable. Apart from that, airlines will continue to get financial support, which is viability gap funding, with over 10,000 crore allocated as VGF. Now remember, regional routes in India take longer to become profitable, and this policy is acknowledging that reality by continuing the funding support. So far, Udaan has connected 95 airports and flown over 1.6 crore passengers in the last 10 years. It was launched in 2016. The big question now will be this, will this revamped version finally make regional flying sustainable or not?
Okay, all right, Madhya, thanks very much for that. So it's an important story, the aviation space, which we will come back on later. Bharat Dynamics is the next one we're going to focus on. Ria's got details on this one. Ria, good morning.
Well, good morning. Bharat Dynamics has announced that they have successfully completed the first production model of the Akash weapon system with upgraded subsystems, which will lead them to commence delivery for the project soon. And remember, this is a big project for the company, costing over 8,160 crores. And apart from this, the company has also come out with certain updates on the capex front. They have said that they are setting up units for advanced systems as well as propellants at Hyderabad and Uttar Pradesh. And the production for each of these facilities is expected to start sometime in FY27, and they have also highlighted that these facilities will be able to carry out rocket motor testing as well as warhead penetration testing, along with the bulk manufacturing of Grad rockets and also the in-house R&D development of new energetics. And apart from this, the company has also highlighted that the current order book stands at roughly 26,000 crores, and in FY27 they are expecting a further fresh order inflow of roughly 15,000 crores. So positive developments all across, and the stock expected to open in the green today.
Thank you very much for that. Let's do a quick recap then of the top stocks. Stocks with positive news flow are all the oil marketing companies, Infosys on the back of the acquisition, Shriram Finance, RBL Bank, Interglobe Aviation. Additionally, for Interglobe Aviation, the excise duty on ATF has also been cut, so that should be a positive. GMR Airports, Bharat Dynamics. Stocks with negative news flow are LTTS and Tata Motors Passenger Vehicles. And a mixed view coming through on Fino Payments Bank. But let's talk about commodities, currency, and what's happening in that world. Manisha now joins in with a complete roundup. Manisha.
Well, thank you for that. I'll stick to the prices really, and we've seen the crude oil prices actually heading for a weekly decline of 4% therein. Even right now at 106 or thereabout is what it's holding. Remember, we started this week almost with 110, hit a high of 115, and that is where we're trading at this point in time. Crude prices, though, have gained 40% since West Asia conflict began. Markets clearly looking at U.S. extending deadline for Iran to secure deal. Iran, in the meanwhile, has allowed 10 tankers to pass through Strait of Hormuz this week, And that's exactly what the street seems to be looking at. In the meanwhile, when you look at the metal prices, well, we have seen further decline come in for this. Gold is headed for a weekly decline as well. Prices have seen 3% of a cut in the overnight market. Gold clearly seems to be like a source of liquidity rather than protection at this point in time. Silver fell 3% overnight. Copper has declined 1% overnight. Metals, precious metals, everything weak. Energy prices trading slightly in the positive. Coal has gained 3% yet again in the Asian markets right now.
Got it. All right. Thanks a lot for that, Manisha. For the time being, though, we'll slip into a short break. On the other side, we have Siddharth Khemka of Motilal Oswal Financial Services, who will be joining in for some fundamental stock talk. Stay tuned. Welcome back. Well, Sid Khemka of Motilal Oswal Financial Services is joining us on the show. Hi, Sid. Good morning. Good to see you in. It could be a good start to trade for OMCs. You know, they were getting rogered because the way crude oil prices spiked up one way and the marketing margins would be getting hit. Now you have the government that's taking the hit themselves, so it could be some kind of relief. How would you approach all the three names, HPCL, BPCL, as well as IOC?
Good morning, Nigel. I think there are still concerns with regards to the oil, the crude oil availability for some of them. And yes, if there was a big concern with the start of the war that there would be going to be a big impact that these guys have to take in the form of the subsidies which the government would have paid up separately. But now two fronts: A, government taking that hit, and B, the crude oil prices also kind of stabilizing below that $100 mark. With the escalation kind of taking a status quo for now. with the U.S. administration postponing the hit on the energy infrastructure. I think that's kind of giving some calmness to the energy markets. And I think you would say that from a medium to long-term perspective, one can definitely look at some of the oil marketing companies. In the interim, any sharp spike or changes in the supply chain that could induce volatility. Having said that, valuations have come down. Dividend yields are pretty good so far, bearing the impact of the subsidy that they are going to take in their books, which could impact the cash flows in the interim. So I think among the three, IOC, HPC, I think those are the two preferred picks between among the OMCs, purely from a medium to long-term perspective.
Siddharth, hi, morning. Do you look at LTTS, SWC, Smart World? They bought it 3 years back in April of 2023 for 800 crore rupees, and now they're selling it for 450 crore. It's a sharp markdown in the valuation. What is your own view on it? Have you had a chat with shareholders or investors? How are they reading this move by the company?
I think it's a small acquisition that they did, and I think getting out of it even at a loss, I think that's a pretty kind of strategy that they want to focus on. Not much read-through right now, but I think that is an acquisition that they wanted to take in and see if they can benefit out of it. But I'm not reading much through this sale right now.
Okay, not reading much. On Infosys and the two acquisitions, which strengthen their presence in healthcare and insurance?
Yeah, I think Infosys is a much bigger acquisition and definitely a welcome step that we are now seeing some of these IT companies looking at, rather than looking at buybacks and paying back the cash, looking at acquisitions and strengthening their portfolio. So from the BFSI space, now diversifying into healthcare. So overall, we see that's a good step, and I think that is a positive read-through for Infosys as of now, and I think market will take that in a positive way.
All right, Sid, wanted to ask you about the graphite players. I'm just looking at Graphite, which is the global giant. Ex of China, I think that is close to 25 to 30% of of the market. They have gone ahead and they've increased pricing on graphite electrodes by $600 to around $1,200 per ton. That could have a positive rub-off on our listed guys, that is HEG as well as Graphite India. Any view on both those two names?
So, Nigel, I think the news flow is definitely positive, but what is a structural positive for some of these electrodes, graphite companies, is that the overall demand environment looks pretty strong. The metal sector, that is likely to do well there. The EVs as well as the battery segment, I think that is a structural story that we believe should be positive for the entire space. And on top of it, you have the global supply chain issues, the shipping issues, that is only adding to the overall realization. So I think that's a positive for both from a structural perspective, that they should benefit from the increasing demand as well as the increased price, at least in the near term.
Fino Payments Bank has gotten hit so hard, 35% lower. The latest news is that the MD and CEO Rishi Gupta has got bail, but the company has removed his reappointment agenda from the ongoing postal ballot. But this whole news flow surrounding, the lapses at the government, lapses at the bank, Rishi Gupta's, the issues, they're playing in terms of value erosion on the stock.
So I think, we don't have a coverage, but even last time we spoke, I think these kind of news flows, especially in the fintech space, that definitely spooks the investors, given that there are a lot of other opportunities in the small finance banks, in the payments bank. Some of them are going to get listed. And especially in this environment where the credit growth is picking up, even the larger private banks, the PSU banks are doing well. So that, I think, until there is any clarity, it's a clear no-go from a retail investor's perspective.
Okay, all right, got that. What about the big boy, HDFC Bank? What's the view on that name? It finally showed some signs of seeing some support, I think $850 or thereabouts. Valuation-wise, no arguments, that it's much lower than what we've seen in the past. The uncertainty is something that will plague investors. But at around 850, 880 rupees, do you think bulk of the bad news in the price?
So, Nigel, I think, yes, there are definitely short-term issues with regards to the bank. But I think the board has been pretty swift in appointing an interim chairman. They have appointed a committee to look into the matter, and they were pretty quick in terms of allaying the fears of the market in terms of what was going on. The good part is that the core operations business that is being taken care by the CEO, whose term is coming up for renewal later part of this year, and we see that as a continuation of the overall growth story. So I think what we are seeing is that the development definitely dampens the near-term sentiment, which more or less looks like in the price. Now going ahead, what will be important is the appointment of a new full-time chairman, and again submission of Mr. Shashi Jagdishan's name for the next CEO term. That will help restore investors' trust. And in the meanwhile, improve operating performance in FY27. That will also be crucial for the stock price performance. So I think overall in the price, we do have a positive view on HDFC Bank with a buy rating and a target price of 1100. But those near-term news flows will be key to determine the stock price trend over the next few months.
All right. Sid, there's news at the bottom of the screen. There was sources with regards to in Gujarat, which were saying that we should actually have those graphics up if we can. Basically, I think an industry body, source-based information, but asking Gujarat Gas rights to industrial consumers and asks them, I guess, to calibrate usage of gas, industrial customers to assess gas consumption in April to manage supply. So, I mean, it's like a soft touch approach at this point in time, and prices from April 1st have been increased. I mean, it's been what? It's gone up massively, right? Yeah, it's gone up quite a bit. If less than 70% gas allocated, we might not be able to start production, etc. So this is stuff coming in at this point of time. I'm just waiting for that price increase because it looked like it was double, right? Yeah, 41 has gone to 85 to 88. So that is a doubling of prices, and we should stick with that. That's the important one as far as Gujarat Gas is concerned. All source-based information at this point in time. We'll take a break here. We are back, and we'll get you voices from the CNBC TV 18 town hall. Hormuz will join in after that to decode the big cues. There were a couple of downgrades from Goldman, etc. Stay tuned. Yeah. Welcome back. There's 9 minutes to go for the market pre-open session to kick off. Just want to play out a few sound bites. We did a market town hall day before yesterday. You can check out 3 panels, one global, oil, macro. The third one, of course, markets focused. They're all available on YouTube. I urge you to check them out. There were excellent discussions, if I say so myself. This is, from the macro and global discussion. Art Berman, who's a near 40-year veteran in oil markets, and Ben Powell, who's, of course, with the BlackRock, both echoing what is, I think, a bit of a non-consensus view. While it's hard to say what is consensus, but many do believe that, this war is in the first stages of being wound down in the next 10, 15 days or so. Both say, well, no. This is not likely to end very soon, and there is a permanent risk premium in oil prices, even if this war were to end immediately. Listen in.
On the ground, I live in Abu Dhabi, the drone strikes have continued, the missiles have continued, and the Marines, the US Marines, I believe, arrive later this week. So I think the situation is, frankly, still very tense. The facts on the ground are mostly unchanged. Indeed, it feels more of an escalation in the last week than a de-escalation. So I recognize President Trump's words. Of course, I'm watching with huge interest, both as a citizen of the UAE and as a markets professional. But I think we need to be careful from being too confident and too optimistic, because sadly, as I say, the facts on the ground continue to be, frankly, quite alarming. And there is the potential for this to continue and worsen as these attacks on the physical infrastructure. Just overnight, we've had an attack on the Kuwaiti airports, one of the fuel depots kind of struck there. So I recognize President Trump's words, very important. He's the most powerful man in the world. But the facts on the ground continue to be unsettling, and that has not changed in the last 24, 48 hours.
I see no de-escalation. I see more potential for escalation. I think that the words from President Trump are purely performative. It's very difficult to have your negotiating partner take you seriously when you're moving, combat units into the area. There will now be a permanent risk premium on oil, regardless of how this thing ends. And I would say that premium is no less than $10 per barrel. And so if everything ends tomorrow, the very best case we can get back to is maybe $80 Brent. Now, I don't believe that everything's going to end tomorrow or that we're going to get back to $80 anytime soon.
All right, let's move across to the big cues on India from global brokerages. Goldman Sachs has downgraded India, while HSBC warns that the rising crude oil prices typically leads to earnings cuts. Hormuz has stepped up to run us through, what those two brokerages have to say. Hormuz, take it away.
One of the many others that have downgraded the Indian markets in the recent past, Goldman Sachs has joined that list this morning, and they have downgraded India's rating to market weight from its earlier weight of overweight. And as a result of this downgrade, they have also cut their price target on the Nifty. The 12-month forward price target, which earlier stood at in excess of 29,500, is now cut to 25,300. That's a 14% cut from the earlier price target. Not only has the price target been cut, but the earnings estimates for calendar year 2026 and 2027 have also been cut. The 2026 estimate has been cut to 8%. That has been half from the 16% earlier. The 2027 estimate has been cut down to 13 from 14% earlier. What they also say is that they are seeing risks tilted to the downside over the next 3 to 6 months, as the market may not be fully pricing in the extent of the earnings cuts that are likely to happen. What they have also done is that they have lowered the GDP growth forecast to 5.9%, raised the CPI estimates by 70 bips, widened the current account deficit to around 2% of GDP, and included a rate hike, not one, but two, and that of 25 basis points each, including a 50 basis points rate hike for 2026. What are the risks to the upside? In case there is an earlier than assumed resumption of oil flows from the Strait of Hormuz. If that happens, that's a positive, and a clear recovery in India's earnings cycle, that remains a positive as well. So based on this, what are they overweight on? They are overweight on banks, they are overweight on staples, they are overweight on telecom, defense and energy. They have downgraded durables, autos and NBFCs to a market weight, and downgraded oil marketing companies to an underweight rating. Now on to HSBC. What they also say is that they are focusing on three important categories here. Is the fact that they are focusing on stocks that provide a defensive tilt in this current macro uncertainty. They are also betting on stocks that have a limited war impact but are caught in the crossfire, and they are also betting on structural winners that look more attractive after the recent correction that have strong fundamentals. So which are these? Let's take a look at them one by one. In the defensive tilt, you have Reliance, Sun Pharma, Bharti Airtel and NTPC, where they see upsides of anywhere between 9% to as high as 31%, including a 26% upside for Reliance Industries. The second list is those stocks caught in the crossfire but do not see a big structural impact. Here they have Adani Ports, Hindalco and SAIL, where they expect these stocks to rise anywhere between 30 to 40% from current levels. And lastly, the stocks that look attractive after the recent correction with strong fundamentals, ICICI Bank, Apollo Hospitals and SBI Life, where they see anywhere between 15 to 30% as the potential upside. So Goldman Sachs coming in with a downgrade on India, price targets cuts, earnings cuts, but HSBC is betting on these 10 names for the future.
Okay, all right. Thanks very much, Hormuz, for that. Well, not a pretty picture from both of them, Goldman and of course, more brokers. I think these downgrades will happen. Nilkant Mishra, for example, said that these downgrades will come on the earnings front and of course, consequently on the view on the market as well. We'll take a break. We're back. There's the pre-open session in 3 minutes or so. We have Somal Mehta of Mirai and we have Mitesh Thakkar of Bonanza with some technical trading ideas. Stay tuned. Coming up.
Welcome back. In a few minutes from now, we'll be getting in the pre-open rates and we'll also take stock of the markets. But for the timing, let's welcome our technical experts. We have Somal Mehta as well as Mitesh Thakkar who join us on the show. Good morning, gentlemen. Thanks a lot for joining in. Well, the GIFT Nifty is suggesting a little deeper gash actually. Now I think it's down more than 200 points. That's the pullback we like to start off with. Mitesh, last few trading sessions, it's been good to buy the dip. Today, what would you advise? Stay away?
Morning, guys. So, I think last week we talked about getting past 23,100, which could give a reversal. We did get a bounce back to about 23,500. And I'm not sure, it's done yet. But also the fact that today will be lower opening. So the immediate pivot which I would want to observe would be close to about 23,060 to about 23,100. In case this zone manages to hold, I think then it will be a short-term buying opportunity. But in case we start breaking below 23,060, 50 zones, then I think we might see the supply pressure come back into the markets again. So the idea is that it's still an oversold chart, but there's no sign of a confirmation of a reversal as yet. So therefore, I think, trade with levels, be slightly nimble in executing your trades and keep and follow the stop loss strictly.
Yes, we're going to be starting off sub 23,000. Then what would your view be? Because you're talking about 23,050, but if we start sub 23,000, then what's your take?
Yeah. See, sub 23,000 would possibly, mean that you might see actually 22,800 come into picture. But again, I think I'll just wait for the opening and then take a call over there.
Mitesh, by the way, the Indian rupee as well has breached the 94 mark for the first time ever. Remember, the last couple of trading sessions, the equity markets pulled back, but the rupee stability is something that we're still looking forward to. And now with these excise duty cuts, it could put some pressure on the fiscal, which in turn is reflecting on the rupee as well. That's why we're starting off at around 94.2. Let's get in Somil. Hi, Somil. Good to have you on the show in the morning. What's your take with regard to the Nifty? Would you be a buyer on this dip? And if yes, what would the stop loss come in at?
Good morning to everyone. The overall trend still remains negative. We're still forming low tops, low bottom on higher degree time frames, that is monthly, quarterly, weekly charts. So the trend definitely stays negative, and we'll be looking for lower targets, maybe close to around 22,250, 22,000 levels in the medium term outlook. However, in the very short term, last week we have had a positive weekly close. That means a leg has completed here and a bounce back is expected. We've also seen a good bounce back last week, and I'll be expecting this bounce to continue till 23,800, 24,000, which is very close to 20 daily simple moving average, and also a 38% retracement of the entire fall. So overall, in the very short term, I'll be a buyer for a target of 23,800. And in the medium term outlook, I'll be expecting markets to take resistance around those levels and again start the move on the downside. So yes, in a buyer in the very short term for a target of 23,800.
Okay, but then medium-term outlook is a bit worrying. 22,000 is the level that you see on in Somil. Morning, hi, Rima here. What about stocks?
So I'm focusing on strong sectors. One of the sectors would be IT, where it has been consolidating, making a small base. I'll be expecting a sharp bounce here. And I'm only talking about a bounce. I'm not talking about a reversal in the medium term or long term. So a bounce expected in IT, where I'll be buyer in Infosys. Infosys has started forming high tops, high bottom, trading above short-term averages. So my stop loss would be 12.15 and target would be 13.55. And the second stock which I've chosen is from the pharma pack, which is defensive. They have been consolidating or being around trading around 200 daily exponential moving average. So I'll be buyer in Biocon, which is forming, a small consolidation and has broken on the upside. So my stop loss would be 365 and target would be 405.
Mitesh, what about the stocks that you're looking to trade?
I have 3 sells to a buy. On the buying side is DMart. I think that stock kind of did very well, and the overall structure for the indicators, etc., is positive. So DMart is a buy with the stop at 38.88 for targets of 39.65. All these calls, will take a fresh look at it once the pre-market settles in. HPCL is a sell with a stop at 350 for targets of 332. HAL is a sell with a stop at 3,700 for targets of 3,600, and Ashok Leyland is a sell as well. Keep a stop at 173.5, look for targets of 166.
Yeah, no, absolutely. And I think, there is these oil marketing companies. Let's have IOC, HP, BP up. Mitesh, any thoughts? BP is up 1.5%. HP and IOC are also higher. They'll come up on your screen. So while the news is positive, it's a relief. It's a liquidity help. So see it in that context instead of, at a time like this, which is a mini, very, very stressful situation. This is not the government this is not the government asking oil marketing companies, well, you continue to make money. So this is not that. So don't read it like that. The government is essentially saying that, well, you're losing a lot of money. Let me come in and take some of the burden because, we got to continue to get the oil. And it's a liquidity thing as well. So read it in that context instead of saying, well, this is a quote-unquote market, an eye on the market kind of a thing with a signal to the market. This is not that time. This is basically help from the government to tide over the liquidity crisis. And the government saying, we'll collect less. Consumers will pay the same. Consumers, of course, if you look at that pyramid, that, on the gas side, when the government came out, well, consumers right on the top in terms of the set of consumers who have to be supported and protected. So households were top of the list. And right at the bottom, of course, were industrial consumers, etc. So this is that. This is not, a signal to oil marketing companies to make money. Prabal Sen is with us, energy analyst at ICICI Securities. Prabal, good morning. Good to have you with us here. How would you read this?
Morning. No, I think exactly. I think what you said is basically what is relevant. This is essentially an attempt by the government to absorb part of the loss, to say to the OMCs that, okay, there is obviously a significant amount of loss that is actually there in the system. And the government is doing what it can to, alleviate the pain to a certain extent. The losses have certainly not disappeared for petrol and diesel even after this move, particularly at the current prices, with spreads being what they are and, crude prices effectively for India being what they are. But it does help, alleviate the pressure to a certain extent. We would hope that it's followed by some price increases allowed to be passed through as the situation normalizes. But as of now, it's a little bit of a relief. Yes.
All right. Hi, Prabal. Morning, and thanks a lot for joining in. Give us a specific number if possible. What were the marketing margin losses? And with this kind of a cut, what does it come down to?
So, frankly, let me just clarify that at this point of time, given that, there is ambiguity about exactly the crude cost itself that is actually being paid by most of the companies. It's all guess estimates on our part because the Dubai benchmark no longer holds, which used to be the benchmark earlier. So, one has to assume Brent plus a certain premium. Having said that, retail margin losses, as far as our estimates go, were probably closer to about 18 to 20 rupees for petrol and between 30 to 35 rupees for diesel prior to this. This is based on the elevated, of course, a mix of Brent and Dubai benchmarks feeding into the estimates. So obviously, everybody will have their own numbers. So at these levels, a 10 rupee cut is a significant reduction in those losses. So the blended losses will obviously come down to below 15 rupees or maybe even below 10 rupees, depending on the prices as they behave after this cut. So that tends to sort of then reduce the losses on an overall basis because GRMs, should, as crude normalizes, should also rise a little bit. So on an integrated level, I think these companies will probably start to see a little bit of relief, assuming prices don't spike too much from here.
Prabal, in the event the conflict comes to an end and crude prices retreat, they go down to, say, $80 per barrel. Do you think then the government will immediately look to reverse or roll back these excise duty cuts? Because if yeah.
So, sorry, please complete your question.
No, just trying to understand that in an optimistic scenario then, crude prices have come down, but these excise duty cuts still stay, they hold. Then oil marketing companies are at an advantage, not just a neutral ground.
I would, I really don't know whether the government is looking at it like that. I think what Prashant was saying is probably very relevant. This is a move done to alleviate the losses in the system. It is not a move intended to let OMCs make, or anybody else for that matter, make any exceptional profit. So I think given how volatile the situation is, even if the conflict were to sort of get alleviated, let's say over the next week or so, and crude prices retreat, the government, I think, will be prudent enough and proactive enough to ensure that margins maybe are allowed to get back to normalized levels rather than any exceptional. There's a whole lot of losses that need to be made up The previous break-even was somewhere around $71 to $74. Just to put it in context, a 10 rupee price hike takes care of a $20 increment in product prices effectively. Every dollar increase is about 53 to 55 paisa per liter of change to keep margins at the same level. So we have a long way to go yet. I think it's premature to sort of say that they will be allowed to retain these profits even when crude softens. I don't have a, opinion on that.
Yeah. No, absolutely. So yeah, that's where we find ourselves at right now. Prabal, just feedback since we have you on the line, right? Is there the critical part, of course, is continuation of energy supplies, both oil and of course gas. Oil's not been a problem. Gas, LPG specifically, but maybe also gas. Any reports, anything at all which you hear, which you're picking up from your circle, analysts, investors, companies that you track of shortages of any kind?
No, I think in LPG very clearly, of course, the delivery timelines have increased. There are reports here and there that we read that, certain cities are facing issues with respect to there's a little bit of panic buying and, people sort of are actually purchasing more than they normally do because they're sort of uncertain about availability of fuels in the near future. But as of now, at least anecdotally, I've not heard any stories in terms of fuel pumps running dry or, sort of any shortages per se. At least and even in natural gas, we have not really seen too any disruptions, at least on the domestic front. Commercial, of course, there have been cuts, and that has been announced by the government itself. So there have been cutbacks. That is something that every commercial establishment is having to deal with. And the same goes for commercial LPG. But on the domestic front, I have not really at least heard anything as of now.
Yeah, absolutely. Prabal, that Gujarat gas news, you must have seen it, right? Steep hike. Why would that be?
I'm sorry, I have not seen the news. What is it? You can kindly tell me.
Okay, they've basically, for industrial consumers, they've increased the price to some 82 rupees from about 40 rupees earlier. So basically they've it looks like it's a doubling of, the gas that they're selling to industrial consumers, Prabal. This is source-based information, of course. They're up on your screen. The graphics are up on your screen. Gujarat Gas is asking industrial consumers to assess gas consumption. Prices from 1st of April increased to 85 to 88 rupees plus VAT from 41 rupees plus VAT before the crisis. So, yeah, it's a doubling.
So, I think, what would have probably happened is that the gas that Gujarat Gas is able to procure for its industrial customers, given that there's very little domestic gas available at this point of time. If you look at the way LNG prices have behaved, LNG prices have actually nearly doubled from levels of $11, $12 to as much as, $25 at this point of time. So I have not had the chance to look at the news or talk to the company. Yeah. So, I would refrain from commenting at this time. Maybe, I can update you later.
We'll invite you back, Prabal. But a very useful conversation. Thank you very much for joining us. And thank you for those updates and those insights. I think we are a couple of seconds away from the market open, and we have the first race which will start to come up. It is a lower start, and how low is the question? But 0.6%, 0.8, that's about 23,100. Nifty Bank is starting about 1% lower. Small cap index is up on your screen. That is starting about 0.9 lower. Midcap index should be something similar. The advanced decline is 500, 550 stocks are higher and about 1,200 stocks are lower right now. So it's about 2:1 in favor of declines at this stage. So 23,100, 200 points down, 0.9, 0.95% in the red as we begin the day. The Nifty heat map will come up on your screen. I can spot a few IT companies in the green, and Rima will have more on these as we go along. But it's overwhelmingly down, as is to be expected. Tata Motors passenger vehicle, Eternal, Shriram Finance, Indigo are some of the stocks which are lower, and TCS, Infi, Coal, ONGC, etc. are higher right now. So 230 lower, that's about 1% clean down right at the word go within the first 1 minute. Rima.
Well, on the way up, let me start with the gainers because there are a few of them. It's IT. So the Nifty IT index is the only one managing to get away without any cuts at open. So flat opening, now up 0.3% on the Nifty IT index, led by names like a TCS, Infosys, HCL Tech. Infosys has made 2 strategic acquisitions in the last 2 days, and that's keeping the stock excited. But even Tech Mahindra is on the gainers list. Other than IT, even the PSUs are up and about. So NHPC, ONGC, Coal India have opened up with mild green. But on the way down, you can see a broad-based cut on PSU banks, realty, auto, metals. These indices have opened with cuts of 1.5% to 2%. Tata Motors, CV and Tata Motors passenger vehicles under pressure. Shriram Finance, despite getting that RBI approval for the MUFG deal, stock is under pressure with the broader financial NBFC banking complex. So Shriram Finance, HDFC Bank, SBI, across the board, you can see weakness in names. Interglobe Aviation is also under pressure. Interglobe Aviation is lower by 2% at start. Eternal is weak. It rebounded in the early part of this week, but today under pressure. Similarly for Eternal, from Monday to Wednesday, L&T stock price was up nearly 6%, and today it's giving back some of those gains. Auto names on the back foot. Reliance Industries has lost more than 1%. HUL, Titan, a couple of these consumption names too are under pressure. But overall, at least in the opening, the Nifty and the Sensex are down nearly 1%. Banks are underperforming, and the advanced decline ratio is overwhelmingly in favor of the losing side, 1:4 in terms of an advanced decline ratio.
Solid pullback from the IT names, actually. Oracle Financial as well, up close to 5% as we speak. Good move is what we're seeing on that name. Let's highlight a few big movers, though, from the broader markets. You have Azad Engineering. That's been chosen as a single source supplier partner and assigned a long-term contract, for an 8-year term with Mitsubishi Heavy Industries. So that one is up close to 5%. Good move is what we're seeing out there. Sula, a stock that's got badly beaten out of shape. I think they've got some positive news flow over the weekend, and that's why, in fact, over the holiday, and that's why that stock as well is doing a relative outperformance, up close to 4%. Gujarat Alkali is a stock that's been doing very, very well all through the month. That continues with its winning ways, so that stock as well up and about in today's trading session. Let's pull up the graphite electrode makers. You had Graphite that overnight went ahead and increased prices by close to around $600 to around $1,200 per ton. Graphite India as well as HEG, both of them have opened up with some green. A positive read-through for those stocks. After a while, we're seeing a price increase, and that's why, in fact, both those two have opened up well in the green as we speak. On the flip side, Gokuldas is down in trade, seeing some selling pressure. And on the Nifty itself, now actually we're moved to the day's low. We're down 270 points or thereabouts. I think the 22,900, that's an important support to hold for today's trading session. But a weak start, guys.
It's a weak start, and, it's 270 odd points lower, as you said, as we begin the day. 4 minutes into market open. Tahir Badshah is with us. He's CIO, Invesco Mutual Fund. Tahir, good morning. Great to have you with us here. Appreciate your time.
Thank you.
It's a tough one, right? There's a squeeze underway, and you're getting these downgrades from sell side, which you must have seen, right? Growth estimates and I was seeing the inflation shock. OECD is saying, well, inflation shock for India is right on top of the list, just purely because of the fact that we're a very large oil importer in that sense. What does it mean? How do you distill all of this into your investment case and what you're doing, Tahir?
So, Prashant, it's never easy, right? I think, some of the things which probably are happening today, for example, expectations, like as you said, that inflation is probably going to rise, is something which probably was expected in the sense that, we've seen extreme inflation, lower inflation figures throughout most of 2025. So, in a way, something had to give. Probably these are not exactly the reasons why we would have wanted inflation to go up. But by and large, I think at some level, some bit of pricing power will probably come back. We've seen inflation go down to as low as 1.5% to 2%. I think that's something which, as we know, has been coming in our way in terms of top line growth. So I think, yes, it'll hurt. It'll definitely, hurt, especially if this whole situation continues for a long period of time. We don't have a choice but to start looking at businesses which have adequate pricing power in order to be able to pass on some of these cost increases. And that is something which we'll have to probably, approach, at least in the near to medium term. And then over the longer term, I think we'll have to probably contend with what exactly happens to the geopolitical landscape, because tides are turning significantly, and there are different forces which are at work right now. So I think those will have their longer term implications. But I think this is how we'll probably have to think about the markets as things stand today.
Tahir, one argument that everyone makes to perhaps say that India is looking attractive is now that valuations have corrected quite a bit. We are at 17, 18 times, which is at the lower end of the 5-year average. But the risk is that what if the earnings also correct? The earnings expectation was also of double-digit, low teens kind of an earnings growth. If this persists, there is a risk to earnings. What if earnings get reset lower then to high single digits? Then in that case, are valuations still attractive? And are you all recommending to buy the dip now, or do you think this is going to get worse?
So at a headline level, Reba, you probably may have still a little bit of correction to go. We may probably be more closer to the lower end of the market than to the top. But yes, as you say, and as market would most likely factor in, there's going to be an impact on earnings. We started off the year believing that FY27 will probably be approximately somewhere in the vicinity of a 13 to 15% earnings growth over FY26. Part of it is definitely probably going to get affected. So we are talking about maybe 6-7% odd. If you look at the valuations that you indicated, it probably bakes in a relatively higher level of growth. So I think if you were to probably adjust for that, we are not at about 18, perhaps closer to 19, which is more like an average, the longer term average. Do we stop at this average, or do we probably dip a little lower? I think we probably, in the current circumstances and given the volatility, it's quite likely that we dip a little lower. Not too much from here. The comfort I think we take is basically if you were to probably look from the point of view of differential of bond yields versus earnings yield. And I think that is probably we are closer to about 100 odd basis points differential. Even as 10-year continues to rise, we are closer to 7%. But nonetheless, I think if we were to probably bottom at somewhere around 80 odd basis points, that is what happened during COVID, let's say, for example. I think we are maybe about 7-8 odd % away on Nifty terms and probably 10 odd % away from a broader market terms with regard to the downside. But I think then, of course, we can't really wait for that. We have to put money to work wherever we think it makes sense. And particularly keeping that framework in mind, like I said, that try to beat the market probably by being in businesses which have a certain amount of pricing power in order to especially contain inflation or contend with inflation at this stage.
So just to summarize the point about earnings, we started the year with 13-15% earnings growth expectation. The reality will be, say, 6-7%. And if we go by that, then India is trading at 19 times forward valuation multiple average, not at the lower end. And you believe just going by, the bond differential, etc., the downside from here should be 7-8% tops for large caps and 10-odd% for mid caps at a headline level.
That's equivalent to probably saying that, the earnings expectation goes down to zero in a way, if we were to probably look at it from that standpoint. That's another way of cutting it.
So if there's a downside of 8%, you're saying earnings expectation assumes to be zero?
Yes. I mean, that is what it will lead to. I mean, if we were to probably go down 7 or 8 odd %, then it essentially implies that we are starting with a zero growth assumption for the coming 12 months or thereabouts.
Got it. Hi, Tahir. Good to see you, Ben. Tahir, getting into the month of March, the biggest underperforming sector was tech. It got bombed out of shape. It got slammed in the month of February. But in this month, actually, it's been a relative outperformer. If we can pull up a last 1 month chart, you'll see that the tech index actually is flattish with a mild negative bias, while the Nifty has pulled back 10%. What is your view on the tech index? Some of those stocks, that come down to fairly, trading on a PE that was in line with historical averages. And some of them believe that maybe, in fact, they will, they've already factored in any kind of negative news with regard to AI. Are you in that camp? Or do you believe these companies are not going to grow much any which ways? Why should they be even getting these multiples?
So your observation is right, Nigel, and we kind of started getting a little additionally constructive, incrementally constructive on tech, even during that AI, meltdown, which was probably happening a month and a half ago. And then the entire focus has obviously shifted to the newer developments. In that regard, I think just as it happens, this is one of the sectors which has probably underperformed the most on a 3-6 month kind of a basis. And it has probably taken the most of the pounding. So it's quite likely that in a shorter term scenario where we probably see mean reversion setting about in one way or the other, this is a sector which probably will find favor. It has a somewhat lesser direct influence as far as the ongoing conflict is concerned. And it has, like as I said, it's been beaten down fairly significantly. We had already started to kind of hunt for this sector from a value standpoint, and I think that proposition remains. And this is what, by and large, I think the market has started to kind of reflect over the last few weeks. I think this is something which I agree with you will probably extend over the next some time, especially if the current market backdrop were to continue.
Yeah. Got that. Just a quick word, Tahir, on, as you see it, right? Earnings cuts will start to happen now, or you think it'll hit a couple of quarters down the line?
Well, I think it'll probably not show up as much in the March quarter for sure. I mean, we will have, a very short period of time in which most corporates, I think, should be able to probably manage. I think the June quarter, obviously, and especially if things don't resolve in any manner, or maybe at least even if they don't resolve, but at least energy prices, if they remain elevated, then I think June quarter will be the first quarter where we'll probably start to see some bit of the impact, and that too may not be as significant, especially if, let's say, for example, pump prices essentially remain the same for us in India, and we are only hit by gas. Then I think the impact will be relatively less so even in the June quarter. I think a full-blown impact probably will be more towards the, let's say, the second part of calendar year 26.
Second, yeah. And just this inflation bit, right, Tahir? Do you reckon that, I mean, actually, this is generalized cost push inflation, right? So across the board, we will start to see price increases for most consumer items?
Well, I think, we were in a somewhat mixed mode before the conflict. We were coming out of a little bit of a slowdown, but at the same time, we had some things to cheer, especially the fact that we'd seen some interest rate cuts and tax cuts, etc., which were probably supposed to buoy overall demand. So I'm hoping that this supply side issue on inflation and costs does not transform into a demand side challenge as things progress. So if this can get nipped in the bud and we see a resolution to the conflict and energy prices coming off, then it is more only a supply side kind of push which we have to contend with. If it prolongs, then that is when things become a little more complicated, because then some of the levers that we probably thought of last year might probably wane, and it might start affecting overall demand conditions as well.
Oil marketing companies, Tahir, what is your view? The government today has announced an excise duty cut on petrol and diesel, so in a way acting as a shock absorber in light of the rising crude prices. So your view on oil marketing companies, and now that government finances are going to get hit, are there any implications of that, say for sectors like defense, etc., where large spending is expected?
Yeah, so basically, as far as oil refiners are concerned, I think obviously these are the times when you buy them. But unfortunately, they're not as cheap as what they were probably in the past cycles when such episodes have happened in the past. But perhaps some part of it can also be explained due to the fact that their balance sheets have clearly improved compared to what they were in prior episodes. So I think, this then by and large becomes a good starting point. But we will have to contend with volatility, or at least, not so good numbers to come through in the next 1 or 2 quarters. And what has been done by the government is essentially what would have been expected in any case, because it just then allows pump prices to still remain within control, and probably allows for some buffer, as you said, in terms of inflation. So I think net these are ranges in which you start to gradually look at them favorably. With regard to defense, I think obviously from a 2-3 year perspective, the macro call still remains fairly positive from the point of view of the fact that defense will remain an important element. Geopolitics will be around for a good length of time, and also basically things like possibility of reduction in imports and a probability of even exports for India. But I think what probably in the very short run I'm kind of intrigued by is the way in which these wars are being fought and the nature of the dynamics on defense and defense spending and the kind of technologies which are being used, one needs to assess in terms of how this landscape is likely to evolve. We have countries which are using very low-tech defense, but at the same time bringing in as much of damage compared to the very large defense budgets which are being put aside by many of the other economies and other countries. So it's a new reality, and we probably need to understand that a little better. But barring which, I think on a more medium-term perspective, this is a time to probably be, we are fairly positive as far as defense is concerned. It reflects very adequately in our portfolios as well.
You know, the oil minister, okay, there's a export tax. That's a new thing, I think, which is coming through, right? We should just have this up on the screen. Basically, you know, the oil minister Hardeep Singh Puri is confirming that this is basically helping oil marketing companies tide over. We are taking the hit. We're not asking consumers to pay more. That's it. I mean, this is basically transfer from the hit which was to come to you know, consumers at petrol pumps, and the government absorbing it. That's a confirmation, as we've been pointing out as well. But this is now coming in from the oil minister. But the other bit is, I just sort of wonder if this is new, right? The government essentially saying that an export tax has been levied as international prices skyrocketed. I'm not sure.
This was part of the morning notice itself.
We didn't address it, right? The export tax bit in that.
It was, it was on the screen.
I see. So maybe we should get some more perspective, because we had Prabal in the morning as well, but I don't think there was, we discussed it. So on the export bit, the government is saying that any refinery which exports, you know, to foreign countries and export-oriented refineries will have to pay an export tax. So I'm assuming this is essentially to try and, you know, collect a little more, because refined product prices have gone through the roof. I mean, for example, if you look at aviation turbine fuel prices, they are $200. Actually, they hit $240. If you look at diesel, refined diesel, diesel as an end product, refined product, those prices have gone through the roof. So, you know, this is the oil minister essentially saying, or talking about this export tax. So, trying to make up from shielding consumers, taking a hit, but at the same time trying to buffer with this export tax. So, more details on this one a little later as we go along. Tahir, any thoughts on this?
Well, again, you know, it's part of the package in order to basically shield domestic consumers. But it is also unclear at this stage. I obviously have not read this, but I'm just wondering if how long and whether this is going to be for a long period of time. This can always reverse if things normalize. So, you know, this may be a short-term temporary measure as well.
Yeah. Now it looks like it. It's a temporary measure, because hopefully it's a temporary situation as well, right? Absolutely. In that sense, I mean, fingers crossed. You know, anything? Just run us through anything fresh you've done, Tahir, in terms of deployment or otherwise.
So, Prashant, we've been operating at, like as I said, you know, both ends of let's say the spectrum. On the one side, clearly, like as we discussed with Nigel, sectors which are probably pummeled and, you know, in any case are trading in some kind of a value zone, perhaps a little unaffected, and maybe can turn defensive. So private banks, tech are the areas where we probably have focused. And then on the other side, we've also looked at businesses, and, you know, they have been some of our important holdings, particularly those which are sensitive to crude, sensitive to energy prices, but are fairly strong domestic franchises in one way or the other. So aviation stocks to you know, things like even like as I said, private banks, maybe even some of the consumer tech companies which were actually affected through indirect route. You know, autos is another area which has been one of our larger bets. Cyclicals, some of the domestic cyclicals particularly, all those which are kind of sensitive to crude. So they having come down, we still continue to kind of believe that, at least from a couple of years perspective, if not the next 6 months, they still have things going for themselves. So these are some of the areas which we have been keen to kind of, you know, add on to and, you know, place higher confidence in, even under the current circumstances.
Tahir, I know you all have a mandate not to take a cash call. You'll get money in, you'll deploy it and find the best possible opportunity bottom up. But for other investors, right, people who have the opportunity to deploy now, or perhaps wait for some more time to wait to see how this conflict plays out or the impact on earnings over a period of time or prolonged period of time, what is your own advice or gut? Do you think, it gets worse from here on and therefore you should keep your powder dry?
Well, it can always happen, but as we assessed, we are at a stage where probably downside appears relatively lesser compared to upside. And especially if one doesn't just talk about the next 6 months, maybe I'm not even talking 3 years and 5 years, but 18 to 24 months is a reasonable time to expect that upside could probably be better compared to downside from here on. So I think it's time now to start putting money to work. This is generally always a time when we reflect back in hindsight to have been good opportunities, especially for investors who gradually invest, and it just bumps up your overall compounded returns as we see it over a somewhat longer period of time. So I think we should start. We basically expect investors to operate or rather look at products which are at one level conservative. Those investors who are a little risk conscious can probably look at flexi cap type of funds. I think the other is investors who probably have a somewhat higher risk appetite. For them, I think even small cap funds are recommended, because generally you buy them during these kinds of turmoil, are not with a near-term expectation of returns, but over a 2-year out, they typically end up doing better. And I think the market is still looking forward to a better earnings trajectory out of small caps over the next 2 years compared to what it has been over the last 15 odd months. And lastly, I think the one area that we have kind of been very positive about is been multi-asset allocation strategies. The case for which only becomes stronger and stronger by the day. So they lie in the middle of these two other opportunities. So investors who probably are wary of some of the circumstances today can look at, because asset class rotation is going to be an important consideration even going forward. It becomes even more important, and that is another area through which you can probably put money to work in a reasonably safe manner.
Tahir, great conversation as always. Thank you very much for joining in. Moving on now, the war in West Asia has now coming to the close of its 4th week now, and the ripple effects are being felt across various sectors. Real estate, construction costs, in fact, in Mumbai have risen by nearly 50 rupees per square feet, according to Anurag. There are supply disruptions, input prices are going up. We have with us Irfan Razak, CMD of Prestige Group, now joining in. Thank you very much, sir, for joining in. This is Reema here. We understand from the start of the conflict, in the last 1 month itself, we've seen property prices come down in the city of Bangalore. Is that true?
Morning, Reema. It's the other way around. Property prices cannot come down because all components, all the material costs are going up. And the only thing that can happen is if this doesn't settle down quickly, there'll be shortages, and all the components that go into construction, starting from steel, cement, tiles, all these prices will go up. Consequently, the price of the end product also will increase.
Okay. So prices have not gone down, that's clear.
Reema, Mr. Razak, good morning, Prashant here. And that's a problem, that's a tricky bit, right? Because it's not the shock is not one way. On one side, you've got an inflation shock, as you're pointing out, because cost of inputs have gone up. On the other side, there is going to be some amount of demand destruction in a lot of industries. And that kind of, unfortunately, feeds through into, eventually through, purchasing power for consumers in general. So it's on both sides. So that makes it even more tricky, Mr. Razak. Just your thoughts, sir. Or you don't think that is necessarily true? This is largely a inflation shock more than anything else.
No, the thing is, unlike any other commodity, real estate is a very rigid asset class, and the pricing really doesn't move in any manner up or down. The only question is that we always have to have an eye on the affordability, right? Like you rightly said. And I think the customer is also conscious of it, that in case they don't commit themselves, if they have a real need, and that need is always growing. The only thing is the product will become that much more unaffordable as we go along. So that way, I believe the business on ground has been quite good. In fact, last week we did a couple of launches in Bangalore, and that the demand was quite amazing, and the overall uptake was good. So that proved the point that in spite of what is happening, around the world, people are still buying and committing themselves to buy property and invest in a home for themselves.
So some more questions on this. You spoke about an increase in cost prices. Overall, what's been the increase in raw material costs for you and the overall cost inflation?
I see everything will slowly go up. You can't really put out a percentage that it's gone up so much, but only we have to hope and pray that it's only temporary. Obviously, we always, any construction projects, it's a 3 to 4 year span. And we pre-sell these projects, and in case there's too much of a cost increase, that goes and hits the bottom line. Today, yes, things like commodities, first of all, price has gone up. Secondly, very soon we'll be in short supply of simple things just like tiles because there's no gas. So, but then these are all, I believe, short-term phenomena. We do hope and pray will correct itself as we go along in the long term.
Have you reached out to RERA to push forward any deadlines?
I see nobody can set any deadline, but we are, as I said, ours always is a 3-4 year window for any construction project that you start on day one. So obviously, we do believe that in the long-term period, things should settle down and we go back to a similar inflation, the normal inflation, and not this abrupt inflation.
So, Mr. Razak, in short, you're saying that, yes, price hikes will be coming about, but input costs have gone up. But you believe demand will be strong enough to absorb some of these price increases. Would that be fair?
Demand is strong, but as I told you, Nigel, this price just can't go up too high, and then there will be resistance. So we have to be very conscious how we price our product, bring it to the market, at the same time, get the interest of the consumer.
Got it. All right. Now, because it's going to be a little bit tricky since the RBI will have limited headroom now and limited firepower to go ahead and cut rates as well, which otherwise could have provided a bit of a tailwind for a sector like real estate. That said, I think you had earlier guided for a booking figure of close to 25,000 crores. But the street was optimistic you can do even better. 30,000 crores would be a better number to work with?
It's only 3 days more for the financial year to end. I'm waiting with bated breath for my team what they're going to do. And I'm sure they have definitely crossed the 25K mark.
Yes.
And now where they end the year from, we'll know in about a week's time. And I do hope that they touch the number that you have told me. And I think they will. They should.
Mathematically, seems like it should be around 30,000 crores.
That maybe it's also, again, the last minute chase for approvals goes on.
Yes.
But there's a very large development in Hyderabad, which is to be launched this month. And if that happens, we'll go way past it. But if that doesn't happen, we'll be close to the number that you have told me.
All right, Mr. Razak, what about the NCR region? You have some exposure out there. How has demand been out there and how has pricing moved to there? Because that's normally the market that normally gets out of the blocks in style. But when it cools off, it does pull back sharply as well. So demand and pricing, what's been the latest in the NCR market?
NCR, we have one project which is going on full speed, which is the Prestige City Indirapuram, which has sold almost 90%. And customers have got into contracts and paying their installments. Construction is also going on at full speed. We have tied up a few properties subsequently in both in Gurgaon as well as in Noida, which should hit the market sometime, if not in the first quarter, at least in the second quarter of the coming financial year. And I'm sure if we've designed it sensibly, if we price it also sensibly, it'll meet a great demand and we'll get a similar response as we go along.
Mr. Razak, thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC TV 18. We'll take a break. We're back. Markets under pressure, rupee under pressure. More coming up on the other side. Okay, welcome back. Some market opinion, some macro opinion, which I think is much needed at a time like this. This is the CNBC TV 18 town hall from day before yesterday. Sajid Chenoy of JP Morgan says every $10 oil price increase leads to about 0.4 to 0.5% negative terms of trade shock. And he says, well, how it translates into a growth shock depends on who absorbs the shock. Interestingly, Sajid essentially went on to say that if the government absorbs it, it's negative because the fiscal impulse is negated to that degree. There was also Neelkanth Mishra of Access Capital who essentially talked about how the market will eventually decide the outcome of this war. Enough stress and the fighting will stop. Listen in.
Every $10 increase in crude prices is about a 0.4 to 0.5% of GDP adverse terms of trade shock. How much that translates into growth will depend on how much is borne by the public sector versus the private sector. Ironically and paradoxically, the more the public sector bears, the larger the hit to growth. If the fiscal deficit doesn't change because it's a one-for-one loss in other spending. Now, if there's an impact on a lack of availability, then for every $10 increase in price, the 50 basis points, you have to add that on. And therefore, it's so difficult to make an assessment so early in the process.
I think the financial markets will force everyone to stop fighting and bring down the problem, right? So the question for us now is if the fighting stops today and the Strait of Hormuz, say, opens, say, one month later, and I told you on the show 15, I'm still sticking to that if it doesn't open up by 15th of April, I think we're staring at a severe global recession. So I'm not too worried about capital flows, especially if it is for a period of a month. What's the point of having $700 billion of reserves?
Okay, let's talk about the rupee. That's hit a fresh low today, 94.3 against the dollar. Lata now joins in with her take on what's happened today in the morning.
Actually, reasons galore for the rupee to keep falling, or rather for the dollar to rise. First of all, the overnight, we didn't trade yesterday, and the last 48-hour comments have, almost erased that 5-day piece, which we went with on Wednesday when the markets closed. There was actually some jubilation on Wednesday because the MUFG investment also was coming in. The CCI clearance had come. But, that jubilation got wiped out over the last 24 hours with the many comments coming from Iran saying that they are not in any negotiation, and 10,000 soldiers, WSJ report saying 10,000 soldiers are headed towards the Middle East. All that giving the impression that, the de-escalation with which we went into the market in Wednesday has largely gotten erased. Plus, if you want, there are smaller reasons. The export duty on petro products has been raised by the government with good reason, so that more petrol is available within the country. But that also means lower export earnings. So clearly, where does the government's emphasis lie is very clear. At the moment, rupee is not the most important thing for them. The most important thing is that the consumers get what they need at a reasonable price. There is also, of course, a continued expectation that the current account deficit with each passing day is likely to be marked higher. Now, more economists are moving towards probably a current account deficit of 2% of GDP for next year. Many people were still at a 1 point something level. But with each passing day, those numbers also become, questionable. But immediately, the demand is coming from the, usual suspects, from importers, from foreign portfolio investors who are pulling out money, as well those who are hedging. Until now, there was the sacredness of 94. Once any such psychological level crosses, more people have to come in and hedge. So the demand generally goes up. What's our good old Reserve Bank doing? They're there in the market, dealers tell us, but they're not trying to defend a level. They're just supplying dollars at higher and higher levels where they see necessary. So that's the story in the rupee market. When I tried to ask for levels, there was one comment which came from a treasury guy saying it is a bottomless pit, which means at the moment there's no point trying to draw these lines. Just a word on the bond market. That is where the real problem is, because that's going to hit all of us. The government is now borrowing at nearly 7%, 6.94 as we speak. And that's, in step with all the bond yields. Look at Britain, the way the yields have gone up. This is a global phenomenon. And for us now, that fiscal excise duty cut was announced, which means another 0.3% of GDP coming in as fiscal deficit. All that explains the rise in bond yields.
Bond yields. Absolutely, Lata. Thank you very much. It's a pretty sharp analysis and take on what's happening with the currency and fixed income markets right now. Pranjal Bhandari is with us, Chief India Economist at HSBC. Pranjal, good morning. Great to have you with us here on the program. Thanks very much for joining us. It's always a pleasure. So it's a tricky spot, tough spot, whatever you want to call it. Have you brought down your growth expectations, Pranjal?
Yes, Prashant, thanks for having me. Never a dull moment. Even this morning, there's just sort of been like news, back to back. But yes, we all don't know where oil will end, for how long this will last. But if it peaked in March and say for the rest of the months, it gradually comes down. And for the year as a whole, it averages about $80 a barrel. My growth expectation would be about 6.3% for the year. And before this entire energy crisis, it was 7. So we have a 70 basis points cut if oil averages $80 a barrel. But in case it's worse, and say in the next 2-3 months, oil goes up to $140 a barrel, which is, by the way, where some of the Middle Eastern benchmarks are trading right now, and the average of the year is more like $100 a barrel, then I'm afraid I think growth would be lower than 6% in the 5.8% sort of ballpark. So yes, definitely a growth hit. But I really want to say something here that all of these are, sensitivities from previous episodes. But every episode is special because the burden sharing between public sector and the private sector is different. So far in this episode this year, we are putting all the burden in the public sector. First on the oil PSU companies, now in the government, with all the excise tax cut that we had this morning. This basically means that the private sector, the consumers, the retailers are not really facing that much pain, which sounds good, but on the whole, it's better if everybody faces a little bit of the pain because the overall growth hit is lower. So the news in the morning is putting extra burden on the government, which I'm not sure is optimal.
Yeah. No, and I think, so you're saying if oil averages $80, growth, you're penciling in 6.3%. You were at 7% earlier. If it's, of course, higher, then you're basically looking at below 6% real growth. That point is important because we had Sajid Pranjal with us on the town hall day before yesterday, and he said something very similar. He said, well, if it's the public sector which picks up the tab, then that directly impacts how much they're able to spend, and that is a bigger growth driver. And if there is a gradual pass-through to consumers, then, consumer behavior adjusts to higher prices. So far, we've not seen that. You're saying that will start to happen as well if this oil shock persists?
Well, that's a tough one after what's happened today morning, because they have not just cut the excise duty, but they've cut it quite drastically by 10 rupees a litre, which basically for now, under today's Brent prices, takes care of all of the losses that the oil PSUs were suffering. And at this point of time, there's honestly no need for them to increase pump prices by any meaningful number, by any significant number. So, once the state elections are over in April and they want to relook at this whole situation in May, and they think at that point of time, let's increase pump prices and let's also increase these excise taxes that we cut today, that is something they could consider. But it would be odd, right? Like, every month you have a different tax rate on excise. So I think the bar has become a bit higher for pump price increases in May. But I'm going to still bat for it because I think that's sort of the best, most optimal impact from policymakers we can have if they increase pump prices. So I'm going to still hold on that maybe they'll find a way and in May they will increase
post the elections. What about inflation, Pranjal? Have you bumped up your estimates there?
Yeah, absolutely. So when it's $80 a barrel, I'm calling for inflation at 4.5%. And earlier my forecast was 4, which is RBI's target. Now, 4.5 is not a very high number. And I do think that while this whole situation is a supply shock, it's inflationary, there are many things that are helping us on the inflation front. Firstly, the starting points. We had low inflation going into this event. That is always helpful. Second, we are a flexible inflation targeting economy. And yesterday, we actually reaffirmed our flexible inflation targets, and we're continuing with them. This basically tells you that when you have a supply shock like you have right now, it's all right if inflation goes up from 4% to almost as high as 6%. It's okay. You can live with this for a year. And that's the freedom which I think RBI can really play with this year, that even if inflation rises a little bit, but over a one-year horizon, you're under 6%, it doesn't really have to tighten aggressively. That's helping us on the inflation front as well. And the final thing is the new CPI series. The weight on food is lower, the weight on regulated pump prices is higher, but they're not being changed. So from that perspective, this food and fuel shock should hurt a little less than in the old series. So in a sense, inflation is not my number one worry. My number one worry is rupee.
Yeah, absolutely. And the current account deficit, Pranjul, right? What's the portfolio flows have been negative, and the situation right now does not help. So what about that? What are you penciling in?
Yeah, so look, the balance of payments has been negative for 2 years in a row. And I think this year is going to get even more negative because both capital inflows and the current account will not be working in favor of you. So I think that is one problem. The second problem is a slight shift in the reaction function of RBI, which I sensed somewhere in the middle of last week. I think until the middle of last week, they were intervening very heavily and very actively. But somewhere they have sort of reduced it a notch. And I think that's when the rupee depreciation has picked up. And we are now in line with the Asian average in terms of rupee depreciation. Before Wednesday last week, we were actually outperformers. So I think it's a good step by the RBI to step back a little bit and let the rupee find its market value. So I think that's also something that is, contributing to the depreciation in the rupee. But having said all of that, this is a global shock. It's not like 2013 when India was an outlier. So it's all right if our currency depreciates, as long as it's happening in a sort of, gradual way. We can intervene a little bit, but it's okay if the currency depreciates.
All right. Pranjul had more questions, but on the clock and the clock's run out. Thank you very much for joining us and hope you come back because this is a very dynamic, fluid situation. As you said, never a dull day, never a dull moment. Appreciate your time here on CNBC TV 18. We've got the next management as real estate in focus once again. I think Brigade's Pavitra is with us. Nigel, take it away.
Well, that's right. We welcome on the show Pavitra Shankar, the Managing Director at Brigade Enterprises. Hi, Pavitra. Good morning. Thanks a lot for waiting by. Well, before we get to your launch, just a quick word with regard to how are you all dealing with the input cost spike as well as the availability? Have you all faced any kind of issues?
Hi, morning. We are waiting to see how the situation develops. Naturally, we've definitely heard from various suppliers that they are experiencing these shocks, especially on the tiles due to the closure of specifically Morbi in Gujarat. We've already heard about that. Definitely, we are expecting to see some of these costs increase, especially as the conflict continues to prolong. So the sooner it ends, it might be, a short-term kind of blip, but the longer it is, I think there will be a prolonged, sort of impact and therefore elevated prices for some time. But that said, we're yet to see how this all pans out. I think it's too early for us to say how much, in which project, etc. So there are some projects where contracts already closed, so that may not impact too much. There we might have supply shocks and, from a time frame perspective instead.
All right, Pavitra, tell us about this foray into industrial real estate. What are the plans out here? What could the booking numbers look like? If you want to give it to us in volume terms as well.
So in terms of traditional bookings per se, it's going to be run a pretty different way. I would liken it to a bit like, I mean, there's no real sort of benchmark to show it against, but it's basically a project where we've launched construction and started construction, and we'll be looking at tenants to take up the space, potentially some tenants to buy some of the space. So we're still evaluating. It's a very niche kind of space. So we're not approaching it in the traditional manner of trying to, show bookings immediately. The project itself is located in a fantastic area. It's part of the aerospace park, in Bangalore, and it's surrounded by a number of companies in the aerospace field and other light industrial kind of activity. So this is where it's we are catering to this tenant base and occupier base, as well as the project will also potentially have a hotel and an office. So it's like a mixed-use industrial park that we're very excited to launch and look at how this kind of new niche segment will also do in cities like Bangalore.
Yeah. Over what period are you looking to develop this entire, industrial park? Is this a 3-year, 4-year, 5-year exercise? What is the investment you're planning? How will you fund it? And what is the overall return potential?
So in terms of the time frame, the construction time frame will take about 3 years or so. It's a little simpler in terms of it's not as complicated as, say, a residential development, but it is development that is enabling some heavy equipment, etc. So there is more in terms of the structural load, etc., that we need to plan for. The overall township, I think on the industrial side, we will be launching it phases. So given all of the phasing, I think 3 to 4 years for the industrial phase, we'll be funding it from our internal accruals and potentially, if required, construction financing based on how we see the appetite for monetization as well.
Pavitra, given that input costs are likely to go up, and as you all take some periodic price increases, on a blended basis, what could the price hike be in the vicinity, say in the next 3-6 months or thereabouts?
Yeah, I'd say it's different for different kind of projects. There are many projects where we've sold a substantial amount already. So we're fairly locked in, and any kind of price increase on the remaining inventory won't necessarily make a huge impact in terms of margins. And we'd also be looking at overall demand and trying to balance those two things. In terms of the newer projects where we're yet to launch, or in terms of projects where we're underwriting, we're definitely looking at that a lot more intensely in terms of what kind of contingencies we need to budget for from a costing standpoint. If I just look at our projects where we've already launched on a like-to-like basis, we've been pricing in more of a single-digit price increase, which is something I've been indicating towards for a long, for maybe the last year or so.
Yes.
Because a lot of the substantial price increases that we've seen from 2022, those double-digit increases have led to sharp increase in pricing overall. And I think going forward, it was more likely that we would see single-digit price increases. Now we do need to see how to balance that along with the demand picture and the consumer sentiment. So it makes for interesting times.
All right, final question, 15 to 20% booking growth guidance. Do you stick to that for FY26?
Well, actually, after Q3, we were indicating that there is a significant, dependency on new launches coming in. We had guided for maybe another 4 million square feet to be launched this financial year. The happy news is we did get those launches, but the timing has been sort of not ideal. We've just got those RERAs in the past week. So we're doing what we can to, reflect that as much as possible. But it looks like some of the guidance on the booking value will definitely get right shifted into the next financial quarter.
Okay, very quickly, one question. Other than the tile issue at Morbi, is construction getting affected due to any other shortages for the industry?
Definitely. I mean, the oil price increase is impacting multiple things, definitely on the logistical side in terms of petrochemical inputs, on copper, aluminum, UPVC, cement, potentially at some point. So naturally, anything where there is like an impact on oil and diesel and fuel prices, that does have an impact to varying extents for raw materials as well. And we're pretty downstream. So, everyone else sort of trying to manage their costs will have an impact on us as well.
Yeah, absolutely. Thank you very much, Pavitra. Good speaking with you. It's always a pleasure getting that perspective, and we all hope this winds down soon. Thank you. Time for a break. We're back. Manisha Gupta with Commodity Focus on the other side. Stay tuned. Welcome back. Well, we're shifting focus to the commodity space. Manisha is here with a focus on not oil, but gold. Manisha, money.
Well, yes, because gold clearly hasn't been performing the way the markets expected to. So currently we are holding around $4,400 an ounce. It has been a near 3% of a decline for the gold prices in the overnight market. And with that, we've turned negative for the gold prices for this week. This is going to be a fifth straight week that you're looking at a negative week continuing for gold prices. Since West Asia war, we are down by 15%. But when you look at the last 12 months, gold price is still holding 50% on the higher side. So it clearly has been mixed when you look at the short-term and the long-term scenario coming in for the gold prices there. Now, there are various reports and unconfirmed ones really, but data shows that some central banks now seem to be selling gold. Turkey, which is the 11th largest gold holder, has perhaps sold gold into the market in last couple of weeks. So when you look at that breakdown, in last 2 weeks, it has sold nearly 60 tons of gold and likely sold gold valued at more than almost $8 billion there in 2 weeks since war. This is as per various reports coming in from Bloomberg and other agencies as well. And Turkey perhaps is not the only one. We do know that the Central Bank of Russia has been selling gold in 2026. They started doing that in 2025, by the way, to get to cash or to swap reserves, etc. So when you look at Russia, it is the fifth largest central bank gold holder in the global markets there. The third one that should come in on your screen is Bank of Poland. Now, there have been various official statements coming in from the central bank that they're looking to tap unrealized profit from huge gold accumulation that they have seen. Poland also is the largest gold central bank in the last 3 years that you have seen. Also, gold sales perhaps would help fund the government defense spend and they would have to borrow from various European schemes is another reason that Poland perhaps is coming into the market to sell gold. Also, when you look at the overall data, it does show that the largest gold buyers in 2025 clearly have been Poland. In last 3 years, we've seen constant buying coming in from Poland, which wants to now sell gold. So in 2025, 102 tons was bought by Poland, Kazakhstan 57 tons. You have Azerbaijan buying nearly 53 tons there, and Turkey at 25 tons. So when you look at 2026, the first quarter itself, Poland, Kazakhstan and Turkey are looking to sell gold as well. These are the countries that bought most gold in 2025 therein. Also, when you look at the central bank gold buying in 2026 in the month of Jan, we just saw just about 5 tons of gold buying. When you look at all of 2025, every month an average of 27 tons of gold was being bought. And we've seen record numbers actually in 2022, 23 and 24 from central banks as well, when they bought more than 1,000 tons of gold. Last year was 863 tons, so a bit of a decline there. And the first quarter of 2026 perhaps could see further decline as well, because January is just about 5 tons. And in the month of March, we're looking at many of these central banks actually selling gold and not buying gold. These are the gold reserves that various central banks hold. US is the biggest by far at 8,100 tons. Then you have Germany, Italy, France. So when you look at the overall numbers, it really is between US and Europe. These central banks hold the largest amount of gold there. And then you would also look at Switzerland, which is holding stronger golds. China holds nearly 2,000 tons as well. And then you have Switzerland at 1,000 and then India at 880 tons. India actually has been a strong buyer in 2023 and 24, not so much in 25 and 26. We believe that number is next to negligible. Finally, I want to show you what the gold prices have done in 2026 till time. So we started this year with $43.30 an ounce. We saw an all-time high in the month of Jan itself at $56.08 and currently trading at $4,400 an ounce. So on a month-on-month, week-on-week basis, we may be in the negative, but YTD is still positive, and year-on-year, the last 12 months, clearly 50% on the higher side.
All right. Manisha, thank you very much for that. I just want to quickly highlight what's happening with Muthoot and Manappuram, if we can. Because they saw rebounds day before yesterday, the last trading session, as gold and silver, after sharply correcting, had come up. But if you look at, as Manisha pointed out, the last 2 days, there has been some more liquidation, which has happened. Silver is at about under 70, gold's, of course, corrected as well. So there's gold financiers up on your screen right now. It's interesting, right? And I was saying this earlier, don't read this excise cut as a signal for investors. This is help. That's it. It's an oil shock, it's a rupee shock, and this is help. So look at oil marketing companies. They're all in the red now. IOC, HP, BP are sideways to slightly lower. I mean, when the war winds down and stocks perhaps should do well, and a lot of these emergency measures, and these are emergency measures. I mean, the government's not going to let go of excise duty revenue. It's substantial for the government. It's doing so because it wants to shield consumers at the pump from paying more, because oil marketing companies would have had no option but to pass this on. So the government's saying, well, don't do that for now. So, so in that sense, it's a temporary measure, and when that's reversed, oil marketing companies, a lot of these measures will be reversed whenever this war winds down. So companies will do well. But I mean, the impulse to go and buy, because this should be read as great or positive news for oil marketing companies. As I was saying, that's not the way to read this. And markets reflecting that reality, with stocks being sideways to off the highs as well. We'll take a quick commercial break here. We'll come back. Lata will be in conversation with the MD and CEO of IDFC First Bank on the Haryana fraud and the outlook for the next financial year. So that's V. Vaidyanathan of IDFC First with Lata in just a bit.
Welcome back. This is a corporate radar special, and my guest is the Managing Director and CEO of IDFC First Bank, Mr. V. Vaidyanathan. So Vaidyanathan, thank you very much for your time. Well, the urgency to speak with you was just to get, what is the latest on the Haryana fraud case, and how you are going to account for that, 600 odd crore that you have paid the government.
The answer is simple for that one. As you know, our bank doesn't postpone anything. So this amount, we'll take it to the profit and loss of this quarter.
This quarter itself?
Yeah.
So it might be a loss this quarter?
Might not be. Okay. Actually, we expect to be profitable, because what is happening is that, fortunately, the microfinance incident is behind us, and the credit costs are coming down. Margins are looking good. So the core profitability of the bank this quarter is quite strong. So we will be able to absorb it and still be profitable.
That's very good to hear. Now, just to complete this fraud issue, I don't want to dwell too much on it. The two other banks, AU Small Finance, along with your incident itself, and now Kotak Bank. And the chatter in banking circles is that a few more banks may also be in this issue. So it looks like a Haryana government problem. won't you all approach the RBI or the Ministry of Finance or the government of Haryana to clean it up generally? It looks like a banking sector problem than an IDFC issue.
No, it is, of course, we hear these names, and I don't know beyond these three names what other names are coming about. But basically, it is a situation where a set of employees of, in our case, our bank, I can talk about our bank, and obviously, it appears that people from the other side as well, as coming from the arrests that have been made by the Haryana government or the ACB. So they have probably colluded to clear a forged check, or forge a check and get it cleared through our bank, and the money has gone to certain beneficiaries. That's the nub of it. Frankly, many agencies are involved in it, in investigating this.
No, the other banks are resisting paying, saying that the fraud is on the other side. You did not think of, why should I pay up first? Let us get the whole thing cleared since other banks are involved.
In the investor call that we did on Monday morning, this issue came to light on Saturday. On Monday, we did an investor call. One of the questions asked by one of the investors was exactly this. Our answer was that, look, we want to be straightforward about this. It is pretty clear to us that our employees are involved. Now, we don't want to hide under investigation, this, that, etc. And we just wanted to pay. It keeps it clean. We now are together with the other government to go after perpetrators. Else we will be discussing with each other who has how much liability.
Fair enough.
And also it's a good customer trust. You have left money, you meaning the government, has left money with me trust. You have a issue happened our end, we pay for it. That's a model.
Fair enough, but I somehow have a feeling that this is going to be a banking sector issue, but we'll come, we will see it when it happens. We want more about IDFC Bank in this conversation. Will this war and the fact that gas is not available, etc., lead to some fall in your bank loan growth? Because your loan growth was stellar in the first 9 months.
So before we come to that, Lata, one thing for the benefit of viewers we must add about this incident itself. A bank has a maker, it has a checker, it has authorizer, it has SMS alerts that goes to customers, a statement of account goes to customer, balance certification, everything goes, everything works. This is a collusion. So one thing I want to point out is that now we have put some extra controls to address for collusion risks, which means that we are not allowing the branch to clear checks anymore beyond a particular limit. There was a limit, now we're cutting the limit, and we're bringing it to a central level. So I want to tell you that there's an extra level of control we brought here, so that collusion doesn't happen again. In our lifetime, they should not happen.
So that is the learning from the event, that you will not allow it to happen again.
Above vertical cutoff, it goes to a central level, so a scanned image process. And also specifically for government institutions, we will ensure that there is a proper email from the customer to accompany the check. I'm also happy to share, to the extent it is relevant to the viewers, that we have confirmed, or we have written to all the government departments across the country, and we have got no other dispute from any other government. I'm just happy to hear that.
Okay, that's very good to hear. What was the limit earlier, and what have you raised?
We don't share limits, because then fraudsters also get to know the limits.
Okay, fine. So let me come to the war issue, and the fact that there's no availability of gas, ceramic industry and plastics industry are all suffering some shortages. Do you see loan growth being impacted?
See, we have been growing, like you said, at 20% for the last 3 years.
Even more.
Even more. So that was, in the first 3 years, we did not grow for other reasons, because we had liability side issues, but now growing at 20. Our own sense is that we should watch this very carefully. We do not want to program the bank to say we will necessarily grow at 20. Okay. We will have to watch the markets, like how in a cricket pitch, depending on the condition of the wicket and how the balls are coming at us. But chances are, at this point of time, there is no material damage to the ecosystem or economy. At this point of time, we are still growing in that zone like the 1920. But we'll watch by time Q3, Q4. If the conditions change, we'll play differently.
Yeah, your SME 0+1 and your NPAs have all been falling. The last quarter, the 9-month numbers were very good. Do you think this can disturb asset quality?
In this quarter, certainly no. I told you that I'm actually expecting a good quarter. And frankly, as things are laid out, we feel next quarters our credit cost will be even lesser. We are traditionally used to having about 2% credit cost on a yield of 13.5% or a NIM of, let me call it 5.7%. At least next year, we're expecting credit cost to come down because microfinance is issues behind us.
Okay. Oh, microfinance. The government has announced a guarantee scheme. Won't that help you? I mean, in any way?
You know, we are lenders to microfinance industry or
NBFC MFIs.
Anyway. So, by the way, it's a welcome thing because it gives more confidence for the entire industry. But
it doesn't change your numbers.
It doesn't change the numbers materially because we are anyway lenders to that segment. But good to know that the sector will get that much more comfort from the whole ecosystem gives comfort to us as well.
One more immediate question before I come to the medium term. I've been looking at the deposit rates. I mean, everybody is offering 7.5 large banks like SBI. Will that mean that NIMs will have one more quarter of pressure?
Not in this quarter, because in this quarter, we have, despite this crisis, really good news, Lata, is that our deposits are intact. Imagine 8 million customers staying steady with the deposit. That's good. So coming back to your question. So
no, I mean in cost of funds.
I'm coming to that. So therefore, since the deposits are intact, we have not raised money at some exorbitant price in the market. Nothing like 8% and all. We don't even go close to those numbers. I know some institutions have raised that money. We don't raise those monies. We expect this quarter's margin to, of course, be in our zone of guidance, whatever we said at that point of time, 5.8, 5.85 kind of rates. But next year, it would be safe to assume that like 5.7-ish kind of rate is what we should expect as far as our eyes can see today.
Okay. All right. Those were the immediate questions. My more medium-term question is that, you know, I appreciate the fact that it was a Capital First and NBFC which took over another large asset book without retail liabilities. Yeah. But, you know, the point is you'll have been in that investment mode, and that is why your cost to income is, you know, 70% plus. At what point will this investment phase end and you will start, you know, giving investors return on investment?
Okay, short answer is that next year itself. Okay. So by FY27, you should expect, and you anyway interview me every quarter, and you grill me hard. So you should expect that Q1 to Q1 you should see material improvement. Q2 to Q2 you will see improvement, and let me say this year is going to be 27 will be a breakthrough year, is what we expect.
What about ROA itself? I mean, the benchmark of a good bank is of a strong bank is ROA of 1% and above. When do you get there? So
you should understand the breakup for that. So today our return on assets, we have two sides, right? We have a lending side and a deposit side. Lending side, our ROA is very good. In fact, next year we expect our lending side return on assets to be like 1.5% or so. Lending side, because obviously we're borrowing money at 6%, lending at 13, our credit cost is 2%. It's you know, that's a spread of 7%. Credit cost of 2%. So net of spread, you're making a lot of money. So lending makes a lot of money for the bank, net of credit cost. Okay, but the bank is investing it in deposits and branches and ATMs. Lata, let me point out to you, this bank, because for the reason we discussed, did not have any PSL franchise.
Yes.
40% has to be given to priority sector. We had no priority sector franchise.
No, so I agree. Your early years were tough.
So in the last 7 years, we had to build
deposits and priority
40% priority sector, deposits, CASA was 10%, now it is 50%. So all this took investments. So I believe that from this year onwards, i.e. in 27 onwards, we will be here, you are on the channel, I am on the channel, you will see that 27 will be a breakout year.
So ROA at 1, by when? For the whole bank? I mean, I know in lending side you already are.
In lending we're making money, deposit we are investing. But on an overall sense, we should be by fourth quarter of next year, we should be in kissing distance.
Okay, so, that's a very big promise. We will hold you to that.
Yeah, we should be, you should hold us, we should be in kissing distance, we're getting there. And imagine, Lata, we should not forget, it came from 0.
Yes.
So when people are disappointed at 0.5, I agree we're 0.5 today, it's not great. But you should know it's coming from 0, right? So from a 0 to a 0.5 to 1, it's a direction. And I think we are getting there. I do believe, except for this one incident that has happened in our lives, I think the first bad incident that has happened in the last 7 years of our microfinance also happened, but that was a industry.
That was an industry issue.
It was an industry thing. But in our lifetime under this 7 years, it's probably the first one. I'm not happy about it. We should go seriously after it. But numbers next year, you should expect the bank to do well.
Okay, that's very good news. Thank you very much, Mr. Vaidyanathan, for joining us, and let us hope that you will be within handshake distance of that 1% ROE.
Thank you. But I was to take this opportunity, Lata, since you've given me this opportunity to even share with everyone that the incident, I am assuming that when our Q4 results come, Q1 results come, Q2 results come, will be a forgotten thing. But the franchise is strong, the customer proposition is great, the brand is very good, experience is good. So there is something fundamentally good. We have 40 million customers. It's not small, right, across. So we have a good franchise. People should have confidence and just watch the next year. Things will get better.
All the very best. Thank you for joining us.
Thank you, Lata.
That's it on this edition of Corporate Radar. Thanks for watching. After a break, Chartbusters.
Deepening energy risks from West Asia. War drags the rupee to a record low. Market 2 opens with a deep cut following 2 solid sessions this week. Autos, PSU banks, worst hit.
India cuts excise duty on petrol from 13 rupees to 3 rupees per litre and scraps it on diesel. Oil Minister Hardeep Singh Puri puts the move into perspective, says the government decided to pass the burden of lofty prices to customers, move a sentiment positive for OMCs on account of reduced cost burden and improved cash flows.
Depreciating rupee triggers an upmove in IT stocks. Additionally, IT bellwether Infosys has also expanded presence in the healthcare and insurance space. making 2 acquisitions for nearly $560 million.
Brigade Enterprises launches premium residential projects in Bengaluru. Company cumulatively eyes a revenue potential of around 1,800 crore rupees. The stock outperforms in an otherwise weak market.
US-based industrial leader Graphite hikes graphite electrode prices by about 600 rupees to 1,200 rupees dollars per ton. And price hikes are in response to lower prices over the last few years, coupled with rising raw material costs amid the West Asia war. Shares of Graphite India and HEG higher amid weakness.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And as you can see, the markets are down. Friday morning has started off as a bit of a freaky one. The hope is that we see some kind of stability that's coming in there. But the Nifty Bank, that's the one that's taking the harder knock, Mangalam.
That's right, Nigel. You know, holding on to the 23,000 mark by the skin of its teeth will be very interesting to see whether it supports or not. All those put writers at 23,100, 23,200, 23,000 would come under pressure, be caught on the wrong side ahead of expiry if that happens. But all of that is predicated on how the rupee performs from here on. It's hit a fresh record low of 94.3 per dollar versus Wednesday's close of 93.98, even as the 10-year government bond yield rose 7 basis points to hit 6.94%. Lata joins in with more. Lata, it was imminent that the rupee weakened, but now it's crossing all record low levels.
Absolutely. There are reasons all over the place why the rupee should have weakened. When we went to bed on Wednesday, the expectation was that the 5-day pause announced by President Trump would hold. Now, after 24 hours, it looks very, very bleak with statements from Iran and the fact that probably 10,000 soldiers are headed from the United States to West Asia, all giving an impression that, things are going to, the de-escalation we hope for is not there. In addition, the way the union government has reacted in terms of, putting duties on petro-product exports like petrol clearly indicates they are worried about the consumer first. It will mean lower dollar inflows in terms of lower exports. But that's clearly a policy preference, and that's not lost on the market. Of course, there's going to be a higher, current account and trade deficit as the war prolongs. That also is getting into the calculation. There is a psychological mark. Once 94 crosses, people who are otherwise sitting expecting that level will hold will now jump in and start buying hedges. So there is an all-round reason why people are buying dollars and rupees under pressure. Yes, the Reserve Bank is there, but they're not trying to protect the level. They're supplying dollars at higher and higher levels, is what dealers tell us. When I ask them, what's the level you're looking at? A bottomless pit was the answer. Clearly, no one is willing to draw a line. But I want to emphasize that the bond market is in bigger trouble because it impacts the citizenry more closely. It's a double whammy for them. First, of course, higher inflation. First step, the government has taken the hit on the fiscal deficit. That cut in excise duty on petrol and diesel is going to mean about 1.3 to 1.5 trillion rupees of revenue loss. That's about 0.3% of GDP in terms of fiscal deficit increase. But the next step will be to increase consumer prices. Already consumer prices of several things like tiles and cement and steel have gone up because these guys are importing their raw material at a higher rupee level. So inflation is seeping in regardless. At some point in time, it will hit the pump price as well. So that's why nobody wants to buy bonds. The other big reason, bonds, banks usually will buy. For them, March 31 is the mark-to-market date. That's another reason why no one wants to hold bonds. And of course, they will have to up interest rates where it is not tied to the repo or something like that. There is no reason why bond yields should not go up. 7% on the 10-year seems round the corner.
Right, Lata.
All right, thanks a lot for that, Lata. Well, to discuss the rupee weakness, we're now joined by Dheeraj Nim, the economist, forex strategist at ANZ Research. Hi, Dheeraj. Good morning and good to see you win. Not such a good morning for the Indian rupee, but given the kind of news flow, one was expecting the rupee to actually weaken. What is your analysis on it? Clearly we're in for challenging times because inflation is likely to remain elevated. The yields are hardening as well. And now the deficit number is going to be just expand a little bit because the government has chose to take the hit. Where do you see the rupee headed?
Look, I think at the moment, the rupee is tracking along an adverse scenario as are oil prices. And I don't really think that the adjustment is over. I think if oil prices remain where they are, and mind you, India's crude basket is much more expensive at the moment than the Brent crude. We could be looking at rupee at 95 or even weaker if the pressures persist and the conflict in the Middle East drags on. I mean, the headlines coming from the scenario are, of course, very murky to gauge any definitive signal. I would hazard a guess that rupee could be in for more weakness in the coming weeks if things do not alleviate.
But don't you think the RBI at some point of time will have to come in there, or do they have any kind of ammunition, some kind of measures that they could introduce? Because otherwise, we're getting into a free fall kind of scenario. One thought that 92, 93 would be okay. Now we're already at around 94. And going by the cues, you won't be surprised if we see a couple of more percentage point, depreciation on the rupee. Better for the RBI to let it flow, let it run its course, or do you think they come in there and they intervene at some point of time?
Look, ideally, from a macro policy perspective, in events like this, where the scale of the oil price shock is so large, the exchange rate has to play its part as a shock absorber. And thankfully, the Reserve Bank of India is letting it do that, because otherwise it just means an inessential drain on certain resources, including the FX reserves. I do not mean to say that the Reserve Bank of India does not have sufficient FX reserves to deal with the situation, but I do think they're quite prudently choosing to intervene when necessary to smooth out the volatility instead of defending any particular level aggressively. But also, it is worth noting that the events of the recent week, including the sell-off in the gold prices, etc., has meant that there are valuation losses on the Reserve Bank of India's FX reserves, and the forward book remains very strained. And some estimates suggest it could be close to about $100 billion. So this obviously limits or curtails the capability of the central bank and also its willingness to sort of defend any particular level of the exchange rate. I think the Reserve Bank of India's slightly hands-off approach to let the currency weather this shock will continue. But of course, they would not like to see any wild or violent moves which are extremely volatile.
Take that point, Dheeraj. Do you track the bond markets as well? And Lata said that 7% is imminent on the current 10-year. Do you think that's a possibility?
Oh, very much so. I think, there were fiscal concerns even before we headed into the oil price shock. And this would essentially be a drain of fiscal resources, even after reallocation from the capital expenditure account to all of these items that we're talking about. I think that the fiscal stress could continue and yields could continue to head higher.
So does that mean at some point there would be a revision of the government's fiscal deficit target of 4.3% as well by a couple of basis points?
Look, at the moment, we are not projecting it to be so, only highlighting the risk of it. So far, we have seen an excise duty cut, a very mild increase in, the cooking gas prices. But I think if the shock continues, more can be expected. So, of course, the risks of a fiscal slippage will increase. And this is on top of the fact that, the nominal GDP under the new GDP series will be actually smaller than the government was predicting anyway. So, the compounded fiscal risk can actually play out if oil prices stay where they are.
Okay, all right. What kind of numbers are you working with in terms of growth? Now, that will be scaled back a little bit. If you've done any kind of scenario analysis, crude at 80, at $100 per barrel, what's the likely growth likely to be?
Look, our most recent forecasts were predicated on the assumption that after the initial shock, the oil prices will average close to $85 a barrel for the rest of the FY27, on the back of which we had deducted about 30 basis points from our growth forecast to bring it down to 6.7%. As I said earlier, things are tracking along an adverse scenario, and I think that growth could be lower in such a situation. But I do think we need to be slightly more mindful of other macro numbers, including inflation, which I think is rebounding faster in the new CPI series. And so far, we have not seen a hit to pump oil prices, but that's just only one aspect of it. As Lata mentioned, input prices have surged. We have seen that in the PMI data that came for March. And so far, producers are more or less absorbing those costs into their profit margins, but that cannot be a strategy ad infinitum. And if this continues, at some point, we could see the broader price pressures in the economy to start rising.
All right, take that point, Dheeraj. Thank you so much for stopping by and giving us this perspective. A grim picture, but that's exactly what is playing out on the street as well as we speak. The Nifty is broken that 23,000 mark, on the verge of breaking it significantly. Currently just below that, hovering around 22,999 and 23,000 itself. But there are a barrage of triggers for the market, and oil continues to be one of them. With a view to address the volatility in domestic fuel prices, the centre has slashed the excise levy on petrol, scrapped it on diesel. Earlier today, we caught up with M.K. Surana, the former chairman and MD of HPCL, to understand what he makes of the move and the impact of that on prices going forward.
It depends. Unlikely, because in the past it doesn't happen like that. So, and one more thing is that the total under recovery may be much higher right now. So, I think it's unlikely that the pump prices will change. The fact remains that when the crude prices are running like $100, $100+, and so there will be under recovery right now, because the oil prices of the pump prices are the same since last 4 years almost. So under recovery will be there right now without doubt, and it will definitely help the oil companies.
All right, time to slip into a short break. Come back, we'll continue our focus on markets as well as on stock-specific action. Stay with us.
Well, the market's now considerably below that 23,000 mark, and it has led lower by index heavies. HDFC Bank, the intraday chart of that one comes up for you. It's at the low point of trade after having seen some bit of a recovery over the last couple of trading sessions. It's come back to selling ways, so 760 on HDFC Bank. ITC is the other one which has slipped to the day's low, was a decent gainer in the last couple of trading sessions along with the market as well. And we have Reliance as well, the big boy at the low point of trade. So we're seeing selling across the board right now. The Nifty's cut has extended to 325 points, with the Nifty Bank as well as the other indices down almost in 4 digits for all of them. With that, let's get you some ideas for profit, capital protection from our colleagues at Money Control Pro. Today we have Varsha Bang joining in with the stock that she's tracking.
We are talking about J&J Electronics. which is riding a very interesting shift in market right now. The business itself is quite simple. They procure laptops and desktops from the global distributors, refurbish them, sell them at a lower price under their own brand name, Electronic Bazar. Now what's really working in their favor is sharp increase in memory prices because of strong AI demand and supply constraint. RAM cost has moved up, making new laptops more expensive. That increases the gap between new and refurbished devices. And that's where the GNG gets more benefit. This is clearly visible in the last quarter, where revenue growth has been strong, margins are improving, and volumes are steady. So it's not just pricing, demand is holding up well. They have also built a strong scale with refurbishment centers in India, UAE and US, along with strong global sourcing network. Now on the West Asia situation, there could be some impact on logistic and shipping cost, but in uncertain times, companies tend to focus on saving cost, which actually supports demand for refurbished devices. So overall, things are looking positive for GNG with strong demand and steady execution likely to keep the momentum going.
Thanks a lot for that, Varsha. Well, let's focus on the graphite electrode players. You have Graphite India as well as HEG. Both of them are higher in trade. In fact, they're outperforming. The reason is the big boy Graphitech. Overnight, they went ahead and they announced price increases from the tune of around $600 per ton to around $1,200 per ton. Remember, Graphitech, if you look at their total market share, ex of China, it's roughly around 25 to around 30%, very, very roughly. So when the big boy Graphitech goes ahead and increases prices, it gives reason for some of the domestic players as well, like HEG as well as Graphite India, to go ahead and increase prices. So what do you track from here on? The quantum of the price increases that both these two graphite electrode makers will take, point number one. Point number two is how much of this price increase is because input costs have gone up. Needle coke prices or the freight cost as well, how much have that gone up? And in turn, how much of this price increase will actually flow down to the margin? So we'll wait for further clarity on that front. But after a very, very long time, we are seeing a big price increase being pushed through. Acceptance of this, the quantum of acceptance is something that we'll have to track, and we'll have to see what do HEG as well as Graphite India do from here on. But the management of HEG will join us at some point of time in April. Maybe we can get further clarity on that front. For the time being, both those two stocks are rejoicing in trade.
All right, Nigel, thanks a lot for that. Meanwhile, just looking at a couple of other stocks which are also doing well in an otherwise wobbly market. Piramal Pharma has moved to the high point of trade, so good up move is what we're seeing out there. And from the frontline end, some bit of capital moving towards safer assets like FMCG. So we have Nestle too, which has recovered about 1.5% from the lows and currently at the high point of trade, whatever that means, but marginally in the green. And that's what Nestle is. We take a short break, come back, get you more on the markets and a lot of stock-specific action. Stay with us.
Welcome back. You're tuned into Chartbusters. You're on CNBC TV 18. We'll get you some global opinion then. While speaking of CNBC TV 18 Town Hall, BlackRock's Ben Powell says that the situation in West Asia remains quite alarming. And we had Larry Ritz Consulting's Art Berman saying that there will be a $10 permanent risk premium on oil. Let's listen in to what both of them had to say.
On the ground, I live in Abu Dhabi. The drone strikes have continued, the missiles have continued, and the Marines, the US Marines, I believe, arrive later this week. So I think the situation is frankly still very tense. The facts on the ground are mostly unchanged. Indeed, it feels more of an escalation in the last week than a de-escalation. So I recognize President Trump's words. Of course, I'm watching with huge interest, both as a citizen of the UAE and as a markets professional. But I think we need to be careful from being too confident and too optimistic, because sadly, as I say, the facts on the ground continue to be, frankly, quite alarming, and there is the potential for this to continue and worsen as these attacks on the physical infrastructure. Just overnight, we've had an attack on the Kuwaiti airports, one of the fuel depots kind of struck there. So I recognize President Trump's words, very important. He's the most powerful man in the world, but the facts on the ground continue to be unsettling, and that has not changed in the last 24, 48 hours.
I see no de-escalation. I see more potential for escalation. I think that the words from President Trump are purely performative. It's very difficult to have your negotiating partner take you seriously when you're moving, combat units into the area. There will now be a permanent risk premium on oil, regardless of how this thing ends. And I would say that premium is no less than $10 per barrel. And so if everything ends tomorrow, the very best case we can get back to is maybe $80 Brent. Now, I don't believe that everything's going to end tomorrow or that we're going to get back to $80 anytime soon.
All right, and right now the market's deepening its cut. We have seen the Nifty down to around 22,950. So that's a significant cut from the time when we started the show. And all through today's trading session so far, at every smidge of a recovery, we've seen the market sell off with a lot more volumes. India VIX is higher, and now the culprit is the IT pack. So the IT index comes up for you. It had been resilient, it had been doing well, but from highs, we've seen some sell-off. So pull up something like a TCS, pull up Tech Mahindra, which has moved lower, and Infosys as well has currently now moved into the red at the low point of trade, down about 1.5% from the high. So that's the one that is impacting the market and accelerating its sell-off closer to that 22,950 mark right now. But amidst this West Asia war, we're getting you some more market and macro opinion. Speaking at the CNBC TV 18 town hall, Sajid Janoy of JP Morgan says that every $10 oil shock is 0.4 to 0.5% negative in terms of trade shock. How it translates to growth depends on who absorbs the shock, whereas Neelkant Mishra of Axis Capital says the financial market stress will force everyone to stop fighting.
Every $10 increase in crude prices is about a 0.4 to 0.5% of GDP adverse terms of trade shock. How much that translates into growth will depend on how much is borne by the public sector versus the private sector. Ironically and paradoxically, the more the public sector bears, the larger the hit to growth if the fiscal deficit doesn't change, because it's a one-for-one loss in other spending. Now, if there's an impact on a lack of availability, then for every $10 increase in price, the 50 basis points, you have to add that on. And therefore, it's so difficult to make an assessment so early in the process.
I think the financial markets will force everyone to stop fighting and bring down the problem, right? So the question for us now is, if the fighting stops today and the Strait of Hormuz, say, opens, say, one month later, and I told you on the show 15, I'm still sticking to that if it doesn't open up by 15th of April, I think we're staring at a severe global recession. So I'm not too worried about capital flows, especially if it is for a period of a month. What's the point of having $700 billion of reserves?
All right, we take that point. Thanks a lot for watching us here on Chartbusters. The market's still a deep shade of red. What we'll do is take your leave and leave it to the team of Trading Guard, which comes up after this short break. Thank you for watching. Good morning. After 2 days of respite and hope that there could be some sort of de-escalation, we're back to square one, and there is another renewed vigor of uncertainty in the market. You're watching us here on Trading Hour. I'm Mangalam Malu. With me, Hormas Vatakia and Ritu Singh. We come to you live from the CNBC TV 18 Motilal Oswal studio. And not a particularly good Friday for the markets. Down 350 points for the Nifty, below that 23,000 mark once again. And the broader markets have it worse. 2,600 stocks in the red for 375 in the green. Ritu.
That's right. Good morning, Mangalam. Not looking very good. Almost a 1.5% cut on the frontline indices. The India VIX also is now above, 26 as we speak. So, broad-based pressure everywhere. I guess it's evident across most of the sectors. The PSU Bank Index is a major laggard. It's down more than 2.5%. Shriram Finance, Bajaj Finance, HDFC Bank all down in trade. Nifty IT is actually the only major sectoral index that is showing some resilience still. It is bucking the trend with gains in, TCS, HCL and Infosys. There's also some sentimental positive, I guess, with what's happening with the rupee fall. But other than that, the markets, of course, continuing to be pressured by what's happening globally, the macro getting affected, and of course, rupee now at almost 94.5 to $1. Not looking very good on that front, but Hormas is standing by with a spotlight on the top movers. Hormas.
Bringing this to your notice on Wednesday as well, at the market being recovering, but the VIX hadn't cooled off, and the VIX is now extending that move higher, along with the currency that is extending its move lower. There's a 94.50 now on the currency, but the big talking point since the morning has been the oil marketing companies after that excise duty cut. Now, they opened higher, but take a look at the fall that they have had from the highs of the day. HPCL at one point was up almost 5%. It's now trading at the flat line. 75 lakh shares have been traded so far. The 20-day average is just around 33 lakh shares, and close to 40% of the shares that have been traded so far have been marked for delivery. Now, for BPCL as well, more than 1.5 crore shares have been traded so far. The 20-day average is around about 40 lakh shares. This stock too was up almost 4.5% in early trading, has reversed all of those gains and is now trading with losses. And half of those shares that have been traded so far have been marked for delivery. And Indian Oil Corporation as well, 1.5 crore shares traded. The 20-day average is 80 lakh shares, and this is the underperforming one among the three OMCs today. 1% lower already. The stock had not seen a big up move, was up around 2.5% in early trades, is now down 1%, and 43% of the shares traded so far is being marked for delivery. A positive read-through for some news developments taking place for HEG and Graphite India. Both of them are among the top gainers on the Nifty 500 today. HEG is up 13.5%, Graphite is up almost 10%. Take a look at the volumes as well. HEG has had more than 1 crore shares that have been traded. The 20-day average is only 4 lakh shares. And even for Graphite India, 50 lakh shares have been traded, and the 20-day average is only around 5 lakh shares. And lastly, Bajaj Finance is one name that is among the top Nifty losers today. And despite this 3% fall today, the stock is still higher for the week, and it is net to snap a 4-week losing streak that the stock has had, which took it to a 52-week low before a bit of a rebound that came in this week. More than 38 lakh shares have been traded so far. The 20-day average is around about 20 lakh shares, so it's about 2x its 20-day average, and 63% of the shares traded so far have been marked for delivery. Back to you guys.
All right, Hormas, thanks a lot for that. A lot of weakness in the market, and a large part of that can be attributed to the oil price move, and that's exactly the big story that we have today. Oil marketing companies are in focus as the government has slashed the excise duty on petrol and diesel. Oil Minister Hardeep Singh Puri said that the government has decided not to pass on the burden of lofty prices to customers. Sentiment positive for OMCs on account of reduced cost burden and improved cash flows. Sonal joins in to give us more details. Sonal.
Thank you so much for that. It is an important update that has come by. The excise duty on petrol has been cut to 3 rupees a litre from 13 rupees per litre. On diesel, it has been cut to nil from the earlier levels of 10 rupees per litre. Now, the impact is largely on OMCs because remember, these will not be passed on to consumers in form of a price cut. This is done to ensure that there is better working capital for oil marketing companies. Lower excise duty will reduce their cost burden. Additionally, since retail prices are unchanged, the benefit has been retained with these companies. Marketing margins which have been negative, which will see some expansion action right now. And if we talk about their balance sheet as well, there will be better cash flows. It will help their balance sheet overall. Now, do remember, oil marketing companies, they were making negative marketing margins to the tune of 27 rupees per litre on petrol and 50 rupees per litre on diesel. This is the data as per last week. So if there is a cut which has come by an excise duty, of course, they'll see some relief. But remember, they will still see negative marketing margins. So it is not a complete benefit which will come to OMCs. So it is a relief that the government has given to oil marketing companies. It is not to manage the final retail prices. But if we look at the balance sheets of OMCs, they have improved over the last couple of years. So they are in a better position to absorb such shocks that are coming by. For BPCL, it has reduced to 0.3 times in terms of net debt to equity. For IOCL, it has reduced to 0.8 times. For HPCL, it is still higher versus the other two, but it does have highest exposure to marketing segment as well. So these are the stocks that will continue to be in focus. What about consumers? Well, there is no relief which is coming by, but yes, there is no passage of high crude oil prices to consumers as well. So that is very important to note. There will be no relief in household budgets, but no impact on inflation as well in the near term. Additionally, there's one more news where the government has levied additional duty on export of diesel and ATF, 21.5 rupees per litre on diesel, around 29.5 on ATF, and this is done to discourage exports in wake of the energy crisis that we've been seeing, to ensure there's more supply in the domestic markets. So these are some updates that just come by. This is largely done to ensure domestic availability, plus give some relief to oil marketing companies which had issues because of high crude oil prices, and they were not able to pass it on to consumers. So this will fix their balance sheet issues for a bit.
Indeed, Sonal, thank you for that update there. The OMCs have come off sharply from the initial highs, at least. The centre, having slashed excise levy on petrol and scrapped it for diesel, we caught up with M.K. Surana, the former chairman and managing director of HPCL, and asked him if this excise levy cut could also translate into price changes at the retail level. Listen into what he had to say. Meanwhile, Probal Sen of ICICI Securities said that the government's move will mean relief for these oil marketing companies. Listen in.
It depends. Unlikely, because in the past it doesn't happen like that. So, and one more thing is that the total under recovery may be much higher right now. So, I think it's unlikely that the pump prices will change. The fact remains that when the crude prices are running like $100, $100 plus dollar, and so there will be under recovery right now, because the oil prices of the pump prices are the same since last 4 years almost. So under recovery will be there right now without doubt, and it will definitely help the oil companies.
At these levels, a 10 rupee cut is a significant reduction in those losses. So the blended losses will obviously come down to below 15 rupees or maybe even below 10 rupees, depending on the prices as they behave after this cut. So that tends to sort of then reduce the losses on an overall basis, because GRMs, should, as crude normalizes, should also rise a little bit. So on an integrated level, I think these companies will probably start to see a little bit of relief.
All right, that's about the big story of the day. What we'll do is take a short break, come back. We'll be back with a macro check on the markets as well, because all of those are impacting the micros as well in the front line and the broader markets. Take that short break, come back, and we get more.
Welcome back. It's time to get you a quick check on all the macro signals. The markets, of course, trading with a cut of almost 300 points, down 1.3% as we speak. The Sensex as well, down about 1,071 points. And the pain is seen across the markets. That's also happening on the back of what's happening on the macro front with the rupee breaching that 94 mark to a dollar for the first time today, making new record lows around 94.5. In fact, that's the level we're currently seeing. We closed at 93.97 on Wednesday, opened today with a very swift fall that is continuing. It took barely a week, actually, for the rupee to slide from 93 to 94 because of what's happening with the oil prices, the foreign fund outflows, all of that continuing to exert pressure. We, in fact, have seen the rupee depreciate by almost 10% in the last 1 year. Now, oil prices, they've retreated slightly today, but still remain at elevated levels compared to the start of the conflict. Of course, oil prices have cooled by approximately 2% early in trade today, now trading at $107 on the Brent. That's on the back of what's happening. Again, U.S. President Donald Trump announcing this 10-day pause on strike against the energy infrastructure in Iran to allow for negotiations. The 10-year benchmark, by the way, keep an eye on that as well. The yields have spiked to near 16-month highs, and they're closer to the 7% mark than we've seen in the last few days. Higher oil prices, currency weakness, all that is negative. And of course, bond markets continue to be under pressure from the deluge of government debt and oversupply concerns that continue. And Indian yields are also tracking what's happening in the U.S. 10-year Treasury yields that have rallied on, stronger economic data locally there. So that's all the macro signals. We'll have to take a short break. But up next, a very special conversation with the IIFL Capital team. On the way ahead for banks and NBFCs, we'll be joined by Rikin Shah and Viral Shah, and we'll discuss valuations, macro shocks following the Iran war, and what next for the sector.
Welcome back. You're watching us here on Trading Hour. The rupee extends its losses, hitting a record low, and even the market currently is reflecting that at the low point of trade for the frontline indices, 1,000-point plus correction for the Sensex, the Midcap index, and the Nifty Bank as well. And there you have it, the rupee now crossing that 94.5 mark on the currency as well. 94.5 against the dollar, a fresh record low. And you ask analysts, you ask macro experts, all of them don't have a lower level on the rupee as we speak. In fact, as we go forward with the show, let's hear out what the finance minister had to say on the current situation and how they're planning to manage that as well. Listen in to what the finance minister had to say, and thereafter we continue our discussion on the macros and the impact on financials.
अभी क्योंकि विदेश में मार्केट में दाम बढ़ रही है क्रूड का, उसके कारण पेट्रोल और डीजल का, ETF का, माननीय प्रधानमंत्री जी ने ये चाहा कि कंज्यूमर का प्राइस बढ़ना नहीं है। उसके कारण हम निर्णय लिए हैं कि ऑयल मार्केटिंग कंपनीज को सपोर्ट दें और जिससे वो ज़्यादा दाम में खरीदने वाली चीज़ों को सरकार उनको मदद करेगी, मगर जनता के ऊपर रेट बढ़ाना नहीं होना चाहिए। दूसरा, बड़ा दाम विदेश में बढ़ रही है, उसके कारण ऑयल मार्केटिंग कंपनीज खरीदना रोकें। ये से हालत ना हो, वो फिर भी खरीदें, फिर भी ले आएं और हमारी जनता को समय समय पर सही क्वांटिटी जितना भी मिलना चाहिए उतना मिलने का इंतज़ाम करें। इसीलिए आज इस निर्णय के कारण सप्लाई कमी नहीं होगा, सप्लाई में, अवेलेबिलिटी में कमी ना होगा, जनता को डीजल भी, पेट्रोल भी, क्रूड भी मिलेगा। और ETF बहुत इम्पोर्टेंट है, भारत देश का एयरक्राफ्ट और हमारी कंपनियों का एक ETF मिलना आवश्यक है। उसके कारण भारत में बहुत सारे रिफाइनरीज हैं जो विदेश से माल खरीद करके इधर उसको रिफाइन करके विदेश को एक्सपोर्ट भी करते हैं, हमें भी देते हैं। मगर वो एक्सपोर्ट के ऊपर हमने अभी ज़्यादा रेट बढ़ाया, एक्साइज ड्यूटी बढ़ाया, जिससे वो एक्सपोर्ट ना करते हुए भारत में ही उनको सेल करेंगे, जिससे भारत में अवेलेबिलिटी का भरपूर अवेलेबिलिटी रहेंगे, लोगों को कमी महसूस नहीं होने देंगे। कल रामनवमी के दिन माननीय प्रधानमंत्री जी ने इमरजेंसी में एक मीटिंग बुलाई और इस विषयों के ऊपर चर्चा गोष्ठी करके तुरंत निर्णय किए और इसके जितने भी करना है काम वो सब कल रात को ही हमारे मंत्रालय भी और पेट्रोलियम मंत्रालय भी बैठकर काम करके आज इस निर्णय हमने घोषणा कर।
Okay, that's the finance minister on the excise duty cut on petrol and diesel. But let's shift our focus back to the financial space, because after the sharp sell-off we've seen in these stocks, the key question really is if it's just a correction or the start of a deeper reset. Now, private bank returns have lagged recently. PSU banks have seen a stronger run-up, but that dynamic is again getting tested with what's happening on the macro front. So where are the real opportunities in the space now, and where are the risks still building up? Let's bring in our expert guests to decode just that. Rikin Shah and Viral Shah of IIFL Capital join us in our Mumbai studio. They track this space very, very closely, and we will be asking them these key questions on the macro shock, who gains, who loses, the PSB versus private bank debate, and whether it's time for a re-rating there, the big foreign money that's coming into Indian banks and NBFCs, whether that is a disruption or a bigger opportunities within NBFCs. Are housing companies the safest space to hide? And of course, their top picks. Rikin and Viral, again, welcome. Thanks very much for joining us here. Rikin, let me just quickly start with you with what's happening on the macro front. Rupee at 95.5, oil prices surging, bond yields touching 7%. I mean, what does your stress test indicate the worst and the best case scenario for banks, and are PSUs the worse off? And where is the bigger hit? Is it on the loan front or the credit cost?
Sure, Ritu. So we did this stress test for the banks, and there are a few levers through which it will have the implications, starting from the top on the loans. while the working capital loan demand actually goes up, what we are essentially seeing is that the retail loan demand, which is recovering from the low base, may support the near-term loan growth prospects. But if this elongates for a longer period of time, then clearly the household disposable income will also go down due to elevated inflation, and that can have ramifications on the loan growth. But near-term loan growth should be reasonably supported via increase in the working capital loan demand. The second level, and where I worry a bit more, is on the margins. What we are seeing is with the liquidity tightening, the bulk deposit rates have really shot up by almost 100 basis points in the last quarter. And this will clearly have implications on banks' cost of fund as well as margins. We were anticipating the margins to keep improving gradually. I think the margins may potentially now peak out sometime in 1Q or 2Q and maybe a lot more gradual from there onwards. The third lever for the banks would be on the bond yields and the impact on the trading gains. Our sensitivity analysis suggests that it can hit the net worth anywhere between 50 to 60 basis points for the banks, and PSUs are clearly a bit more vulnerable there. Credit costs at this point in time, not a very big risk. There are certain sub-segments for the banks which are more vulnerable, but as Viral will subsequently elucidate, NBFC's pocket could see a bit more stress. And the last lever is the remittances. So every year in India, $135 billion of remittances come in India. 40% come from Middle East. And I think that's the number which can potentially be at risk if this war elongates. A summary of this is that our stress test scenario suggests that private banks' earnings can be cut by 4 to 6% and PSU banks between 8 to 10% PAT hit.
So in that case now, with this scenario that we are in, let's before I go into Viral as well, you take a look at the banking stocks, the sell-off that you have seen in the banks. The Nifty Bank and the PSU Bank Index, both of them are down anywhere between 14 to 15% this time around. Look at how the valuations compare right now. The Nifty Bank, the current price-to-book ratio is at around 1.8 times. The 5-year average is only 2.2 times. So it's below its 5-year average is the Nifty Bank. You take a look at the PSU Bank Index as well. It's trading at 1.4 times price-to-book. The 5-year average is around 1 time. So right now the tables have flipped as the PSU bank's valuation is now higher than its 5-year average compared to the private banks. And the private bank index itself is trading at 2 times price to book compared to 2.6 times, which is the 5-year average. Now take a look at the banking returns as well. In comparison to the Nifty, which is down around about 8.5% over the last month or so, the PSU bank index is down 13%. And over a 12-month period, the index has not gone anywhere, but the PSU bank index is up almost 40%. And that is reflective in the stock prices as well. The stock prices, of course, the PSU banks have sold off sharply because of the rise in bond yields and so on. The PSU banks like SBI, PNB, Bank of Baroda, Canara Bank, Union Bank, all of them have seen double-digit losses over the last 1 month. But you take a look at the figures in the 1-year period as well. Now they are up anywhere between 20% to as high as 60% for stocks like Canara Bank. Now take a look at the private banks in comparison. While PSU banks are up anywhere between 20 to 50, 60%, private banks have not given as significant returns. HDFC Bank, ICICI, Axis, Kotak, IndusInd, all of them down anywhere between 10 to 15%. And over a 1-year period also they haven't gone anywhere. The IndusInd Bank, of course, has bounced from lows, but the bigger ones, HDFC Bank, Axis Bank, ICICI Bank, negative returns or low double-digit returns as well in that comparison. So that's the kind of picture that has come up. So now in that case, Rikin, the valuation picture is showing that the PSU banks have outperformed the private banks. But is the risk priced in enough for the private banks, and is the best priced in enough for the PSU banks, or do you see some more changes taking place as this elongates, as you just highlighted?
So for us, I think the risk reward in the large private banks is looking extremely favorable now. If I look at the last 6 months, the large private banks have derated by 5 to 20%. On the other hand, the PSU banks have re-rated between 5 to 30%. Now, this valuation divergence that we have seen, I think there are 2 catalysts which will change. Number one, you will see that the trading gains, which almost contributes anywhere between 10 to 30% of the PBT for PSU banks, with the hardening of the bond yields, that will start decelerating from this quarter itself. So that's a significant contribution to the bottom line. And the second one, which is the recoveries from the written off, while it may still have lags for a few more quarters, directionally it cannot further improve from current levels. So if I put both of these things together, the non-core items are constituting anywhere between 25 to 60% of PSU Bank's PBT, which will now start seeing slowdown, and hence it will become more apparent that this narrative of 1% sacrosanct ROA for PSU banks will continue, will not hold if we slightly take a medium-term view. So from that context, we clearly prefer large private banks over PSUs. We have a bit more picky even within our large private bank picks. We like ICICI and Axis more within the banking space, but even frankly speaking, following the recent corrections, HDFC and Kotak also have some reasonable upside from the current levels as well.
Right. Enough about banks now. You did say that, we'll have to ask Viral about the NBFCs. Let's put the NBFC underperformance into perspective as well. Over the last 1 month, the Nifty is down, 8.5% because of the war, etc. Nifty Bank has it worse, down about 13%. We've had the Nifty Financial Services down about 12%. And in that as well, if you look at some of this bluest of blue chip NBFCs, right? You have Bajaj Finance, which is down 14% this month itself. And the last 1 year return has become a negative 5%. Shriram Finance, Muthoot Finance, Manappuram, all of them saw big rallies before this month started. Anywhere between 10 to 35, 40% because of the rise in gold prices as well. This month, all of them down between 10 to 15%. Chola Fin as well, down about 17% this month. And as a result of which, the 1 year return has turned negative. Looking at your own stress analysis, you're saying that maybe the stress case would have 2 to 13% cut across the board, and severe stress would mean 8 to 17% EPS cuts across the board. So the question in that is, how much worse are NBFCs as compared to banks? And is there any pocket of outperformance in NBFCs? Are you looking at gold? Are you looking at housing? Are you looking at any particular pocket which is better off and any pocket which is worse off?
Thanks, Mangalam. So, see, NBFCs in general are more of a beta play. Both, whether you look at it in terms of growth or in terms of valuations also, it is reflective over there. What we have been essentially highlighting is that the kind of correction that we have seen in the last 1 month of, say, anywhere close to 10 to 15%, you would see that in the base case itself, there is a 5 to 7% earnings cuts that is something that has already come through.
Yes.
Now, this does not take into account the other risks that are quite, I would say, emerging. And as this war kind of continues, the scenario continues, and the impact will keep playing out. We see that in a stress scenario, there is a potential for another 5 to 15% earnings cuts. Wow. Which would mean that essentially the multiples for NBFCs would not have corrected despite this kind of correction. So while optically it may seem that they have corrected, on a relative basis, once one bakes in a stressed case scenario, one may not actually see a meaningful correction to see in case of NBFCs. Now, in this as a construct, we have laid out a framework to assess on which parameters, which kind of NBFCs kind of stand out, because NBFCs are very diverse, right? So if you look at, let's take the housing space. I think housing space is a segment which is going to be relatively much better placed now. In general, if you look at, they have a better, I would say, sensitivity of the rates, the rising rates environment are positive. And I would say the valuations that have corrected, I think that kind of now at this levels makes sense to incrementally turn positive over there. And they have the least sensitivity of all these issues which are we are referring to. So in that construct, I would think that housing finance, one should look at it now incrementally quite positively. The other bigger segment which is there is vehicle finance. And over there, what we are advocating is that growth is something that can actually take a hit depending on how long this war scenario continues. And they also have a higher sensitivity to the margins. So your cost of fund goes up, the yields don't go up, and which is where they can be a bit more vulnerable. And the third segment, if you look at it, is gold. I think, of course, the stocks have done tremendously well. The gold prices, as you see, which are quite good. From here on, we see that this sector, from a medium-term perspective, can see greater competition.
All right. Gold sees greater competition, high sensitivity to vehicle finance. Safe as houses will obviously be housing finance. We'll continue this discussion after this short break. Stay with us here on CNBC TV 18. Both Rikin and Viral with us. A lot to discuss in the financial space.
Welcome back. Rikin and Viral Shah of IIFL Capital still with us. A quick question to both of you. Rikin, we've been talking a lot about these large banks and, all the news flow that's happening there. But what about the mid-sized and the small banks, especially in the private space? Whether you talk about the DCB banks of the world, the South Indian Bank, Karnataka Bank, are we likely to see some moves there by way of strategic investments, consolidation opportunities? Could that throw up the next set of opportunities? And Viral, very quickly on the gold financiers, so much volatility every day, up 6% one day, down 4% one day. The tonnage growth, all of that combined has been very low for them. Are we overpricing? Are we underpricing the risks there? Are we getting overexcited in the gold financier space as well?
Yeah, Ritu. So taking your first question on the mid-small size private banks, clearly in the last calendar year, we have seen almost $12–13 billion of deals where foreign players have put in fresh capital into the banks and NBFC. Almost $8–9 billion of that dollars is primary infusion and not even secondary. So clearly, this has improved the fundamental lending as well as business capabilities of some of the small mid-sized banks who otherwise would have been a bit more vulnerable in this ongoing shock. So we clearly think that they put them on a better footing, and I wouldn't be surprised that if in next 12–18 months, we see some more further potential deals in the mid-small size private banks. Of course, there could be a few names where the managements have publicly talked about, being okay to raise any strategic money or even inviting the financial investors. So that's one thing that will play out, but it also has ramifications for the broader lending scape as well, right? Because when new capital comes in, it improves the lending capacity and reduces the profit pool for the incumbent players. Of course, Viral will talk a bit more about how that competitive intensity plays out, but clearly within this small mid-sized banking pack on this particular theme, RBL is a phenomenal play in our mind. Wherein I think this $3 billion infusion really puts it on a growth and improving ROE profile from what we have known. But what it means for the other competitive landscape, maybe Viral can add a few points on that.
In fact, to that itself, I'll put up a graphic once again. You spoke about RBL having $3 billion where the RBI nod is pending right now, but Shriram, MUFG, everything is done. Just the RBI approval on director appointment is pending. That's near 40,000 crore deal. You have Samman Capital, another 1 billion, where everything is done. Manappuram Bain, you have about 4,300 crores completion by March 31st. So the table comes up for you on the screen. There you have it, all those deals. Put all of them together, $10 billion worth foreign capital coming into the country. 3 of them obviously in the NBFC space. So Viral, what does this do to, one, where the money comes, but as was pointed out earlier, what does this do to the competitive scenario? Because everyone will then be chasing the most prized loan borrowers, right? Then everyone will also be chasing them at lower prices. So profit pools of the industry reduce. And at a time when things are so stressed, what happens?
So, Mangalam, how this landscape will evolve is we do have template to look at certain other segments, how this has panned out. So, if you look at, say, the housing space, right? Over the last 5 years, we have seen a lot of standalone affordable housing finance companies enter the segment. And at the same time, you have seen the larger NBFCs or HFCs also get into that. That did clearly impact the profitability and also, I would say, at the margin, the growth for the existing standalone guys. I think that over the medium term, this definitely will impact the profit pools and also at the margin, the growth rates for respective lenders who are bigger in those respective categories. Whether we look at, say, a vehicle financing or, say, a gold financing, and which is where we see that over a medium term, this is a competitive scenario that will evolve. Having said that, I think the name of the game in the NBFC space will be diversification. What you need to look at is that NBFCs who can diversify to offset the impact over here, whether it be it in terms of growth or profitability. We have seen someone like your Cholamandalam Finance very clearly demonstrating this diversification. Of course, Bajaj Finance is the template that people emulate. So that is what you need to see. But yes, it's going to impact the profit pools for NBFCs in general.
So in light of this very insightful conversation that we have had, the bottom line being, where do you put your money to work? Rikin, you briefly alluded to the large size private banks, right? So why do you prefer these larger lenders over the mid-sized names that Ritu was just highlighting? And Viral, for you as well, the NBFCs, where do you play this theme? The leaders, the Bajaj Finances, or you go down to the MFI themes? Rikin, to you first.
So within the banking space, our pecking order is pretty clear in our mind. The large private banks, where our top two picks are ICICI and Axis, followed by certain mid-sized banks where our top pick is RBL, and then the PSU banks. And within the PSU bank, it's only SBI which can sustain 1% plus ROA despite all these headwinds. But again, this would be the pecking order among the large. So to reiterate, ICICI, Axis and RBL would be the most preferred picks for me in the banks.
ICICI, Axis, RBL, SBI. You?
So within the NBFC space, as I clearly highlighted, mortgage finances and housing financials, PNB Housing stacks up quite well over there. I would say beyond that, within the diversified space, we prefer Tata Capital, Cholamandalam Finance, who have relatively lesser sensitivity. And I would say even Shriram Finance, with the kind of money that has come in, they also will be better placed.
All right, take that point. Thank you so much, gentlemen, for joining in. Just as an aside, is this an IIFL uniform or
This was not supposed to be the case today.
That's okay, but makes for a good picture. All right, gentlemen, thank you. We'll take your leave with the news that it's not particularly good in the market right now. 22,950 for the market. The Nifty is down 350 points. Nifty Bank has a bigger gash right now, 2.15% lower. So what we'll do is wrap up on this conversation, take a short break, come back, focus on the markets and a lot of stock-specific action. Stay with us. Welcome back. Close to 400 points lower now, 370 points lower on the Nifty. So perfect time to get you an update from the F&O desk right now. If you look at the Nifty Bank, the Midcap index, all of them have been extending their cuts. 22,900 on the verge of breaking as well as we speak. And it's a function of three problems at the macro level. One, oil, which refuses to cool off, close to around $108 per barrel right now. Rupee, which continues to weaken, now closing in on that 95 mark. So by today itself, seen a big surge, cross past 94 versus the dollar, and now swiftly is moved to 94.65. And the third part is the bond yield, which has earlier been pointed out by experts, tracking that 7% mark on the new 10-year. So all these factors taking the markets lower, and that's also caused the VIX to rise. The VIX now is up around 8.5%. As we speak, 26.62 is where we are. One of the lowest levels or the highest levels, as we can see, in the last 2 years or so. Market breadth, even worse. Has your portfolios feeling a lot worse right now? We have nearly 2,600 stocks declining for sub 400 stocks which are advancing. And all of this has been further pressured by the fact that we saw a gain on the previous two occasions, which meant there were a lot of puts that were written in the system. And one day ahead of those expiry levels, put writers are caught on the wrong side. So 23,300 put, as you can see on your screen, seeing a lot of short covering. If you see the other one as well, 23,200, that also has seen a fair amount of short covering. The important part, however, is what happens to the 23,000 put, because the 23,000 put had a formidable amount of open interest built up, and we've still not seen shorts cover out there. They have about 1.08 crore shares left in open interest. With the Nifty, if the Nifty holds around that 22,750, 22,800 mark and goes below that, then maybe these put writers will have to cover their positions, and that will cause the market further lower. What this also means is that on the way up, 23,000 now is an important psychological resistance. So 23,200 thereabouts is what the call writers are playing for in terms of resistance. So supply zone comes in closer as well. A lot of stocks on our radar. Let's talk about the ones which are doing well right now. So shorts covered on Oracle Fin and Piramal Pharma. So there are a few stocks which are doing well. But the real estate pack has been sold lock, stock and barrel. So one day ahead of expiry, a lot of short positions added on Prestige Estates, Lodha Developers and Phoenix Mills as well, down anywhere between 3 to 5%.
All right, Mangalam, thanks very much for setting that up for us. Good time to welcome Vinay Rajani of HDFC Securities, who joins us for a quick technical check of the market. Vinay, welcome. Thanks very much for being here. 22,947, that's where we're at, just 20 point off the day's low. What are the charts telling you? Where do we go from here? What are the key levels you'll watch out for? And your top trading ideas in the current volatile session that we're seeing?
Yeah, good morning. So definitely there has been a choppy trend. Yesterday we saw a nice recovery in the market. Almost 1,000-point recovery was witnessed in last two trading session. But again today Nifty has resumed its downtrend. Now it is very difficult to come out with levels, and as the rupee is not supporting, rupees at all-time low, crude is not falling. So this has been the negative cues. Asian markets are also falling. So yes, the development has been negative, but today's correction has already been healthier. 360 point already down, so it might happen that it may see some recovery, because the 1,000 points recovery which was there in last two trading session is still holding, and 22,850 to 22,900 according to us is a very strong support for the trading purpose. So 22,850 should be kept as a stop loss, and we may expect some recovery from here, intraday recovery at least, because of the oversold condition on the intraday chart. So we feel that market should bounce back a little from here, and the stop loss should be at 22,850.
So in light of that, Vinay, what are the stocks that you're recommending?
Yeah, so in this kind of scenario, the pharma space can do well because of the rupee depreciation. This is the safe haven sector, and Lupin is one of the strong stock in the pharma space. So Lupin around 2349, one can go long. 2300 should be the stop loss, and on the upside we are expecting a target of 2425. The second stock is from the mid cap space, from the metal, that is the Godavari Power GPIL. So that has remained very resilient in this recent correction of the market and still holding its primary uptrend. So 274 is the price around which one can go long. 268 should be the stop loss, and on the upside we are expecting a target of 285.
Vinay, thank you for sparing time and joining us today with your views on the index and on specific stocks as well. By the way, a lot of movers on the downside within the broader markets. Traxon Technologies is now down 9%, the top loser on the small cap index. So that's one name that's not doing very well for itself. PTC Industries is down around 6% as we speak. Brainbee Solutions is down 5.5%. That's First Cry. Minda Corp down 5% as well. And Tata Motors passenger vehicles among the index names that has extended its losses. That's down 5% as well after the reports that suggested a production shutdown yet again at its at a JLR facility in Solihull. 5% lower on that as well. What's bucking the trend though? HEG and Graphite India continue to do well. HEG is up 11.5%. Graphite India is up 8.5%. And Acme Solar, there was an initiation in today's session on the stock, and that is doing well for itself. 5.5% higher on Acme Solar as well. Take a short break. We'll come back with more on the markets on the other side and put the spotlight on the bond markets with Manisha Gupta.
CNBC TV 18 and India Bonds present Bond Street.
Welcome back. You're watching Trading Hour. It's not looking very good for the markets, but even worse for the macros. Keep an eye on Rupee now at a new record low, 95.6 to the dollar. That's where the Rupee has touched. It's been a swift fall since we opened today after yesterday's holiday, and it's been a near 62 point fall on the Rupee so far, and it looks like it's continuing the downward trajectory. But let's bring in Manisha Gupta, who's joining in with the all-important action on the bond street as well. Bond yields, 10-year yields, touching nearly 7%, Manisha.
Well, the government bond yields have jumped in yet again today, headed for a very rough fiscal year, and as it seems to be, the 10-year yield is currently flirting with that 7%, very important psychological mark there. The Indian rupee, remember, hit a record lows at beyond 94.45 at the last count. It also has to do with the rising crude oil prices, holding above $100 a barrel for a 7th or 8th trading session now. Even if it does decline, markets feel that 85 to 95 is the near-term range that the crude prices could be looking at. And because India imports 85% of its crude requirement, well, you perhaps are looking at a higher current account deficit also impacting the money markets therein. The higher crude can widen CAD, not just that, but also keep the inflation sticky. Take a look at the outflows, and that continues from the domestic equity market. There is strong dollar demand coming in from importers as well, especially ahead of the year-end, quarter-end, and that is impacting markets. RBI, in the meanwhile, is expected to have already sold more than $15 billion in the month of March to contain the declining rupee. Interestingly, it also has to do with the push of state debt sales. States have raised a record $12.31 trillion in this fiscal. The final numbers, of course, are awaited as we head towards that March end. RBI also, the net short dollar positions are estimated at around $100 billion. This is way higher than $67 billion that we saw in the month of January. So big number movement is what is impacting the overall money markets there. Despite the pressure, though, if you look at that has been seen in G-Sex, if you look at the AAA and non-SLR corporate bonds, well, they seem to be trading around and above 7.25%. Bond market is looking at a structural growth therein, and we are also looking at corporate bond fundraising nearly at par with nearly bank credit. 2025 till time has seen 1.2 million retail trades, and expectation that FY26 could be doing or improving on that number.
Right, Manisha, thanks a lot for that. That's the update coming in on the bond market, but nothing going well for the equity market right now. The Nifty on the verge of breaching that 22,950 mark as well at a low of the today's trading session so far. As the charts tell you, any time of recovery is being sold into, and right now the fresh sellers are on UPL, which is at the low point of trade. Muthoot Finance and Manappuram are tracking lows of trade so far as well. And MCX is the other one, which is lower too. Some bit of recovery over the last two trading sessions was witnessed on a name like Indian Hotels. That too has come in for some bit of selling. But we'll wrap up on some of the gainers that we have, and gaining with decent volumes. We have Acme Solar, which is up around nearly 6% at the high point of trade. We've seen some traction in Affle India as well, and Cupid is the other one which is seeing some volumes. That stock higher too. What we'll do is we'll wrap up on this edition of Trading Hour with the news that the market continues to sell off. The team of Halftime Report takes all the market action forward. Thank you for watching.
Stocks take a tumble as ceasefire hopes fade despite Trump's pausing strikes on Iran's energy assets till April 6th. Realty, auto and financials are the biggest losers.
The government steps in to offer relief to oil marketing companies amid surging crude prices by cutting excise duty by 10 rupees on diesel and petrol. It also imposes a tax on fuel exports as a discouragement and to offset some of the burden.
Infosys will buy 2 more businesses, taking its tally to 5 acquisitions of over $800 million this fiscal. TCS too has spent near $800 million and HCL Tech and Wipro near $400 million apiece as Indian IT levers M&A to grow.
The Indian rupee depreciates further, going over 94.5 as statements from Iran and US show no sign of de-escalation. The 10-year bond yield has spiked to 6.94%, up 7 basis points as the government's excise duty cut on petrol and diesel points to higher fiscal deficit. Very good afternoon. You're watching Halftime Report live from the CNBC TV 18 studio. Motilal Oswal studio. I'm Ekta Batra and with me is Sonal Bhutra. Well, it's turning out to be a session, another dull session for the market. So we have the Midcap index, which is down over 1,000 odd points. We have the Nifty, which is sub 23,000 at this point, so down around 377 odd points. And we have the Sensex, which is showing a cut of around 1.7%. So red across the screen at this point in time. And there's no respite despite that little bit of a break that we got midweek.
Oh, yes. But, so much happened midweek as well, and that's what we've been talking about. There's no clarity on what will happen with the West Asian conflict, and that's exactly which is worrying the markets again. We'll discuss Rupee in a greater detail, but across the board, asset classes, the signs that they're showing are worrying. Brent at that $107 per barrel mark. We are seeing that with Rupee. We are talking about most of the sectors in the red, barring IT today, which is doing well. We do have gains of 0.3% there. Even the CPSE index is in the green, but the advanced decline ratio absolutely in favor of the declines, 1:7. That's the number that we are working with. And yes, there is some relief to oil marketing companies in form of excise duty. Again, we'll discuss that in detail, but no really fresh positive fundamentals that the market is looking at.
Well, yes, absolutely. That's basically what's taken place. And I just want to point out that, it's been 28 days since the West Asia conflict has taken place. And just want to give you a sense in terms of how exactly key prices have moved since then. So remember that the conflict started around the 27th, 28th of Feb, and today we're sitting at the 27th of March. So it has been 4th week of the conflict. But nonetheless, we have Brent crude prices, which are up 48% from that point in time. It started at around $72.53 per barrel, currently at over $107 per barrel. We have gold prices, which have shed around 15.4% at the same point in time. Silver prices down around 25%. The dollar index has strengthened all the way to around 99 at this point. It started at around 97, 98 levels when the Iran conflict, in fact, began. The US 10-year has hardened all the way to around levels of 4.42 versus 3.93. That's where it was at when the Iran conflict started. And we have the Dow, which is down around 6.2%. What does this mean for the Indian markets? The Nifty is down 8.8% at current reckoning. We have the Rupee, which is depreciated around 3.8, 3.9%. It's difficult to track considering the kind of movement that it's showing on an intraday basis. And we have the Indian 10-year, which is hardened all the way close to around 6.93 levels versus 6.66. So that's basically the setup in the past 28 days. We've seen such a rapid movement across commodities as well as in terms of equities as well as the macros.
It's very comprehensive. Thank you for getting us that data. So that explains what happens across asset classes globally. But let's get you what we have on the show today. In our What's Trending segment, we'll focus on the excise duty cut and the impact that we'll see on OMCs. Later, we'll also connect with Kenneth Fu of S&P Global Energy to decode how much of the global gas supply is impacted due to production cuts and understand more about the LNG scenario. We'll also speak with the management of Aarti Drugs to decode how war in West Asia has disrupted healthcare and pharma space. Manisha Gupta will focus on recent moves in cryptocurrencies as uncertainty looms over West Asia peace talks. Stay tuned for that.
All right, well, on to our What's Trending segment. We continue to track the West Asia conflict, which has now entered its fourth week. The rupee continues to weaken, slipping to record lows amid rising oil prices and that global risk aversion that we're seeing. In response, the government has stepped in to cushion the shock by cutting excise duties on fuel. We're tracking all this and more. Let's begin with Sonal telling us about the excise duty cuts.
That's a big one that has come by, a big relief for oil marketing companies. To give you the numbers first, it has been cut to 3 rupees per litre from 13 rupees per litre on petrol. To diesel, it has been cut to nil versus 10 rupees per litre that particular fuel had. But remember, there's no relief for consumers. It is totally on the OMCs and there'll be no price cuts at the pump level for consumers. But what does it mean? Let's talk about oil marketing companies first, because they had been facing massive losses in their marketing segment. This will reduce their cost burden. And since retail prices are unchanged, the benefit is retained for them. Again, marketing margins, they'll expand from current levels because of this excise cut that has come by. These companies will see better cash flows, better working capital management. Now, do remember they were making negative marketing margins on both petrol and diesel. On petrol, it was 27 rupees. On diesel, it was 50 rupees per litre. So, yes, losses will continue, but they will reduce after the excise duty cut that has come by. Now, remember, these companies are in a better position with respect to their balance sheets now, right? So, if you look at their net debt to equity, which has improved in last couple of years, for BPCL at 0.3 times, for IOCL it has come to levels of 0.8 times, for HPCL it has come into levels at 1.4 times. HPCL has the most exposure to the marketing segment in all the three oil marketing companies. What about consumers? No respite that has come by, but of course there's no rise in prices as well at the pump level. No relief on household budgets and no immediate impact on inflation as well. Additionally, government has also levied additional duty on export of diesel and ETF. This is to ensure that there's no shortage back home and to manage supplies in the domestic market. So this is an important step as well. Now do remember, India is the net exporter of ETF, so this is coming as a relief for the domestic markets. Quickly taking a look at how fuel prices have increased across the globe and how it compares with India. We've seen no price hike in diesel since the time the West Asia conflict has started. For US, it has increased by 38%, UK 24%, Germany 24%, France as well has seen 30% increase. This is as per IRU intelligence platform, which is used globally to understand where fuel prices are going. So yes, that way India has not seen a price hike yet, despite higher crude oil prices. Let's stay with this news because this continues to be in focus. So we are now joined by Kenneth Fu, who's the Global Director, LNG Pricing at S&P Global Energy, to understand the gas part of it. Kenneth, good afternoon. Thank you so much for joining in. If you can begin by explaining how much of global LNG supplies have been affected since the time West Asian war has started. We saw attacks on energy infrastructure as well. So earlier it was a supply problem, but do you think now it's a production problem as well, and the global production is impacted now?
Yeah, that's a very good question. It is still very much a supply problem on a global basis because even though Asia's gas supply is diversified, the risk is highly concentrated. The Middle East remains the single most important pillar for Asia. Qatar and the UAE together account for roughly 19 to 20% of global LNG trade, and more than 80% of that volume flows to Asia. So almost entirely via the Strait of Hormuz. That creates a really structural choke point. Now, the US is the key flexible supply and the main balancing source during times of disruptions. However, what we are seeing is that US LNG export facilities are already operating close to maximum utilization, so effectively above 100% of nameplate capacity. So there is very limited scope to add incremental volumes in the short term to save the day. What the US provides is optionality. So cargoes can swing between Europe and Asia depending on price signals. So if you look further afield, what you have is also Australia. It continues to provide quite good baseload supply into Northeast Asia, not so much India and South Asia, while Russia still supplies China via pipeline gas and LNG, giving China a bit more resilience than South Asia and India. So the core takeaway is that when Middle Eastern LNG is disrupted, what you see is that Asia's marginal replacement supply would come from the Atlantic Basin, which means, longer voyages, higher freight costs, and structurally a lot higher delivered prices.
Okay, that point is taken, Kenneth. So yes, we could possibly be dealing with higher, longer timelines in terms of procuring LNG. But just wanted to understand that if you're talking about it from, say, a medium-term perspective, say maybe a 2-year perspective, how much of the energy infrastructure is damaged according to you, according to the people that you've spoken to? And hence, how long can this particular disruption continue for, and how extended can it be?
So the impact to energy infrastructure is definitely worrying, right? But let's talk about volume impact first. That impact is both immediate and structural. So we are talking again about 20% of global LNG supply being affected either directly by damage to liquefaction infrastructure or indirectly through shipping and transit constraints. So what we are seeing is that, of course, the news have arisen that 2 major LNG trains are offline, removing about 12 to 13 million tons per annum of supply. That's about 3% of global LNG supply for between 3 to 5 years. So you're talking about a longer time frame than your 2-year mark, which also represents about 17% of Qatar's export capacity. So beyond that, what we are seeing is that it will immediately tighten the expansion projects in the Gulf and tighten the medium-term outlook. Some assets may return within months, but critical LNG infrastructure would take that long, 3 to 5 or even more years to recover, and that will extend market tightness well beyond the immediate conflict period that could last for just several months. So this is not a short-lived outage. It shapes the whole supply outlook into the late 2020s. And to your question on prices right now at around $20 on a kind of a spot basis. And looking further forward to the rest of the year, we are seeing forward prices looking at around $18 to $19, and then post 2026 into 2027 dropping into the mid-teens. So you do see some softening on prices longer term, but that supply tightness means that prices are very unlikely to drop below the low teens or even to single digits over the next 3 to 4 years.
Okay, well, next to 3 to 4 years, it will not go below the $10 per MMBTU mark. And that has been the case. Spot prices have been around $4 to $5 per MMBTU, barring some supply concerns that we've seen in the past, right? Happens during winter and other seasonal factors that we see. Kenneth, quickly, if you can tell us, then you must be speaking to so many economies across Asia. You've been tracking it for so long. When such supply disruptions do happen, how do economies ensure that there's energy supply? Do you see that quick transition to alternate fuels? And if that is the case, is it easy to switch to that? And India, you spoke about it during India Energy Week as well, that it is emerging as price-sensitive swing buyer in the LNG market. How does that change things now?
Yeah, so economies across the globe are adjusting through different ways. So let's just talk really through the lens of Asia first and foremost. We are seeing some adjustments by consumers through price-led rationing. So you have fuel switching, you have demand curtailment. A lot of that has been happening within South Asia itself. So what we are seeing is that higher LNG prices are really forcing certain buyers, particularly those in India, Pakistan, Bangladesh, to already reduce spot purchases. In response, what we are seeing is power generators and industrial users across most economies, whether it's developed or developing, switching back to coal, fuel oil, naphtha whenever possible. So this reversion really underscores how energy security is taking precedence over your immediate fuel preference in the short term. In fact, just in the last 24 hours, Japan also passed a recent billing around unlocking some of its coal assets to start producing coal-fired power. India stands out as one of the most exposed countries, I would say, because it relies heavily on Gulf supply, both for LNG and LPG, and you have very limited gas storage buffers. And you use and imported gas in sectors that are economically and very politically sensitive, such as fertilizer, city gas distribution, and power generation. So, unlike crude oil, where you see strategic reserves providing a cushion, gas and LNG systems within economies tend to operate with far less flexibility. As a result, even partial disruption or your price spikes would have a lot of deep economic impacts.
Okay, all right, Kenneth, we're going to let you go on that note. Definitely a developing story, so we're going to touch base with you as and when there is more movement with regards to all of this. Getting you some global opinion while speaking at the CNBC TV 18 town hall, BlackRock's Ben Powell says the situation in West Asia remains quite alarming. And Labyrinth Consultants' Art Berman says that there will be a $10 permanent risk premium in oil. Listen in.
On the ground, I live in Abu Dhabi, the drone strikes have continued, the missiles have continued, and the Marines, the US Marines, I believe, arrive later this week. So I think the situation is frankly still very tense. The facts on the ground are mostly unchanged. Indeed, it feels more of an escalation in the last week than a de-escalation. So I recognize President Trump's words. Of course, I'm watching with huge interest, both as a citizen of the UAE and as a markets professional. But I think we need to be careful from being too confident and too optimistic, because sadly, as I say, the facts on the ground continue to be, frankly, quite alarming, and there is the potential for this to continue and worsen as these attacks on the physical infrastructure. Just overnight, we've had an attack on the Kuwaiti airports, one of the fuel depots kind of struck there. So I recognize President Trump's words, very important. He's the most powerful man in the world, but the facts on the ground continue to be unsettling, and that has not changed in the last 24, 48 hours.
I see no de-escalation. I see more potential for escalation. I think that the words from President Trump are purely performative. It's very difficult to have your negotiating partner take you seriously when you're moving, combat units into the area. There will now be a permanent risk premium on oil, regardless of how this thing ends. And I would say that premium is no less than $10 per barrel. And so if everything ends tomorrow, the very best case we can get back to is maybe $80 Brent. Now, I don't believe that everything's going to end tomorrow or that we're going to get back to $80 anytime soon.
Welcome back. Well, continued weakness for the markets. We have the bank Nifty, which is down around 2.3%. We have the mid-caps, which are now sulking with the over in 1150-point cut, as we can see. The India VIX should also come up for you because that had spiked up around 7% in the early part of trade. So let's see where that stands at this point in time, up around 8.3% currently for the India VIX, depicting the kind of volatility that our markets are seeing at this point in time. But the war in West Asia has disrupted the pharma sector as well in terms of the supply chain. Remember, around 99% of pharma feedstock is linked to petrochemicals. The pharma industry says that as of now, there's no immediate shortage. But to discuss this, where prices stand, we have Adish Patel, who's the CFO at Aarti Drugs, now joining in. Adish, thank you very much for taking the time out. Well, a majority of your revenues do come in from APIs. You also look at formulations. Explain to us what is the kind of disruption that companies such as yours have seen when it comes to the West Asia conflict. Say, for example, when it comes to gas prices which have risen, oil prices which have risen, shortages of gas which people are talking about.
Yeah. Thank you for having me. So this war has definitely affected API industry in a big way. And in fact, for that matter, all the manufacturing sectors. Fortunately for us, we don't have gas-fired boilers, but many industries who are working on gas-based boilers, they are facing shortage of steam as well. So production can be hampered. But for us, we are mainly into coal and briquettes, so we are not hampered that much. Whereas there are few raw materials, like, ammonia-based raw materials, IPA, phenol, acetone, and even methanol, which is a crude-based derivative. There, the prices have gone up quite significantly. In some of the cases, we have seen that almost 80 to 100% hikes are there. And in fact, when the war just started, there was slight panic in the market, as in where the supplies will come in or not. There was force majeure executed by a few of the raw material suppliers. The existing pending orders were cancelled, and then the prices were revised for new supplies. So as of today, fortunately, we are able to sustain our production in a decent manner. And we are also able to pass on the prices. There are existing pending orders for us as well, where we are trying to negotiate. Some we are able to pass on, some so we are taking hit 50% between the customers and us for the existing orders. And the newer orders are definitely going at a much higher rate.
Okay, so Adish, if you can quantify that for us, when you say you're able to pass on price hikes, how much of price hikes are you able to pass on? Because when ammonia prices or methanol prices are going by 80 to 90%, that is not the kind of price hike that you can give to customers. So what is the price hike there? And how much inventory do you have right now to take up new orders? Because there's a point in time when this war could continue and the supplies would be impacted. Right now, it's a pricing issue. If it becomes a supply issue, how much can you sustain?
Yeah. So inventories that way, we always carry an inventory of around 90 to 100 days when it comes to raw material, WIP, and the finished good all put together. However, till now, we haven't seen any cases where we think that we'll face the supply disruption. In fact, being in essential sector, government, we have also spoken with the government, and they're giving priority to us in terms of supply for gas-based raw materials, ammonia gas, etc. Then one of the major question of you is that whether we are able to pass on the entire price hikes to the customer or not. Well, fortunately, so in any API manufacturing, there are 7 to 8 raw materials which are used.
Yeah.
So the impact on the API prices is not equivalent, but definitely in some cases there have been like 30 to 40% hike in the prices of the API as well, and that is able to take care of the corresponding raw material price increase.
Okay. I just wanted to specifically talk about which are these APIs which have seen these price hikes of around 30 to 40%. And if you could also touch upon IBB, which is basically a key input for ibuprofen, and also metformin, which is one of your key products as well. Are you seeing any kind of shortages there in terms of, say, the inputs, the intermediates, and hence what the street is worried about is that eventually will there be a drug supply shortage, which any market could see, say export or domestic?
Regarding metformin and metronidazole are the two APIs where we have seen a bit of disruption in terms of the price hikes of the raw material because of ammonia and the derivatives of ammonia. Definitely intermediates of metformin were quite significantly impacted because of these disruptions, and that is where we have to take the price hikes, and we were able to take price hikes of around 30 to 40% in these APIs. We actually don't see any disruption as of now. Frankly speaking, the situation was much worse in COVID for production. And then as far as crude-based raw materials are concerned, the situation was a bit worse when the Russia-Ukraine war took place in terms of pricing and the price hikes we had to take. In fact, the prices of the APIs, if you look at the last 10 years period, it was still maximum in the year 2023 when that war took place.
Okay, all right. Are you seeing incremental orders as well because of, say, the conflict?
Yes, and yeah, I mean, actually, we are taking it slow because the pricing is so dynamic right now. You know, even if you book for like 2 months any raw material, but if the situation changes, the supplier will come and say again, enforce a force measure and say that we can't execute those pending orders. So we are also taking it a bit slow. We are booking orders only for 8 to 10 days as of now because of the pricing volatility till the situation stabilizes.
Take that point, Adish. Quickly, if you can tell us, you were to have 50% capacity utilization at your Sayakha facility. Has this been impacted because of whatever is happening?
Yes, because that is the facility where we are seeing shortages for the intermediates. Fortunately, that is the facility where we are producing the same intermediates which are being in short supply in the market in last 2-3 weeks. So we will be slightly insulated. However, the Saika plant utilization was slightly impacted, not majorly. Probably we might miss the mark by 5-10%, but still we are going to increase the production capacity as compared to December. That is what we believe.
Okay, all right, Adish, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Aarti Drugs talking about the fact that, yes, there has been a hike in terms of the intermediates and API costs at this point in time, but there is no shortage that we are seeing, and the situation is not as bad as, say, what we saw during COVID. We'll take a short break, but we'll be back with more. We'll be talking technicals and F&O on the other side, so stay tuned.
Welcome back. Well, while the benchmark index is not doing so well, a couple of stocks in the Nifty which are buzzing on the upside. We do have ONGC, which is up 4%. That, of course, is on the back of higher realizations because of higher crude oil prices. There's no fear now of whether there'll be windfall taxes on oil because that has been indicated by the ministry earlier. But, of course, now there's an export tax on diesel exports and ATF. So Reliance Industries is the one which is lower in trade. So these two stocks should be on your radar. IT has made a comeback. So TCS, Wipro, HCL Tech, all these stocks are higher in trade. Now it's a good time to then talk about the commodity space. We have Manisha Gupta joining us, and with her is Rahul Suri, Chairman and MD, Aeroplane Basmati, to discuss the commodity space. Manisha?
Thank you so much for that, and welcoming in Mr. Suri as well. Mr. Suri, hi, thank you so much for joining in. Your first reactions really to the West Asia conflict, and I do understand that this seems like a difficult period when it comes to basmati rice exporters. How has it been for you for the month of March in sense of exports?
Great, thank you so much. Thank you for inviting me. First of all, let me tell you a little bit about the company, and then I'll come to your question. So the company does, branded basmati, and manufactures and processes branded basmati. It has got three large plants. One of the biggest plants is in Amritsar, which is a mega unit, also produces its own electricity, and also a carbon green unit registered with the UNFCCC. Another plant is in Safilo in Haryana, which is known to be the capital of basmati, where the most aromatic basmati comes from. Then the third unit happens to be in Delhi, in Alipur. Coming to your question straight away, whenever these, we have seen in the past, whenever these geopolitical issues come in or something like COVID comes in, I would not say fortunately, but I would say, somehow the food demand triggers. So it becomes, completely opposite for the food, for food companies, because this is a basic, this is a basic requirement. Rice or atta is a very basic requirement, and that's what, the demand is triggered. So yes, of course, there is an issue with logistics, and maybe logistics have gone up, but the consumer is very much ready to, accept the price increase on this, because right now it's become the most important thing at home. It was just like LPG, just a few days in India, a few days before, that you needed it, so you don't mind what price are you going to pay for it. Somehow, I would not say this is good for, because for the world it's not good, but somehow, for companies in the food segment, this demand rather becomes higher than the normal, triggers, and there's a sharp spike.
Mr. Suri, I do understand that the food demand, the basic requirements does not go out. And yes, the international diaspora does or is ready to pay higher for the kind of rice that they want to eat. But US has been a bit of an issue. And now with Middle East on what's happening there, would you say that the overall export numbers, at least perhaps for this quarter, could see a decline?
I do not see that, because we were almost in March when this started. And with the, there was a disruption for about 10 to 12 days. Now they open up Khor Fakhan, Sohar, Salalah is open, Jeddah for Saudi Arabia is open, which is completely the opposite side of Dammam, which is not in Gulf of Hormuz.
Okay.
So it's become expensive, but it's not that it's not available. COVID was a different scene where the human being was not available, But right now it's expensive, the insurance is expensive, but that we are easily able to pass on to the customer.
Not a great news for importers, but for exporters, the current rupee, how does that work for you? Because as we speak, 94.71 of an all-time low for the currency.
Works in our favor somehow, because when you're in exports, it works for your favor.
At a time when most companies are struggling, and so is the equity market, Mr. Suri, we do understand that your IPO seems to be heading on quite strong.
Yes, by the grace of God, yes. I believe it is a 40 years legacy, which you started with my grandfather, my father, and I think it's probably, many customers which know us. I believe that is probably the reason that we have had a good response. And within these times, I'm very happy, and I'm very thankful to all the investors who have trusted us, and we look forward to keep their trust.
Mr. Suri, to the overall rice business then, and we do understand that there is a lot of competition now, a lot of people who are exporting, especially basmati rice. The other day we were talking about the kind of number of companies within that space as well. How are you looking at the overall markets? US and Middle East is what we've spoken about, but we do understand that India rice goes to 70, 75 countries therein. How are the rest of the markets opening up for Indian rice?
Yes, so as the consumer is getting is getting his capital his earnings are increasing. People are switching to basmati. That's what happened. All around the world. Saudi Arabia was a non-basmati player. India was all non-basmati. So as it's a tailwind is that from unpacked to packed and from non-basmati to basmati. So basmati still amounts to 5% of the total world rice, and basmati is 150,000 crores market. So imagine what is the size of 20 times the size of rice in the world. So I believe the tailwind is there, and slowly first the basmati is changing from unpacked to packed products, just like what happened in atta. There were times we were buying people just to make it cheaper would go to atta chakki and get it bring the wheat and get the atta from there, and now we buy probably any one of those brands which is available. Okay. We are also in the because we have entered into FMCG space already. So probably let's name a bigger one, let's say Ashirwad or something, and that's what is happening to rice. And I believe this will continue.
Okay, all right, Manisha, thanks very much for that. So bumper crop for rice. We're hoping that there could be a bumper crop for other commodities at this point in time. Thanks very much for taking us through that conversation. Well, it's definitely worrying for the rupee because now we're at the low point of the day in terms of a depreciation. 94.71 is where the rupee has hit on an intraday basis. Remember that when the Iran conflict or the West Asia conflict did begin last month, the rupee was at around 90.97. So it had already crossed over that 90 mark, and now it's all the way close to around 95. So it's been a rapid depreciation of around 4% that we've seen in just about 4 weeks for the rupee, giving you an indication in terms of what the street is worried about when it comes to the commodity prices as well as the FII outflows that the market has been seeing. We'll take a short break, but Ajit Mishra of Religare Broking will join in with some trading ideas on the other side. Stay tuned. Welcome back. Well, you're still tuned into Halftime Report on CNBC TV 18. Well, just a quick check on the rupee, which is now depreciated to around 94.7. Just want to give you a sense in terms of how the rupee has done versus other currencies from the start of the conflict. So the rupee is now depreciated around 4% but other Asian currencies such as the Thai baht as well as the Korean won have depreciated even more than the rupee since the start of the West Asia conflict. Malaysian ringgit, Indonesian rupiah, they've depreciated less as compared to the Indian rupee. But we have other currencies such as the Swiss franc, the euro, the British pound. All of them have depreciated over the past 1 month, but less than what we are seeing vis-a-vis the rupee. So this is basically a general picture in terms of what the rupee is trading at versus its Asian currencies. But Ajit Mishra now joins in to tell us about the technicals that he's tracking in the market. Ajit, hi, welcome to the show. Well, definitely a volatile day. We have the India VIX, which is spiked up as well. How would you approach the Nifty?
Yeah, good afternoon, Ekta. So, Ekta, in fact, if you see that in the last trading session also, when the market experienced a rebound, both the days, there was hardly any correction in the India VIX. It was still quoting at 24, and today we are again, inching toward 27 mark, while crude has reclaimed, $100 mark again. So both the critical factors are still pointing towards that it's too early to call that market has set a bottom, and there'll be a possibility that we might consolidate we continue to experience volatile swings within this 22,500, 23,500 band in the near future. In the next trading session, being the monthly expiry, also we expect that maybe closer to around 23,000, 23,100 is something that where we have the maximum pain based on the derivative data is something that markets might try to hold. But broadly, the tone is likely to remain on the negative side until we decisively see a move below $100 mark in crude and subsequent decline in the India VIX. But as of now, it's still a sell-on-rise market, when it comes to the index.
Sell-on-rise market for the index. What about individual bets, Ajit? If you can quickly tell us, is it a sell call or a buy call?
Yeah, in fact, you should look for ideas on both sides, considering that the market is offering opportunities, even on buy side, despite the overall negative tone. So pharma is a basket wherein we are seeing consistent strength. Sun Pharma, Oro Pharma, these are the names. Sun Pharma, wherein we are seeing a base formation around the short-term averages. We are anticipating a near-term target of around 1910. So with stop at 1750, one can look for buying opportunity in Sun Pharma. At the same time, from the defensive basket, FMCG, HUL is, in fact, witnessing further correction after the marginal rebound. So we are anticipating that this decline may further extend towards 1950 area. So with stop at 2160, one can go short in HUL.
Okay. All right, Ajit, thank you so much for joining in with your thoughts on the Nifty levels and individual stocks as well. We'll slip into a short break. When we come back, Manisha Gupta will join us and focus on recent moves in cryptocurrencies as uncertainty looms over West Asia peace talks. Stay tuned for that.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back. Let's go on to our special Crypto Corner segment. Cryptocurrencies rebound overnight after US President Donald Trump pauses strikes on Iran energies. Manisha joins us with more details on this one. Manisha.
Thank you so much for that. Yes, overnight we did see some gains come in for many of those cryptocurrencies, altcoins, etc. After we did hear US President extending deadline for Iran attacks by nearly 10 days. But when you look at a week-on-week basis or even YTD basis, it still is a weak year for the cryptocurrencies therein. This is what we've done on a week-on-week basis, like gold and silver and base metal prices. This isn't a week that is going positive for many of these cryptocurrencies as well. So you have Bitcoin, which is down 2.5%. 2% decline for Binance as well. And it is anywhere between 4 to 4.5% of a decline, which you can see coming in for Ethereum, for Cardano, for Solana as well. Ripple, which did gain quite strongly in the previous year, is down 5.5% for this week right now. The only one that I see positive among a few is Tron, which has gained up by 10% in this week. Well, let me remind you that the overall market capital for cryptocurrencies also has seen a decline. We've seen a record of 4.4 trillion in 2025. That has declined and come to below 3 trillion as we speak right now. This is what we've done in 2026 till time for many of these cryptocurrencies. So Bitcoin is down 21%. And when you look at the altcoins, Ethereum, Binance, Cardano, anywhere between 25 to 30% of a decline coming in for these as well. Solana and Ripple are down 25 to 30% as well. So the only one that is positive on your screen now also is Tron. And there is a reason for that, which is that there are various reports suggesting that Iran's central bank is accumulating dollars in USDT. This is a stable coin, and it is using this for forex intervention for itself and for the international markets as well. And much of these trades are being conducted in Tether's USDT stablecoin on the Tron network is the reason you're looking at stablecoins doing well. And then, of course, some of those platforms doing well, which are in use. So Tron on a week-on-week and YTD basis, trading quite in the positive.
Okay, all right, Manisha, thanks very much for getting us that check on the crypto space. We need to take a short break, but do watch out for stocks such as Reliance Industries, which is now down around 4%. We have Shriram Finance, which is down around 4.6% at this point in time as well. Tough day in terms of specific stocks. We'll take a short break, get you more on the markets once we're back. Stay tuned.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back. Well, currently for the Nifty, we're down around 350 odd points. The Sensex is now showing a cut of over 1,200 odd points. And it's not just the frontline stocks which are under pressure. We have smaller stocks such as Spark, which is down around 7% odd in today's trading session on high amount of volumes. We do have Vodafone Idea, which is down on huge volumes as well. And separately, we have banks which are under pressure. So Yes Bank is down around 2.2% at this point in time. So it's definitely turning out to be a day where we are seeing a lot of stock-specific declines. It's a wrap on Halftime Report. Business Lunch will take all of the action forward. Thanks for watching.
Stocks take a tumble as ceasefire hopes fade despite Trump's pausing strikes on Iran's energy assets till April 6th. Realty, auto and financials are the biggest losers. The government steps in to offer relief to oil marketing companies amid surging crude prices by cutting excise duty by 10 rupees on diesel and petrol. It also imposes a tax on fuel exports as a discouragement and to offset some of the burden. Infosys will buy 2 more businesses, taking its tally to 5 acquisitions for over $800 million this fiscal. TCS2 has spent near $800 million and HCL Tech and Wipro near $400 million apiece as Indian IT levers M&A to grow. The Indian rupee was in a new war-free fall. Goes over $94.50 as statements from Iran and US show no signs of de-escalation. The 10-year bond yield spiked to 6.94%, up 7 basis points as government's excise duty cut on petrol and diesel points to higher fiscal deficit. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnin, and with me as always is Hermas Fatakia, who's waiting by the wall. But the market's not doing well today. The sell-off in global markets not boding well for India. And, no resolution in that West Asia war is making markets fall even more. The Nifty is down nearly 400 points, 365 points in the red. Sensex also down 1,265 points. Broader markets are faring worse than the blue chips. Let's toss it across to Hermas, who's going to decode all the market action for us. Hermas?
One step forward, 2 steps back, and unsurprisingly, going into the weekend, traders want to remain light on positions. And the Nifty today, well, we're at least up for the week until today's session, but this 360, 400-point fall has now turned the Nifty negative for the 5th straight week. Not aiding sentiment whatsoever is the currency. It continues to fall, plunging to new lows today as well. 94.70 was the low, now at 94.65. So weakness continues in the currency, and the broader markets too are no different. And the advanced decline will tell you that the picture has not seen any improvement whatsoever. That line has only widened, and since then this yawning gap has become even bigger. 2,700 stocks on the NSE declining compared to just 400 that are advancing. You can take a look at the contributors as well. The index heavyweights are playing a big part in dragging the index lower. Look at Reliance and HDFC Bank together are contributing close to 170 points to the Nifty downfall. SBI, L&T and others, of course, bucking the trend. Some of the IT names and some oil and gas names. But look at the excise duty cut was the big story of the day in the morning. And the OMCs at one point were up almost 4 to 5%. They have given up all of those gains. Indian Oil, in fact, is now down 1% compared to the 2 to 5% gains that they had seen earlier in the day. The hardening of the bond yields, as Arundhati mentioned in the headlines, has had a negative impact on the PSU banks. In fact, the PSU bank index is the worst performing index this month already for the market. And take a look at these names: PNB, Bank of Baroda, Canara Bank, Indian Bank, all of them down anywhere between 3 to 5%. What's bucking the trend is IT, and unsurprisingly so because of the rupee and of course the news flow regarding Oracle as well. 4% higher on that stock, and the others seeing gains of anywhere between 1 to 2%. What's also seeing a positive reaction today are HEG and Graphite India. Positive news flow regarding both of these names. 11% higher for HEG, almost 8% higher for Graphite, slightly off the highs of the day, but still holding on to substantial gains. And lastly, stocks that are at a 52-week low in today's session. Aegis Vopak continues to make new lows, another 4.5% shaved off. Not good going for Amara Raja as well. And Bajaj Housing Finance is now at 76 rupees. The IPO price is 70 rupees. The stock had one point had almost touched 200 and is now cooled off almost 50-60% from those levels.
So Hermas there decoding everything that's happening with all of the market action today. Thank you for those details, Hermas. But moving on, the free fall in the rupee worsens, hitting a record low of 94.71 against the dollar. This as government bond yields continue to rise. Lata Venkatesh is here to put the moves into perspective. Lata?
Well, it was a sudden fall. The market was prepared for some fall, but once 94 crossed, it looked like the Reserve Bank did not stand in the way. And throughout the day, the rupee went lower and lower, or rather, the dollar went higher and higher from 94 to 94.50 to 94.70 and so on. The reasons are not far to seek. On Wednesday, when we stopped trading, there was still an optimism that the 5-day pause that President Trump had announced would lead to a de-escalation of the war. But the announcements or the statements of the last 24 hours have only proved the opposite. People had also gone somewhat less long dollar because of the money coming from MUFG for Shriram Finance, because the permissions had come. So there was kind of, not too many long dollar positions, and that's why you're seeing a kind of a rubber band effect, and the dollar went much higher than expected. The fundamental reasons were there. The crude bill is going to be higher. The government has also, imposed export duties on petrol exports, which means the government doesn't mind if our export earnings are less, but they don't want the hit to the domestic consumer. That is also a hint for traders that the rupee will be allowed to depreciate. The Reserve Bank was there at several points, but they were not defending a level, dealers said. And when I asked them, what is the level for the rupee? It was like it's a bottomless pit, which means at the moment no one is willing to take a position because current account deficit as well as, interest rates are going to take the rupee higher. The bond yield rise is what caught everyone by surprise. Actually, bond yields all over the world have been rising. So ours was headed higher, but this sudden 7-8 basis point jump was not expected with the 10-year bond going towards 6.95, which means it is inches away from the 7% mark. It's a double whammy for the bond market because with the government saying that the excise duty is going to be cut, it means the oil marketing losses are now becoming the government's cost. That is about 1.3 to 1.5 trillion rupee bill that the government takes. That's about 0.3% of the GDP in terms of fiscal deficit going higher. And for the next year, that is mostly, that will figure in the next year. Plus, there is a higher inflation. Even if the pump prices don't go up, there are other products that are rising because both the rupee is expensive and crude and petro products are expensive. Which means a whole lot of imports that Indians buy are going to become expensive. So there's the inflation hit and a fiscal deficit hit, and that's why the yields are going up. Also, there's no appetite to buy. For the banks, it's 31st March around the corner. If you're holding bonds, there are going to be mark-to-market losses. That's a further disincentive to buy at this point in time. Well, there is no saying that bond yields are going to stop at this level. There has been some buying at lower levels today, but it does look like yields are headed even higher.
15-month high for the yields, and not something that you would want to hear when you say what is the low, a bottomless pit. Well, Lata, thank you for that update there. Last week, in fact, we caught up with former IMF Deputy Managing Director Geeta Gopinath on what she makes of the depreciating currency.
At this point in time, if there is a real risk of oil staying at $100 a barrel for the rest of the year or more, that would be consistent with a deterioration in India's balance of payments. And in that case, a weaker rupee would actually help the country insulate itself against that shock. So I would keep keep the powder dry. India is strong in terms of its reserve position. It has about $700 billion of reserves. So in that sense, it is at a good starting point. But there is good reason also to keep your powder dry at this time.
We also caught up with Pranjal Bhandari of HSBC earlier today on what she makes of the depreciating rupee. Take a look.
Balance of payments has been negative for 2 years in a row, and I think this year is going to get even more negative because both capital inflows and the current account will not be working in favor of you. So I think that is one problem. The second problem is a slight shift in the reaction function of RBI, which I sensed somewhere in the middle of last week. I think until the middle of last week, they were intervening very heavily and very actively. But somewhere they have sort of reduced it a notch. And I think that's when the rupee depreciation has picked up. And we are now in line with the Asian average in terms of rupee depreciation. It's all right if our currency depreciates, as long as it's happening in a sort of, gradual way. We can intervene a little bit, but it's okay if the currency depreciates.
The government has now reduced the special additional excise duties on petrol and diesel amidst the global energy crisis due to the ongoing conflict in West Asia. The excise duty on petrol has been reduced from 13 rupees a litre to 3 rupees a litre, while the excise duty on diesel has been slashed from 10 rupees a litre to nil. Let's now hear out comments from the Finance Minister as she details the rationale behind this move.
अभी क्योंकि विदेश में मार्केट में दाम बढ़ रही है क्रूड का, उसके कारण पेट्रोल और डीजल का, एटीएफ का, माननीय प्रधानमंत्री जी ने ये चाहा कि कंज्यूमर का प्राइस बढ़ना नहीं है। उसके कारण हम निर्णय लिए हैं कि ऑयल मार्केटिंग कंपनीज को सपोर्ट दें और जिससे वो ज़्यादा दाम में खरीदने वाली चीज़ों को सरकार उनको मदद करेगी, मगर जनता के ऊपर रेट बढ़ाना नहीं होना चाहिए। एटीएफ बहुत इम्पोर्टेंट है। भारत देश का एयरक्राफ्ट्स और हमारी कंपनियों का एक एटीएफ मिलना आवश्यक है। उसके कारण भारत में बहुत सारे रिफाइनरीज हैं जो विदेश से माल खरीद करके इधर उसको रिफाइन करके विदेश को एक्सपोर्ट भी करते हैं, हमें भी देते हैं। मगर वो एक्सपोर्ट के ऊपर हमने अभी ज़्यादा रेट बढ़ाया, एक्साइज ड्यूटी बढ़ाया, जिससे वो एक्सपोर्ट ना करते हुए भारत में ही उनको सेल करेंगे, जिससे भारत में अवेलेबिलिटी का भरपूर अवेलेबिलिटी रहेंगे, लोगों को कमी महसूस नहीं होने देंगे।
So what's the impact of this excise duty cut on the oil marketing majors? Let's go across to Sonal Bhutra for more details on this. Sonal?
Thank you for that. Well, as the finance minister pointed out, this is a relief for oil marketing companies and nothing will go in the hands of the consumers. So oil marketing companies will see some relief on their marketing margins. So let's talk about the impact now. First, they've been looking at a lot of marketing margin losses to the tune of around 27 rupees per litre on petrol, 50 rupees per litre on diesel. And with this, those losses will come down. But do remember, despite this excise cut, the losses will not become nil. They will just become lower for all these companies. The second part, of course, it will help them with working capital issues that these companies have been facing, better cash management, cash flows will improve, and the fact that the excise duty has been cut will improve their P&L overall. Since retail prices are unchanged, the benefit will stay with the oil marketing companies. If we look at their balance sheet strength as well, it has been improving in the last couple of years, so they are in a better position to absorb such shocks that would come by. For IOCL, BPCL and HPCL, for all of them, net debt to equity has been coming lower. If you look at a BPCL, it is at 0.3 times. For IOCL, it has reduced to 0.8 times. If we talk about HPCL, which has the highest exposure to the marketing segment, that's where it is 1.4 times. But yes, it has been reducing for all these companies. For consumers, as I said earlier, there's no change. Inflation remains as is. Household budgets will not change. And you will pay the same prices for petrol and diesel as you've been paying earlier. The other change that has come by is they've increased or they have levied export duties on export of ATF and diesel. This is to ensure that there's enough domestic availability of these two fuels and there's no shortage as such. So it has been increased by 21.5 rupees per litre on diesel and 29.5 rupees per litre on ATF. But this is a positive move considering that there will be enough supply in the country itself. But some of these exporters like Reliance, CPCL, MRPL, they will be in focus on the negative side because of this. Now, just a quick check on how prices have moved globally as far as fuel is concerned. How much have they increased since the time the West Asia war has increased? For India, it has stayed as is. For US, it has been to the tune of 38%. UK has seen a 24% increase. Germany at similar levels. And France has also seen an increase of 30%. So there has been no price hike for customers. There's a relief in terms of excise duty cut that has come for oil marketing companies.
Sonal, thank you for that update there. The oil marketing company significantly off the highs of the day. Now, the Bombay High Court has dismissed a petition seeking a CBI probe against Reliance Industries and its director Mukesh Ambani for allegedly stealing over $1.55 billion worth of natural gas from ONGC wells in the Krishna Godavari basin off the coast of Andhra Pradesh. We'll take a short break, get back with more news and updates on the other side. Stay tuned. Welcome back. Now, as the war in West Asia continues to escalate, US President Donald Trump says that on the request made by the Iranian government, he is pausing the strikes on Iranian energy infrastructure for 10 days. Dan Murphy is now joining in with the latest. Dan, a lot of back and forth from the Trump administration. What is the clarity that you are getting right now from West Asia?
Well, back and forth is the right way to put it. Good morning to you from Dubai, where the war is entering day 28, and markets are really trading the competing narrative and the fog of war, if you could call it that. We saw US markets suffering their worst day since the war began, and initial optimism for a quick de-escalation faded. As you've been reporting, Asian indices following Wall Street's lead, with the region really bearing the brunt of the energy supply shock. And of course, oil prices also continue to show a bias to the upside as well. Brent crude on track for a 40% gain so far this month. And this is all against the backdrop of the Pentagon now considering sending up to 10,000 additional ground troops to the Middle East, on top of the thousands of Marines and paratroopers already ordered to the region. That is to give President Trump more military options here as he weighs these peace talks that he says are underway with Iran. Overnight, the president confirmed that he would extend this deadline for Iran to reopen the Strait of Hormuz for a second time, now pushing that out to April 6th. Trump saying the extension was at Iran's request. Iran says they never asked for it. And of course, those two accounts cannot both be correct. However, we are seeing some signs of negotiation actually taking place, which is quite interesting. Iran actually allowing several Pakistani-flagged oil tankers through the strait, which President Trump called a present, showing that Iran's leaders are serious about getting a deal done. But of course, with only a handful of vessels transiting daily against what was a pre-war figure of around 130 ships, the strait effectively remains closed, which is why we're seeing that risk premium continue in oil. And as we come into the weekend as well, that is precisely why the question of a ground operation is no longer just a hypothetical here. President Trump has hinted that he does not want a long war, but also appears to be leaving the option open of putting boots on the ground on Iranian soil, as the scale of the troop buildup now underway suggests that the military may actively be planning for that possibility. The most discussed option is, of course, an operation to seize or to neutralize Karg Island. And I know you've been speaking about this as well. This is Iran's main oil export terminal, which would really strike directly at Tehran's ability to fund the war and to maintain its stranglehold on the Strait of Hormuz. Of course, whether or not this actually eventuates remains to be seen at this point.
All right, Dan, thanks for laying out what's happening in West Asia and all the back and forth between both countries. But on that note, it is time for us to head into a short break. More news and updates on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. Infosys has announced two strategic acquisitions, Optimum Healthcare for $465 million and Stratus Global, which is an insurance play for $95 million. And with this, Infosys has made 5 acquisitions this year, spending a total of $800 million, making it one of the highest acquisition spends in a single year for the company. Our Indian IT companies getting more aggressive on M&A. Reema Tendulkar is here with all of those.
The big one, of course, is what they announced, $465 million for Optimum Healthcare. You had Stratus Global, which was announced. Prior to that, there was Versan, which was announced by the company. This is amongst the highest that the company has ever spent on acquisitions in a single year. So last year, that's FY25, the company spent a little less than $500 million to acquire Intech. In the prior year, it was a modest, they were tuck-in acquisitions that the company had done. So as you can see, this year, with $808 million, it's been far more aggressive than it's been in the recent past. TCS, now this was a company you would remember which was known for its organic growth discipline. They spent $773 million in FY26, the highest since their listing in 2004. They made 2 acquisitions, and plus they had those data center investments. It's a big strategic pivot for the company. And when we chat with the management, they tell us more M&A is lined up. Now, HCL Tech and Wipro, on the other hand, have used M&A far more steadily across periods. So this year, HCL Tech has spent $420 million. They made 4 acquisitions. And Wipro did 1 acquisition. It was called Harman DTS. And they paid a little less than $400 million for that. But in the past, Wipro has made large bets like Capco and Rising. But, you know, outside of the large 4 IT companies, the biggest, the boldest bet came in from Coforge, when it acquired Encora for $2.3 billion. And outside India's shore, it was Capgemini acquiring WNS for $3.3 billion. Now, why is this happening? FY24 to FY26 has been amongst the weakest phases in terms of revenues for the Indian IT companies in over a decade. Revenue growth has slowed to low single digits now. AI is reshaping the whole industry. The traditional model of hire, scale, bill is under pressure. It's getting questioned. And AI is also compressing the timelines. So now buying capabilities is faster than building capabilities, and Indian IT companies seem to be responding to that by getting faster, sharper, and more aggressive on the M&A front.
Reema, thank you for that. What's also happening faster and sharper is the fall in the rupee. 94.78 now, a new low for the currency against the dollar. And the market too is reflective of that. 360 points down on the index as we speak. A new low for the currency. Take your leave on this edition of Business Lunch from Barundhati and me. Thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me today is Harmis Patakia. Harmis, good afternoon. What a day and what a fall in the markets, fall in the rupee. That's been a free fall since the time we started trade. There's been an excise cut, mid-caps are not doing well, and there's no clarity on West Asia war.
I'll run out of breath after saying all of that has transpired in just for a couple of hours now since the trading began. And well, that's been the kind of market that we've been in all through the week. One day up, one day down, and down a little more severe. But let's take a look at what are the headlines in store at 1:30 this afternoon. Stocks have tumbled as ceasefire hopes fade despite Trump's pausing strikes on Iran's energy assets till the 6th of April. Realty, auto and financials are the big losers.
Shares of Graphite India and HEG surge as US-based industry leader Graphite hikes graphite electrode prices by $600 to $1,200 per ton. Price hikes in response to lower prices over the past few years, coupled with rising raw material costs amid the West Asia war. Shares of Graphite India and HEG higher amid weakness.
Shares of Oracle Financial have fired up in trade today after the company signed a $100 million perpetual licensing deal with a US global bank.
Gujarat Gas has asked industrial customers to review and rationalize their April gas consumption to help manage tightening supplies. Sources told CNBC TV 18. This comes as industrial gas prices are set to jump sharply.
That is, 74 stocks on the Nifty 500 are with gains. So the free fall that we saw on Monday, there were only 20 or 25 of them. And that's one positive. There are still double-digit gainers in the mid-cap index and the small-cap index today as well. But of course, we were supposed to end the week higher until Wednesday's close. That's not the case as of now. It will close above 23,150 in that case, but that seems distant as of now. But what are the top movers in the broader markets today? Ria is here to take us through all of that. Ria.
Well, Homers, even in today's market, a lot of stocks have managed to stay in the green, starting off with HEG as well as Graphite India, both trading with very strong gains today as a global leader in the graphite electrode manufacturing space has announced steep price hikes. Acme Solar as well trading with gains of roughly 5% today as they have commissioned a 4-megawatt wind power project in Gujarat. Oracle Finserv as well higher by roughly 4.5% as they sign a $100 million deal to license software to a bank based in the US, and even Brigade Enterprises trading with gains of roughly 5% today as they have launched a residential project in Bangalore with a revenue potential of roughly 700 crores. But apart from this, the Nifty PSU Bank continues to be the top sectoral loser in today's trade, down roughly 3% at the moment. Bank of Baroda, Canara Bank, Indian Bank as well as UCO Bank down anywhere between 3 to 5% today. Among the individual losers today, we have Reliance Power, which is down roughly 4%, PTC Industries, Chennai Petro, Godfrey Phillips, as well as First Source Solutions trading with cuts of anywhere between 4 to 6%.
Priya, thank you for those updates there. Let's also welcome in Hemen Kapadia from DR Choksi Finserv for a quick chart check. Hemen, good afternoon. Thank you for joining in. It's a one step forward, two steps back sort of a scenario now for the index. We are heading towards that 22,900 mark yet again. But with the kind of fall that you've seen, do you see a retest of Monday's lows that we made on the index, or do you see some support at that 22,900 level? That and your stock calls as well for the afternoon.
A very good afternoon to you, Thomas. Thank you for having me on the show. It's always a pleasure. Two steps forward, two steps back. You remind me of a Paula Abdul song, Opposites Attract. But anyways, on a serious note, I think you guys have covered everything. The rupee, the VIX, frankly speaking, there is nothing left. And I don't think, but yeah, coming back to the crux of your question, I think there is some semblance of a support. Monday's lows, I think, could be holding. IT is one of the main reasons why I'm seeing this. Reliance is under pressure today, but it had been showing relative strength until today. Markets are deeply oversold, Hormas. So, I mean, I don't know, it's a very event-driven market, but frankly speaking, we are at support. Something like an HDFC Bank has bounced from a support. So, yeah, I don't think Monday's lows would be broken very easily. And I believe there is some respite going on in terms of a recovery.
Some respite. Okay. Oh, please go ahead. Go ahead.
Yeah, sorry. Yeah, stocks which Hormas told me to look at. I mean, going with the IT theme, I believe IT is set for a recovery after a precipitous decline. Firstly, a buy call on Infosys, deeply oversold, positive divergence, oscillators, crossover buys, a small rounding bottom on the daily chart. Everything seems to suggest, I mean, this goes for the whole sector, but specifically Infosys, recovery. It's been very mild, but that's still around the corner. So one can buy Infosys at around 1270, stop loss of 1245, target of 1320. The second one looks a more sort of conviction call, Hormas, IPCA Labs. We've been over here for quite some time, and these levels look like being taken out after almost more than a year. Rounding bottom, above moving averages. Once again, the weekly picture is looking strong. The script is on the cusp of a breakout in a market which is extremely wobbly. So buy on IPCA Lab at 1580, stop loss of 1540, target of 1660. Modest target, I believe it should get overshot. Yeah.
Okay, take that point. Amin, thank you so much for joining in today. So those are some technical bets on individual names and the benchmark indices as well. With that, we'll slip into a short break. When we come back, we'll get you on more on the markets and a lot of stock-specific action that's happening in the broader markets. Stay tuned for that.
Welcome back. Still 380 points lower on the index, but the one stock that has been fairly resilient through the day has been Oracle Financial, and Rima is here to tell us exactly why. Rima.
Thanks so much for that. So the company has signed a definitive agreement with an existing US global a US global bank for a $100 million deal. This is an existing client for the company, but they're saying this deal supersedes any contractual obligations that the company had prior. It is one of the largest client-specific licensing deals for OFSS in the recent times, and therefore it provides strong revenue visibility for Oracle Financial Services, which is why you're seeing in a weak market, the stock is holding up in the green with a gain of about 5%. And plus, the stock is down 47% from its all-time high levels of 13,222. Back to you.
Okay, all right. That is about Oracle Financial Services. After that big fall, is seeing some gain in an otherwise weak market today. Let's talk about Gujarat Gas. We've been talking about how it is the most impacted by LNG supply cuts that we've been seeing, and it has issued gas supply cuts notification to customers as well, and there has been some notification from the government where there is some recalibration with gas supplies to industrial customers. Gujarat Gas has now written to industrial customers and they've asked them to assess gas consumption in April already in order to ensure the supplies that would come by or manage or recalibrate those supplies as well. Remember, it is a phased supply that will come by for those consuming more than 50%, for those consuming more than 80%. The prices will also differ accordingly. So prices have actually increased from around 43.6 rupees per SCM plus VAT to anywhere between 85 to 88 rupees plus VAT. So that's a big hike which would come by if you increase the threshold of consumption that Gujarat Gas has spoken about. Interestingly, industry has said that if less than 70% of gas is allocated, they will not be able to continue production and they'll halt the entire production line because they need gas 24/7 for production of tiles, which is the major consumer for them. They've been asked to give more bank deposits or bank guarantee ahead of these supplies as well, which is becoming a working capital issue for them. So this gas chain supply continues to be a problem, and Gujarat Gas has reiterated that, saying that April consumption has to be contained or at least recalibrated in order to ensure enough supplies for consumers.
Indeed, and there's some developments there around Gujarat Gas. The stock is looking to recover from the lows of the day, but still 2.5% lower. But a couple of stocks actually that are bucking the trend today, apart from Oracle Financial that Rima spoke about, are Graphite India and HEG, both among the top gainers today on the Nifty 500. Let's go across to Nigel to understand what exactly is triggering this up move. Nigel.
Well, that's right. Graphite electrode companies here in India, well, they are buzzing in today's trading session. The reason is that GrafTech overnight, they announced that they're increasing the graphite electrode prices by around 600 to around 1,200 rupees per ton. So there's a bit of a variance out there. This is good news because for many, many months, we haven't seen a price increase, and that too to this quantum. We'll have to understand the exact quantum and on which products this is going to be increased. For the time being, the street is taking it positively. But we'll have to track a few points from here on. One, how much will the domestic players go ahead and increase prices? That's point number one. Point number two is that input costs as well would have gone up. Whether it's freight cost, whether it's needle coke prices could have probably gone up as well. And point number three is price hike is good, but it could be offsetting part of the input cost hike. So you'll have to see it on the margin basis how much actually comes down to it. But for the time being, the street is fixated on the fact that GrafTech, which has close to 25 to around 30% of the global graphite electrode market, they have gone ahead and increased prices, which sets some kind of momentum for these graphite electrode players who have otherwise been reeling under pressure. Back to you guys.
Nigel, thank you for that update there. Take a short break. More of the markets and specific stocks on the other side. Stay tuned.
Welcome back. You're still tuned into Midcap Radar, getting you some global opinion now. While speaking at the CNBC TV 18 town hall, BlackRock's Ben Powell says the situation in West Asia remains quite alarming, and Labyrinth Consulting's Art Berman says there will be a $10 permanent risk premium in oil. Listen in.
On the ground, I live in Abu Dhabi, the drone strikes have continued, the missiles have continued, and the Marines, the US Marines, I believe, arrive later this week. So I think the situation is frankly still very tense. The facts on the ground are mostly unchanged. Indeed, it feels more of an escalation in the last week than a de-escalation. So I recognize President Trump's words. Of course, I'm watching with huge interest, both as a citizen of the UAE and as a markets professional. But I think we need to be careful from being too confident and too optimistic, because sadly, as I say, the facts on the ground continue to be, frankly, quite alarming. And there is the potential for this to continue and worsen as these attacks on the physical infrastructure. Just overnight, we've had an attack on the Kuwaiti airports, one of the fuel depots kind of struck there. So I recognize President Trump's words, very important. He's the most powerful man in the world. But the facts on the ground continue to be unsettling, and that has not changed in the last 24, 48 hours.
I see no de-escalation. I see more potential for escalation. I think that the words from President Trump are purely performative. It's very difficult to have your negotiating partner take you seriously when you're moving, combat units into the area. There will now be a permanent risk premium on oil, regardless of how this thing ends. And I would say that premium is no less than $10 per barrel. And so if everything ends tomorrow, the very best case we can get back to is maybe $80 Brent. Now, I don't believe that everything's going to end tomorrow or that we're going to get back to $80 anytime soon.
Since we are on the subject of oil, those prices too, after that initial dip that we saw in the morning, have reversed. Brent is now nearing $109 a barrel as we speak. So the gains back in oil nearing that 110 mark now for Brent. The one stock that is holding out as a result of this on the index is ONGC, is now at the highest point of the day, 5% higher on that stock, even as the index continues to struggle. And as a result of which, the stock, along with as one of the few names on the index that are still continuing to trade with gains, others being, of course, TCS and Wipro, and a couple of other PSU names like Power Grid and Coal India that are seeing some modest gains as we speak. Take your leave on this edition of Midcap Radar. From Sonal and me, thank you for watching. Your stocks on the other side.
Good afternoon. You're watching us here on Your Stocks. We come to you live from the CNBC TV 18 Motilal Oswal studio. This is a show where we answer all your stock and investment related queries. I'm Mangalam Malu, with me Sonal Butra. Obviously, joining us today are a bunch of experts. We have Pankaj Patel, who's the head of retail research at ICICI Securities. Along with him is Mitesh Thakkar, president retail at Bonanza Portfolio. Thanks a lot, gentlemen, for joining in. Before we get to the queries, Mitesh, I have to ask you this, because over the last couple of weeks, you've been saying that the market is structurally weakening and any sort of rally should be used to short this market. The 2 days of rally that we got, we've seen the market come off from those levels. Do you think there are further lower levels from 22,900 right now? Because oil is rising, yields are rising, the rupee is weakening.
I think, I eventually do look at the possibility of lower levels. The first level which I'm watching is the last time, when the markets bottomed out, which is rewind the markets back a year around this mark of 22,000. That's a very important support given the fact that there were multiple lows made on those levels. So on the long-term charts, 22,000 is very important. But the structure is weak, which means that even if we give a good reversal from 22,000, the threat of it breaking eventually in the next 6 to 9 months remains. So the market for me is a weak market. What can happen is that since we have fallen with a lot of velocity, we'll keep getting those bounce back from oversold levels.
Okay, take that point, Mitesh. That is on the benchmarks and markets overall. Let's get some specific queries going. And this one is to you, Pankaj. It is coming in on 2 stocks, and from Rishikesh Prasad. He's writing to us from Bihar. He holds 500 shares of Indian Railway Finance purchased at 168 rupees. He also asks if we can buy Canara Bank at current levels. Considering the moves that we've been seeing in the banking names, what do you suggest, Pankaj? Should these be a part of their portfolio? Should be held? What's your take?
Yeah, hi, good afternoon. Thanks for having me. See, on IDFC, this company has done well from the perspective that it is the sole financial for Indian Railways with a book of somewhere about 4.7 lakh crores. And largely, historically, this company has always commanded good asset quality, largely because of the sole financial. But in that process, what they earn is some 40 bips kind of a spread. And company is now looking to sort of foray into renewable energy and metro in order to sort of increase the spread to somewhere about 100 to 120 odd bips. Now, this stock is already trading at about 2.2 times adjusted book basis, which we feel is quite okay. The only challenge is that if you are sort of foraying into renewable energy and other segments, the underwriting risk can sort of crop in. So our sense is that one should sort of exit this. And also the government stake is still sort of quite high. So overall sense is that you'll continue to sort of keep seeing supply in this stock. Coming to specific to PSU banks, I think compared to private sector counterparts, we feel that PSU banks are a better of the lot. And within that topic is Bank of Baroda. Our sense is that second half the growth will pick up. And valuation-wise, they are sort of okay. So I think Canara Bank or even Bob look attractive to us.
All right. Mitesh, do you have a view on both IRFC and Canara Bank? You believe that Canara Bank is a decent accumulator at current levels?
So I think PSU banks are slightly better than the rest of the bank, no doubt about it. But what is also important is the fact that the stock is also undergoing some kind of a corrective movement. To my sense, if we are looking at to getting into Canara Bank, I think the idea should be that 120 to 115 are big supports on the long-term charts. I think that's a good level to accumulate and keep a stop below 104, and 155, 160. Whenever it bounces back from those levels, is the target area on the upside. And IRFC, I think, still is weak. I think the long-term charts are negative, which means that there's another 15-20% decline which could happen before the support levels are being hit. So try to, if the investor can hold on, try to buy around these levels of 75, keep a stop below 65, and on a bounce back, exit around 105 to 110.
Okay, take that point, Mitesh. Those are some technical views on these two names. Let's go across to the next query. Adarsh is writing to us from Bengaluru. Holds 665 shares of CG Power at a price of 105 rupees. He asks if we can hold the stock for the long term or should he book his profits. There are decent profits that he's making. The buy price is 105 and he's kept it till 673, which is now. So long-term investor. But Mitesh, tell us, what do you make of this technically?
Which one, sorry?
It is CG Power.
CG Power, yeah. So CG Power to me, I think, is one of the good stocks in the sense that the long-term charts, even in this market decline, has been sideways. If you look at the last 1.5 years of charts, it's doing a range of broadly about 530 to about 780, give and take a few points. And so hold it till it breaks 510, 500 support level. But a good chance is that once the market correction plays out and the stock keeps on consolidating, it will eventually break on the upside and head towards 1,000 plus levels. So to me, it's one of the better stocks in this market to remain invested into.
All right. What's your view on this, Pankaj? Pankaj, on CG Power? I think he can not listen to us right now here, but let's move on. And we have another query that comes in, and this one is from N. Gopalakrishnan, who writes to us from Chennai, holds about 2,000 shares of APJ Surendra Park Hotels. 160 rupees is his buying price, losing about 1.1 lakh rupees on his investment. Also has 1,000 shares of Saregama at 460 rupees. Wants to know whether he should continue to hold or book his losses in the current weakness. He's losing about a lakh and a little more on both Saregama as well as APJ Park Surendra Hotels. Pankaj, if you can hear us now, do you have a view on... Okay, we'll probably go back to Pankaj later once we fix that audio. Mitesh, both APJ Surendra Park Hotels and Saregama are currently way off his buying price. What are the charts suggesting on them?
APJ, I think, I don't have a very clear view purely because the history is slightly limited to work on the monthly and the quarterly charts. So I don't have a very good idea about the long-term outlook. So I would suggest take a fundamental call over here. And coming to Saregama, I think the bigger support for the stock is around 290 to about 275. That's on the monthly and the quarterly charts. And we are roughly about 10-12% away from that. So if the investor can hold on, try to buy more around those 275 or levels. 290 to about 275 odd levels, and for the fresh quantity, keep a stop below 265. In case the support levels hold, which is my understanding that there's a strong chance of that happening, and then the price kind of rebounds into a short to medium term uptrend, I think anything close to about 380, 400 would be a good exit.
Okay, take that point, Mitesh. Let's go to the next query. Suma is writing to us from Lucknow with an investment query. She asks if it is a good time to buy Hindustan Copper. What do you make of this one, Mitesh?
Yeah, again, like other stocks, Hindustan Copper is also corrected a lot. But this is one stock, when the monthly indicators, the quarterly indicators are still in a rising mode and the averages are also pretty positive. So I think a good chart, but then you should identify where to enter because, if you enter at higher levels and the corrections keeps on going, then you might be worried about making a mark-to-market loss. My suggestion is that around 410, 415 to about 380 is the zone of long-term support levels for this stock. So that entire 30-point zone from 415 to about 410 to about 375 is a good area to look into it. So another 10-12% lower, I think he can get into his accumulation mode and keep a stop below levels of 340. And once this correction plays out, Hindustan Copper, I think being an outperformer on the long-term charts would have the power to get back to 550, 600 zones, which is where profits can be booked.
All right, we take that point, Mitesh. As we speak at the bottom of your screen, there are some important updates that have come in. There is an inter-ministerial panel formed under the Defence Minister Rajnath Singh with regards to the West Asia war, and the market continues to, reel under some bit of pressure. Now, 400 points and counting on the Nifty had briefly broken that 22,900 mark as well. So this morning we've broken through important levels, 23,000 first and 22,900 right now. And it's more of the same stocks that are pressuring the frontline index lower. Shriram Finance, the top loser on the Nifty. Reliance down about 4.5%, the top contributor on the downside to the frontline index. But we're answering some of your queries. This one was on Hindustan Copper. Pankaj is back with us. Pankaj, if you can hear us, our viewers, what Hindustan Copper wants to know, or rather wants to know whether it should be bought right now or not. It's a stock which has seen a big rally and after that saw a big correction as well, fairly volatile.
So, see, Hindustan Copper, the issue is that this is the only company in the PSU copper ore mining space. And when we sort of look at overall, this year, the prices have improved from, say, $9,500 to somewhere about $12,000 plus dollars. Now it's sort of currently lower. So, as and when the copper prices turn volatile, the stock is also sort of volatile. From a production perspective, this company mines about 4 million tons and expected to sort of take it to about 12 million tons, but that will happen by 2031, which means that anyone who's sort of looking to buy should hold it for more than 5+ years. Given the fact that when you look at valuation, this is trading somewhere about 40 times EV by EBITDA. Whereas when we sort of look at most of the metal companies, typically the valuation range is between 8 to 10 times on a EV by EBITDA basis. So unless the horizon is 5+ years, the stock is going to be volatile. So it all depends on the horizon. If the horizon is not there, then I would suggest to sort of switch to the ferrous counters like, say, SAIL or Tata Steel.
Okay, take that point. Gentlemen, hold on. There's an important story flashing at the bottom of your screen. Sources tell CNBC TV 18 on the interministerial panel formed under Defence Minister Rajnath Singh with respect to West Asia war. Sapna is joining us with what she's picking up and what this could mean in response to what's happening currently.
Absolutely. So this is exactly what you're given to understand, that a new interministerial panel has been formed under Defence Minister Rajnath Singh. Of course, this is regarding the West Asia war, and the panel is going to take all the important and necessary action that we required in with respect to the ongoing crisis in the West Asia region. We are also importantly given to understand that probably some more tax relief could be possible on a few more items. Government has taken a big decision by cutting the excise, very steep cuts on petrol and diesel. Of course, there has been export duty levy also in terms of ATF and diesel exports. However, so any further tax relief, probably on any other item, mainly energy related, this could also be taken by the panel. So that's something important to watch out for. Of course, it's headed by the Defence Minister. But also the Finance Minister, the Home Minister and the Petroleum Minister, among other senior cabinet colleagues, are part of the panel, cabinet colleagues of the Minister's concerned. Over to you.
All right, Sapna, thanks a lot for that. So some tax reliefs on more items not particularly ruled out. This interministerial panel very crucial to track how the developments in the West Asia war go, and our response to that would be from the government and the citizenry perspective. Meanwhile, market continues to sell off, even in the broader end of the stocks, which are seeing a bigger gash right now, over 2,700 stocks in the red. We'll take a short break, come back, continue to answer your stock and investment related queries. You're watching us here on Your Stocks.
Welcome back. You're still tuned into CNBC TV 18. Your stock still with us. Pankaj Pandey of ICICI Securities and Mitesh Thakkar of Bonanza Portfolio to answer all your individual stock queries. The next one is coming in the hospitality sector. Pankaj, let me take it up with you. Sriram writes to us from Chennai. He holds 75 shares of Mahindra Holidays at an average price of 149 rupees a share. He's a long-term investor and asks if he can add more shares. There is some profit that he's making, Pankaj. Do you think at current levels it's a good buy? Or should wait out till the time we see the West Asia war crisis impact that we've been seeing across the market?
So on the Mahindra Holidays, our sense is that the entire hospitality as a space looks attractive to us, given the fact that demand is expected to grow at nearly 9.5–10% whereas the supply at best is going to grow at some 6.5%. Mahindra Holiday and Resorts, the key issue was that the member to room ratio was some 61, which was on a higher side. Now that has sort of come down to about 51, which is in line with the global standards. In addition to that, they've got about 6,300 rooms and looking to sort of take it to somewhere about 10,000 kind of rooms. And which is why I feel that the overall top line and bottom line growth could be sort of good for the company. So from a long-term perspective, I think he can continue to hold the stock.
All right, continue to hold the stock with a long-term perspective in mind. KS Rao writes to us from Andhra Pradesh, holds about 200 shares of Indian Overseas Bank at 31 rupees, wants to know the prospects of the company. Mitesh, on the charts, how does IOB look to you?
Like other stocks, I think IOB is, while it's in the public sector banking place, which is a slightly better place. But again, the long-term charts have turned weak over here, and there could be some more downsides, about 20–30% from the current levels, which means that I'm looking at bigger supports coming in around the levels of 25 to roughly about 27. So I think that's the range. If we can hold on to that, I think try and buy more around those levels. Keep a stop below levels of 22, and on a bounce back, I think anything beyond 40, and in a good case around 46 is the target price.
Take that point, Mitesh. Pankaj, come in on this. What's your take from a fundamental view?
So on the Indian Overseas Bank, recent numbers have been pretty good. We've seen about 50% plus growth in profits for the third quarter. The credit growth of the bank is also pretty robust at around 24–25%. And I think when we sort of look at ROAs, have also improved to about 1.28%. But a lot of it is there in the prices because it is trading at a premium compared to the PSU counterparts, somewhere about 1.8–1.9 times book. And in addition to that, the government holds somewhere about 92.5% kind of a stake. Obviously, they need to sort of bring down the stake. There is a chance that possibility they might get relaxation, but our sense is that this stock will probably continue to witness supply from the government. And which is why our sense is that most of the positives are there in the stock, and which is why we would sort of recommend to sort of exit this stock.
Right, a lot of PSU queries coming in today. Ravi writes to us from Bengaluru. He holds about 16,000 shares of NCC and his average price is about 209 rupees. He's a long-term investor, wants to know whether to hold or sell at current levels. Pankaj, your thoughts on PSUs? NCC in particular?
So on NCC, since he has been holding it for 5+ years, our sense is that this is definitely not a portfolio stock. In general, EPC as a category requires a lot of things to sort of get right to sort of perform. Now for this one, the order book is quite healthy at 72,000 odd crores. Order book to bill ratio is also good at 4 times. And the challenge is that some of their money got stuck in the Jal Jeevan Mission projects. And as a result of that, their working capital days had sort of gone up from 78 days to some 87 odd days. And as a result of that, the company had to sort of taper down the execution. And our sense is that till first half of next year, the execution is expected to remain weak. Subsequently, it should pick up. And that is where probably that will give him an opportunity to sort of exit. Our sense is that NCC or in general EPC companies are not a portfolio stock.
Okay, not a portfolio stock. That's the word on NCC. Let's go to the next one. K. Padma is writing to us from Andhra Pradesh. She holds 200 shares of Quality Walls at 26 rupees. Long-term investor wants to know if she should continue to hold or sell these shares. Mitesh, coming to you first on this. What do you make of this one?
Yeah. The Quality Walls, for me, I think the problem is the amount of chart which I have is very limited. I think the stock got relisted So on the NSE, I think I have only about 4 or 5 months of chart. So I think I'll pass it on to Pankaj. He might be better placed to advise on this.
What about you, Pankaj? What's your view on quality walls?
So this company got demerged from HUL. Now they've got new promoters. And our sense is that with the open offer, the promoter stake is also expected to sort of go up. They've got pretty good distribution network, one of the largest cold chain networks as well. Our sense is that on a FY28 basis, on a EV by sales basis of some 4 times, the potential for the stock to go up to somewhere about 40-45 rupees is there. So he should sort of hold the stock at current levels. The stock is definitely down, but our sense is that the potential is good in the stock.
All right. You're saying that there is a good potential in this stock, and obviously we're moving into summer season, which typically does well for the sales of companies like this as well. Thanks a lot, Mitesh and Pankaj, for joining in, helping all our viewers with their stock and investment related queries. Meanwhile, the market's broken the 22,900 mark on the Nifty, and Eternal, it's a stock which is very sensitive to the mood of the market. Every time there is weakness in the market, these stocks get pummeled a lot more, and every time sentiment improves, we see a big up move on all these platform companies, and Eternal is actually the sort of flag bearer for all of them. Currently, just very close to turning negative for the week on that stock. And if you look at the sectors as well, across the board, there is swift selling, and real estate stocks fairly hurt, down about 3%. The IT stocks, more resilient, but still at an index level, down 1/3%. With that, we'll wrap up on this edition of Your Stocks. You keep writing into us for your queries. We'll get them answered with our experts. Take a short break, come back, a crucial last hour of trade with the team of Closing Bell.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The Taiwanese index down over 1.25% now. The Hang Seng is trading just below the flat line.
So is it possible he's buying time for the Marines to arrive? I think that's at least possible. Of course, we don't know.
This is what he said. He basically said that I'm pausing the period of energy plant destruction by 10 days to the 6th of April. Government has essentially cut excise duty on petrol to 3 rupees per litre from 13 rupees a litre.
They have downgraded India's rating to market weight from its earlier weight of overweight.
As crude normalizes, this should also rise a little bit. So on an integrated level, I think these companies will probably start to see a little bit of relief.
It's overwhelmingly down, as is to be expected. Tata Motors passenger vehicle, Eternal, Shriram Finance, Indigo are some of the stocks which are lower.
They are worried about the consumer first. It will mean lower dollar inflows in terms of lower exports. But that's clearly a policy preference.
Not looking very good. Almost a 1.5% cut on the frontline indices. The India VIX also is now above 26 as we speak.
माननीय प्रधानमंत्री जी ने ये चाहा कि कंज्यूमर का प्राइस बढ़ना नहीं है.
Samman Capital, another 1 billion, where everything is done. Manappuram, Bain, you have about 4,300 crores completion by March 31st.
Now, FY26 has been quite a landmark year in terms of M&A spend by Indian IT companies, the highest that we've seen in the recent past, and particularly that inflection point seems to have come in for Infosys and TCS.
All in the rupee, that's been a free fall since the time we started trade. There's been an excise cut, mid-caps are not doing well, and there's no clarity on West Asia war.
Okay, it's a pretty poor Friday all told. That's the day so far, and if anything, I mean, there's no recovery on the screens whatsoever. 60 minutes to go as far as the market closed today and for the week is concerned. This is Closing Bell. We'll run you through what matters and, of course, what to look out for. We're coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, afternoon.
Hi, afternoon, and we're at the day's low. We started gap down, 150, 200 points lower on the Nifty. But since then, the selling pressure has picked up. And look at the Bank Nifty now, 2.5% gone. Very poor advanced decline ratio.
Well, that's right. No recovery in sight. We're at the low point of the day, both in the equity market as well as in the money market. So you'll want some kind of pullback in the final 60 minutes. Otherwise, we'll be going into this weekend with a rather bleak close. 22,900 gone. Rupee close to around 95. Oopsie daisy, not too good.
Brent is also now back to 110, a little just under $110 per barrel.
Well, it's not looking good. And, half of the gains over the last 2 days are given back with this 400-point cut. The Nifty managed an 800-point bounce and 400 gone. Almost just today. So lots of moving parts, but unfortunately everything moving in one direction, which is lower, except, of course, the dollar rupee, which has been shooting higher. Mitesh Thakur is with us with what she'd want you to do in terms of trades. Mitesh, good afternoon. Good to have you here. Yeah, I mean, let's get straight to it then. About 22,883 is where we're at. So where are supports? What's the target? And what would you recommend viewers do?
Prashant, I think till Wednesday there was this hope that the bounce back will extend, but today we had a gap down and then immediately, kind of declined below Wednesday's low. Not a very good sign. We have maintained that 22,500 is a minor pivot, and eventually big support is around 22,120 to over 22,000. I think that could be tested, but right now I think it's also oversold. It's also negative. So keeping things into perspective with levels, as long as we are below today's high, which is roughly about 23,200, I think maintain a negative stance. It could be a fast moving market because of news flow, but 200 is the 186 or 200 is the level to watch on the upside. Only above that, exit or come out of the short side and get into the long side. And on the downside, take some profits around 22,500 and maybe, hold till 22,100 is being tested.
But the probability of headed lower down to 22,100 is high. Mitesh?
On the long-term charts, very high. On the near-term charts, I think, again, as I said, we are extremely oversold, so things could change. But for the timing, I mean, the idea is that you have to be slightly fast, nimble-footed on the short-term charts. But yeah, I think on the long-term charts, strong chance that you might see some kind of a reversal because of the extreme oversold levels on the markets.
Stocks, Mitesh, for the near term, what would you go with?
On the stock side, I have one buy and one sell. On the buying side, Aurobindo Pharma that continues to make fresh highs, and on the selling side is Bank of Baroda. So Aurobindo Pharma is something which I would recommend taking long positions with the stop just below levels of 12.98 for targets of 13.55, and Bank of Baroda is a short or a sell side trade with the stop at about 264 for targets of 245.
Got it. Okay, all right. Thanks a lot for that, Mitesh. Sounding a little bit downbeat in terms of probable further correction from here, though in the near term, we could be a little oversold. Well, let's move on then. Following that excise duty cut on petrol as well as diesel, Morgan Stanley has come out with a note on the expected impact on retailers and refiners. Sonal joins us to break it down for us. Sonal?
Thank you for that. They are quite positive on oil marketing companies. In their note, they say that India's inventory levels on crude and tax cuts should be positive for refiners and fuel retailers. It will also reduce the overhang of any possibility of further windfall taxes for the sector as well. Yes, there's an export duty, but it is not on the back of windfall realizations that these companies are making. They say refiner margins should now rise $3 to $4 per barrel, despite the export tax that has come on diesel and ATF. They are overweight on most of the stocks: ONGC, Indian Oil, Reliance, HPCL, BPCL and Oil India as well. They say the tax cut that has come by on gasoline and diesel by 10 rupees per litre came in quicker than what they had expected. It is around $20 per barrel. It raises India's crude basket fuel price to $75 per barrel, and this will reduce the overhang of potential windfall taxes because now there are taxes in place in terms of export taxes. However, they say it will impact Reliance Industries, the export taxes that have come by on ATF and diesel, by $1.5 to $2 per barrel. They are also expecting and assuming that this tax is not levied on the export refinery the way it was done in 2022. India exports roughly 1/3 of its total production of diesel and jet fuel, and hence this would be an impact on Reliance Industries, according to Morgan Stanley. Additionally, they say that the reduction in excise duty that has come by will reduce the monthly losses for OMCs by $1.2 billion. So that definitely will mean better working capital, better cash flows for these companies. They've also spoken about the inventory that the country has right now: 60 days of crude oil and refined product inventory, which is basically 81% of the total capacity that we have. So we are in a decent position, and all the refineries are operating at over 100% utilization. They're reiterating the kind of inventory that we have in place as far as the entire economic picture is concerned.
Sonal, 2 points. Sorry, that $75 was what they're saying is the cost of oil purchase here post the excise cut. Is that what they're saying?
Post the excise cut, yes. So now what is happening is, as Probal was also mentioning earlier, we have been looking at the crude basket, which was at $147 per barrel. However, we need to understand that it considers Dubai, Oman, the Middle Eastern crude, which is not the fact for India as of now. We're also taking or importing Russian crude right now. With that, it could be anywhere between $90 to $100 per barrel. So if we take off the excise, which is around $20 per barrel, they are saying that after the cut, it would mean $75 per barrel. So we should not go by the crude basket which we get weekly, because that doesn't consider the price at which India is importing currently.
But I don't know, the 75 math still to my mind.
It doesn't add up. Yeah, it doesn't add up, but that's
because
how
Russian oil is apparently $10-15
premium, yes.
Premium to Brent. And the other stuff is 150, 160, whatever, 140, 150. So 75 is a far... Anyway, the other point, I wanted to clarify, is that 60 days, right? Is that the crude which has been contracted, or are they saying we have reserves? Because that number initially was, we have somewhat 25 days worth of crude inventory.
No.
But I heard 60 there.
Yes, so the way it works is we have 9.5 to 10 days of strategic petroleum reserves. That is a different thing which is used only in emergencies. Apart from that, there's commercial fuel that we have in form of petrol and diesel, and we got this clarification from the government as well, because over the weekend there was an RTI reply which suggested that SPR is just 9.5 days. But that is not the oil that we have, right? We have commercial oil at depots, we have it with the oil marketing companies who keep inventory of these fuels. So that is around 60 days. Considering all the supplies that we have, India has 60 days of fuel currently, petrol and diesel. But yes, that is still 87% of what we usually have, which is around 74 to 75 days.
Okay, thank you for explaining that. You're also looking at ONGC, and here UBS has upgraded it to a buy.
Oh, yes, they have. So basically, UBS is positive on ONGC, and this is one of the stocks which has outperformed, right, considering the fall that we have seen in the markets. So UBS has upgraded the stock to a buy, raised the target price to 350 rupees a share. They say macro tailwinds and policy support are underappreciated on the stock currently. They view that this ad hoc levy on realization is unlikely because the oil ministry has spoken about how there will be no windfall taxes on higher realizations from here on. They have increased FY27 EPS by 62%, FY28 by 22%, and after capex of around 28 rupees per share, they may deliver free cash flows of around 40 rupees per share in FY27 on a standalone basis, and that would imply an attractive 8% dividend yield at the current market price. They are, of course, assuming a 50% payout ratio in this case. They are looking at PE and price to book value, which is currently at a discount to historical averages, and they expect further up move considering the crude oil prices that we are seeing, and also additional production that will come by from their new facilities, and that is something which will add to their profitability.
Okay, all right. Sonal, thank you very much for that. That $75 mystery, if you can solve.
I will do that.
We will get you back on. It'll be interesting to know how they computed that. Thanks very much for that. Well, sources tell CNBC TV 18 that the government has formed an interministerial panel under Defence Minister Rajnath Singh with respect to the West Asia war. This panel will decide West Asia-related actions that the government will take. Sources say that the tax relief on some more items cannot be ruled out. The Finance Minister, Home Minister and the Oil Minister are among others part of this interministerial panel. So basically, more measures expected as we go forward. Mehrabun Irani is with us with what he makes of this entire situation. Mehrabun, tough spot, but what do you make of it and what have you been doing?
I think, Prashant, if you allow me just a couple of minutes or less than a couple of minutes, I would say that let's understand the problem, because people are just saying Trump, 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 Trump. And that's a fact, Trump. Trump right now is in blind panic. He's caught in a war that he does not have a face-saving exit. And whatever options are open to him, it does not add in any way to his credibility, which he has lost in a big way. He knows fully well that if the war gets prolonged further, it will add more pressure on the US as well as on the global economy, as well as his own chances as far as the November by-election goes. Now, coming to India, let's accept the fact that India imports 85% of its oil. Also, let us be positive in thinking and accepting that what dependence we had on oil and what we are depending right now, I think oil is not as critical as what it was, say, 15 years ago. But there is going to be pressure on Rupee. There is going to be pressure on the import bill. Exports are going to possibly slow down because of freight problems, logistics problems, shipping insurance cost has gone up. And there is always a risk of further disruption, God forbid. Nearly 1 crore Indians are working in the Gulf. Remittances will slow down, putting more pressure on the rupee, fiscal deficit, and all sorts of problems India are facing. And that is what the macro risk which is there is affecting stocks of banks right now. In the midst of all this, there is a further risk of a prolonged war, disruption of the Strait of Hormuz. Somewhere we are not ready to understand certain positives India has relatively to many other countries. We have strong forex reserves. We have diversified oil sourcing. We have a government.
Wherever we know all this. We know all this. But just if you tell us what you've been doing, what you are, how you've been responding to this. I mean, these are facts we discuss day in and day out. But I think, Prashant, that's what I was coming to. You don't know what's going to happen tomorrow morning. Yeah.
So this is the time where we have to accept the fact that if there is ceasefire of any kind, there could be a sharp rally coming in stocks. And for all you know, the oil-sensitive stocks like maybe the auto and the cement may show a sharp bounce. Sharp means sharp bounce. Does it mean that we should assume and go and buy in a hurry? I'm certainly not doing that. So what should investors do? And that is what I'm doing. We should be tactical in what you do right now. You should also understand the fact that this is the year end. People are running after trying to protect their tax by selling off the mid caps and small caps. As far as the frontline indices goes, I still belong to the camp which believes that Indian markets are relatively expensive despite the sharp fall. I don't think there is going to be too much of money going to be made in the Nifty stocks. And I feel that this pressure which is coming on mid caps and small caps, forget the Gulf War, forget the war, it's also because of the year end. There are quite a few stocks which are going up begging right now, and they could give you a decent rally. So I'm looking at tactical buying. I'm buying into ONGC and Oil India. I'm buying into some sugar stocks. I'm buying into certain chemical stocks where they have competition from imports because I see imports drying up. And the simple clue for everybody, included possibly you, Prashant, I'm sorry to say everybody, is that go and check up the winners post the COVID scenario. Those type of stocks, because I see imports drying up. Say, for example, phthalic anhydride player like a Thirumalai Chemicals, facing competition from China and Korea, imports drying down. So this company will do well. So go and buy into such type of stocks, and please accept one thing, that there are many stocks which were expensive, which have come down sharply, but even at today's valuation, they're expensive. So first parameter should be, I will not buy any mid cap or small cap where the earnings are getting distorted and where the valuations are more than 10 to 15 times as far as the PE.
Merabun, Thirumalai, right? What else?
Simple.
Any other names? Thirumalai, what else? Thirumalai Chemicals, what else?
I just said it. I just said it. I've been buying ONGC, Oil India for the last 6-7 days. I've been buying sugar stocks. I've been buying some simple chemical stocks which face competition for imports like a Thirumalai. And there are quite a few of this type of names. So I'm doing a little bit of tactical buying right now. And certain mid caps and small caps which I've always liked and which are now available at 10-15 PE, I'm going and buying into them.
Okay, in fact, sugar is doing well today. Sri Renuka is up 6%, Dwarikesh and Bajaj Hindustan also up 3-4%. Let's get those stocks up for you on your screen. Sugar is resilient, and that's a space Mehraboon is tactically buying. Let's talk about LIC Housing Finance. That's a buzz on the back of an HSBC note. HSBC has upgraded the stock to a buy. Sudarshan joins in to tell us why.
It's one of the few stocks today that is trading in the green, and today HSBC has come out with a note upgrading the stock to buy from hold and increase target price to 610 from rupees 570 per share. It has mentioned few catalysts. So first, firmer interest rates, potential of repo rate hike, faster disbursement and softening bond markets. And if any of the catalyst plays out, HSBC believes that there can be a sharp re-rating as far as LIC Housing is concerned. Also, it has increased FY 26-28 EPS estimates by 3 to 4% to build in firmer rates. On the valuation front, it said it's at an all-time low and also 38% below 5-year average. It believes that there is no solvency risk that might warrant a 50% discount to its book value.
Thank you very much for that. Mehraboon, anything in the NBFC pack? You know, you've got names like a Shriram Finance getting pounded, that's down 5%. RBL Bank is weak. LIC Housing Finance, Sudarshan was just talking about. Would you cherry pick any NBFC stock?
No, honestly, no. I think quite a few of the stocks in the NBFC space and quite a few other spaces can show a decent 5 to 10% rally in April, considering the fact that there's too much of selling happening because of the year end, and also if there is any talk of a ceasefire type of thing. But I would like to say one thing on which Prashant told me that I should be brief on this particular aspect, and that is a clear case. I mentioned sugar, and you mentioned all three names which I would not touch with a barge pole. Bajaj Hindustan and Renuka Sugar are not stocks. I would like to look at it, and I would tell investors also not to look at it. There is a Balrampur Chini, there is a Dalmia Sugar, there is a Triveni Engineering. Those are the type of stocks, quality stocks, which I am quite sure will give you good returns. So when you are doing tactical buying, you are buying industries or stocks in those industries which will benefit, which will do well, and which will not be affected by the Gulf War, and where the valuations have become extremely attractive. Be patient, and you are going to make decent money over the next 6 months, 1 year, 1.5 years. So there is a time where you have to be patient, go and buy stocks, protect your money, because you honestly don't know where we are heading for as far as the Gulf War goes.
Okay, all right. Point taken, Maribun. Just want to bring in Anandya Banerjee as well, Head of Research, Currency, Commodity and Interest Rate Derivatives at Kotak Securities, with what's happening out there on the Rupee. Anandya, I mean, of course, there is pressure. But what's the dominating driver? Is it the same thing, or there's Russian oil, which some of these large export terminals have been attacked. So is that a new worry at the margin? I mean, those attacks happened Tuesday, Wednesday, and Reuters yesterday said that some 40% of that Russian oil export has been impacted because of the attacks. This morning, there's a Bloomberg story saying that some of that has restarted, loading of oil onto ships. So I don't know. I mean, I'm just looking for, is it the old drivers which are at play, or are there any new worries here?
Yeah, a very good afternoon, and thank you for having me, Prashant. The Russian attacks and all these things wouldn't have really worried the market unless and until the West Asian crude flow is almost choked. It's not just the oil; it's also the gas and other commodities. So anything which is now causing incremental supply issues is having an outsized impact on the oil prices. So that's the issue over here. So until and unless we see the Hormuz flows improving, I think markets, all kinds of markets, bonds, currency, equities, will continue to be impacted by what's happening with the oil and the gas prices.
So RBI has had a hands-off approach today. We've had a nearly 1 rupee fall in today's trading session. Do you think at some point RBI will come back to defend? What if 95 is gone as a level, for instance? Psychologically, that's damaging.
Right. Actually, I think because when you are trying to manage your flows, your bond market, the rupee liquidity and the currency, you have to let one thing go. I think the RBI is allowing the Indian rupee to become the shock absorber. In a way, with a low inflation environment, still we are able to absorb that higher cost as of now. And secondly, RBI is also betting on the fact that we are at the last few days of the financial year when we tend to see a pickup in the selling from exporters, because the year end we see a lot of repatriation flows. So it is quite possible that over the next couple of trading sessions, the exporter selling can get heavy because it is the year-end book closing. But apart from that, going into April, until unless the Hormuz situation improves, the oil prices are not coming down, which means there will be constantly a pressure on the Indian rupee. RBI will have to intervene, but at a higher level.
Yeah. By the way, there is a statement from the government of India essentially says that excise, there's a number, there's one number which we have, which is that the daily under recovery, the daily losses on sale of fuel before today was 2,400 crores, which was being absorbed by OMCs. But this is before the 10 rupee excise cut. So this 2,400 crore number will be lower, but lower by how much we don't know. I don't think that number is there in terms of what is the net under recovery or net losses on a daily basis after the 10 rupee cut that we've seen. If it is there, we will see. But I think that's the statement coming in from the government of India at this point in time. Anandya, thank you very much for joining us. Good speaking with you. Maribun, appreciate your time here as always. And thank you very much for joining us with that quick perspective. We'll take a quick break here. We'll be back. Rupen Rajguru of Julius Baer will be with us on the other side.
Well, let's focus on the FIs selling. This as the FIs are pressing the exit button. But why are they selling so aggressively? Well, here's what's driving the outflows. The Middle East tensions, that's something that's weighing on. The rising rupee, well, that's a bit of an issue. The pressure on the fiscal deficit as well in turn. And Indian markets not particularly cheap in comparison to global peers. Equities, well, they are following in order in terms of preference as well globally among other asset classes. Let's look at the data now. The FI net sell number in March 2026 has already hit 1.1 lakh crore rupees. That's the highest ever we've seen. It's surpassing the FI outflows we've seen in previous months like January 2025 when they sold close on 78,000 crores. Even in October 2024, they sold roughly around 94,000 crores odd. But what happened post this FI selling is a little bit interesting. Now, after October 2024 sell-off, the Nifty slipped 3% in the next 3 months or so. While the FI flows, well, they stayed negative in November 2024 also, when they sold closer on 21,600 crores, but they turned buyers in December 2024. That time, they bought roughly around 15,000 crores. However, after the January 2025 sell-off, when the FI sold big time, the Nifty actually gained close to 3.5% over the next 3 months. The FI flows, well, they stayed negative in February 2025, when they sold roughly around 35,000 crores, while they sold only around 4,000 crores in March 2025. But then they turned buyers in April, and they turned bigger buyers in May 2025. So post FI selling, sometimes you see markets, they often stabilize, sometimes they even bounce back. So the big question is, what can bring the FIs back, right? Stability in the Indian rupee. That's something that's really something that they'll be looking forward to. The FI ownership in the Indian markets, it's at multi-year lows. That's giving some room to increase from there on. The Indian market cap is just around 3.1% of the global market capitalization. That's closer to the lower end. And finally, valuations, well, a little bit more palatable. Remember, at one point of time, we've gone to 22, 23 times. Now we're in that vicinity of around 18 to around 19 times the forward earnings. So while the FI selling has been very aggressive, hope is that they're reaching some kind of excessive levels, and that's why they pause and gradually rotate back into the Indian markets. That's the hope. Let's see whether or not that happens. Rupen Rajguru, the head of equity investment and strategy at Julius Baer, joins us on the show. Hi, Rupen. Well, a very, very tricky market. What do you think? It's going to get a lot worse before it gets better? Or do you think now majority of that bad news is in the price?
Hi, afternoon, Nigel. Yes, during times like these, it's always important to look through, from the historical lens that whenever situations like these in different form and shape has happened, how the market has reacted immediately and how market has reacted once that event is stabilized. So you're absolutely right. Currently, the situation is fluid. Every day is a new day. The noise and the news flow, the gyrations which are happening, And when we saw that market currently is reacting to extremely, to news flow. So last week, 2 days we were up 2% in a row. Today we are down. So, these kind of big movements are happening. But as they say, history doesn't repeat, it rhymes. And historically, who knows, 5 years down the line, people would have said that, would say that this is one of the best time one should have invested. So as per history, clearly investing in times of panic, while at that point of time, situation is extremely fluid and usually the market reacts that the bad news will continue perpetually and tries to price in. So always that first 2-3 weeks, the markets are down, but once that is absorbed, and assuming that this war probably finds, at least in next one or few weeks time, it will probably stabilize, or at least there is the oil prices stabilize. The market definitely we are close to the bottom. And Nigel, I think the valuation comfort is there. So we are definitely recommending investors to buy to this current level.
What kind of sectors, Rupen? Hi, afternoon.
Hi, afternoon, Prashant. So see, earlier, while there were select pockets which was expensive, select pocket was cheap, but today, frankly, it is across the board. There has been a decent correction. Since the war began, the Nifty is almost down 10% considering today's fall. The mid and small cap index are also down similarly 9 to 11%. I think the big message here is that if you are under allocated to equity, definitely this is the time to add into equity. And within sectors, probably some of the sectors which we have liked, which were outperformers some time back, but has now seen a decent correction. So financials definitely is the one that we are looking very closely. Some of the high ROA NBFCs, which has seen a decent correction, I think that also makes a good case to add into the current market. While if you see, surprisingly, that in this since the war began, the defensives have been the exporters. So the IT and pharma index actually has been the outperforming market or outperforming segment of this market, while IT had a big fall in February because of some other news flow. But probably in pharma or healthcare definitely looks pretty good even now, and within that, some of the players on the hospital sides also we like. And all in all, consumption as a basket, again, as I said, the entire market has corrected, and it is a good time to cherry pick into this current market.
Any sector which you would completely avoid right now, Rupen?
Rima, hi, afternoon. Here we will look into some of the sectors whose valuations, some of the, while staples might still do well in the near term, but we would not probably be too much enthused to add into staples in the current time. It might outperform till such time the war is on. I would say some of the news flow driven sectors, because you can get cut on both ways. So say like at times the upstream companies in today is up, yesterday it was down, this is the oil price. So I would try to avoid trading into those highly sensitive news driven counters into the current market. Otherwise, some of the heavy consumers of oil and gas probably in the next 2 quarters might definitely face some margin headwind. So that can be avoided. But as I said, that's on case-to-case basis, because across the industry, they have exposure.
Okay, all right. Rupen, if you had to pick up that one contra bet that you're looking at, which one is it?
Say contra, if I were to look through Nigel here, say, frankly, some of the hotel, and it's not contra, but I'm saying looking into the price point, the way they have corrected. So the QSRs, QCs, hotels, they all have corrected significantly. So the consumption basket, because of variety of news flow related to availability of LPG and some of the other news flow which impacted them. So they have corrected in a big way. So I think that's a bet I would say, that will look pretty interesting from next few quarters perspective, because they have seen a meaningful correction. While there will be an impact in this quarter, but we believe the long-term earnings power of these companies are pretty strong, and this correction is something which one needs to be important.
Oil and gas, oil marketing companies, some relief right now, downside protected. ONGC, Oil India see an upside as crude prices remain elevated. What's your play?
So, Rima, as I said, these would be highly news-driven companies. So yes, at a margin, probably you see historically, whenever the OMC's companies get closer to price to book, they definitely, it makes a case to add into them. So while today's news flow is positive, and it initially reacted positively, but thereafter, it has fallen in line with the market. Yes, some of the OMC companies, at a one-time price to book definitely becomes a good bet to buy into, because from there on, historically, they have given decent returns.
Okay, Rupen, thank you very much for joining us. Good speaking with you, and really appreciate your time here on CNBC TV 18. Well, Hormuz is here with the spotlight on the top movers and shakers as far as the market goes. Hormuz, take it away.
Surprise, surprise. There are some gainers today in this list as well in the market that we are in. But start off with ONGC, and for obvious reasons as well. The stock is up almost, 4.5–5% today. The top gainer on the Nifty for whatever little stocks that are up in the index today. The highest volumes in 3 weeks for the stock in today's session. In fact, for the next series, the premiums for the 280 rupee call option have gone up by 110% in today's trading session. We've had close to 5 crore shares that have been traded today. The 20-day average is around 2 crore shares. And around 40% of those shares have been marked for delivery so far. The stock remains above key moving averages as well, and is nearing a 52-week high, which is at 293, having gained almost 20% so far in 2026. On the flip side though, Bajaj Housing Finance, there's no bottom as of now for the stock. It has declined in 10 out of the last 14 trading sessions. It is set for its 7th straight weekly loss. And here today we have had more than 1.3 crore shares that have been traded, which is double its 20 20-day average of around 57 lakh shares. Almost 70% of these shares that have been traded have been marked for delivery. And since September of last year, the stock has failed to cross the 50-day moving average on the upside. It has continued to remain below that and has continued to grind lower since. And it is on the verge now of breaking below its IPO price of 70 rupees. From that post-listing high of 188.5, the stock is now down 60% from those levels, is Bajaj Housing Finance. And on the last on this list today is Acme Solar, is a positive brokerage note that came in on the stock today. The third straight day of gains, is up 14% now in the last 3 sessions. The second highest volumes of the year so far in today's session for Acme Solar. 1.1 crore shares traded today. The 20-day average is just around about 17 lakh shares in today's trading session. 24% of those shares that have been traded today have been marked for delivery. And on the Nifty 500, the stock is the third best performer for the month of March so far, followed by Premier Energies and Vari Energies, of course, all from the same pack. But despite this, though, the stock is still below its IPO price of 289.
Thank you very much for that. Get into a break. On the other side, we'll get you a check on dealing rooms as saying in our segment D Street Chatter and a few BTST calls. Stay tuned. Welcome back. Extending the fall now. It's closer to 22,800 on the Nifty. It's more than a 2% decline on the benchmark indices. For the week, it's going to go down with a cut of 1.5%. On Monday, we had a massive downfall on the markets, which slipped about 650 points on the Nifty. Then Tuesday and Wednesday, we had a big recovery, 800 points cumulatively in 2 days. And today, we are giving back 500 points. So, and the Nifty Bank now is down 1,500 points. Great time then to get in Nimesh and find out what's happening in dealing rooms. Nimesh?
I remind us, last 2 days of gains are completely wiped out, under pressure. In fact, India is actually underperforming the Asian peers as well. And I guess today's fall is largely to do with the macro call. A lot of the India macro is turning for the worst, and that's the reason why you're seeing such a knock across Nifty, Bank Nifty, and for that matter, broader markets as well. From a flow perspective, the sense was that day before we saw not a very large number. That's the case today as well. I'm not getting a sense that there is a very large FI sell-off. So you need to see the numbers today, but across the board, whether it's financials, whether it's the momentum names, all are under pressure today. But the last 30 minutes are going to be high in terms of volumes because of the index rebalancing. So 40,000 crores worth of buy and sell will happen, which is why the gross number may look very large in today's market. From a sector perspective, IT and pharma stands out. So while there is selling across the board, these are the two sectors where there's a bit of nibbling or buying from large institutions. But broadly, today's fall seems to be completely India macro driven, and the fact that Rupee yield, crude, all are under pressure, and hence you're seeing a bit of pressure in the markets as well.
All right, just talking about that rebalancing, just going to ask my director Shreya to just pull up two stocks which will be part of that rebalancing, which you could see buy flows. One is Tata Motors CV. I think we should get the intraday chart out there. And Bharti Airtel, both those two, I think they'll be receiving some inflows because of this rebalancing that we've seen. And both of them have moved to the high point of the day. The rebalancing that Nimesh was just talking about, these two stocks are likely to see inflows. So that's why you're seeing a big spike up. But Nimesh, what about individual stocks? What are you picking up?
Well, so a couple of names which stands out in terms of delivery-based buying in a weak market, that is Cummins India as well as Nestle India. Both, Nestle is in the green in a weak market, and even Cummins has actually recovered from the intraday lows, but there is delivery-based buying in both these names in today's trade. So that's the first set of stocks. The second name is Mankind Pharma. Pharma as a theme is doing good. Mankind stands out. There is a bit of buying interest from large institutions, and also there was a Morgan Stanley note in the morning. They've initiated coverage with an outperform overweight rating and a target price of 2,500. In general, I'm getting a sense that pharma is well bid at institutional desk. The third couple of names, Chola as well as Bharti Airtel. You mentioned Bharti Airtel in terms of rebalancing flow, but net of rebalancing, there is selling in Bharti Airtel as well as in Chola Invest today. And the last name is 5-Star Finance. Well, the stock has been consolidating of late, almost at 52-week lows, but at current levels, my sense is at least one leading family office seems to be accumulating 5-star at current levels.
Got it. Thanks a lot for that, Nimesh. Well, let's take stock of the derivatives market then. The PCR was at around 1.2. That's cooled off to around 0.98. Remember, on Monday, we'll have the monthly expiry that will play out because Tuesday, our markets are shut yet again. Today, there was nowhere to hide, whether you're looking at the frontline indices, the large cap names, or even the mid caps. Because the Nifty Bank has been under pressure. That's been underperforming. That's underperforming yet again today. But Reliance Industries, the news flow is a little bit negative for the company. And that was the big boy that was batting for the bull. So that's given way in today's trading session, down close to around 4.5%. And the tech index that's been the outperformer for bulk of March, that as well has come in for some profit taking intraday. The problem is the India VIX. That's clearly tell you the fear gauge is spiking up. That's up close to around 9% or thereabouts. And volatility in the system has spiked up. So that's a bit of a fear out there. The India VIX at around 27 odd. You want that number to cool off. That's not yet happened. Even the last couple of days when we rallied, we didn't see a substantial cool off on the India VIX. The options data is quite interesting. The call writers, well, they're having a blast. They're not expecting any good news over the weekend. The 23,200 call, 23,500 call. Just take a look at the premiums out there, down between 75 to around 85% in today's trading session itself. The glimmer of hope is that you're seeing a fair bit of action, at least at around the 23,300 put, and that has the highest open interest on the put side. Now you punch in there, the premium over there is close to around 550 rupees approximately. So you're hoping at least this 22,750 level holds out. But the way the markets are falling, that's giving you a bit of a jitters. PG Electro Plus was a stock that bounced back. That's coming for unwinding as well as selling. So big pressure on that one. And Paytm as well. For some part of this last 45 days, it was actually outperforming. That as well has given way. So the hope is that the low that we saw last Monday, we don't revisit that. With the day to go to expiry, the bulls will be hoping for some kind of positive trigger over the weekend. For the time being, that remains elusive. Well, Midesh Thakkar is back with us. Midesh, you've been pointing at the markets, drifting a little bit lower from here on, and you'd given us that stop loss in the morning as well. If the markets breach the 23,000 on mark, you'll get a negative on the indices. That's worked out. What about individual stocks? What are your fresh trades for us?
I think, on the stock side, Hero Motors is estimating with a stop at 51.61 for targets of 5100. Again, we'll take some sell calls despite the fact that, every day is a news flow day and we have weekend now because the trend is still on the negative side. And HUL is estimating with a stop at 2085 for targets of 2030.
Okay. All right. So those are specific individual trades. Thank you for that. Anand Tandon is with us. Anand, good afternoon. It's a bad afternoon because it's down in the dumps again as this war goes on, and now it's going to be the fifth week as we enter the next one. So the rupee is at almost 95. I mean, it's a pretty dramatic fall that we've had. But as we've understood from people like Pranjul, etc., we spoke with from HSBC in the morning. I mean, I think at some point towards the end of last week, or actually middle of last week, the RBI basically just started to step away. I mean, as a sole supplier of dollars, I mean, it can work for a while, but if this were to last for a long time, I guess the thinking is, then is there really a point to intervening aggressively? Your thoughts, Anand? Are we in for a test of recent lows, and how are you thinking about this?
So thanks, Prashant. So as far as the dollar goes, obviously, India is one of the worst affected economies when the oil goes up. So it is something that is going to create a problem for the rupee. And while they may want to try and reduce the volatility, I think it makes perfect rational sense to not try and stand in the way of a falling knife, even though you are RBI. Because at the end of the day, as you mentioned, there is no clear understanding of how long it will last. And if it does extend for a long period of time, you have, after all, limited reserves. You have better use for it. Coming back to what the war is, like I've been maintaining, I think one simple way for investors to understand is to stop listening to what people say and see what is happening. And the only thing that needs to be looked at is the traffic through the Hormuz Strait. Do you think that is likely to resume anytime soon? That will mean that somebody has to give in to demands of Iran. That doesn't seem very likely to me, which means the traffic will not resume. And if that doesn't resume, then all economic problems continue to remain. We don't have to worry about what's happening on the geopolitics, but the economic problems will continue to remain, and that will exacerbate because you are looking at a situation where fertilizers are going to go in short supply. Slowly, you will have to either increase the efficiency of use of fertilizer, which is a behavioral change and will take a long time to happen, or you will be faced with that in the next couple of months, where you will have a serious shortage and there will be pressure from there as well. You remember a while back I had mentioned that soft commodities are something which will likely go up this year, and unfortunately for the wrong reasons that's beginning to happen. While there was surplus till not so far back in terms of agri commodities, for example, there is now fear of disruption either because of poorer production this year or for supply. So net, I think you have begun to see the analysts starting to cut down. I mean, Goldman put out a report which you must have referred to, I'm sure, where the earnings have already been cut to about 8% for this year from 16%. Now, this is the typical behavior. You start with 15, 16% and bring it down, which is what I was referring to in my last interaction with you, that, while the market looks reasonably priced compared to where it was, and based on the older estimates, it may actually look reasonably a place where you might want to start investing. I think if you compensate for the lack of or for the slowdown that is expected in the current year, then again, you may have some more downside from here.
That was the point. Even Tahir Badshah was telling us that, we started the year expecting 13-15% kind of earnings growth. Now we're at 6-7% earnings growth. And on that earnings expectation, valuation is actually not at the lower end of the range, but at the middle of the range at 19 times forward multiple, because the E of PE is also getting reset lower. Anand, hold that thought. We'll need to slip into a very short break. As we do that, hear out snippets from our conversation from the CNBC TV 18 Market Town Hall with Sandeep Tandon and Harish Krishnan on where they see the market and oil prices headed.
We think we are getting signs of capitulation now.
where even bullish thought process is getting capitulated. It's a typical signs where best of the global houses makes big targets about crude. This is not the first time we are seeing, It's a human reaction, when you are in pain, you will try to see that everything has changed. But the fact remains that the relevance of oil has already lost as compared to what was earlier years. Now it's a gas. My point is that maybe, yes, this month oil can remain elevated based on our predictive analytics. In February, we talked about that oil will rally, and we talked about dollar index risk to the global equities. And I think has played out. My view is that this will not last for long, and we are in the final fag end of that crisis.
The reality is that a shock like this, typically the weaker hands don't have the purchasing power to kind of remain in business. Again, therefore, there's going to be a greater formalization and a cleaner balance sheet that's going to sustain through. So our call is not that, we have any edge to predict what the next 3-6 months is. But if I am able to identify and distill certain companies which are going to go one leg up compared to the rest of the competition, okay, that gap is likely to sustain for years to come, and that gap is what is going to get alpha for our unit holders. So that would be another area which I would say can come through. Another area could be, there's going to be this huge rebuild that's going to happen in Middle East. I mean, the war cannot go on indefinitely. And imagine the amount of desalination plants that have to come through. Imagine the amount of pipelines that have to go through. These are all economies for whom this is the bloodline, right? And so they're going to have a massive amount of capex that's going to come through.
On the verge of breaking below the 22,800 mark. From the start of the month of March, it's been a decline of nearly 10% now for the benchmark indices. And then the question is, if the conflict comes to an end, say over the weekend, do you think the Indian equities bounce back ferociously, or the bounce back will be tepid? Because at the end of the day, there are macro implications. Crude prices don't go back to where they were at the start of the conflict at $60-65 per barrel. Earnings are going to get cut through the course of this year. Whenever the war comes to an end, what's the extent of the recovery we should expect?
If the war comes to an end over the weekend, I think you should expect a very sharp recovery, because I think people are still in the mode where they are looking for opportunities. And while they have been somewhat kind of mauled by the recent fall, I think the behavior that has been inculcated in the retail market of buying the dips is still very much there. The challenge is also the effect on the economy will not be that deleterious, because you would have had only a few weeks of a problem, and therefore the likelihood of it being sorted out is a little better. No doubt the oil and gas availability and prices will be higher, and therefore there will be some amount of slowdown, but I think the first reaction will be of relief and a significant upside. That said, I personally don't think it's going to go away very soon. You're looking at a country which has kind of been hammered over every few months, and would have therefore prepared itself to act at least in a guerrilla mode, not necessarily taking on the might directly. But they have the world by the jugular. And therefore, so long as they are able to create a problem for everybody else, their pressure to kind of resolve is going to be difficult for the US to take or Israel to handle. While at the same time, they can't just back off. So I think it is not an easy problem to solve. And the longer it delays, the longer the problem becomes, because not only is the economy impacted negatively, but also the behavior of the so many years of buying every dip would get punitively punished every time. And that would certainly create a kind of a problem for the domestic investors.
The whole outsourcing narrative also gets stronger, right? Or even the GCC narrative. With a 10% depreciation seen in the rupee in FY26, if earlier you could say fund 100 seats, you can now fund 110 seats for the same amount of dollars, because the rupee has gotten so much more cheaper. So, if you look at names like a Sagility, for instance, it's an outsourcing company in the US healthcare space, 6.5% higher. Generally, is that a space you would look at more attractively, any of the BPO themes, or a company like a Sagility, First Source?
So broadly, I think you would be looking at things which are going to benefit from a weaker dollar, and clearly anything which exports is great. Pharma and healthcare, far more difficult to replace, therefore even better. IT too may actually do a little better over the next few quarters, because the rupee has fallen so sharply, and to the extent that they would have fewer people onshore over a period of time, those who have got more offshore capabilities would certainly find at least a marginal increase in their improvement in the margins. But all those are not enough, in my view, to move the needle from an economic point of view. I think the overall economy continues to struggle if this thing lasts for a long period of time. But from a sectoral point of view, certainly the focus from domestic has to shift to those which are looking at exports.
Focus has to shift from exports to domestic, or domestic to export, Anand?
From domestic to exports. By and large, we were looking at domestics earlier, right? I mean, most of the growth is supposed to be domestic. I think that has to clearly move to the export side.
Manufacturing exports, Anand, or...
So, pharma, etc. is easier. IT is also easier. You're not so much dependent on inputs from other places. Manufactured ones, the problem is that we also import a whole lot of stuff. And given where the supply chains are being hit, you don't know which ones will be affected. I mean, take, for example, electronic exports. Now you are looking at capacity constraints from simple memory, because of the fact that the AI boom has taken away so much capacity for GPUs that the capacity available for making memories is becoming a constraint, given the fact that the GPUs will write the code, but something else has to actually execute it. So when you look at agentic AI, for example, it is the agents that need to run on, and they run on regular CPUs. So the capacity constraints for CPUs and memories is now coming through. So, it all depends on where the supply chain chokes. And therefore, to that extent, manufacturing is always going to remain a bit more specific to company rather than a overall sectoral call.
Okay, Anand, we'll wind down today's conversation. 1 minute to go before we wrap up trade, and it's going to be a dismal Friday. The Nifty, by the end of it, is closer to that... just get that rate up finally, closer to the 22,800 mark, but managing to hold on to it. It's a fall of 480 points on the Nifty. Across the board, you're seeing indices bleed. The Sensex down 1,700 points. The Nifty Bank down 1,500 points. For the week as well, we're ending with cuts in excess of 1%. And from the start of the conflict, we've seen a 9.5% decline for the Nifty and an 8.5% fall on the Midcap index. No place to hide, really. But some of the PSU stocks managed some amount of resilience. So you had green on the screen when it came to an ONGC, Coal India, Power Grid, and some IT names saw buying, whether it's Wipro and TCS. On the way down, the list is long. Shriram Finance, Tata Motors, Passenger Vehicles, Reliance Industries got hit, Interglobe Aviation, NBFC's banking names like Bajaj Finance, SBI, Eternal got whacked, HDFC Bank under pressure, consumption names not spared, with HUL dragging nearly 3%.
You know, Rima, broader market actually much better. Much better. Actually, pretty good, I would say. How much was the small cap index down? 1.8%. But I'm just wondering, where is this cut coming from? Because I'm looking at, some of the bigger volume-led losers, right? There's nothing. I can spot about 8 names which are down more than on volumes. That's it. 6-8 names which are down with volumes. Nothing else. Whereas, if you look at gainers, and by the way, so I'm not saying advanced decline is good or anything. It's some, 10, 11 is to 1. For every 11 down, for every 1 up. But volumes on the upside, stocks which are up quite a bit. So this is a very encouraging kind of a session. And I'll just cite a few names, right? HEG, RPG Ventures, Graphite India, Oracle Financial Services, Apar Industries, Acme Solar, Ather, Karur Vaisya, Piramal Finance, Lenskart, Sigility, Nazara, MCure Pharma, OneSource Specialty. I could go on. I mean, actually, volumes all on stocks which are actually higher, and very little. Actually, you could count them on your, one hand. Stocks which went down, well-owned stocks which went down with volumes. That's it. So, while, the Nifty was down 460, 470 points, it's actually a pretty different picture if you look at the broader markets and the broader space as well. I think we're going to wrap up on this edition of Closing Bell, and stay tuned because we just, wrap this up and come back with Editors Roundtable on the other side. So see you on that.
Global headwinds continue to rattle Dalal Street, a broad-based sell-off, surging oil prices and a sharp slide in the rupee, keeping the investors on the edge. There was no let-up in tensions in West Asia. The Nifty and the Sensex have now clocked their 5th straight week of losses. And this week, we were down in excess of 1% for the benchmark indices. Financials led the decline, with the Nifty banking index slipping close to 3%, while IT stocks offered some resilience in an otherwise weak market. Over the next 30 minutes, we will break down the rupee's steep fall. We'll assess the impact of the government's excise duty cut on petrol and diesel. We'll track the stocks which have managed to buck the weak trend. And we'll also turn the spotlight on India's IT sector and its accelerated M&A push. Hello and welcome to Editors Roundtable. I am Prima Tendulkar. With me are Prashant, Nimesh, Nigel. And here with us in the studio is Mihir Vora, Chief Investment Officer at Trust Mutual Fund. Hi guys, another week, another down week for the markets, and now the conflict 4 weeks done.
So this week I didn't see Friday to Friday we were up or down?
We were down more than 1%, 1.3%.
But that doesn't say but that doesn't say the right story.
Yeah. But I'll tell you one thing, guys, right? Friday looked very bad because we just wrapped up on closing bell. I just looked at stocks and broader market. So the Nifty is down 450, 460, whatever. Broader market and advanced decline is very bad. I was wondering, the small cap index is down 1.8, but what is down on volumes? Actually, there is not very much down at all on volumes. If you look at the 400, 500 NSE stocks which are higher today, that is where all the volume is. So, you know, it's kind of random smaller names which are lower, no volumes at all, but the gainers are basically it's volume-led gains across the board, those 400 names, which I think is a bit of something we should highlight, because otherwise it looks like oh wow, it's such a poor day because the Nifty is down 450, 460 odd points.
We've also seen a big jump in the volatility this week, right? Every single day. It was a truncated week, 4 days, but very big moves. On Monday, we were down, 550, 600 points. Then Tuesday, Wednesday, up 400 points. And today again down nearly 500 points. So Friday to Friday, we look like we're just down 1.2%, 1.3%.
Friday looks very, only 1%. Exactly. The VIX has picked up. In all those 4 days, the VIX was hovering around 24, 25. You know, it's not fallen. I mean, even the days when the markets rallied, the VIX was not falling below 24 and a half, right? So that showed that there is a bit of volatility, and there is a bit of fear as well in the market.
You know, sorry. Just one data point, you know, next 10 days, we are going to be working only 4 days. Not such a bad time to have holidays in the middle, because hopefully things settle out. And I think the date that Mr. Trump has given is Easter Monday next. So hopefully that's, you know, something has to give at that point of time. And a fewer number of trading sessions in an uncertain environment, I think it's a blessing in disguise, actually.
So here we'll come to you on the market, but today's picture is not complete without talking about the rupee and the free fall that we had, Prashant.
No, absolutely. And, you know, I'll just quickly... We won't go into we know why the rupee is weak, right? Because, I mean, it's essentially the macros are getting hit hard. We're a big oil importer. On per capita basis, if you look at our North Asian neighbors, etc., I mean, we are at the lower end of the rung. So in that sense, the impact is felt by consumers that much more. So, you know, same time last Friday, the dollar rupee was pushing to 94, and now we are pushing to 95. So 94.8, I think, is where we came to, how close we got to the 95 levels. So successive record lows through the course of the week. And of course, in addition to the rupee, so far bond yields had been remarkably steady. I mean, steadier as compared to the rupee, but I think there also we are starting to see some upward pressure on yields starting to show up. By the way, if you look at the developed market yields, bond markets, yields are up from the 27th of February, anything between 40 and 60 basis points, you know, across the board. FII selling is a big one. So they're selling about what? They sold $12 billion, is the single largest, and Nigel will talk more about this in a bit. But $12 billion in a single month is the largest ever that we've seen. And that is the problem. I mean, you know, we need dollars, and there is only one entity which has got dollars right now, which is, actually exporters also dollars. But because the rupee has been creeping lower, you know, they don't want to sell. And why should they? So the only entity with dollars is the Reserve Bank of India. And looks like Reserve Bank of India, as Pranjul Bhandari and others pointed out, from the middle of last week has stepped away, because the problem is you can continue to defend, but if this goes on for a while, then you're basically wasting reserves. By the way, we came into this shock in a pretty good shape, right? Strong growth, modest inflation, ample forex reserves. But we also came into this crisis with positioning, not just in India, but around the world, with positioning which leaned more towards rate cuts, not rate hikes. And second, scars of if you go back just 3 years, right, people really underestimated the inflation shock because of Russia-Ukraine. So some of that, I think, also has led to people quickly repricing their expectations for what this crisis is going to do. In any case, I mean, this is, just think about the last BOP crisis India has had. That was 1991. That was in the back of the Iraq war. Of course, now the situation is much stronger, reserves, etc., is a completely different. But this has always been the Achilles heel. A war in the Middle East, which raises energy prices, creates physical supply shortages, and of course threatens those remittance flows as well into the country. As I was saying, people are not waiting. Goldman Sachs, for example, has cut their growth forecast by 0.5%. CPI inflation bumped up to by 0.3. They're saying that CAD will widen by, that's current account deficit will widen by 1.2% of GDP this year. And of course, I mean, they're saying 95 on the rupee on a 12-month basis, but we're already at 95. So I guess they'll have to work on this as we go forward. The other thing, of course, is that, you know, as I said, RBI has been providing, supplying dollars, but not all of it has been done in the spot market. They also sell dollars in the forward market. So it doesn't show up on reserves now, but because you are selling dollars in the forward market, and there are some reports which suggest the forward book on for the RBI is $100 billion US, which means that at some point they'll have to buy the dollars back. And that is the reason why the market does not expect that there will be any big relief which will coming, because you got $100 billion to cover. I mean, some of it will be rolled over, etc. But you got a large position in the forward side which has to be covered. And this persistent dollar demand, I think, is a feature, not a bug. Have we overshot in the very short term? I think presumably yes. But who knows? It all depends on how long this oil shock will really persist for. Mir, I don't know if you have any thoughts on the macros, because this is a macro shock more than anything else.
Oh, absolutely. And it's a bit different from what we saw during the global financial crisis and even the Ukraine, because during the Ukraine crisis, which is the more recent one, there was always a threat of, you know, commodities and oil being choked off, but it never happened really. Yeah. This time we're actually seeing physical curtailment of the oil supply and gas supply especially. So, and we've seen physically, you know, countries like Australia, New Zealand, Vietnam, you know, running out of, you know, reserves very soon. So that's I think this physical part is what is different from the last time. GFC was more of a financial crisis, so you could pump your economy, cut rates aggressively and revive the markets. But this time around, it's a bit more complicated than that. So I think, in my view, oil prices have gone up. Yes, it's a shock, but the levels of oil price are less important, frankly. Even if it stays 100 for a while, the world will adjust to that new reality. It's fine. But the length of uncertainty is what's kind of, you know, spooking investors.
You know, 4 weeks back, right, or 3.5 weeks back, we all thought this is going to be short-lived, and we all made historical parallels saying that every time there's geopolitical uncertainty, it's a great buying opportunity, and therefore buy the dip. That's not really worked out.
No, absolutely, because as you rightly, we have been conditioned to the fact that every time there's a crisis, central banks and governments will use monetary and fiscal measures to fix the markets, so to say. But when you have physical issues of supply, any amount of monetary or fiscal, you know, pump-priming will not work. And that's what's kind of, you know...
So where do we go from here? And then what's the investing advice?
So I think our best bet is the taco trade. And that seems to rear its head from time to time. 48 hours became 5 days moratorium, and now 5 days become 10 days moratorium. So that's our best bet, that the pain that the good... Okay, let me put the positives out. The good part about this is that it's all controllable and avoidable. Moment of 2 or 3 people decide to end this, they can end this, right? So it's not like COVID where we don't know what was going to happen, you know, there was no solution, etc. The solution is right there. 2 or 3 people can get together and fix this. So this pain, economic pain, the physical pain that people are seeing is what will determine the reaction function, I would say. And that's the good part about all this. But having said that, you know, as I said, it's more about the length of the crisis rather than the absolute level of commodities that is bothering the markets.
You know, I still think, we were saying the 3 weeks back, we thought it'll be over soon, right?
Yeah.
But it's only 3 weeks, right? So this is the 4th week ended. I mean, I still think this is the first stages of winding down the conflict, not escalation. There's 10 days is the timeline, which, I mean, with no strikes, etc. But I think, as Mihir also pointed out, and I think Neelkan made that point, and I think everyone is basically the fact that markets will force outcomes. Yeah. S&P is on Friday, yesterday's close, down 10% from the all-time highs, right? Yeah. And like it is here, stock markets in the US are also very powerful. You know, it's the wealth effect. You feel richer, you feel good about yourself. Yeah. You want to vote for a certain president when the midterms
far
come.
more than what the implications are for India.
So
for India.
Because of the 401ks. The 401ks are far more important out there.
But I guess, more from the equity, I think the US 10-year and 30-year yield is something which will force as an...
It forced him the last time as well,
exactly.
April 9th or 10th, I think. So that was the Liberation Day that it forced him. And maybe this time around as well, when it went to close around 4.5% on Monday.
You know, President Trump's approval ratings were 34% before the war broke out. It's gone down. Yeah. Typically, after every conflict, right? Yeah. A president's approval rating goes up, not down. Because, you rally around your country, you say, well, that kind of feeling. Nothing of that sort. 34 has become 32. And this is 6-7 days back. Yeah. I mean, and at the end of the day, he's a businessman, but he's also a politician, and there are midterms coming. So, I mean, I think it's all, of course, I mean, anything can happen. As
but he's said, Trump.
It is, yeah, exactly, right? So we don't know. He could say this and he can say that, and he may not end it. But I think balance of probabilities, I would still say that this is not some, I mean, whatever, 6 months, 1 year. But in the meantime, we have to adjust, like oil, the government has done, Nigel, right?
On that optimistic note, I hope that, there's going to be some de-escalation. Let's talk about oil, because that was the big data point, right? Global, if you look at the Western world, the oil prices are up between 20 to around 30%. So people are wondering whether or not there's going to be a price increase. But we have elections that's coming up in various states, so that's not a probability. However, on Friday morning, we suddenly got a bit of a surprise. You could term it as a pleasant or a negative one for the markets and as well as on the consumer front. But there was a cut on the excise duty, both on petrol as well as on diesel. And on petrol, it's come down from around 13 rupees per litre to around 3 rupees. On diesel, from around 10 bucks, it's come down to nil. Now, remember, the OMCs, they were having negative margins to the tune of around 27 to around 50 rupees per litre on petrol as well as diesel. So with this excise duty cut, well, that comes down by around 10 rupees approximately. And on a blended basis, I'm looking at ICICI Securities note, they say that the marketing margins on a negative basis comes down to roughly around 30 rupees per litre. That's the estimate that they're putting out. Remember, they'll be gaining on the refining side of things, but on the marketing margin side, they'll be losing out. So the blended impact will be a little bit lower. Moving to their balance sheets, not in such bad shape as what we have seen in the past. Sonal has put this data. Either below 1 or around 1 is what we have seen in terms of the net debt to equity. From a consumer perspective, the prices don't go up. And in the near term, inflation will not go up because the price of petrol is not going up. However, to offset some part of this from a government perspective, on exports, they have implied a duty out there, both on ATF as well as on diesel, so they'll get some kind of revenue from there. Net on the economy, what is the impact? Well, I've looked at a couple of estimates, and the broad consensus that, the numbers throw up is that every litre of excise duty cut, that's what results in a loss of close to around 15 to around 18,000 crore rupees. On an annual basis, it could be around 1.7 lakh to around 1.8 lakh crore rupees. That's for the full year. So working with, maybe 3 to around 6 months, the impact on the fisc will be around 0.1 to around 0.2% if it goes for 3 to around 6 months. If it goes for an entire year, then in fact, you're looking at a hit on the fisc at around 0.4% or thereabouts. So net, for a consumer, nothing much changes. On the fisc, there is an additional, hit out there. And for OMCs, they get some breathing room. Difficult one, right? For the OMCs, they've been getting hit, but this was like a bit of a breather shot that did come in there because the losses on the marketing margins will come down a little bit. On refining side, they're gaining though. What's your view on the space?
So we tend to be underweight because I'm very wary of sectors where there is frequent need for government intervention, frankly speaking. Even today, if you look at the pure refiners, they should have gone up actually today. They did not. So market's not really extrapolating these profitability.
You're talking about MRPL and CPCL.
Exactly. So market's not extrapolating either the negatives or the positives in terms of marketing margins or refining margins infinitely. Market is still treating this as a transient factor. So even if there's a windfall gain in refining margins, it's not going to be assumed that it's going to last forever.
Chennai Petro was down today.
Yes, right? But even MRPL was down today.
But I don't know why.
So exactly. So refining margins are
huge right now. No, that export tax, Chennai Petro, I don't think exports anything.
No.
It's all into India. MRPL may...
a small part.
So actually the export tax does not apply to Chennai Petro, maybe a little bit to whatever they export. MRPL exports in that sense. But anyway.
I think the problem is that now the shareholders are looking at it as there is an uncertain situation and there is a possibility the government is not going to let them keep all of the gains. Though, as you said, the GRMs are still very, very high. They're much higher than what the street is working with. And for CPCL in particular, they could be reporting one of the most blockbuster quarters ever because the refining capacity globally itself has come off substantially. So they'll stay up, but the multiple, is something that you'll be wondering what to give out there.
All right. So everyone wants to know the stocks which have been resilient in this downfall, right? Everyone's looking for bargain hunts.
Nimesh is bringing us the good news.
So we'll ask Mihir about what is he shopping and what is he doing. But I just put out a small data on since the war broke out, how the indices have done and which are the stocks which have actually outperformed and bucking the trend in this fall. So first, the big picture, if you look at in the last 4 weeks, Nifty down, Midcap down, small cap down, NSE 500 down 8-9%. The biggest loser is Nifty Bank Index, which is down 13%. This is a data which I guess everybody knows. Now look at the breadth as well. If you look at the breadth across all these indices, it's almost 80%, 90%. The breadth has been weak. So the gainers, losers will come up. Out of 50 names, 45 stocks are down. In Nifty Bank, all the 14 stocks are down. In Midcap, out of 100 names, 87 is down. And same is the case with BSE 500 as well. Out of BSE 500 names, 445 stocks or 440 stocks have ended in the red. So the breadth has also been weak across the board. Now it's interesting. In this weak market, what has bucked the trend? I've just identified, this is within the BSE 500 data. Stocks which have actually outperformed and have done well. Surprise, surprise, Premier Energies is up 25%, Vari is up 15%, Acme Solar is up, Aether Energy is up, MQR Pharma is up in that list. Going down, which are up between 7 to 10%, the likes of Happiest Minds, there was a news there, which is why that stock was up. But Adani Power, Aurobindo Pharma, Linde India, and Granules India. What this list suggests is there are two sectors which are actually standing out and outperforming, which is power or maybe solar and power and those kind of theme, and the pharma. And pharma, of course, benefits because of the rupee as well, right? So, Mir, coming to you, is this going to be the hiding space, the power names, or for that matter, pharma names as well? I know you have some of the pharma stocks in your small cap portfolio, but what are you doing and what are you shopping at these levels now?
So it's the normal flight to safety behavior. So we've also increased exposure to IT. By the way, we've been underweight and negative on IT for a long period of time, but finally, even before this, war, IT stocks did correct on the AI scare, etc., and they became kind of maybe too cheap, almost down. Some of the mid-cap names were good quality mid-cap names were down almost 32%, 33% in the last month and a half. So we thought it was a good hiding place. Plus the currency is helping.
Yeah.
And most importantly, I think.
So your comfort is to the large cap IT or the mid-cap IT?
Both.
Because I know,
but we are more biased towards the mid-cap IT because you're still talking about 15-20% growth potential. The one key factor is that if you look at the relative strength of economies, the US is the least impacted by all this, right? Because they got the gas, they got the oil. So to that extent, the damage to the US will be the least, and IT is most exposed to the US. So that's a play on the US and the Indian rupee, the way it is behaving. So IT is one place we've been hiding. We've been adding to pharma also, not so much because of the defensive nature, but also because of the fact that you have the GLP-1 plays and the derivatives of GLP. And plus bit of a flight to safety, I would say.
So is that, have you churned within the portfolio? Because you own a lot of the small mid-cap banks as well, the private banks.
Yes.
What's the call there? So, have you moved out of them and bought into this pharma and all, or you're holding on to them?
So a couple of things we've done in this volatile market. One is that we've taken some cash. So normal cash holdings used to be 4 to 6%. Now we're between 9 to 10% cash. So that's one. And we have removed some of the higher beta names in the industrial space as well as the discretionary space. So some of the auto names, some of the auto ancillary names, and some of the industrials we have reduced there.
Rima, he's added IT.
He's added IT. Yeah, it's good to hear because we've been
NBFC. And NBFCs we have reduced.
Reduced NBFCs. Yes. But we wrap up the week, but we're also wrapping up the financial year. Right? Next time when we meet on Editors Roundtable, it's going to be the month of April, the start of a new fiscal year. And one thing that stands out in FY26 is that Indian IT companies have become aggressive on the M&A front. As we wrapped up this Friday, we got the news that Infosys made 2 strategic acquisitions, which bolsters their presence in insurance and in the healthcare space. Now, cumulatively, Infosys has made 5 acquisitions in FY26. They've spent $800 million this year, and this is amongst the highest that they've spent on M&A in this year compared to the prior years. And Nomura believes that these acquisitions can contribute 2.25%, 225 basis points inorganically to their revenue. So assume organically they do, 3, 4, 5%, plus this will add another 2.5%. So that's fairly sizable in terms of the inorganic move. The other one is TCS, and this year was an inflection point. TCS historically was always known for their organic growth discipline being very conservative, but this year they spend more than $700 million and plus the data center investment. Wipro and HCL Tech have been periodically making M&A, and that continued even this year. Now, the Indian IT sector in the month of March is only down 3%. It's outperformed the Nifty, which is down 9%, and one helping hand has come in from the rupee depreciation, very sharp rupee depreciation, and BofA says that we expect a 100 basis point tailwind to the profitability of the Indian IT companies in Q4 on account of the FX movement. But the entire thing will not be passed on. Part of it will be passed on, part of it will be kept by the Indian IT companies just to provide a cushion and shore up their investments for the first time, just to shore up and provide some cushion to the profitability. And finally, what the street is going to watch very closely in April will be the FY27 guidance. JP Morgan says for the first time in 8 years, the focus on the revenue guidance will be crucial given the widespread pessimism. They're working with 2 to 5% revenue growth for Infosys organically, and for HCL Tech about 3 to 6%. So all eyes on IT as well.
Rima, you're off on Monday, or are you?
No, I'm here on Monday.
Monday is the 30th, no?
Monday is the 30th.
Yeah. Still same financial year?
Same financial year, but I say next time
Next time
we'll meet
it
on
was-
editors round, editors round table.
And we was not there next
sliding
week.
in a fast one. Huh? Next time. Mir, you own MCX in your portfolio?
Yes, we do.
So it's 60,000 crore market cap. Is it cheap, expensive? What is it? What's the?
I wouldn't like to comment on stocks, but for us it's more of a this space exchanges per se, especially on the commodity side. We're playing it on a couple of aspects. One is the higher exposure to options now compared to before.
And
So
apparently the
options, and plus it's
expectation
also a play on commodities like oil and
Q4
gold.
will be a blockbuster is what the street has been
So
expecting for MC.
It's been a secular play for us for a while.
Okay, thank you very much, Mihir, for joining in, and good to see the optimism on IT finally after so many months. It's curtains down on Editors Roundtable. Thank you very much for watching. Stay tuned to CNBC TV 18 for more news and updates.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The market snaps a two-day winning streak. The Sensex nosedives nearly 1,700 points. The Nifty slips below 22,850, wiping out over 9 lakh crore rupees in investor wealth. PSU banks and real estate companies take the worst hit. The rupee's free fall continues. The currency hits a record low of 94.80 to the dollar, on track for the highest yearly loss in nearly 14 years. The government slashes excise duty on petrol to 3 rupees per litre and on diesel to 0. The move is expected to soften the blow for OMCs by up to 20,000 crore rupees, but the cuts will not change prices at the pump. The government also imposes additional duties on diesel and ATF exports to ensure adequate domestic availability. The duties will be reviewed every fortnight. The government says it is expected to garner about 3,000 crore rupees a month from the hike on diesel and ATF exports. This will offset the 7,000 crore rupee revenue hit it may incur on account of the excise cut on petrol and diesel. Defence Minister Rajnath Singh to head an interministerial panel to monitor the West Asia conflict. Other members include the Home Minister, the Finance Minister and the Petroleum Minister. The panel will discuss actions that the government may need to take in lieu of the war. Tax relief on more items is being considered too. US President Trump extends the deadline for Iran to reopen the Strait of Hormuz by 10 days to the 6th of April, claims the request came from Iran and talks were going very well. Tehran consistently denies these claims. Iranian Foreign Minister, while speaking at an emergency UN Human Rights Council session, calls the Minab elementary school attack a war crime. Israel continues to bomb Iran as the war completes 4 weeks, claims it targeted ballistic missiles and aerial defense system production sites across the country. Kuwait says its main commercial port suffered damages in an Iranian drone attack. Wall Street Journal reports that the US plans to deploy 10,000 additional ground troops to West Asia. Infosys continues its buying spree in FY26 with 2 new acquisitions, buys healthcare tech consulting firm Optimum Healthcare and insurance platform Stratus for a combined $560 million. Total value of the acquisitions in FY26 crosses $800 million. Well, let's start with the day's market action. The market snapped its 2-day winning streak with frontline indices falling over 2%. The Nifty fell below 22,850 and the Sensex was down nearly 1,700 points today. All sectoral indices closing in the red. The Midcap index down over 2%, almost a 3% cut there on the Nifty Bank, and the Sensex and the Nifty down by about 2%. For the week, the markets have also closed in the red. For the 5th straight week, in fact, the markets have closed in the red. The Sensex down a little over 1%, 2% lower on the Nifty and on the Nifty Bank, and the Nifty Midcap index lost about 1% or so. Financials did underperform, and that is why we saw the Nifty Bank lower. Prashant joins us now to wrap up what has been a very painful week for our markets. Prashant, the uncertainty with respect to the Iran war continues. How are traders looking at the week ahead?
The market pulled back, in short order. 22,800 around is where we finally left off at. Add to all of this, of course, is what's happening with macros, growth estimates being brought lower, inflation forecast being bumped up, current account deficit as a percentage of GDP being seen higher, earnings expectations being brought lower. So all of that showing up in the rupee in a big way. We were same time last Friday, we were pushing to the 94 levels. In a week, we are pushing 95 now on the dollar rupee. I'll just quickly run you through the indices and where there was maximum amount of pressure. PSU banks down 4%. You had the real estate index down about 3%. Autos, which was down about 2.5%, and the capital market index, which was down about 2.75% as well. Wix, which sold off day before yesterday, was up about 8.5% today. But that's it. I mean, that's the only index actually which was higher. You could maybe look at the CPSE space, which was kind of absolutely flat. Otherwise, it was pretty poor all across. The large cap losers and Shriram Finance had run up 100 rupees over the last 2 days. The CCI approval, of course, came through, but ended about 5.5% lower. Tata Motors passenger vehicle down about 4.75. Indigo down 4.5. Reliance was a big one. That export tax, right? I mean, taking a bite out of it, so almost 4.5 lower. Bajaj Finance, State Bank of India with the other 4% lower today. ONGC was the single biggest gainer with a 4% pop, and next in line was a Wipro and a Bharti, which were slightly higher as well. Now, on the downside, I mean, advanced decline is pretty weak, pretty poor. Spark, Eco Mobility, lots of these names, but not really on the back of lots of volumes coming through. Advanced decline skewed really, but if you look for volumes, you would not really find very much. Pretty thin as far as the broader market action is concerned.
Prashant, many thanks for joining us. Now, the government has stepped in to provide some relief to oil marketing companies. Remember, OMCs have been bearing the brunt of the steeper global oil prices since the start of the Iran war. The government has cut excise duty on petrol to 3 rupees a litre, and the duty on diesel has been cut to 0. We learned that the move is expected to soften the blow for OMCs by up to 20,000 crore rupees. However, prices at the fuel pumps, which means the prices that you and I will pay, remain the same. There is no change there. Now, the government has also imposed an additional duty on diesel and ATF exports. So remember, we used to have a windfall tax. Now we have pretty much the same. It's an export tax to secure supply for domestic industry and help mop up the revenue loss that the government is accruing. The government believes that it is expected to garner about 3,000 crore rupees a month from this export tax. This will offset a part of the 7,000 crore rupee revenue hit it may incur due to the excise cut on petrol and diesel. Now, the allocation of commercial LPG has been increased to 70% from 50% earlier this month. The government has said that additional supplies will be directed towards labor-intensive and essential sectors like steel, automobile and textile, among others. Separately, as per Reuters, the government is in talks with Moscow to resume direct sales of LNG for the first time since the start of the Ukraine war. The report adds that the government has already reached out to Washington for a sanctions waiver. Petroleum Minister Hardeep Puri has said the government had only two choices to manage the rising prices of crude oil prices: either increase prices of fuel or take a hit on revenue. He added that the government chose the latter to insulate Indian citizens from global price volatility. The centre has also maintained that India has sufficient crude inventories. Finance Minister Nirmala Sitharaman said the excise cut decision was taken by Prime Minister Modi in yesterday's cabinet meeting to ensure adequate fuel supply to consumers. Take a look.
It was decided that there should not be a shortage and there should not be an increase in price due to the global situation in crude, in petrol, diesel and in ATF. Today we have announced a decision whereby we will be giving support to the oil marketing companies so that they can import the material and not really, even if it is imported at a higher cost, the common citizen will not have to face any increase in the price of petrol or diesel. For ATF, which is so required for aviation, we are making sure that the prices will not go up and the oil marketing companies will be supported to bring these commodities to India. Those refineries which get the material from outside, refine them and send as exports these materials will now have to face a higher duty so that both of diesel and ATF, so that these materials are available for India. They will be made available for domestic market and ensure that we shall not be sending products at a time when we so need them without any shortage.
These duties on petrol and are nil at present. So the duties which have been imposed on diesel and ATF. The duties on petrol are nil based upon the present crack margins. However, the rates will be reviewed on a fortnightly basis. The idea behind having these changes is to prioritize the domestic availability of these products.
We have sufficient crude inventories और अगले 2 महीने के लिए supplies have been lined up. Situation is comfortable with respect to LPG and PNG also. हमारी refineries 100% या उससे भी ज़्यादा capacity पर operate कर रही हैं और domestic production of LPG has increased by almost 40%.
Thank you for that. Well, as the finance minister pointed out, this is a relief for all marketing companies and nothing will go in the hands of the consumers. So all marketing companies will see some relief on their marketing margins. So let's talk about the impact now. First, they've been looking at a lot of marketing margin losses to the tune of around 27 rupees per litre on petrol, 50 rupees per litre on diesel. And with this, those losses will come down. But do remember, despite this excise cut, the losses will not become nil. They will just become lower for all these companies. The second part, of course, it will help them with working capital issues that these companies have been facing, better cash management, cash flows will improve, and the fact that the excise duty has been cut will improve their P&L overall. Since retail prices are unchanged, the benefit will stay with the oil marketing companies. If we look at their balance sheet strength as well, it has been improving in the last couple of years, so they are in a better position to absorb such shocks that would come by. For IOCL, BPCL and HPCL, for all of them, net debt to equity has been coming lower. If you look at a BPCL, it is at 0.3 times. For IOCL, it has reduced to 0.8 times. If we talk about HPCL, which has the highest exposure to the marketing segment, that's where it is 1.4 times. But yes, it has been reducing for all these companies. For consumers, as I said earlier, there's no change. Inflation remains as is. Household budgets will not change. And you will pay the same prices for petrol and diesel as you've been paying earlier. The other change that has come by is they've increased or they have levied export duties on export of ATF and diesel. This is to ensure that there's enough domestic availability of these two fuels and there's no shortage as such. So it has been increased by 21.5 rupees per litre on diesel and 29.5 rupees per litre on ATF. But this is a positive move considering that there will be enough supply in the country itself. But some of these exporters like Reliance, CPCL, MRPL, they will be in focus on the negative side because of this. Now just a quick check on how prices have moved globally as far as fuel is concerned. How much have they increased since the time the West Asia war is increased? For India, it has stayed as is. For US, it has been to the tune of 38%. UK has seen a 24% increase. Germany at similar levels. And France has also seen an increase of 30%. So there has been no price hike for customers. There's a relief in terms of excise duty cut that has come for oil marketing companies.
All right, Sonal, many thanks for joining us. Now, the government has formed an interministerial panel under Defence Minister Rajnath Singh. Sources tell CNBC TV 18. The panel will look at issues linked to the war in West Asia and the steps the government will take. We also learned that tax relief on more items could be considered. The Finance Minister, Home Minister, Petroleum Minister and other ministers are part of this panel. Explosions intensify in West Asia as the war completes 4 weeks, with President Trump extending the pause on strikes at Iran's energy infrastructure by 10 days. Now, Trump said on Truth Social, and I quote, "Talks are going well despite erroneous statements to the contrary by the fake news media and others," end of quote. Separately, in an interview to Fox News, the president also said that Iran had asked for a 1-week extension, but he decided on 10 days because they gave him ships. Trump had initially given Iran 48 hours to open the crucial Strait of Hormuz to oil tankers, threatening to destroy Iran's power plants if they didn't act. But he has now extended the deadline twice. Doubts about the possibility of a de-escalation also spooking Wall Street. Benchmark indices, the Nasdaq and the S&P 500 witnessed their sharpest fall since the start of the West Asia war. Asian and European markets also in the red. Reports of more U.S. ground troops in the region sparking fears of a further escalation. The Wall Street Journal reporting that the Pentagon is also looking out to send up to 10,000 additional ground troops to the region to give President Trump more military options. Meanwhile, Gulf countries remain under fire, with Saudi Arabia, Bahrain and Kuwait all saying they intercepted missiles. 2 key ports in Kuwait were attacked, resulting in material damages, but no casualties reported. Iranian missile attacks also struck the northern areas of Tel Aviv. The blast killed 5 people and injured several others. According to Israeli military, the attack involved 1 ballistic missile and multiple cluster munitions that dispersed in smaller explosives. Israel also continued to bomb Tehran with a new wave of strikes on civilian infrastructure. Israel's attacks on targets in the heart of the city came after the country said it would intensify strikes on Iranian weapons production facilities. Smoke also rose over Beirut. The southern suburbs of the city were hit with airstrikes. This as Israeli military's ground invasion near the Lebanese border also took speed. Meanwhile, Iran's Foreign Minister Sayed Abbas Araghchi addressed the UN Human Rights Council, said the war of aggression by US in Israel is blatantly unjustified and brutal. He also said the US betrayed diplomacy for a second time in 9 months and called the attack on a girls' school in Minab a war crime.
We have very substantial talks going on with respect to Iran, with the right people. You know, I told you about a president, right? Steve, can I reveal the present?
You can do anything you want.
Thank you. They said to show you the fact that we're real and solid and we're there. We're going to let you have 8 boats of oil, 8 boats, 8 big boats of oil. They then apologized for something they said, and they said, we're going to send 2 more boats. And it ended up being 10 boats. All right, I hope I haven't screwed up your negotiations, but I thought it was appropriate to say, because I did taunt you the other day by saying they're going to give us a present.
Well, that is President Trump speaking at that cabinet meeting that was streamed live. Moving on now, the Bombay High Court has dismissed a plea seeking a CBI probe into allegations that Reliance Industries illegally extracted natural gas from ONGC fields in the Krishna Godavari Basin. The petition claimed the company carried out unauthorized drilling between 2004 and 2013 and 14. Reliance maintained it had the right to extract the gas as it naturally moved between blocks. Shares of Fino Payment Bank rose in trade today after a special judge for economic offences in Hyderabad granted bail to CEO Rishi Gupta. The bank has clarified that the ongoing investigations pertain to certain program managers associated with multiple banks, including Fino, adding that the investigation does not relate to the bank's GST compliance. Meanwhile, the bank has withdrawn the reappointment of Rishi Gupta as MD and CEO due to the ongoing case. His reappointment will be submitted for shareholders not at an appropriate time. Biocon's Managing Director and CEO Siddharth Mittal will step down on the 31st of March and move to a new role within the group. Biocon Biologics' current CEO and MD, Shrihas Tambe, has taken over from the 1st of April. Tambe has been appointed for a 5-year term. The company has also chosen Kedar Upadhyay to take over as the Chief Financial Officer. We'll head into a break, but up next, Infosys continues its buying spree in FY26 with 2 new acquisitions. Total value of the acquisitions this fiscal crosses $800 million. Other IT majors also spend big as Indian IT leverages M&A to grow. Tech giant Infosys announced a strategic acquisition, Optimum Healthcare for $465 million and Stratus Global for $95 million. With this, the company has made 5 acquisitions just this year, spending a total of $800 million. Rima joins us now with more on the tech industry's M&A blueprint. Rima.
FY26 has been quite a landmark year in terms of M&A spend by Indian IT companies, the highest that we've seen in the recent past, and particularly that inflection point seems to have come in for Infosys and TCS in the wake of slowing growth. So let's begin with Infosys. Now, Infosys, as you said, has spent $808 million so far, making the acquisitions. The big one, of course, is what they announced, $465 million for Optimum Healthcare. You had Stratus Global, which was announced prior to that. There was Versan, which was announced by the company. This is amongst the highest that the company has ever spent on acquisitions in a single year. So last year, that's FY25, the company spent a little less than $500 million to acquire Intech. In the prior year, it was a modest, they were tuck-in acquisitions that the company had done. So as you can see, this year, with $808 million, it's been far more aggressive than it's been in the recent past. TCS. Now, this was a company, you would remember, which was known for its organic growth discipline. They spent $773 million in FY26, the highest since their listing in 2004. They made 2 acquisitions, and plus they had those data center investments. It's a big strategic pivot for the company, and when we chat with the management, they tell us more M&A is lined up. Now, HCLTech and Wipro, on the other hand, have used M&A far more steadily across periods. So this year, HCLTech has spent $420 million. They made 4 acquisitions, and Wipro did 1 acquisition. It was called Harman DTS, and they paid a little less than $400 million for that. But in the past, Wipro has made large bets like Capco and Rising. But, you know, outside of the large 4 IT companies, the biggest, the boldest bet came in from Coforge when it acquired Encora for $2.3 billion. And outside India's shore, it was Capgemini acquiring WNS for $3.3 billion. Now, why is this happening? FY24 to FY26 has been amongst the weakest phases in terms of revenues for the Indian IT companies in over a decade. Revenue growth has slowed to low single digits now. AI is reshaping the whole industry. The traditional model of hire, scale, bill is under pressure. It's getting questioned. And AI is also compressing the timelines. So now buying capabilities is faster than building capabilities. And Indian IT companies seem to be responding to that by getting faster, sharper, and more aggressive on the M&A front.
All right, Rima, many thanks for joining us. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Welcome back to the CNBC TV 18 Market Town Hall. As promised from global macros and the oil shock, we now turn our attention to opportunities in the market. With me is my colleague Nigel. Nigel, hi.
Well, thanks a lot for that, Prashant. Well, they say with crisis comes opportunity. And that's precisely what we're going to be focusing on here. What can you do to make money from here on? That's the big question. We have with us Mr. Harish Krishnan of Aditya Birla AMC, and we'll also be joined by Sandeep Tandon of Quant AMC. We'll be focusing on the micro opportunities with Harish and focusing on the macro opportunities with Sandeep. But before we bring them in, let's assess the damage to the markets since the entire war broke out. Prashant, take it away.
It's not a pleasant task, Nigel, but someone's got to do it, right? Assessing the damage, the tally, or whatever you want to call it. But let me go across and tell you exactly what's happened since, the 27th of February it was. Just absolutely a quick run-through in terms of what we've seen. And returns, basically, I mean, a big bite has been taken out of returns for investors. The Nifty and the broader markets have lost between 8 and 9% since the war began. The damage to the otherwise still recently resilient banking space has actually been quite large as well. The Nifty Bank has lost about 13%. This is all from the 27th of February close. But it's not just India, right? Look at the damage to other markets in Asia as well. Markets like Korea and Indonesia actually have lost the most, 14.5%, 15% in that range. You look at flows, FPI flows, which had turned briefly into the positive the month before. They've turned negative once again. FIs have sold big, and you can see that almost $10 billion or so. But who's on the other side? It's locals. Those SIP inflows providing some amount of counterbalance coming through. Now look at commodities as well. There are fears of demand destruction. There are also input shortages with regards to metal processing, etc., which basically means that base metals have taken a knock as well. Things like copper, aluminum, not so much, but a bunch of other things. Gold and silver, magnificent rally over the last couple of years. And they were all the rage through the first 2 months of this year, but they've taken sharp knocks. Gold prices at about $4,300 at the lows recently were basically back at where we started this year. And of course, valuations will come up on your screen as well. So I'm just using the Nifty, the Midcap index and the Small Cap index. And what I've done is not taken forward estimates, but trailing earnings, P's based on trailing earnings, because the future is always uncertain, but it's more uncertain right now. But on a trailing basis, Nifty, P multiples at about, 18 point something compared to the 10-year average, which is about 20 plus. Midcap index, Small Cap index, basically valuations have come off. The question is, have they come off enough for you to really jump in and deploy some serious amount of money and do some sensible things? That's the question. Let me invite Sandeep Tandon and Harish Krishnan. Gentlemen, if I can request you to come up on the stage, and we will ask both of you, exactly that question, what to do. Please. Welcome. Thanks. Hi, Harish. Please.
Thanks.
So let's start right there, guys. And, we were having this conversation earlier on the earlier panel, right? It's not just this one shock. It's like shock after shock after shock. Start with the tariff one, then there was the AI one, and now this is the oil shock. Let's start with the latest, which is this oil shock that we've seen and the 8-9% correction in the index. Have valuations become reasonable? Harish, let me start with you.
Sure. Clearly, as you said, that this is the here and now, but I just want to kind of contextualize. In these 18 months, we've kind of focused on 5 key resets that have happened, right? We've had domestic demand getting fired by tax cuts. You've seen rate cuts happening. You've seen a currency upgrade in the form of a sovereign upgrade. You've seen trade deals with 70% of the world economic output. And then you also are starting to see a transmission of rate cut cycle. This is what had happened before the war kind of broke out in the Middle East, right? So when you are a farmer and you start looking at, say, owning the farm for the next, say, 50 quarters or 70 quarters, what happens in the first 2 quarters has got very little meaning compared to the overall competitiveness that eventually will start coming through for the farm. So therefore, we think that, in this kind of a framework where we've done a lot of hard, heavy-hitting kind of shifts in policy response to all the other issues before this kind of development, we should kind of look at this correction very favorably rather than to get worried about. So that's point number 1. Secondly, to your question about energy shock and therefore, is it only India that's going to get impacted or is it going to have a cascading impact to the rest of the world? Let's draw our attention to what happened in the Ukrainian conflict, right? Now, at the Ukrainian conflict, at the peak, when there was an overall commodity boom, and do remember that at that time, agri-commodities went up through the roof, overall crude shock was roughly about 5.3% of world GDP. At today's prices, it's close to about 4.6, 4.7% of world GDP. That's where the total spending on crude, if this were to annualize for the whole of the next year is concerned, right? So there's still some gap, but the bigger thing is the Western world had far lower interest rates at that point of time. Today, a lot of that is being fed into the Western world, and that is going to have a far bigger knock-on effect, right? So therefore, if I were to contextualize, can the world really absorb such huge amount of a shock absorption? The answer is no. And which means that we think that it's going to be a lot more pragmatic, that both the administration in US and hopefully the Gulf Council kind of puts their heads together and kind of de-escalates the situation rather than letting it go out of control. So if that be the base premise, we think that, you know, valuations are reasonably attractive in a lot of parts of the market, and which is where we think that, you know, rather than get obsessed about the next 3-6 months, let's look at companies which have become more competitive and which are on the right side of all of these disruptions.
You know, Nigel, what we'll do, and what we thought for our viewers, what we'll do is we'll divide this conversation after getting initial comments from you, Sandeep, as well. We'll look at the three disruptions: the big AI disruption, tariff disruption, and energy disruption. We'll ask both of you which are the companies, sectors which are on the right side of this disruption. Which are the companies which actually, I mean, for the lack of a better word, benefit or get hurt less. So that's what we want to do. I mean, there's one framework to use. But Sandeep, just to sort of kickstart and get your views, you use so many tools to analyze where we are at and whether things have priced in a fair amount of damage, or is there more to be done here? So what do you say to that question?
So Prashant, let's start. We in the beginning of the year, I described 2000 on this one of the panels out here. We talked about fragile 2026 and as a PE contraction year. And we also talked about correction in global equities, particularly DM, and we talked about a massive correction in silver and gold, because that's the euphoric move which we saw. Now, if you really look at, it has corrected a lot, okay? And we think we are getting signs of capitulation now, where even bullish thought process is getting capitulated. These are typical signs where best of the global houses makes big targets about crude. This is not the first time we are seeing, you know. It's a human reaction, you know, when you are in pain, you will try to see that everything has changed. But the fact remains that the relevance of oil has already lost as compared to what was earlier years. Now it's a gas and we are getting a renewable. Now, if you look at the walls data, the question which I asked, my point is that maybe yes, this month oil can remain elevated based on our predictive analytics. In February, we talked about that oil will rally, and we talked about dollar index risk to the global equities, and I think has played out. My view is that this will not last for long, and we are in the final fag end of that crisis. Maybe get extended by a few more days. That's what data is showing. Okay, and if you ask me, the beginning, by the end of the year, where the crude will be, I think it will be below 70. Okay, so where the concern, this is how we reverse calculate based what we call it market implied analytics. Okay, that is our data is showing. So I will go with that thesis. The data is got. Okay, and we are slave of data. So I'm not that much concerned the way people are panicking. Yes, obviously manufacturing sector will be affected. We have issues on the utilities side. We have issues on the input side. We have issues on the output also. We don't know the trade related or the logistic challenges which we are seeing. But I think every crisis has opportunity. So I think I will look as an opportunity because India has already corrected a lot. We turned negative on India in July 2024. And I said in January, what was the situation in India in July 2024? Something similar is there in January 2026 for US, and something similar is there for Taiwan and Korea in 2026, where whole world is very gung-ho about Taiwan and Korea now. We think we are getting signs of complacency out there. I will not say a maniac sort of thing, but there is signs of euphoria. I think the way I look at maybe beginning April, India has opportunity to outperform global equities, and India will fall less. And maybe by end of the year, in absolute and also you will see a new all-time high in the indices. Okay, I will not be surprised at all to see maybe by the mid of the year also. So I think this is a classic phase where everybody is giving up. capitulation is there. And I mean, when we talk about equities from longer term perspective, but unfortunately peak of the cycle, every investor has a very high risk appetite and he's a long term investor. When 6 months later things change, I think if we have thought process, this is opportunity, then I will like to increase our equity exposure. We were sitting on large amount cash. We have deployed up to large extent in this fall. So we like to use this as an opportunity. I think it's a brilliant opportunity for India after maybe 2 years of underperformance.
All right. Take that thought very, very seriously, Sandeep, because the last time we were on the panel, you spoke about 2026 being a challenging year, PE getting derated, but you also made a point that India will outperform, and you're sticking to that stance as well. So maybe we're in for better times from here on. That said, a war like this throws up very opportunities in the post-war scenario. Could you tell us the top 2 themes that you're looking at, from here on? Power could be one, I think, so it's something that you're bullish on. But run us through the rationale on those 2 top themes.
See, we have been, if you have to really play data center story, I think power is a theme, like how we played copper for the EV thesis in the past. I think power or energy as a sector is a great opportunity. That's one of the reasons we have more than 20-30% exposure in this space.
Okay.
So that's the one space which we're looking very constructive. Second space, as compared to IT, we like pharma as a space. I'm not saying all the pharma companies, but a lot of generic companies. And we have to keep in mind some of the pharma company will face challenges on the solvent side or their raw material side, which is a derivative of crude in some manner. So those are the areas which you have to exclude. Then I still like, in the current context, the BFSI space, private sector over public sector. We still like insurance could be opportunity. Asset management company itself is opportunity. Wealth management companies are thing, because asset management companies are serious threat to banking from a longer term perspective. I think great businesses which is getting, we are also part of that industry, so we understand that space quite well. And I think other areas which have to look at should be the sum of the consumption theme. The FMCG stocks particularly, they are still expensive. On relative basis, they have corrected, they have underperformed. Many stocks are in the neglected zone. So I will look for food processing companies also should be opportunity. And if I have to avoid at this point in time, I think it's a manufacturing space, because we really don't know. And none of the companies will going to really explain, because they themselves also don't know how exactly it will. So more from a conservative approach, I like to avoid manufacturing company. You cannot avoid completely. So I will say I will dilute these holdings and look for opportunity once we get more clarity on numbers, maybe down the line a quarter or so.
Okay, all right. Harish, let me get you in there. Now, we look at global markets and we look at PEs, return ratios and the likes. You have another way of looking at it as well in terms of India's market capitalization as a percentage of global market capitalization. Could you tell us what does that come down to and what does it compare with in terms of averages? Is it lower than what we've normally seen?
Sure. So India's share of world GDP of economic activity is roughly close to about 4%. Okay, roughly a $4 trillion economy on $102 trillion global economic output, right? And if we tend to grow at anywhere between 9 to 11%, and the world growing in nominal terms anywhere between say 4-ish odd percent, give or take, how it eventually pans out. You would think that this number should be anywhere between 7 to 8% over the course of the next decade or so, right? Now, it is in that context that you should look at the India share of market cap.
Right.
Okay, India's share of market cap is currently close to about 3.1%. Okay. In the worst of times during the Ukrainian conflict, we kind of bottomed out at about 3%. In the time, in February 25, again, we bottomed out close to about 3%. Now, 3% is not some Lakshman Rekha that will never get broken. But if you are a serious long-term capital allocator and you see that big shift that India's share of economic output is going to rise in points to a point of time to come, if you're going to buy in at 3% of world market cap, you generally should be looking for a very big asymmetric kind of a rise. And this also needs to be contextualized for the fact that, from US, there can be a lot of flows going outside. There's been a lot of money which has chased US assets over the course of the last 15 years. What happens if there is money which is actually going out of US, given the fact that it's exceptionalism, be it on innovation, be it on, let's say, security, be it on the safe haven status, all of that comes under question mark. So I think we should be kind of looking at these opportunities as well. So I would think, therefore, that, now is not the time to panic.
Yeah.
Now is
And
the
I think
time to kind
the
of
point
add
you
on.
made, Harish, earlier, but you used the farmer analogy, right? I think it's such an important point that trying to finesse too much that I'm going to buy 2% lower, 5% lower, over a 10-year period, it's a decimal point change, right? It doesn't matter in that sense, if you're broadly right in the ballpark. So let's talk about what are you doing right now? Let's take energy. I said I'll ask you about energy disruption and who's on the right side of it, right? So who's on the right side of it, Harish?
So, unfortunately, we are all losers because broadly we are large importers of energy, right? But within each sector, when you look at it, there are certain energy efficient players compared to the others. Now, these are going to have outsized gains because in this environment where the going is going to get tough for everyone, the last man standing is the one who is going to take the most out of that, right? So, if you look at, say, some of the larger sectors like, say, cement, which is in effect a huge energy user. I mean, cement is all about transferring from one energy form to another energy form, right? Now, over there, if you've got an edge in form of energy conversion, that is like real solid gold today, right? And that is the one that is going to compound for you in terms of that difference and that dispersion. And that is going to help you gain market share in a very difficult environment. So, I think that would be one area. Similarly, if you think about this entire unorganized to organized in, say, building materials, we've seen a huge amount of unorganized players operating in the building material space, be it in pipes, be it in tiles, be it in ply, be it in other forms of consumer durables, etc. The reality is that a shock like this, typically the weaker hands don't have the purchasing power to kind of remain in business. Again, therefore, there's going to be a greater formalization and a cleaner balance sheet that's going to sustain through. So our call is not that we have any edge to predict what the next 3-6 months is, but if I am able to identify and distill certain companies which are going to go one leg up compared to the rest of the competition, okay, that gap is likely to sustain for years to come, and that gap is what is going to get alpha for our unit holders. So that would be another area which I would say can come through. Another area could be, there's going to be this huge rebuild that's going to happen in Middle East. I mean, the war cannot go on indefinitely. And imagine the amount of desalination plants that have to come through. Imagine the amount of pipelines that have to go through. These are all economies for whom this is the bloodline, right? And they're going to have a massive amount of capex that's going to come through. At this point of time, of course, there is all this fear. But what happens if even the Ukrainian war kind of stops out? Okay, how about the entire kind of that region wanting to kind of rebuild? So I think these are all opportunities. See, markets are about spotting asymmetric opportunities where the optionality is not being priced. And today we are seeing so many such opportunities which are there, which is why we are not so worried about how to kind of navigate the next 3-6 months. I think if we try and over-optimize that, we're going to miss the bigger opportunity that's going to come through, which is where I would say that, you know, as an investor, one should train their eyes on, rather than looking at how do we survive the next 3-6 months.
Cement, building materials, and
pipes,
and,
even chemicals for that matter.
Yeah.
Right, there can be a whole amount of inventory rebuild because post the last 2 years, the big problem has been a destocking problem globally. Now, if everybody wants to get back into that supply chain, there can be a bullwhip effect of inventory again going back. So these are all things that are hypothesis. Nobody knows whether they're going to play out in Q2, whether they're going to play out in Q4. The idea is that you kind of identify the best run companies which are positioned and who can execute for that opportunity, and then you kind
Harish, I know you can't talk about specific stocks, of course, because of regulatory reasons, but we've taken the liberty to use your fact sheet in terms of what you own in the fund, and we're putting them up on the screen for our viewers in each of these segments, each of these areas. But within each of these, the 4 segments that you mentioned, you got to pick what is lesser insulated to, I mean, that's what we started with, right? I mean, more competitive generally.
Yes.
The best, the most competitive actually.
Absolutely.
Compared to the others. So it's not like the entire sector, but specific names, and I think that's an important point to make. It's not a call, it's a call on the sector, but also on companies in that sector.
Absolutely. So it's a call that, you know, as the previous guest was saying, that if the baby is thrown along with the bathwater, that's the time that you have to actually look for the baby, right? And a lot of these sectors have actually kind of got bent. Right, and mind you, these are sectors that have underperformed over 3-5 years. It's not that, you know, these have been darlings and suddenly because of this they have kind of cracked. So therefore, there is reasonable margin of safety. A few trades going right over there can make a huge difference for the fundamentals of many of these companies.
All right, very quickly, Sandeep, I want you to come in on this. You know, one of the holdings that you'll have is in a company, Sun TV, and there is this lot of buzz with regard to the IPL. Valuations going at $1.5 to around $2 billion. Who would have thought? You know, it seems there are companies like this, there are value out there. What do you make of this recent deal closure that we've seen on the IPL? And do you believe there's a lot more scope? Because if you compare it with global leagues, then still there's a massive runway ahead.
So Nigel, the fact remains that it's a new area and people have a lot of excitement. So you don't get into the valuation because valuation looks absolutely absurd, okay? But the way globally this business has built, I think India also has potential to, so far it's only about cricket, but you look at the women's leagues that are coming up, the hockey is also getting built, and many other sports which the current government is also focusing a lot. I'm also very optimistic about this space. These are the space which people will look from a longer term perspective, and valuation globally has been expensive. So India being a growth area, you can give a premium on the global valuation also. So I think it's a great opportunity from long term.
Okay, I think we could go on, but I'm being told that we are on a clock. And the clock is running out. But I think wonderful insights from both of you. Sandeep, thank you very much for dropping by. Harish, fantastic. And I know you had more. The tariff, who's on the right tariff decision, that's another time. Thank you very much, both of you.
Hello and welcome to this special show on the West Asia War. I'm Ashmit Kumar. Now, Israel continues to attack Iran as the war continues to rage on for nearly a month now. US President Donald Trump has extended the pause on attacking Iranian energy facilities by 10 days till the 6th of April. In a post on social media, he claimed the extension was at Iran's request and that the talks were going very well. A report by Wall Street Journal cited peace talk mediators as saying that Iran did not request for a pause. Speaking to Fox News, Trump said that Iranian officials asked for a 7-day extension, but he gave them 10. The president claimed that this was because Iran was allowing the passage of 10 oil tankers through the Strait of Hormuz as a present to the US. This is another statement of Donald Trump that Iran is yet to confirm. So far, Tehran has maintained that no negotiations are ongoing with Washington. Earlier, Trump had said that US would strike Iranian energy infrastructure if Tehran did not reopen the Hormuz Strait. Meanwhile, reports suggest that Pentagon is considering sending up to 10,000 additional ground troops to West Asia for a potential ground offensive. One Marine Expeditionary Unit is likely to arrive this week. As the conflict continues to escalate, Israeli forces have come under strain. Opposition leader Yair Lapid accused the Netanyahu government of steering the country towards a security disaster. He cited Israel's military chief lieutenant general Zamir as telling the security cabinet that the IDF is on the verge of collapse. Lapid also said that the chief of staff no longer has a way to continue mobilizing reserves.
We have very substantial talks going on with respect to Iran, with the right people. You know, I told you about a present, right? Steve, can I reveal the present?
You can do anything you want.
Thank you. They said to show you the fact that we're real and solid and we're there. We're going to let you have 8 boats of oil, 8 boats, 8 big boats of oil. They then apologized for something they said, and they said, we're going to send 2 more boats. And it ended up being 10 boats. All right, I hope I haven't screwed up your negotiations, but I thought it was appropriate to say, because I did taunt you the other day by saying they're going to give us a present.
Well, joining us now to help us decode some of these developments from West Asia is with us Mr. Pramit Pal Chaudhary, Practice Head for South Asia for Eurasia Group. Also with us, Ambassador D.P. Srivastava, former Indian Ambassador to Iran, and Omar Anas, author and professor with University in Turkey. Gentlemen, thank you so much for joining us. Ambassador Srivastav, let me come to you first. Donald Trump giving a 10-day extension, saying that Iran asked for 7, but I'm giving them 10 days. Iran, on the other hand, their foreign minister says, we are not in negotiations with the US, with Donald Trump, but at the same time conceding that they are considering the proposal that has been sent by the US. So again, your reading of this situation, do you see that appetite, that willingness within Iran, within their leadership, to work out a negotiated settlement to this crisis?
I think the question needs to be reframed. It's rather unfair to shift the onus to Iran because they have suffered the aggression. And the aggression took place at a time when the nuclear talks were making progress. At this stage, what has been conveyed has been described by the Iranian side as maximal demands. And, the war, America has not won the war. It's a stalemate, so you cannot impose your terms. From the Iranian perspective, having been twice attacked in the middle of negotiations, it's natural that they'll be very cautious. And they do not want simply a ceasefire, but end to the war. And from the point of view of the international community, the opening of the Persian Gulf and Hormuz Strait, the easiest and quickest way is to stop bombing Iran. The rest of it has not worked out. This is despite the fact that America and Israel have a military dominance, they have escalation dominance, and America will continue to have this military dominance, but it has not been able to ensure that Persian Gulf remains open, which is now under Iranian control. So unless the war is brought to an end, this stalemate will continue. Negotiations have to be resumed. After the bombing is stopped, Iran has to also stop attacks on Arab countries, whatever may have been their justification. The reason is that these Arab countries are not belligerents. And the third stage will be then, after ceasefire and stopping attacks on non-belligerents, will be opening of nuclear negotiations and starting from the point where the negotiations were left off in Geneva on 26 February on the eve of the attack, and where the Omanese foreign minister who acted as mediator had described that a peace deal was within reach.
Right. Ambassador Srivastav, let me just come in again on that. Maybe I didn't phrase that correctly. What I meant to ask you was that given the situation that Iran got attacked in the midst of these talks, conversations with the U.S., given the that they've borne the brunt of the attacks of the Israeli and the U.S. forces, and given the positions they find themselves in, which is through asymmetric warfare, having undue influence in the theater of war through the Strait of Hormuz, given these conditions, is there any reason for Iran to concede to these talks, to have trust in these talks going forward?
They have so far denied that any talks are taking place, but I think for both sides, it's only a diplomatic solution. Diplomatic solution is the only feasible option. So they have to come back to negotiating table. But maybe given the huge distrust having been attacked twice in the middle of negotiations, Iranian side might prefer a different format, perhaps a multilateral format rather than bilateral negotiations, which were being mediated through Oman. I must add that, it's very curious that America has chosen Pakistan to present these proposals. Pakistan is the wrong messenger. Iranians would not have forgotten that, they were attacked by Iran last year. They were attacked by Israel last year on 13 June. On 15 June, Asim Munir was invited for lunch to White House. So while the Iranians were were being bombed, Mr. Asim Munir was having supper with the U.S. president. So I don't think that's the right messenger. But let's come back. Let's hope that the diplomatic negotiation, that both parties revert to diplomatic negotiations, and to prepare for that, the bombing has to stop.
Right, Ambassador. Let me also get Mr. Pramit Pal Chaudhary in on this conversation. Mr. Chaudhary, even as these negotiations are underway, at least as per what Donald Trump suggests, he says that these negotiations are going very well. Assuming that they are, who is in charge in Tehran? Many are asking that question. Mujtaba is not to be seen. Is it the foreign minister, Mr. Arakchi? Is it the parliamentary speaker? Who is in charge? Who can take the calls on behalf of Tehran, on behalf of Iran, to commit to some of these red lines that the U.S. appears to be asking for?
Well, I think the Revolutionary Guard is quite clearly the organization that is leading the resistance right now in Iran. It may be consulting or working with the political leadership, but the Guard is by far the most coherent body left in Iran after the attacks that have been carried out, including the decapitation strikes. There's one of the things about these negotiations is the fact that the Guard has been largely quiet about them, is an indication that Iran at least remains very wary or skeptical about which direction they will go. But anyway, the maximalist demands that the ambassador mentioned, including giving up on nuclear enrichment, the bulk of the ballistic missile program, and so on, I think would be completely unacceptable to Iran. This would leave them almost completely defenseless for the future, let alone what it would do to them now militarily. They would simply not be willing to accept that. So those and other demands, including the surrender of their present capacity to veto any movement in the Strait of Hormuz, are things Iran is not going to give up. So they're basically the negotiations right now. The gap between the two sides is simply far too wide for anybody to see how that can be bridged, which is one of the reasons I would argue that the air war in effect at an impasse. We are now in a pause before the second part of the war begins, which may include in that land action.
Which, in fact, Mr. Chaudhary, was my very next question. There are already reports of Pentagon considering deployment of additional forces of 10,000. This has been countered by the Iranian regime, who is saying that we have 1 million personnel who have been deployed for asymmetric warfare should the U.S. consider deployment of their ground offensive. Again, is this another miscalculation that the U.S. may be steering towards? 10,000 people, even with their superiority, a country as large as Iran, 1 million personnel on offer. Is this a possible miscalculation on part of Donald Trump once again?
Well, the American troops are much more than 10,000. We're looking at an Marine Expeditionary Force, which can be up to 15,000. We have heard of elements of the 101st Airborne are also being mobilized. That would be another 15,000 at max, and then another 10,000 on top of that. So you're looking at a much larger force. We'll have to see. One, is this just a negotiating chip? The seizure of an island is not impossible or one or two islands, and be used as a negotiations chip by the Americans. But yes, it would be a problem for the Americans if this drags out, because if they do commit land military troops on the ground, they will be almost not only make asymmetric warfare, would not possibly include suicide bomb attacks and so on, but it would also include almost a non-stop hail of drones and so on. So they would have to have incredibly good air defense. And that's one thing the Iranians are showing, that they are capable of penetrating. But if you have static positions, defense positions on the ground, casualties are almost inevitable. And it's something the American system tends to be very sensitive to politically.
Well, that's an interesting thought. In fact, many military analysts are asking how the American troops will enter and go all the way to the Karg Island without crossing the Strait of Hormuz, which again, at least as we speak, appears to be under Iranian control. We're running out of time. Ambassador Srivastav, I'll come to you for a quick comment. There is also some amount of battle fatigue setting in as far as Israel is concerned. I just want to get your thoughts on that. The IDF chief, Lieutenant General Zamir, has said that the IDF will collapse unto itself. It's been in a state of conflict since October of 2023. Is this conflict, combined with the conflict with Hamas, now beginning to take a toll on Netanyahu as well, on the Israeli establishment as well?
I think it must be taking a toll on Israel as a nation, because demography does not favor it. It's a country of 7 million, and they have been in a stage of constant mobilization since 2023. So I think that in the long run, Israel's security lies in a negotiated solution out of three problems it faces. Gaza, which is perhaps the most difficult, Lebanon, Hezbollah issue, and the third one is Iran. But a purely military solution is simply not feasible for any country to sustain indefinitely.
Right. Well, in fact, we just very recently had a conversation with the Israeli ambassador to India as well. And while there was an appetite for conversations, he pointed out, but he was clear when he said that the operation is likely to continue with its full intensity. So Israel seems to believe it's possible to do fighting while talking. Of course, the end result of that, we are yet to see how this next 10 days pan out, especially as far as these negotiations are concerned. I'd like to thank both of our panelists for joining us, sharing their insights. But with that, we're heading into a very short break. But coming up on the other side, the government has stepped in to provide some relief to oil marketing companies who have been bearing the brunt of steeper global oil prices since the start of this conflict. Details when we come back. Welcome back. Now, the government has stepped in to provide some relief to oil marketing companies who have been bearing the brunt of steeper global oil prices since the start of this war. The government has slashed excise duty on petrol to 3 rupees a litre and the duty on diesel to 0. Sources say that the move is expected to soften the blow for all OMCs by up to 20,000 crore rupees. However, prices at fuel pumps will remain the same. The government has also imposed additional duty on diesel and ATF exports to secure supply for domestic industry. The duty rates will be reviewed on a fortnightly basis. The government has estimated a revenue hit of 7,000 crore rupees due to the excise cut for now, and it expects to garner around 1,500 crore rupees in a fortnight owing to the hike in duties on ATF and diesel exports. So the entire hit post the offset comes to around 5,500 crore rupees. Here's a caveat. ATF export duty has been levied only on bulk turbine fuel exports by refineries. Petroleum Minister Hardeep Singh Puri has said that the government had only two choices to manage the rising prices of crude oil, either increase prices of fuel or to take a hit on the revenue. He added that the government chose the latter to insulate Indian citizens from global volatility. As per sources, Defence Minister Rajnath Singh will head an interministerial panel to monitor the West Asia conflict. Other members will include the Home Minister, the Finance Minister and the Petroleum Minister. The panel will discuss the actions that the government may need to take with respect to the war and the tax relief efforts. Tax relief, meanwhile, on some more items has not been ruled out. Finance Minister Nirmala Sitharaman said that the excise cut decision was taken by Prime Minister Modi in yesterday's cabinet meeting.
It was decided that there should not be a shortage and there should not be an increase in price due to the global situation in crude, in petrol, diesel and in ATF. Today we have announced a decision whereby we will be giving support to the oil marketing companies so that they can import the material and not really, even if it is imported at a higher cost, the common citizen will not have to face any increase in the price of petrol or diesel.
The revenue gain on account of the proposal for imposition of this duty on exports on diesel and ATF is expected to be around rupees 1,500 crores in a fortnight, and as I said earlier, the situation will be reviewed in a fortnight. Now coming to the second proposal, which is the proposal for lowering of the excise duty by about rupees 10 on both petrol and diesel. These steps of course have been taken to reduce the under recoveries for the oil marketing companies. The revenue implication has to be seen in the overall context of the prevailing situation. And for a fortnight, the back of envelope calculation is roughly in the range of around 7,000 crores.
Well, as the finance minister pointed out, this is a relief for oil marketing companies and nothing will go in the hands of the consumers. So oil marketing companies will see some relief on their marketing margins. So let's talk about the impact now. First, they've been looking at a lot of marketing margin losses to the tune of around 27 rupees per litre on petrol, 50 rupees per litre on diesel. And with this, those losses will come down. But do remember, despite this excise cut, the losses will not become nil. They will just become lower for all these companies. The second part, of course, it will help them with working capital issues that these companies had been facing, better cash management, cash flows will improve, and the fact that the excise duty has been cut will improve their P&L overall. Since retail prices are unchanged, the benefit will stay with the oil marketing companies. If we look at their balance sheet strength as well, it has been improving in the last couple of years, so they are in a better position to absorb such shocks that would come by. For IOCL, BPCL and HPCL, for all of them, net debt to equity has been coming lower. If you look at a BPCL, it is at 0.3 times. For IOCL, it has reduced to 0.8 times. If we talk about HPCL, which has the highest exposure to the marketing segment, that's where it is 1.4 times. But yes, it has been reducing for all these companies. For consumers, as I said earlier, there's no change. Inflation remains as is. Household budgets will not change. And you will pay the same prices for petrol and diesel as you've been paying earlier. The other change that has come by is they've increased or they have levied export duties on export of ATF and diesel. This is to ensure that there is enough domestic availability of these two fuels and there's no shortage as such. So it has been increased by 21.5 rupees per litre on diesel and 29.5 rupees per litre on ATF. But this is a positive move considering that there will be enough supply in the country itself. But some of these exporters like Reliance, CPCL, MRPL, they will be in focus on the negative side because of this. Now just a quick check on how prices have moved globally as far as fuel is concerned. How much have they increased since the time the West Asia war is increased? For India, it has stayed as is. For US, it has been to the tune of 38%. UK has seen a 24% increase. Germany at similar levels. And France has also seen an increase of 30%. So there has been no price hike for customers. There's a relief in terms of excise duty cut that has come for oil marketing companies.
Well, with that, it's a wrap on this special broadcast. More news and updates will continue right here on CNBC TV 18.
Hello and welcome to another edition of the CNBC TV 18 Market Town Hall. The amount of headlines and consequently the market moves have truly been head-spinning and dizzying to say the least. To be sure, the Middle East conflict is only the latest in a series of massive disruptions which I'm referring to now. Since January of 2025, when President Trump took charge in the White House as the President of the United States, we've had non-stop run-through of news flow, which dwarfs pretty much anything else we've seen. At least I remember in the past many years or so. So it's truly been historic. Headline roulette, you can call it, or whatever else. But absolutely head-spinning amount of news flow. And of course, it's had an impact on markets as well. From tariffs to AI to now Iran, all this has meant that markets have indeed corrected quite a lot. I mean, some because they need to correct. And of course, I mean, there's been a fair bit of indiscriminate selling, forced selling, etc. as well. And that is what this town hall is really all about.
Well, there is the micro and then there is the macro. So what we've done is we've divided this into three parts. First, we'll focus on the global macros and oil prices. Art Berman, who is an oil market veteran, and Ben Powell, who's here with us in the studio from BlackRock, is there. Second, we'll focus on the opportunities in the market right now. Harish Krishnan of Aditya Birla AMC, Sandeep Tandon of Quant Mutual Fund will be joining us. And then we bring in the macro heavyweights, Neelkant Mishra of Axis Bank and Sajid Chinoy of JP Morgan. So we've got all three bases covered in the next 90 minutes or so.
Well, I also want to extend a warm welcome to our audience. I mean, it's a small gathering, but it's an intelligent one. It's a very informed one right here in the studios, by the way. And you can see, I think, the visuals there. So just want to extend a very warm welcome to all the CNBC TV 18 Access members and, of course, our guests who are going to be joining us in just a bit in the other panels as well. So, you know, Rima and Art, my job is a little easier because we're going to ask a few questions to kick this off, and then we'll hand it over to the audience and take their questions to all our guests and all our panelists. So that, with that short introduction, with a short preamble, let me dive straight in with you know, the first focus area, which is, of course, the global picture, given the big oil shock that we have. Art, great to have you join us from the US. Thank you very much for being here. And Ben, glad you could make it to our studios. So it's a simple question with not such a simple answer, I guess. Is the war winding down, Ben? What's your sense?
I'm not so sure, actually. So I recognize there's a degree of optimism in the air over the last 24, 48 hours as the US president has made warmer noises, I guess, has spoken about his hope for a deal, a 15-point plan, and so forth. So I recognize that, the market recognizes that, and it's definitely relevant and interesting. However, we have to observe on the ground, I live in Abu Dhabi, the drone strikes have continued, the missiles have continued, and the Marines, the US Marines, I believe, arrive later this week. So I think the situation is, frankly, still very tense. The facts on the ground are mostly unchanged. Indeed, it feels more of an escalation in the last week than a de-escalation. So I recognize President Trump's words. Of course, I'm watching with huge interest, both as a citizen of the UAE and as a markets professional. But I think we need to be careful from being too confident and too optimistic, because sadly, as I say, the facts on the ground continue to be, frankly, quite alarming. And there is the potential for this to continue and worsen as these attacks on the physical infrastructure. Just overnight, we've had an attack on the Kuwaiti airports, one of the fuel depots kind of struck there. So I recognize President Trump's words, very important. He's the most powerful man in the world. But the facts on the ground continue to be unsettling, and that has not changed in the last 24, 48 hours.
Absolutely. If I can get Art, Rima, into the conversation as well. Art, same question to you. Do you believe the war is winding down? Ben, of course, is cautious. I just wanted to get your sense, because things have moved over the last 48 hours or so, and many believe directionally this is the first sign that things are starting to cool down and we are de-escalating rather than escalating. Art?
No, I think Ben has summarized it very well. My view is I see no de-escalation. I see more potential for escalation. I think that the words from President Trump are purely performative. It's very difficult to have your negotiating partner take you seriously when you're moving, combat units into the area. So, I think Trump is managing this like a reality television program. He needs lots of plot twists and, interesting, spicy things to add to keep everyone's interest. But at the end of the proverbial day, I see only escalation in the coming weeks.
So, Art, what is your base case scenario right now? And in that event, where do oil prices end? And the best case is that perhaps the oil conflict ends in the next couple of days. In that scenario, where do you think oil prices will settle? Because even if the conflict ends, there are facilities which are damaged, which are not going to come back on stream immediately. And then even if there is a ceasefire, there's going to be an uncertainty surrounding that. There will be a geopolitical risk premium attached to the passage. So give me your base case for oil prices, a worst case, and a best case. Best case being that actually this is de-escalation.
Sure. So obviously, no one knows the answer to that, but this is about informed speculation. I would say, I mean, for instance, Ben's boss just came out this morning, I believe, and said 100 to 150 is BlackRock's base case for I can't remember if he said for a year or for years, but it was something like that. And I see that as a possibility. But let me make it very clear. There will now be a permanent risk premium on oil, regardless of how this thing ends. And I would say that premium is no less than $10 per barrel. And so if everything ends tomorrow, the very best case we can get back to is maybe $80 Brent. Now, I don't believe that everything's going to end tomorrow or that we're going to get back to $80 anytime soon. So my bottom line is we don't know. It's a probability distribution. I think somewhere in in BlackRock's range is reasonable, certainly for the rest of 2026. And in the longer term, when all this, as you correctly point out, trickles out to the rest of the global economy, then we'll get down to lower prices as the global economy collapses.
And also several nations, considering the energy shock right now, are likely to increase their purchase and storage of petroleum reserves. How much can that push up prices, to your mind, Ben? Sorry, Art.
You want me to? Okay,
yes.
So we're talking about a few million barrels a day. If all the storage in the world could be released all at once, okay, it can't be. So we take 3 million barrels, let's just say, maybe it's 2, maybe it's 4, I don't know the right answer, and we weigh that against 17 million barrels, which is the shortfall. It's a rounding error. I'm not saying that we shouldn't do it. We absolutely should. I'm not saying it's insignificant. I'm saying it doesn't make that much difference. In other words, if we think about a man who's lost 20% of his blood supply and he's bleeding out on the ground, and we put a tourniquet on his leg, and now he's only losing 15% of his blood supply, the guy's going to die unless you get him to hospital very quickly. That's a very crude analogy, but I think that's a realistic way to think about this. Yep. In other words, yes, let's do everything we can, but let's recognize this is an urgent situation.
It is an urgent situation. And Ben and Art, both of you, I mean, I just wanted to come in here. Both of you don't believe that this is ending anytime soon. So am I watching the same news that you guys are, or you don't believe what President Trump is saying, or what is it? I mean, we've heard the man say on tape, on camera, of course, he said a lot of things, but he's also said this, and this is the latest, that we've achieved our aims and we're going to end this soon, et cetera, et cetera. So, Ben, you want to go?
Well, a couple of things. I think President Trump is sophisticated. So is it possible he's buying time for the Marines to arrive? I think that's at least possible. Of course, we don't know, but it is at least possible. And secondly, and I think more importantly, of course, America is the US, they are the world's hyperpower, so we all respect and listen to them because of their heft. But they are not the only player here. So you have to think about also the mindset of the Gulf Cooperation countries, the Gulf Cooperation Council, including the UAE and Saudi. And to be somewhat straightforward, they've just had thousands of drones and missiles thrown in their direction, so they may not be in a shake hands kind of mood. And the same, I think, could be applied to Iran. So Iran, again, we don't know how much is posturing.
But countries like Qatar, Oman, etc., seem to be facilitating. I mean, yes. a sit-down of some sort.
You're right. So there's a blend amongst the GCC, the different countries within the GCC. They're not all the same, that's for sure. But I think in particular, the UAE, Qatar, Kuwait, and Saudi have been surprised, would be English understatement, I think, surprised at the centrality of their role in this war. I think they were very much hoping that they could be something like neutral. It's a conflict between the US, maybe Israel, Iran, and the GCC, and this was not. It turned out to not be correct. Furthermore, I think Iran, they have said they want to make it very clear that there's a price to pay. Iran, the IRGC, the leadership of Iran, perhaps want to make it very, very clear to these other countries that if you mess with us, you will pay. And therefore, again, it's not so obvious that they will just shake hands.
Well, that's the point, right? If you mess with us, there'll be price to pay. And here's President Trump saying we're going to stop messing.
So a couple of things. One is, I think even if President Trump stops messing, which again, I'm not so sure, but if that's the case, then Iran can decide, okay, now the punishment can come. Now the punishment can come. So maybe, we don't know, maybe we are only at the beginning of the economic pain. And I think I would say, just briefly, of course, we're all focused on energy. This is totally appropriate. But it's not just energy, by the way. It's fertilizer. It's helium into semiconductor. So in a way, this is something like a 1970s supply shock on the energy side, multiplied by COVID in a way. Not quite, but there's something there making the point that this is going to be really a very serious problem for the global economy.
The betting market, poly market, right? The marketplace, whatever you want to call it, 60% odds that the war will end by mid-May. Now, I don't know what ending the war, the bombs stop falling or a complete peace, the Strait opens. I don't know what that question or that statement is, which the war ends, but poly market says 60% by mid-May. That's what they're saying. Art, you want to come in on the question? Are you of the view that this is just buying time before we see this continuing and intensify more?
Well, Prashad, I can say a few things as an American. President Trump lies all the time. I mean, that's not a criticism, that's a fact. He has not said a true thing about the situation in Iran for at least a week. So I discount everything he says as performative. I don't discount its significance. I just don't think it. I don't believe anything he says. The bottom line for me is that Iran is right now the strongest country on earth. It holds the entire global economy hostage to its control of the Strait of Hormuz. Okay, it's never been more powerful. It never dreamed of being this powerful, and it's not going to give that up, as you said and Ben said, without extracting a huge cost. Now, back to the betters. Maybe the fighting ends. Maybe there's no more bombs by mid-May. So much damage will be done between now and May that a recession would be an optimistic take. I don't want to be pessimistic. I'm just trying to objectively assess what's going on. And as long as Hormuz is only partially restored to flow, then all bets are off, and chaos, economic chaos, social chaos.
Art, if I can just ask you one thing. You saw the statement from the Iranian Foreign Ministry that they're going to allow non-hostile ships to pass through the strait, right? The problem is the strait and the oil not flowing. And they said, was that different from what we've heard before? Or there's nothing different? Earlier it was we're going to set ships ablaze, and this seems a bit of a pivot, right? In their own way, they can't seem to be negotiating when they're being attacked, but a bit of an admission that they also want this to wind down? No, you don't read it like that.
No, I think, the Iran lies a lot too. That's the nature of this dispute. Iran wants to set up a tolling situation where they can get revenue that cements their control. In other words, if they can get other countries to actually agree to pay them for passage, then that essentially gives them diplomatic recognition that they're in charge of the Strait of Hormuz, which strengthens their position and gives them a little money. Bottom line, Prashad, is we're back to the strategic reserves. Maybe 1 million, 2 million barrels eventually gets through Hormuz with some kind of tolling situation. It's still a rounding error compared to what the world needs.
Well, the point is well made, Art. Iran is militarily weaker, economically weaker, but strategically far more important today than it was prior to the conflict. But Ben, the advice in all this for BlackRock is you all have dialed down tactical risk and you all downgraded U.S. equities to a neutral.
That's true. And I think we are in a different investment regime now, reflecting a more complicated world. And as Prashant said in his typically excellent introduction, it isn't just a very acute and frightening situation. It's tariffs. It's a sense of globalization in decline. You can't trust other people. You have to be more reliant on yourself and your own nation and so forth. And I think that's going to persist. Hopefully this current crisis will pass. But I think those continue to be, as the kids say, the vibes, right? Those are the vibes these days. So what that's leading to from an investment perspective is a much more fractured global market and India market, I think. So we have moved from previously really a kind of everything bull market where you should be risk on, don't touch, and that works very, very well. I'm not condescending that approach. That was the right approach for an easier time, a more pleasant time. Now, in a fragmented, chaotic world at times, I think we're all going to have to work a little bit harder and be much more selective.
U.S. economy, is there a risk of a stagflation? The jobs data is weaker, inflation is rising.
There is a certainty of a stagflationary shock to some degree. And now I hedge a bit to some degree, but for sure, we are going to have a price inflation problem, an increase. Inflation is already too high, by the way, and a growth slowdown. This is baked in the pie. Because last week was very important. We moved from a general concern from a global market perspective to physical damage. So this in particular was the Qatar LNG facility where the Qataris, they will be, I'm sure, roughly giving us a sensible timeline, 3 to 5 years to bring this back online. So this is, I'm afraid, even if we have peace today, the problem persists for some period of time, and therefore for your question.
Okay, so just one quick question then on the valuations of the Indian markets from an FI perspective. When we speak to domestic investors, they find the valuations of India very attractive. But foreign investors have been pulling money out. There's been an exodus. At what point do you think the FIs will be interested in the Indian markets? What will bring them back?
Soon, I think so. Like you say, the valuation is much more attractive. There's a degree of earnings stability and certainty. India continues to grow very well in the very big picture, driven, of course, by its very pleasing combination of great demographics and productivity, an ever more efficient economy, and so forth. All of that is still true. But as they say, capital is a coward. And I think global capital is very nervous to get ahead of the conversation we're having here and the uncertainty specifically around energy. So as and when, and this will happen, as and when we get any more certainty, some of the things that have suffered the most should rebound the most. And I think India will be on that list.
So in terms of emerging market, when we look at the whole world, etc., you guys do that, right? EMs, India's attractive.
Yeah,
within EMs.
We have a structural overweight to India within emerging markets for the reasons I mentioned. The phenomenal growth that is really at the scale of India is really unique on the planet. That persists. I think the AI story weirdly has been a problem in the sense that it's not so geared into India for now. But over time, can India, with its superb, educated and very huge workforce, can India leverage AI and become even more efficient? Sure, why not? Yep. So I think all of these stories, all of these thoughts for India are still true, but for the next short period of time, I'm afraid they are obscured by the geopolitical and specifically the energy problem.
Yeah. Art, you know, in the last conversation we had, you said, well, this is a world-changing event, right? That's strong language. Were you saying it for effect, or is it really a world-changing effect?
No.
Go on, explain that. Explain that quickly.
Yeah, so, I mean, energy is the economy, okay? It is the blood supply of the economy, and everything that happens to energy cascades through the rest of the economy. And so we compare this to previous oil shocks or other financial shocks, and those occurred at a time when the world had a lot more options, had a lot less debt. And so we're coming into this in a very stressed economic and fiscal and social background, and the world can't really take much more strain, and this is over the top strain. So the world will not go back to 2025. I don't know what the world will look like in the future, but I promise you that this is not going to be something in the rearview mirror that we're going to look at and say, oh, that was scary, but it's over now. Not going to happen.
Time now for the tougher questions from the audience here. So we have our CNBC TV 18 Access members, but we also have our next set of panelists here. Sandeep Tandon runs one of the largest AMCs in the country. And Sandeep also used to run one of the largest prop books in India. So he knows a thing or two about trading. Sandeep, go on. Your question.
One very specific thing on oil only. See, yes, we are all concerned about the narrative or noise which is getting built, and it is quite concerning. But if you really look at the data, okay, when I'm talking about the employed volatility data of crude, it spiked up to 180, corrected to half, 90, which means smart people are not factoring this level of pessimism, what we are seeing around us. At least if that was the case, then vol could have been remain elevated for longer term perspective, which is not the case. In the last 7-8 days, it has become half. So that gives us confidence that smart people are not factoring this level of disruption, what people are looking at. And we always see that we all get carried away at that point, you know, and we give up actually, you know. So we are in that sort of capitulative sort of scenario, which is all our bullish thought process has been given up completely. So the Wall's data does not show. Just want to understand your perspective.
Yeah, so I slightly take a point from your question, which is people are not that bearish, actually. So that worries me a bit. So we have this shock is ongoing. And from our perspective at BlackRock, what is priced in the energy market has not really been fully priced yet in other markets. So we've had this uptick in the oil price, most obviously the spot price, but now the price for oil a little bit further out towards the end of the year is now much higher, suggesting the market is somewhat more worried that this situation will persist for some period of time. That should feed through into Rima's question for higher inflation, and this should give central banks a problem, meaning they can't cut, maybe they have to hike, higher yields, And then in turn, higher yields should be a headwind for global equities. So this is a little bit unsettling. Again, I don't want to sound too bearish. Of course, it also presents opportunities, to your point, I think. And will there be certain areas where the baby is thrown out with the bathwater? For sure. And actually, this is the moment over the next, say, 3 months when we can pick the longs that will make our portfolio returns for the next 5 years. So we're very open to this opportunity, but for now, I still a little bit worry that what's priced in the energy market is not yet fully priced in global bond markets and global equity markets. I still think that's got further to run over the next several weeks.
And there's also this thing that oil is a physical, the basic thing, oil is a physical asset, which is so demand and supply, whereas things like equities live in the future in that sense, right? So there is that element of pricing or mispricing, whatever you want to call it, right?
And on the physical point, just quickly, Prashant, like there is a risk of people who can't get it. So you can buy and sell equities. Maybe you don't like the price, but you can.
If you don't have it, you don't have it.
But there's a risk not just of a higher price, but we're seeing talk in certain parts of Asia of shortages, which is also an acute problem building on top of the chronic that we're talking to.
Please, another question.
Right. Hi, good evening. We've heard the saying that, data is the new oil. And as I reflect on that, I'm smirking because it seems that oil is oil and data needs the oil today. Right?
Well put.
So just wanted to ask you, either of the panelists, what's your take on the AI trade in the US? Does that slow down the entire juggernaut? Will the GCC countries withhold their investments that's going into the AI trade and any other second order effects?
Excellent question.
Thank you.
Ben, you want to take it?
I do. So it's been, again, slightly overwhelmed by, of course, the Iran situation. But the AI news flow over the last 4 to 6 weeks has been amazing. Incredibly positive in terms of the demand. No sign of a slowdown in demand. No sign of a slowdown in the CapEx. So people worry, is it a bubble? Will the CapEx slow down? There's no evidence of that so far. So I think the AI hyper mega super bull market is still real and ongoing, but will it suffer as a very crowded position in a general risk? I just sell everything, I don't even care what it is because I just want to hide in money. I think that's quite possible. So again, when I'm thinking about my laundry list of things I want to buy, maybe I'm not quite brave enough today, but I want to be brave at some stage in Korea with the memory play that they have. For energy, as you say, of course, is very thirsty for electricity and we don't have enough. So I'm not so heroic. I want to wait for some more clarity. But the AI trade, for your question, I think is still very, very alive. And the data over the last 4 to 6 weeks actually has been supportive of that. But again, it's been just completely overwhelmed, understandably, by the pictures and the reality of the Iranian situation. So I'm still very positive on AI, but I'm a pragmatist. Can it go down in this general risk-off? Of course it can.
I think wonderful question, and I think fantastic response there as well. We could go on, and such a fascinating topic. It's and so many directions we can take to it, but we're out of time. Ben, I want to thank you for dropping by. A wonderful conversation as always. Great insights. Art, we'll of course keep tracking this with you in terms of where oil goes from here, and I think you've got a close eye as anyone has. Thank you very much for taking out the time and joining us.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The market snaps a two-day winning streak. The Sensex nosedives nearly 1,700 points. The Nifty slips below 22,850, wiping out over 9 lakh crore rupees in investor wealth. PSU banks and real estate companies take the worst hit. The rupee's free fall continues. The currency hits a record low of 94.80 to the dollar, on track for the highest yearly loss in nearly 14 years. The government slashes excise duty on petrol to 3 rupees per litre and on diesel to 0. The move is expected to soften the blow for OMCs by up to 20,000 crore rupees, but the cuts will not change prices at the pump. The government also imposes additional duties on diesel and ATF exports to ensure adequate domestic availability. The duties will be reviewed every fortnight. The government says it is expected to garner about 3,000 crore rupees a month from the hike on diesel and ATF exports. This will offset the 7,000 crore rupee revenue hit it may incur on account of the excise cut on petrol and diesel. Defence Minister Rajnath Singh to head an interministerial panel to monitor the West Asia conflict. Other members include the Home Minister, the Finance Minister and the Petroleum Minister. The panel will discuss actions that the government may need to take in lieu of the war. Tax relief on more items is being considered too. US President Trump extends the deadline for Iran to reopen the Strait of Hormuz by 10 days to the 6th of April. Claims the request came from Iran and talks were going very well. Tehran consistently denies these claims. Iranian Foreign Minister, while speaking at an emergency UN Human Rights Council session, calls the Minab elementary school attack a war crime. Israel continues to bomb Iran as the war completes 4 weeks, claims it targeted ballistic missiles and aerial defense system production sites across the country. Kuwait says its main commercial port suffered damages in an Iranian drone attack. Wall Street Journal reports that the U.S. plans to deploy 10,000 additional ground troops to West Asia. Infosys continues its buying spree in FY26 with 2 new acquisitions, buys healthcare tech consulting firm Optimum Healthcare and insurance platform Stratus for a combined $560 million. Total value of the acquisitions in FY26 crosses $800 million. Well, let's start with the day's market action. The market snapped its 2-day winning streak with frontline indices falling over 2%. The Nifty fell below 22,850 and the Sensex was down nearly 1,700 points today. All sectoral indices closing in the red. The Midcap index down over 2%, almost a 3% cut there on the Nifty Bank, and the Sensex and the Nifty down by about 2%. For the week, the markets have also closed in the red. For the 5th straight week, in fact, the markets have closed in the red. The Sensex down a little over 1%, 2% lower on the Nifty and on the Nifty Bank, and the Nifty Midcap index lost about 1% or so. Financials did underperform, and that is why we saw the Nifty Bank lower. Prashant joins us now to wrap up what has been a very painful week for our markets. Prashant, the uncertainty with respect to the Iran war continues. How are traders looking at the week ahead?
The market pulled back, in short order. 22,800 around is where we finally left off at. Add to all of this, of course, is what's happening with macros, growth estimates being brought lower, inflation forecast being bumped up, current account deficit as a percentage of GDP being seen higher, earnings expectations being brought lower. So all of that showing up in the rupee in a big way. We were same time last Friday, we were pushing to the 94 levels. In a week, we are pushing 95 now on the dollar rupee. I'll just quickly run you through the indices and where there was maximum amount of pressure. PSU banks down 4%. You had the real estate index down about 3%. Autos, which was down about 2.5%, and the capital market index, which was down about 2.75% as well. Wix, which sold off day before yesterday, was up about 8.5% today. But that's it. I mean, that's the only index actually which was higher. You could maybe look at the CPSE space, which was kind of absolutely flat. Otherwise, it was pretty poor all across. The large cap losers and Shriram Finance had run up 100 rupees over the last 2 days. The CCI approval, of course, came through, but ended about 5.5% lower. Tata Motors passenger vehicle down about 4 3/4. Indigo down 4.5. Reliance was a big one. That export tax, right? I mean, taking a bite out of it, so almost 4.5 lower. Bajaj Finance, State Bank of India with the other 4% lower today. ONGC was the single biggest gainer with a 4% pop, and next in line was a Wipro and a Bharti, which were slightly higher as well. Now, on the downside, I mean, advanced decline is pretty weak, pretty poor. Spark, Eco Mobility, lots of these names, but not really on the back of lots of volumes coming through. Advanced decline skewed really, but if you look for volumes, you would not really find very much. Pretty thin as far as the broader market action is concerned.
Prashant, many thanks for joining us. Now, the government has stepped in to provide some relief to oil marketing companies. Remember, OMCs have been bearing the brunt of the steeper global oil prices since the start of the Iran war. The government has cut excise duty on petrol to 3 rupees a litre, and the duty on diesel has been cut to 0. We learned that the move is expected to soften the blow for OMCs by up to 20,000 crore rupees. However, prices at the fuel pumps, which means the prices that you and I will pay, remain the same. There is no change there. Now, the government has also imposed an additional duty on diesel and ATF exports. So remember, we used to have a windfall tax. Now we have pretty much the same. It's an export tax to secure supply for domestic industry and help mop up the revenue loss that the government is accruing. The government believes that it is expected to garner about 3,000 crore rupees a month from this export tax. This will offset a part of the 7,000 crore rupee revenue hit it may incur due to the excise cut on petrol and diesel. Now, the allocation of commercial LPG has been increased to 70% from 50% earlier this month. The government has said that additional supplies will be directed towards labor-intensive and essential sectors like steel, automobile and textile, among others. Separately, as per Reuters, the government is in talks with Moscow to resume direct sales of LNG for the first time since the start of the Ukraine war. The report adds that the government has already reached out to Washington for a sanctions waiver. Petroleum Minister Hardeep Puri has said the government had only two choices to manage the rising prices of crude oil prices: either increase prices of fuel or take a hit on revenue. He added that the government chose the latter to insulate Indian citizens from global price volatility. The centre has also maintained that India has sufficient crude inventories. Finance Minister Nirmala Sitharaman said the excise cut decision was taken by Prime Minister Modi in yesterday's cabinet meeting to ensure adequate fuel supply to consumers. Take a look.
It was decided that there should not be a shortage and there should not be an increase in price due to the global situation in crude, in petrol, diesel and in ATF. Today we have announced a decision whereby we will be giving support to the oil marketing companies so that they can import the material and not really, even if it is imported at a higher cost, the common citizen will not have to face any increase in the price of petrol or diesel. For ATF, which is so required for aviation, we are making sure that the prices will not go up and the oil marketing companies will be supported to bring these commodities to India. Those refineries which get the material from outside, refine them and send as exports these materials will now have to face a higher duty so that both of diesel and ATF, so that these materials are available for India, they will be made available for domestic market and ensure that we shall not be sending products at a time when we so need them without any shortage.
These duties on petrol and are nil at present. So the duties which have been imposed on diesel and ATF. The duties on petrol are nil based upon the present crack margins. However, the rates will be reviewed on a fortnightly basis. The idea behind having these changes is to prioritize the domestic availability of these products.
We have sufficient crude inventories और अगले 2 महीने के लिए supplies have been lined up. Situation is comfortable with respect to LPG and PNG also. हमारी refineries 100% या उससे भी ज़्यादा capacity पर operate कर रही हैं और domestic production of LPG has increased by almost 40%.
Thank you for that. Well, as the finance minister pointed out, this is a relief for all marketing companies and nothing will go in the hands of the consumers. So all marketing companies will see some relief on their marketing margins. So let's talk about the impact now. First, they've been looking at a lot of marketing margin losses to the tune of around 27 rupees per litre on petrol, 50 rupees per litre on diesel. And with this, those losses will come down. But do remember, despite this excise cut, the losses will not become nil. They will just become lower for all these companies. The second part, of course, it will help them with working capital issues that these companies have been facing, better cash management, cash flows will improve, and the fact that the excise duty has been cut will improve their P&L overall. Since retail prices are unchanged, the benefit will stay with the oil marketing companies. If we look at their balance sheet strength as well, it has been improving in the last couple of years, so they are in a better position to absorb such shocks that would come by. For IOCL, BPCL and HPCL, for all of them, net debt to equity has been coming lower. If you look at a BPCL, it is at 0.3 times. For IOCL, it has reduced to 0.8 times. If we talk about HPCL, which has the highest exposure to the marketing segment, that's where it is 1.4 times. But yes, it has been reducing for all these companies. For consumers, as I said earlier, there's no change. Inflation remains as is. Household budgets will not change. And you will pay the same prices for petrol and diesel as you've been paying earlier. The other change that has come by is they've increased, or they have levied export duties on export of ATF and diesel. This is to ensure that there's enough domestic availability of these two fuels and there's no shortage as such. So it has been increased by 21.5 rupees per litre on diesel and 29.5 rupees per litre on ATF. But this is a positive move considering that there will be enough supply in the country itself. But some of these exporters like Reliance, CPCL, MRPL, they will be in focus on the negative side because of this. Now just a quick check on how prices have moved globally as far as fuel is concerned. How much have they increased since the time the West Asia war is increased? For India, it has stayed as is. For US, it has been to the tune of 38%. UK has seen a 24% increase. Germany at similar levels. And France has also seen an increase of 30%. So there has been no price hike for customers. There's a relief in terms of excise duty cut that has come for oil marketing companies.
All right, Sonal, many thanks for joining us. Now, the government has formed an interministerial panel under Defence Minister Rajnath Singh. Sources tell CNBC TV 18. The panel will look at issues linked to the war in West Asia and the steps the government will take. We also learned that tax relief on more items could be considered. The Finance Minister, Home Minister, Petroleum Minister and other ministers are part of this panel. Explosions intensify in West Asia as the war completes 4 weeks, with President Trump extending the pause on strikes at Iran's energy infrastructure by 10 days. Now, Trump said on Truth Social, and I quote, "Talks are going well despite erroneous statements to the contrary by the fake news media and others," end of quote. Separately, in an interview to Fox News, the president also said that Iran had asked for a 1-week extension, but he decided on 10 days because they gave him ships. Trump had initially given Iran 48 hours to open the crucial Strait of Hormuz to oil tankers, threatening to destroy Iran's power plants if they didn't act. But he has now extended the deadline twice. Doubts about the possibility of a de-escalation also spooking Wall Street. Benchmark indices, the Nasdaq and the S&P 500 witnessed their sharpest fall since the start of the West Asia war. Asian and European markets also in the red. Reports of more U.S. ground troops in the region sparking fears of a further escalation. The Wall Street Journal reporting that the Pentagon is also looking out to send up to 10,000 additional ground troops to the region to give President Trump more military options. Meanwhile, Gulf countries remain under fire, with Saudi Arabia, Bahrain and Kuwait all saying they intercepted missiles. 2 key ports in Kuwait were attacked, resulting in material damages, but no casualties reported. Iranian missile attacks also struck the northern areas of Tel Aviv. The blast killed 5 people and injured several others. According to Israeli military, the attack involved 1 ballistic missile and multiple cluster munitions that dispersed in smaller explosives. Israel also continued to bomb Tehran with a new wave of strikes on civilian infrastructure. Israel's attacks on targets in the heart of the city came after the country said it would intensify strikes on Iranian weapons production facilities. Smoke also rose over Beirut. The southern suburbs of the city were hit with airstrikes. This as Israeli military's ground invasion near the Lebanese border also took speed. Meanwhile, Iran's Foreign Minister Sayed Abbas Araghchi addressed the UN Human Rights Council, said the war of aggression by US in Israel is blatantly unjustified and brutal. He also said the US betrayed diplomacy for a second time in 9 months and called the attack on a girls' school in Minab a war crime.
We have very substantial talks going on with respect to Iran, with the right people. You know, I told you about a president, right? Steve, can I reveal the present?
You can do anything you want.
Thank you. They said to show you the fact that we're real and solid and we're there. We're going to let you have 8 boats of oil, 8 boats, 8 big boats of oil. They then apologized for something they said, and they said, we're going to send 2 more boats. And it ended up being 10 boats. All right, I hope I haven't screwed up your negotiations, but I thought it was appropriate to say, because I did taunt you the other day by saying they're going to give us a present.
Well, that is President Trump speaking at that cabinet meeting that was streamed live. Moving on now, the Bombay High Court has dismissed a plea seeking a CBI probe into allegations that Reliance Industries illegally extracted natural gas from ONGC fields in the Krishna-Godavari basin. The petition claimed the company carried out unauthorized drilling between 2004 and 2013 and 14. Reliance maintained it had the right to extract the gas as it naturally moved between blocks. Shares of Fino Payment Bank rose in trade today after a special judge for economic offences in Hyderabad granted bail to CEO Rishi Gupta. The bank has clarified that the ongoing investigations pertain to certain program managers associated with multiple banks, including Fino, adding that the investigation does not relate to the bank's GST compliance. Meanwhile, the bank has withdrawn the reappointment of Rishi Gupta as MD and CEO due to the ongoing case. His reappointment will be submitted for shareholders not at an appropriate time. Biocon's managing director and CEO Siddharth Mittal will step down on the 31st of March and move to a new role within the group. Biocon Biologics' current CEO and MD, Shrihas Tambe, has taken over from the 1st of April. Tambe has been appointed for a 5-year term. The company has also chosen Kedar Upadhyay to take over as the Chief Financial Officer. We'll head into a break, but up next, Infosys continues its buying spree in FY26 with 2 new acquisitions. Total value of the acquisitions this fiscal crosses $800 million. Other IT majors also spend big as Indian IT leverages M&A to grow. Tech giant Infosys announced a strategic acquisition, Optimum Healthcare for $465 million and Stratus Global for $95 million. With this, the company has made 5 acquisitions just this year, spending a total of $800 million. Rima joins us now with more on the tech industry's M&A blueprint. Rima.
FY26 has been quite a landmark year in terms of M&A spend by Indian IT companies, the highest that we've seen in the recent past, and particularly that inflection point seems to have come in for Infosys and TCS in the wake of slowing growth. So let's begin with Infosys. Now, Infosys, as you said, has spent $808 million so far, making the acquisitions. The big one, of course, is what they announced, $465 million for Optimum Healthcare. You had Stratus Global, which was announced prior to that. There was Versan, which was announced by the company. This is amongst the highest that the company has ever spent on acquisitions in a single year. So last year, that's FY25, the company spent a little less than $500 million to acquire Intech. In the prior year, it was a modest, they were tuck-in acquisitions that the company had done. So as you can see, this year, with $808 million, it's been far more aggressive than it's been in the recent past. TCS, now this was a company you would remember which was known for its organic growth discipline. They spent $773 million in FY26, the highest since their listing in 2004. They made 2 acquisitions and plus they had those data center investments. It's a big strategic pivot for the company. And when we chat with the management, they tell us more M&A is lined up. Now, HCL Tech and Wipro, on the other hand, have used M&A far more steadily across periods. So this year, HCL Tech has spent $420 million. They made 4 acquisitions. And Wipro did 1 acquisition. It was called Harman DTS. And they paid a little less than $400 million for that. But in the past, Wipro has made large bets like Capco and Rising. But, outside of the large 4 IT companies, the biggest, the boldest bet came in from Coforge, when it acquired Encora for $2.3 billion. And outside India's shore, it was Capgemini acquiring WNS for $3.3 billion. Now, why is this happening? FY24 to FY26 has been amongst the weakest phases in terms of revenues for the Indian IT companies in over a decade. Revenue growth has slowed to low single digits now. AI is reshaping the whole industry. The traditional model of hire, scale, bill is under pressure. It's getting questioned. And AI is also compressing the timelines. So now buying capabilities is faster than building capabilities. And Indian IT companies seem to be responding to that by getting faster, sharper, and more aggressive on the M&A front.
All right, Rima, many thanks for joining us. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute. Very small.
Hello and welcome to Startup Street. I'm Arundhati Ramanan, and with me as always is Shruti Mishra. These are the top headlines from the startup world. Namayatri's parent firm MTI has acquired Dutch mobility startup Automysel to take its zero-commission open protocol model international. The deal marks MTI's formal entry into the European market.
Lending solutions platform Ansia has raised $3 million in a seed funding round led by Pavestone. The proceeds will be used to accelerate growth in India as well as support the company's entry into the MENA region and North American markets.
Anthropic PBC is considering going public as soon as October as the artificial intelligence company races with rival OpenAI to hold an initial public offering, says Bloomberg. Goldman Sachs Group, JP Morgan Chase & Co. and Morgan Stanley are expected to be under consideration for key roles on Anthropic and OpenAI's listings.
SoftBank Group has secured a $40 billion loan through a bridge facility to fund further investments in OpenAI and for general corporate purposes. The Japanese investor has previously agreed to invest $30 billion in OpenAI through its Vision Fund 2. The bridge loan is unsecured, the company said.
Shield AI is raising $2 billion in a new funding round at a $12.7 billion valuation as the defense technology startup looks to expand its AI-powered software amid growing use of autonomous tools during conflicts. The Series G round was led by Advent International and co-led by JP Morgan Chase's Strategic Investment Group.
Well, those were the headlines we've been tracking for you this evening. Professional services automation platform Rocket Lane has raised $60 million in a Series C round led by Insight Partners, taking its total funding to $105 million. Now, this comes on the back of strong momentum, with the company more than doubling revenue, expanding globally, and launching what it calls an agentic execution platform designed to embed AI directly into enterprise workflows. At a time when companies are under pressure to deliver tangible ROI from their AI investments, Rocket Lane is betting big on what it calls the outcome era, where AI is judged not by promise but by performance. Joining me now to talk about the road ahead at Rocket Lane is its co-founder and CEO, Krishnan Ganeshan. Sri Krishnan, welcome to Startup Street. You've more than doubled revenue in the past year. Your average deal size has grown 4.5x since 2023. Where do you stand today in terms of revenue, and what's driving the sharp inflection from Series B in 2024 to Series C now? What fundamentally changed in the business to fuel this growth?
Thanks for having me on today, Shruti. In terms of revenues, we don't reveal specific numbers, but I can tell you the themes, what's driving this growth. I would say largely three themes. One is AI has been a huge tailwind for us. Just the fact that all of enterprise AI is very services led. So every AI company, every tech company has become an AI company, and all of their, work with their customers is services led. The whole industry pivoted from PLG, product led growth, to services led growth. Secondly, we've had good TAM expansion. We've gone significantly upmarket. We have multiple public companies using us. We've also started serving a lot more pure play services companies. We used to serve services teams inside product companies. So I think all of that has helped us grow faster. And then in general, we've had higher win rates in the market just because we have the most ambitious AI play in the space, and that's definitely helping us.
All right, Sri Krishnan, let's talk about Nitro, your agentic execution platform. What does it do that traditional PSA tools don't? And you're claiming up to a 50% reduction in delivery effort. Where are these efficiencies really coming from? And with 750 plus customers, including names like Intercom and Notion, what's the use case that's truly resonating?
Sure. So I think most PSA is known for doing the following, right? It helps you plan the work, staff the work, measure the work, manage the work, maybe communicate the work in some cases. That's where it ends. Our PSA also gets into do the work. So that's the big difference. And that's how the efficiency is generated. Because now, if you think about the kind of work that a tech consulting firm or a tech implementation team in a product company does, it's about solutioning, documenting what your solution, configuring your product offering for the customer, doing a data migration for them, testing what is set up. And we are bringing agents into every primitive of the type of work that they're doing. So agents for data transformation, validation, agents for configuration work, agents for the documentation work, etc. So there is huge efficiency when people start delegating the work to these agents instead of doing it
Understood.
manually. Yeah.
Okay, so if AI agents begin handling migrations, documentation, and testing, what does that mean for the traditional services workforce? Are you replacing human effort or augmenting it? And where do you draw that line?
We are replacing the low value human effort is how I see it. And I think the game in services is we impact three things, right? One, your work happens faster, your work is going to cost lesser, and it's going to be less risky. And that means there are going to be a lot more companies willing to partner with you. People are going to be willing to take on more services when it becomes faster, cheaper, and better.
Okay, so Sri Krishnan, you know, AI promises efficiency, but also raises concerns around accuracy and control. How are you ensuring reliability when agents are executing these mission-critical workflows?
There is a human in the loop element to the software, and also there are new design patterns that have emerged over the last year that help you get to better reliability. Like agents reveal their process, they show their plan of what they're going to do, you can correct the plan, and then they work with you.
Okay, you know, you've expanded to London, New York, and San Francisco. What are your global expansion plans going forward?
We continue to grow in these markets, in these cities, but as and when we have a little bit of a density in a new city, for example, we have a few people in Denver now, we may just make it a official office and make that one more hiring hub.
All right. You know, Gartner pegs IT services spending at nearly $1.9 trillion. How big a slice of that are you realistically targeting, Sri Krishnan?
Shruti, we dream, one step at a time in a way. I think just the next milestone is let's get to 200 million in revenue, and then we'll get to the next dream. But I think I can easily see getting to a few $1 billion in revenue as you get to do the work, right? So the do the work piece is very valuable, and the revenue ramp will be fast.
You know, I understand you did not give me the current revenue numbers that you have today, but what about the revenue targets going in the future? What does the road to profitability look like?
Yeah, I think, at scale, as we get to, as I said, $200 million, etc., as future goals in the coming years, there is a very clear path to running this profitably. I think even today, most companies which are focusing on growth, if they decide to take a different approach, you can be profitable today if you decide to. I think when you're investing further in growth,
All right.
when you're accelerating, you do that.
Sure. One final question, Sri Krishnan, before I let you go. You know, on competition, how do you view this landscape, this competitive landscape that you're in, and what do you see is your biggest moat?
We have legacy competitors who aren't getting into the AI for execution game, and we have new competitors who are purely focused on the AI for execution part of what we do. I will focus more on, I would say, the new competitors who are emerging, very small today, are probably the bigger threat. And for us, our moat today is we are a very holistic solution, right?
So you're saying the new competitors are a bigger threat than the incumbents?
That's right.
Okay. So there's no real threat from the incumbents who are adding AI layers. I'll have to wrap up at this point. Many thanks, Sri Krishnan, for joining us on Startup Street today. Wish you the very best for all your growth plans.
Thank you, Shruti.
And moving on what's brewing today, Plum is betting big on redefining how India experiences employee health benefits. This Bengaluru-based insurtech platform has raised 193 crore rupees in a Series B round led by Peak 15 partners, even as it turns EBITDA and cash flow positive, a rare combination in the startup ecosystem. With over 6,000 enterprise clients and more than 5 lakh claims processed, Plum is focused on fixing what it calls the most critical moment in insurance, the claims experience. Now, with fresh capital in hand, the company is looking to double down on AI-led operations and expand into a full-stack employee healthcare platform. Joining me now to discuss this further is Abhishek Podar, the co-founder and CEO of Plum Insurance. Abhishek, thank you so much for taking time out and being with us on Startup Street. You know, let's sort of go back to the beginning. Let's start off with the core idea. What was broken in the traditional employee health insurance experience, and how did Plum sort of set out to fix it?
First of all, thank you so much for having me here. When we started this late 2019, I think we originally started with the problem of building a supply for the smaller organizations that wanted to give really high quality insurance and healthcare to their employees. The industry that time was very dominated or very focused towards the large enterprises. But let's say you're a founder, and we had Rocket Lane previously. Think of Rocket Lane starting in 2020 with a 5-people company. That kind of organization didn't have any option. And when they started, they would have onboarded Plum, and Plum was the only option. So that was a core problem that we started. Very quickly, we realized that the problem is not just about creating a supply for the organizations, but fundamentally, when you're giving insurance, the product is the claims. When you talk to anyone who has gone through a claims experience, 9 in 10 times, people are not happy with the claims experience. It's either the speed or what is approved or what is disapproved or what is rejected. And we very quickly, I would say, pivoted to focusing on claims experience as the core thing that we are building.
All right. And, you know, if you could sort of then help us understand the scale that you have today, right? 6,000 enterprises and over 500,000 claims processed. What does this sort of say about the size of the opportunity in India's employee benefits market? And, you know, what do you have on offer?
Absolutely. If you look at, we look at the market from two scenarios. One is what is the existing spend on employee health insurance, and that spend is roughly 60,000 crore today. But what's more interesting is this is one of those markets which is very large, but still has a huge tailwind. This market is growing at 20% for the last 20 years, and you will not find a market which grows at that fast a speed for such a long period of time. But what's more interesting is not just the size of the market, but how underpenetrated the space is. Despite that amount of spend, if you look at what percentage of population is adequately covered in India, our estimate is roughly 20-25% of the Indian population is adequately covered. The rest 75% of the population still don't have insurance. They may have insurance for the namesake, but it's not really insurance for them. So for us, that is the more, that's a much larger opportunity, which is, can we eventually get India to a 90-95% coverage?
All right. And you've just raised this 193 crore rupees, right? How essential is this fresh capital at this stage of growth, and how do you plan to spend the funds? Any new offerings in the pipeline?
Yeah, what's more interesting for us is, I think you touched upon this earlier, we as a company are actually profitable. For us, we look at this not as a way to survive, but this is an opportunity for us to accelerate. This is an opportunity for us to get what we have built, get our product in the hands of more people, and eventually get more people insured. So the way we are spending this money is, one, just acceleration of a go-to-market, so that we have, right now we have 6,000 companies. Our goal is how do we get tens of thousands of organizations insured, and hopefully millions of people that we are able to impact. Number two, we're going to invest a lot on healthcare. For us, health insurance was the starting point, but the core mission of Plum has been how do we impact the health of the people. When you impact health of the people, or when you want to impact health of the people, you have to start with really the preventive care, getting people go through annual health checkups at a regular interval, get people the right kind of primary care, and those are the products that we are now investing into.
All right, so those are the products that you're investing into. You, as you pointed out, right, you have turned EBITDA positive. You're profitable now. Take us through this revenue growth journey, and how sustainable is this profitability? Where do you hope to end this year?
Absolutely. Our current growth rate is roughly 80-90% year on year. And the goal is that we can actually accelerate from here. So far, we were really focused on getting to a unit economics that we can say that, hey, this is actually a profitable unit economics that we are building. So the goal was not to show a 30% EBITDA right now. So we'll right, this year we will end at maybe like a 5% kind of a profitability. The plan going forward is, again, not to showcase a 30-40% profitability, but make the business really efficient, the core business really efficient, and whatever profit we are able to generate, invest that into building better products and more healthcare products for the same set of customers that we are serving.
All right. And, you know, before I let you go, you also pointed out about how crucial AI is, right? So 78% of your claims are now getting resolved without human intervention, which is up from 34% in 2022. What's the ceiling on that number, and how does this AI investment from this round push it even further?
No, absolutely. I think AI has been a huge, huge accelerator for what we are building in two ways. One is it really allows us to speed up everything that we are delivering to our customers. There is a limit to what we can do if everything has to be done by the humans. Let's say the humans are going through every single document for approval of claims. No matter what you do, it will take minutes to hours depending on the volume. And especially as you start scaling up, as you start accelerating, that speed continues to go down. What AI has enabled us to do is actually reduce that speed as we scale while maintaining the quality of experience that we are delivering. So one of the goals is how do we use AI to become more and more efficient? But it's not just efficiency for the internal profitability, but efficiency to deliver better speed for our customers.
Absolutely. Better speed and quality is what's essential while you're using AI. But Abhishek, we're completely out of time. But thank you so much for joining us on the show, and we wish you all the best on your journey going forward.
Thank you so much.
Well, on that note, it's time for us to head into a short break. But coming up, from the forests of Jim Corbett to the front lines of AI, India's top VCs debate the real opportunity and the hard questions around capital, deep tech and global scale. A special report on the other side.
Welcome back. You're still with us on Startup Street. Moving tech innovations, the force behind Namma Yatri has made its European debut with the acquisition of a Dutch mobility firm, signaling a big shift from local scale to global ambition. The company is now looking beyond traditional ride-hailing, targeting niche, high-value segments in Europe, while also bringing global innovations back to India. Aishwarya Anand is here with all of those details. Aishwarya?
India's open mobility revolution is officially heading west. Moving Tech Innovations, the parent company of Namma Yatri, has acquired Dutch mobility firm Automissile, marking its first major foray into Europe. MTI has already processed over 150 million trips in India, putting more than 2,500 crore directly into the pockets of drivers by eliminating middlemen commissions. Now, they are taking that city-first philosophy to a continent at the forefront of sustainability. But this isn't just about taking autos to Amsterdam. MTI tells us that they are specifically targeting underserved, high-margin European segments like care mobility services for senior citizens and people with disabilities. Sectors currently fragmented under traditional giants like Uber. The deal is also a two-way street. MTI is in active talks to bring Automissile's advanced digital parking tech back to Indian metros to solve a chronic urban congestion. This expansion comes on the back of a fresh 40 crore bridge round that the company has raised as it gears up for a much larger institutional fundraise later this year. With India-EU trade discussions gaining momentum, this deal signals that Indian-grown tech protocols are ready for population-scale impact on the world stage. Back to you.
Well, thank you, Aishwarya, for these details. Appreciate you joining us. Moving on, away from boardrooms and into the forests of Jim Corbett, some of India's top venture capitalists gathered to take stock of the country's AI opportunity. But beyond the optimism, there are tougher questions at play around long-term capital, real innovation, and whether investors are ready to back deep tech at scale. So where is the money actually going, and what will it take to build globally competitive AI companies from India? My colleague Aishwarya Anand brings you this special report from TIE Delhi NCR's Capital Connect. Take a look.
The AI summit may have wrapped up with billion-dollar projections and bold claims, but beyond the stage lights, the real test begins now. Will the Indian venture capital actually fund this ambition? We are here at TIE Delhi NCR's Capital Connect, the Jungle Edition, in Jim Corbett, where over 80 venture capital investors have stepped away from boardrooms and pitch decks to talk candidly about what comes next for India's AI moment. Over the next few minutes, we will speak to some of India's most active investors to understand whether this is conviction capital at work or cautious optimism dressed as ambition. Are Indian founders building real AI, or are we mostly funding wrappers around global models?
From the very beginning, our focus was unless you add value, you have no reason to exist. Long run, it never works, right? And more funds are coming to the same conclusion. So what you are seeing an increasing trend towards quality of where the IP really exists, where they have actually innovated at the AI layer and not just building the model is not AI. There's a lot more to AI. How do you make the product work? There's a whole piece of orchestration. There's a whole piece of where the knowledge resides, how memory works. And none of this is solved yet. This is all hard engineering, hard AI problems. And startups that are solving these and building applications which are actually useful, right? Which actually solve a problem. And typically we've seen that works in a vertical.
The deep tech and AI need nearly 8 to 10 years of patience. Do you think our Indian LPs truly ready for that cycle?
It's a very well, I would say, broadly spread capital in the early stage ecosystem. So seed to, I would say, Series A. When it comes to Series B, I don't think there is enough capital focused on deep tech at that stage.
Correct.
I think that gap is going to hit most of the founders.
Is AI fundamentally different from SaaS, or is this just the next software wave that we're seeing?
No, I think AI is different from SaaS in a very fundamental way, in the sense that there is no rule that is being applied to how things move within the enterprise, how data moves within the enterprise. The rule is, to put it quite simply, being figured out at runtime.
Okay.
And that is why, that's why we say AI is non-deterministic versus software being deterministic. And where software focuses on automation, AI focuses on intelligence.
Okay.
So judgment calls that used to be taken by humans are being taken by machines now.
Okay.
And that's why I do believe that the entire suite of enterprise applications will be replaced with AI applications going forward.
Are Indian SaaS founders actually pivoting fast enough to turn their companies into AI ones?
I don't think the playbook is for existing SaaS companies to become AI companies. I think what we are backing is for AI native applications companies to actually replace existing software in enterprises.
So then what happens to the SaaS companies then, who weren't AI first?
I think some of them will evolve and others will die.
Do you think that we need India-built foundational models, or should we dominate AI applications instead?
As a fund, for us, the answer has always been very clear that applications is where capital compounds.
Is too much capital chasing Gen AI while climate and hardware AI remains underfunded?
I believe yes, there's always a flavor of the season. Therefore, there is a lot of capital that's chasing Gen AI. But having said that, I think the realization is that hardware cannot be, ignored per se. Inevitably, capital will chase hardware at some point in time.
From the perspective of frontier AI, what is that opportunity on that front that you think India is missing currently right now?
I think India per se has always been a follower in some pieces rather than a leader in any technology.
You can build excellent applications, excellent language models, but if you don't have the infrastructure, you don't have the semiconductor layer, if you don't have the energy layer addressed, you don't have these three layers addressed, all those that you'll develop will always depend on somebody else outside of India.
If there's one takeaway from these conversations, it's this. India's ambition is real, but capital is getting sharper. Investors here say they're willing to back deep tech and long gestation bets, but only if founders move beyond wrappers, build defensible technology, and show real global potential. The next wave of unicorns, they believe, may not come from traditional SaaS or quick scaling consumer plays, but from AI-led research-heavy and sector-specific innovation. The summit conversations may have set the tone, but here in Jim Corbett, it's clear that execution and capital discipline will define India's AI story.
It is Friday and it's time to take stock of all the big deals from the startup world. This week has seen a total of 18 deals worth $263 million. According to Venture Intelligence, some of the notable deals include Rocket Lane, which raised $60 million in a Series C round from Insight Partners. Wealth management player Neo Investment Value Advisors raised over $53 million from MUFG Innovation Partners, Peak 15 Partners, TVS Capital and others.
Well, that's not all. Commercially, we make Euler Motors back $47 million in a Series E round from investors including Ulterior Capital, Bloom Ventures, Hero Motorcorp and others. Data curation firm Deccan AI raised $25 million, while InsurTech startup Plum Benefits secured over $20 million from investors including CMO Venture Partners and Peak 15 Partners. According to Venture Intelligence, so far this year has seen 253 deals worth over $2.2 billion.
And with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching. More news and updates right here on CNBC TV 18.
Hello and welcome to another edition of the CNBC TV 18 Market Town Hall. The amount of headlines and consequently the market moves have truly been head-spinning and dizzying to say the least. To be sure, the Middle East conflict is only the latest in a series of massive disruptions which I'm referring to now. Since January of 2025, when President Trump took charge in the White House as the President of the United States, we've had non-stop run-through of news flow, which dwarfs pretty much anything else we've seen, at least I remember in the past many years or so. So it's truly been historic. Headline roulette, you can call it, or whatever else, but absolutely head-spinning amount of news flow. And of course, it's had an impact on markets as well. From tariffs to AI to now Iran, all this has meant that markets have indeed corrected quite a lot. I mean, some because they need to correct, and of course, I mean, there's been a fair bit of indiscriminate selling, forced selling, etc. as well. And that is what this town hall is really all about.
Well, there is the micro and then there is the macro. So what we've done is we've divided this into three parts. First, we'll focus on the global macros and oil prices. Art Berman, who is an oil market veteran, and Ben Powell, who's here with us in the studio from BlackRock, is there. Second, we'll focus on the opportunities in the market right now. Harish Krishnan of Aditya Birla AMC, Sandeep Tandon of Quant Mutual Fund will be joining us. And then we bring in the macro heavyweights, Neelkant Mishra of Axis Bank and Sajid Chinoy of JP Morgan. So we've got all three bases covered in the next 90 minutes or so.
Well, I also want to extend a warm welcome to our audience. I mean, it's a small gathering, but it's an intelligent one. It's a very informed one right here in our studios, by the way. And you can see, I think, the visuals there. So just want to extend a very warm welcome to all the CNBC TV 18 Access members and, of course, our guests who are going to be joining us in just a bit in the other panels as well. So, you know, Rima and Art, my job is a little easier because we're going to ask a few questions to kick this off, and then we'll hand it over to the audience and take their questions to all our guests and all our panelists. So that, with that short introduction, with a short preamble, let me dive straight in with you know, the first focus area, which is, of course, the global picture, given the big oil shock that we have. Art, great to have you join us from the US. Thank you very much for being here. And Ben, glad you could make it to our studios. So it's a simple question with not such a simple answer, I guess. Is the war winding down, Ben? What's your sense?
I'm not so sure, actually. So I recognize there's a degree of optimism in the air over the last 24, 48 hours as the US president has made warmer noises, I guess, has spoken about his hope for a deal, a 15-point plan, and so forth. So I recognize that, the market recognizes that, and it's definitely relevant and interesting. However, we have to observe on the ground, I live in Abu Dhabi, the drone strikes have continued, the missiles have continued, and the Marines, the US Marines, I believe, arrive later this week. So I think the situation is, frankly, still very tense. The facts on the ground are mostly unchanged. Indeed, it feels more of an escalation in the last week than a de-escalation. So I recognize President Trump's words. Of course, I'm watching with huge interest, both as a citizen of the UAE and as a markets professional. But I think we need to be careful from being too confident and too optimistic, because sadly, as I say, the facts on the ground continue to be, frankly, quite alarming. And there is the potential for this to continue and worsen as these attacks on the physical infrastructure. Just overnight, we've had an attack on the Kuwaiti airports, one of the fuel depots kind of struck there. So I recognize President Trump's words, very important. He's the most powerful man in the world. But the facts on the ground continue to be unsettling, and that has not changed in the last 24, 48 hours.
Absolutely. If I can get Art, Rima, into the conversation as well. Art, same question to you. Do you believe the war is winding down? Ben, of course, is cautious. I just wanted to get your sense, because things have moved over the last 48 hours or so, and many believe directionally this is the first sign that things are starting to cool down and we are de-escalating rather than escalating. Art?
No, I think Ben has summarized it very well. My view is I see no de-escalation. I see more potential for escalation. I think that the words from President Trump are purely performative. It's very difficult to have your negotiating partner take you seriously when you're moving, combat units into the area. So, I think Trump is managing this like a reality television program. He needs lots of plot twists and, interesting, spicy things to add to keep everyone's interest. But at the end of the proverbial day, I see only escalation in the coming weeks.
So, Art, what is your base case scenario right now? And in that event, where do oil prices end? And the best case is that perhaps the oil conflict ends in the next couple of days. In that scenario, where do you think oil prices will settle? Because even if the conflict ends, there are facilities which are damaged, which are not going to come back on stream immediately. And then even if there is a ceasefire, there's going to be an uncertainty surrounding that. There will be a geopolitical risk premium attached to the passage. So give me your base case for oil prices, a worst case, and a best case. Best case being that actually this is de-escalation.
Sure. So obviously no one knows the answer to that, but this is about informed speculation. I would say, I mean, for instance, Ben's boss just came out this morning, I believe, and said, 100 to 150 is BlackRock's base case for, I can't remember if he said for a year or for years, but it was something like that. And I see that as a possibility. But let me make it very clear. There will now be a permanent risk premium on oil, regardless of how this thing ends. And I would say that premium is no less than $10 per barrel. And so if everything ends tomorrow, the very best case we can get back to is maybe $80 Brent. Now, I don't believe that everything's going to end tomorrow or that we're going to get back to $80 anytime soon. So my bottom line is we don't know. It's a probability distribution. I think somewhere in in BlackRock's range is reasonable, certainly for the rest of 2026. And in the longer term, when all this, as you correctly point out, trickles out to the rest of the global economy, then we'll get down to lower prices as the global economy collapses.
And also several nations, considering the energy shock right now, are likely to increase their purchase and storage of petroleum reserves. How much can that push up prices, to your mind, Ben? Sorry, Art.
You want me to? Okay. Yes. So, we're talking about a few million barrels a day. If all the storage in the world could be released all at once, okay, it can't be. So we take 3 million barrels, let's just say, maybe it's 2, maybe it's 4, I don't know the right answer, and we weigh that against 17 million barrels, which is the shortfall. It's a rounding error. I'm not saying that we shouldn't do it. We absolutely should. I'm not saying it's insignificant. I'm saying it doesn't make that much difference. In other words, if we think about a man who's lost 20% of his blood supply and he's bleeding out on the ground, and we put a tourniquet on his leg, and now he's only losing 15% of his blood supply, the guy's going to die unless you get him to hospital very quickly. That's a very crude analogy, but I think that's a realistic way to think about this. Yep. In other words, yes, let's do everything we can, but let's recognize this is an urgent situation.
It is an urgent situation. And Ben and Art, both of you, I mean, I just wanted to come in here. Both of you don't believe that this is ending anytime soon. So am I watching the same news that you guys are, or you don't believe what President Trump is saying, or what is it? I mean, we've heard the man say on tape, on camera, of course, he said a lot of things, but he's also said this, and this is the latest, that we've achieved our aims and we're going to end this soon, et cetera, et cetera. So, Ben, you want to go?
Well, a couple of things. I think President Trump is sophisticated. So is it possible he's buying time for the Marines to arrive? I think that's at least possible. Of course, we don't know, but it is at least possible. And secondly, and I think more importantly, of course, America is the US, they are the world's hyperpower, so we all respect and listen to them because of their heft. But they are not the only player here. So you have to think about also the mindset of the Gulf Cooperation countries, the Gulf Cooperation Council, including the UAE and Saudi, and to be somewhat straightforward, They've just had thousands of drones and missiles thrown in their direction, so they may not be in a shake hands kind of mood. And the same, I think, could be applied to Iran. So Iran, again, we don't know how much is posturing.
But countries like Qatar, Oman, etc., seem to be facilitating. I mean,
yes.
a sit-down of some sort.
You're right. So there's a blend amongst the GCC, the different countries within the GCC. They're not all the same, that's for sure. But I think in particular, the UAE, Qatar, Kuwait, and Saudi have been surprised, would be English understatement, I think, surprised at the centrality of their role in this war. I think they were very much hoping that they could be something like neutral. It's a conflict between the US, maybe Israel, Iran, and the GCC. And this was not, it turned out to not be correct. Furthermore, I think Iran, they have said they want to make it very clear that there's a price to pay. Iran, the IRGC, the leadership of Iran, perhaps want to make it very, very clear to these other countries that if you mess with us, you will pay. And therefore, again, it's not so obvious that they will just shake hands.
Well, that's the point, right? If you mess with us, there'll be price to pay. And here's President Trump saying we're going to stop messing.
So a couple of things. One is, I think even if President Trump stops messing, which again, I'm not so sure, but if that's the case, then Iran can decide, okay, now the punishment can come. Now the punishment can come. So maybe, we don't know, maybe we are only at the beginning of the economic pain. And I think I would say, just briefly, of course, we're all focused on energy. This is totally appropriate. But it's not just energy, by the way. It's fertilizer. Right. It's helium into semiconductor. So in a way, this is something like a 1970s supply shock on the energy side, multiplied by COVID in a way. Not quite, but there's something there making the point that this is going to be really a very serious problem for the global economy.
The betting market, poly market, right? The marketplace, whatever you want to call it, 60% odds that the war will end by mid-May. Now, I don't know what ending the war, the bombs stop falling or a complete peace, the strait opens. I don't know what that question or that statement is, which the war ends, but poly market says 60% by mid-May. That's what they're saying. Art, you want to come in on the question? Are you of the view that this is just buying time before we see this continuing and intensify more?
Well, Prashad, I can say a few things as an American. President Trump lies all the time. I mean, that's not a criticism, that's a fact. He has not said a true thing about the situation in Iran for at least a week. So I discount everything he says as performative. I don't discount its significance. I just don't think I don't believe anything he says. The bottom line for me is that Iran is right now the strongest country on earth. It holds the entire global economy hostage to its control of the Strait of Hormuz. Okay, it's never been more powerful. It never dreamed of being this powerful, and it's not going to give that up, as you said and Ben said, without extracting a huge cost. Now, back to the bettors. Maybe the fighting ends. Maybe there's no more bombs by mid-May. So much damage will be done between now and May that, a recession would be an optimistic take. I don't want to be pessimistic. I'm just trying to objectively assess what's going on. And as long as Hormuz is only partially restored to flow, then all bets are off, and chaos, economic chaos, social chaos, electoral.
Art, if I can just ask you one thing. You saw the statement from the Iranian Foreign Ministry that they're going to allow non-hostile ships to pass through the strait, right? The problem is the strait and the oil not flowing. And they said, was that different from what we've heard before? Or there's nothing different? Earlier it was we're going to set ships ablaze, and this seems a bit of a pivot, right? In their own way, they can't seem to be negotiating when they're being attacked, but a bit of an admission that they also want this to wind down? No, you don't read it like that.
No, I think, the Iran lies a lot too. That's the nature of this dispute. Iran wants to set up a tolling situation where they can get revenue that cements their control. In other words, if they can get other countries to actually agree to pay them for passage, then that essentially gives them diplomatic recognition that they're in charge of the Strait of Hormuz, which strengthens their position and gives them a little money. Bottom line, Prashad, is we're back to the strategic reserves. Maybe 1 million, 2 million barrels eventually gets through Hormuz with some kind of tolling situation. It's still a rounding error compared to what the world needs.
Well, the point is well made, Art. Iran is militarily weaker, economically weaker, but strategically far more important today than it was prior to the conflict. But Ben, the advice in all this for BlackRock is you all have dialed down tactical risk and you all downgraded U.S. equities to a neutral.
That's true. And I think we are in a different investment regime now, reflecting a more complicated world. And as Prashant said in his typically excellent introduction, it isn't just this a very acute and frightening situation. It's tariffs. It's a sense of globalization in decline. You can't trust other people. You have to be more reliant on yourself and your own nation and so forth. And I think that's going to persist. Hopefully this current crisis will pass. But I think those continue to be, as the kids say, the vibes, right? Those are the vibes these days. So what that's leading to from an investment perspective is a much more fractured global market and India market, I think. So we have moved from previously really a kind of everything bull market where you should be risk on, don't touch, and that worked very, very well. I'm not condescending that approach. That was the right approach for an easier time, a more pleasant time. Now, in a fragmented, chaotic world at times, I think we're all going to have to work a little bit harder and be much more selective.
U.S. economy, is there a risk of a stagflation? I mean, the jobs data is weaker, inflation is rising.
There is a certainty of a stagflationary shock to some degree. And now I hedge a bit with to some degree, but for sure, we are going to have a price inflation problem, an increase. Inflation is already too high, by the way, and a growth slowdown. This is baked in the pie. Because last week was very important. We moved from a general concern from a global market perspective to physical damage. So this in particular was the Qatar LNG facility where the Qataris, they will be, I'm sure, roughly giving us a sensible timeline, 3 to 5 years to bring this back online. So this is, I'm afraid, even if we have peace today, the problem persists for some period of time, and therefore for your question.
Okay, so just one quick question then on the valuations of the Indian